AML and KYC and security law compliance, which then kills the model that we're used to and just turns it, turns it into a digital security.
I have two questions. For you, for the audience. Mario, I don't know if you want to run a poll. I have two questions. Question number one is, where will Circle be in 3 months? And will depositors get their money back? That's my first question. And I want to know what the audience thinks. And I think the option should be, yes, Circle will have recovered and everyone will get 100%, or people will get less than 100%. And the second question that I have is, what happens to interest rates on the 22nd of March when the Fed meet for their FOMC meeting? Do they raise by 50 basis points as we expected before Friday? Do they raise and if they do raise by 50 basis points, risk this contagion spreading even further, because now they're realizing that the banks are breaking because they're raising rates too fast? Do they raise by 25 basis points? Or do they raise by 0? Now, right now, the probabilities on the CME forecasting charts are 60% are going to 25 basis points, 40% are going to 50 basis points. I think that it becomes 0. And I think that
let me jump in because I got to run. Let me just answer those real quick with Rand, and then
before you jump in, I won't do a poll, Rand, just because I'm working with the guys to do a thread that will be tweeted shortly, so I don't want to do another tweet. But for the audience, you can go bottom right corner in that purple circle and tell us what you think while the panel answers that question. Don, do you want to kick it off first?
Yeah, I think the Fed is going to raise it 25 basis points. I also expected it to raise 25 basis points the whole way through. I don't think they're going to go 0, because then it would look like the Fed is driven more by these kinds of events and potential manipulation from the mainstream media to force them to do something. And I think raising it 50 basis points was going to be crazy to begin with. So it's going to be more about what the Fed says. I think there's like an 80-90% chance it's going to be 25 basis points. On the Circle, I think Circle will get bailed out. It's possible that for multiple reasons. One, Circle was basically created to avoid this monopoly of Tether, and too many crypto projects and companies trust Circle, and they need to, like Simon said, they need to solve it like next week. They can't wait a month. So I think Circle will get some kind of a bailout. Jeremy Allaire has been around for a long time. He has big connections to big financial institutions. I think they need to, squash this problem and get back to Circle being the USDC being $1 real quick next week. So I think somehow he'll find, the $3 to $5 billion that's missing. That's not a big hole for someone like Jeremy Allaire to fill.
Is there a reason, Ton? Is there a reason that this hole wouldn't be filled? Is there any reason that we could expect that to be a possibility? Because for me, the only cost return. Go ahead.
Yeah, for me, the only possibility that this hole wouldn't be filled is if there is some kind of secret collusion between the financial institutions and the government to try and destroy the crypto.
USDC will move all the value to USDT, which is not what the government would regulators want.
Yes and no, right? By destroying USDC, they're creating doubts in the minds of many, many people from the crypto space and from the traditional space of how unsafe the crypto industry is. So while those of us or a lot of people will run to USDT, they will basically scare many people that would have otherwise be interested in crypto space, or they may have some people slowly pull out. So there could be, this mental fear of the crypto space, just like another nail by the government into making the crypto space look bad overall. Now that may backfire on them, but the government does many things that backfire on them.
Simon, what's your stance?
Yeah, I think USDC fixes itself if Silicon Valley Bank fixes itself, and I think Silicon Valley Bank is a geopolitical threat to national security for losing the tech war. So I think they have to solve Silicon Valley Bank next week for all the reasons we've covered. therefore USDC will react to that.
Sam, they
and
need to
in
solve.
terms of-
They need to solve it not next week, but they need to solve it by Monday before the
Yes.
banks before
Yeah.
the banks
That's less
open.
than 48 hours.
Yeah,
Absolutely.
they have-
Yeah.
I mean,
Yeah, Simon. So this is where I'm slightly on the other side. I don't think the current administration will see it the way you see it. As I said earlier, I think the current administration I don't think they'll care about this as much. They'll care about this as much as they care about the disaster in Ohio. Their mind's on Ukraine. Their mind's on Taiwan. Their mind is on, helping their buddies that are at the top of the food chain, not at the bottom. So
Yeah,
I'm on the other side of that.
It definitely gets framed by Trump leading into the 24 election that this was, just
But
like
if
as
this was
unpopular as
Trump-
the bankers' bonuses, this will be
Yeah.
the Silicon Valley bailout, which will be a huge political issue heading into 24. But
if this was Trump, he'd be bailing them out. Yeah, if this was Trump, he'd be all over it. But it's not Trump.
Yeah, but Tone,
Yeah, but Trump will
something
use it
Rand
to say
said.
big tech was bailed out by, and it will become the election campaign. But I'm with Tone on. I thought it was a slam dunk for 50 basis points. I think this moves monetary policy. I think it's 25 basis points. If they go to zero, then it would be too much of an embarrassment and it would look too corrupt, because then it looks like they're not really considering inflation. They're thinking more about unemployment and recession, which would be embarrassing. So I think you have to meet at the middle at 25 basis points, I think.
All right, guys, got to run. Amazing space. I got to do a live stream and I got to then I have a space schedule. So have fun. I'd love to talk about this more. Awesome discussion.
Cool. Thanks, Don. Danish. Fuck, bro. Sorry, man. Dr. Danish, we are the thread is almost done for all the reporters in the audience that are waiting for it. So I'll be tweeting it shortly. Dr. Danish and Sleiman are working on it with me, and then we could kind of summarize it again, because I think it's just a really interesting story. But in the meantime, I do want to go to, I don't know if Scott is with us yet, but I want to go back to Tom. Tom, I want to get your thoughts on that particular question. What do you expect to happen with Silicon Valley Bank, and what macro impact do you see? Do you still, you've been on our spaces back in the SBF days, Rand? You've got a bit of feedback sound on your end, man. But you've been back in the FTX days. You've usually been the voice of reason. You're not usually too concerned. Takes a lot to get you concerned. What's your stance now, Tom?
Well, first of all, let me know if you can hear me okay, because there's always issues with
Yeah,
sound.
it's actually good. Yeah, it's good.
Okay, so there's three options here, and I'll tell you what is my most likely option. Option number one is that this whole thing gets purchased as a whole, kind of swallowed by somebody bigger. Option number two is that it's gonna be chopped up to little pieces and sold off to the highest bidder. And there's always an option for this thing to get liquidated, which is the most unlikely option, because this thing has value. So between those two options, there's concerns. So concern number one would be is if you chop it up, then you create kind of a ranking between the different pieces, and the one piece you are most concerned about, which is the startups and the early stages, nobody's going to want to touch that. And then you're going to be basically selling off all the desirables, and the one asset you need to go, you're going to have issues with that. The problem of selling this thing as a whole, there's very few candidates who buy this thing as a whole. You can probably put them on two hands. I don't think there's more than 10 candidates really to buy it, because of, well, there's regulatory concerns, and it's not going to get sold off to a foreign bank, if most likely because of security issues, et cetera, et cetera, et cetera. So it's pretty much the big boys in the US. They're the ones, JP Morgan's, the Wells Fargo's, the Goldman Sachs, Bank of America, whoever, right? The problem is that it doesn't fit their business. They're an 18-wheeler truck, 18-wheeler semi-truck, right? They're cruising along the highway. This thing is a sports car. It doesn't fit. So the only way they can swallow it, they're big enough to swallow it, but it will have to come with a massive, massive government guarantee. So the only way that this deal gets done as a whole, which is the one thing you need to happen if you don't want to destroy the entire startup industry in the US, which has really negative impact. I can talk about it later. Is to tell to one of the big boys, we'll guarantee all this shit that you don't want to buy. So we de-risk that portion of the deal completely. And in that sense, the deal then becomes desirable. If the government takes on the risks of all the startups and the early stages, then there is a good chance that the deal will be made. Now, I'm about to finish with one last thing. Why do we want the big boys to take over this debt? Is because, look, if Silicon Valley Bank is really, like somebody mentioned this earlier, one of a kind bank. Nobody funds these companies. If you come off the street, you don't have any history, any track record, you don't have no assets, no real collateral, nobody's going to give you a loan based on just collateralizing your own equities in your own startup. Pretty much it's SVB and very few other little options.
What about one more crazy one? What about Twitter Bank? They need a business monetization model.
When Elon is involved, there's always Simon. There's an Elon solution to every problem of the world, that included exactly. But staying on my point real quick, look, if they go down, think about it this way: the startup industry in the US is going to take a major hit. No bank is going to give credit to these little startups like SVB did without any history or collateral. So the concern is that existing startups are not going to have credit lines. They're not going to be able to operate. No paying salaries, no nothing. They'll go under. Half of the startups are basically on SVB. Venture capital firms will go out of business because, not go out of business, but a lot of them will have trouble raising capital, which will undercapitalize and underfund innovation. And now if you basically take a shit on innovation in the US, you will feel it down the road as far as GDP growth, et cetera, et cetera. So there's like a macroeconomic interest for
Except
this.
Tom, can I play devil's advocate? I'm a startup founder. I believe that the only way out of this mess of a country is actually to invest in innovation. But I'm going to play devil's advocate here, which is that decisions at the government level are not made in the US on a long-term horizon. That is actually my underlying thesis on why every decision has been incorrect. We don't make decisions on a long-term horizon. A startup does not pay dividends for the US government until, 5, 10, 15 years down the road. And right now it is sexy and juicy to be anti-tech. The only thing the government can do in a bipartisan way is talk crap about tech companies. And so, do you think that there is any part of the government that actually will be thinking about this, not in terms of the upcoming election, not in terms of, the narrative that will be spun? And I hope people thought that was compelling, because I know it's compelling for the people here in the Midwest, which is tech is the government really gonna, they're gonna get rid of student loans. Now they're gonna bail out the tech people. Is this all because of the elite? Because, is it because that tech helped them with the election? I can come up with a very good American narrative, good old American narrative, to say that this is actually not bailing out big tech, or this is not about bailing out. Even though this is not affecting big tech that much. In fact, it could be positive for big tech. That the narrative will be that way.
Well, yeah, I can see the Trump argument here, with what you're trying to present, and yeah, sure, it's always an option. But in my opinion, if we're talking not about a bailout, if we're talking about some sort of a government guarantee structure, which would allow a bigger player to buy this thing as a whole, it's going to be too complicated to spin in a way that's going to play to that simplistic argument that the government bailed out. It's going to be it's a little bit too nuanced that way. If the government gives money and saves SVB, that's a whole different story. But if the government basically sweetens the deal for one of the big banks to buy this, I don't know if it's spinnable in kind of a digestible format for the voters in that sense.
I think Mario should buy it. Turn every Silicon Valley startup share into an NFT, and restructure all the debt into an NFT collateralized lending business, and go 100x leverage. And
Wahid, you'll fund that plan, yeah, Wahid?
Yeah, and put it on the Solana blockchain.
But you know what's really actually interesting?
Hey guys, so Mario, you just asked me. I'm on, so I'm funding something. What is it I'm funding?
He's
Simon
already
came up with a
invested.
plan.
We're turning Silicon Valley Bank into, we're turning every share into an NFT, and then we're doing a collateralized 100x leverage exchange where you can take all of the shares and all of the debt, restructure it into a USDC loan, and create a new token, mark them all to market, pump them up as hard as we can, and raise a bunch of VC funding from Peter Thiel.
I'll go, Wahid. I want to actually give the mic. I'm going to mute you, Wahid, just because you got the feedback sound. I'll let you unmute when you're speaking. Dr. Danish, if you could give an overview of the, actually before that, Wahid, give me a few minutes. We're finalizing a thread we've been working on for like half an hour. I'm going to tweet it in a few minutes, and then I want Dr. Danish to kind of give you an overview of the two pieces of information that came out of Reuters and CNBC, and I'll get your thoughts on it, Wahid. In the meantime, I'd love Mikkel to jump in and then welcome Grant to the stage and get Grant's thoughts on the recent developments. But Mikkel, I'll give you the mic first. I see your hand up.
Hey, yeah, thanks for having me. I just wanted to make a quick comment on the Fed's credibility in terms of whether it's a 50-point basis hike or a 25. I just want to make the point that they just did the fastest rate hike in history by far. So in terms of whether they go 50 or 25, I mean, they are now suffering from the fact that whether or not they are directly the cause of Silicon Valley Bank, a bank just went bankrupt and it was massive. So they just caused a literal massive issue. And now their pressure being put on them by politicians is about to ramp up big time.
Mikkel,
so in terms of whether or not...
Do you really think that this was 100%? I mean, as you read the story that Mario is talking about, this was not 100% the Fed's fault. I'm not trying to be...
No, I completely agree.
1 million % the Fed's fault. 1 million.
It's going to be framed.
100%.
So I'll walk you. Okay. All right.
No matter what.
This is why Mario, the article needs to... We got to get this tweet thread out, because ultimately, of course, the Fed exacerbated and sort of exposed this chink in Silicon Valley Bank's armor. As you learn more, you will not believe the shit that they did and how they went about solving this problem.
Warren, though, is going to... You think Elizabeth Warren isn't going to be pressuring the Fed 10 times more now to stop interest rate hikes? They already had immense pressure, whether or not you dig into the technicals, and it wasn't completely because of the Fed. The Fed jacking up interest rates is tightening liquidity, and we are going into a situation where there's a liquidity crisis. The Fed needs a reason to pivot at some point, and this to me just looks like the perfect opportunity for them to say, things are breaking, we need to pivot, and if this isn't what's going to cause their pivot, what is going to be? We know their interest rates lag in their effect, so eventually they're going to have to stop hiking before we actually see inflation coming down. So to me, they just broke one of the biggest banks in the United States, and whether or not we get into the technicals of did they specifically break it, things are breaking and they're not helping.
Grant, would love to hear your thoughts on this, honestly. Do you think that the Fed broke Silicon Valley Bank?
Well, I don't know if it broke that bank specifically. I worry about the widespread damage, because all banks were taking reserves, checking account, my money, your money, and then reinvesting it in short-term treasury bills to pick up the spread. Those treasuries, 2 years, 5 years, and 10 years, their values have been destroyed. I don't know if anybody here, because you guys are very, very smart in this room, if anybody's done a calculation on what the destruction in the last 24 months has been just on a 2 year, but it has to be immense. It has to be in the hundreds of billions of dollars, many times. And part of what they were liquidating, from what I understand at SVN, was treasury bills. Am I wrong on that?
You're 100% right. And let's layer on. For a freaking decade, they've kept it at repressed. They've kept it at negative rates. And then they told the whole freaking world that the equilibrium rate for neutral inflation is 2 to 2.5%. So this SVB and every other bank starts piling onto treasuries after 10 years of suffering from negative yields, okay, at 2%. And this freaking thing goes to 5%. And they have a duration mismatch. They're idiots. I'm not excusing them. But the poor old depositors that put their money there don't wake up in the morning thinking about this stupid-ass Fed of how they're going to repress rates and then jack up rates to fix the problem that they created in the first place. This is 1,000,000% the Fed's fault. They've been at this for fucking 30 years. They need to fuck off. Leave the system alone. All they do is make it volatile.
Yeah, because the Fed has never, there is no single event, including Volcker, by the way, where the Fed controlled inflation. I know everybody says, oh, yeah, they did in Volcker. It took 10 years for that shit to work. If you start a business and you don't make money for 10 years, that is not a successful program. 10 years will handle inflation. Inflation is a normal activity. Inflation should happen, by the way, and it's good for assets. And the amount of money that was printed in this last cycle, just in the United States, and then lent out how many times? So you got $13 trillion that was printed, lent out 10 times minimum. Assets have not accelerated at the point to the amount of money in direct proportion to the amount of money that's been printed. But inflation is the new COVID of the day. And the Fed, I agree with you, the Fed should step out, let inflation do its thing, let the market decide, I don't want to fucking eat eggs anymore. They're too expensive. Quit eating them. Supplies will mount up, prices will come down, and people will go back to the store and pick up eggs again.
The thing that is insane is that single-handedly, this collapse has perhaps set the innovation economy 5 years back. Like, we legitimately
100%.
Very well.
I wish you guys were there when we first started the Spaces 5 hours ago. It looks like all the people exposed.
I don't think it sets it back, because the big guys, the Googles and the Facebooks, have so much cash they'll go in and gobble these companies up for pennies now, and continue to be a monopoly, which could also be another place.
But isn't innovation move forward by somebody disrupting Google? And isn't that actually how it works? And so now Google buying these companies is only going to slow things down. They might shelve some of these products that actually were doing.
Yeah, that's fair. Fair.
And I think that's what
the companies that are innovative enough are going to survive this. The companies that really have game-changing products are most likely going to figure out how to get through this. There are going to be casualties, no doubt, but to say it's going to set everything back 5 years, I think the companies that really have game-changing products are going to figure out how to get through this. Companies with great CEOs are going to figure out how to get through this.
So I'll tell you,
no doubt it's going to set things back.
So I'll tell you, I'm a Techstars founder. We went through Techstars a couple of years ago. So we have a group of, it's called Techstars Universe. That's how we all communicate with each other. There was a giant group. When I say, hundreds of founders that were commiserating on the fact that if nothing happens by Monday, they don't know what they're going to do. 250K is nothing.
Sunday night.
If nothing happens, how you have to understand, it is incredibly hard in this environment. Think about 2022. Imagine being a founder that just raised a Series A in one of the hardest environments to raise growth stage equity, and then 2 months later, your money is frozen. It's going to be impossible to keep your team engaged. It's going to be impossible to not have your customers leave you. I said it earlier. We are doing a full vendor review. I have been doing it. My team is working on it right now. We are, and I hate to say this, we're going to get rid of vendors that have exposure. I know that they can potentially figure it out. And by the way, it's what my investors expect of us. We are a growth stage company. We're well capitalized. We were lucky to not have our money in SVB. And I hate to do this to my friends, but we have to do what is right. And I can bet you that Grant and the companies he's invested in, any of the investors here, you want us to do that. And so if we're doing it, the second, third, fourth order ripple effects are real. That's where it breaks.
If nothing happens, though, I think there's some serious debate on whether or not, if nothing is going to happen and we're going to see this just let it go bankrupt. I have to say, I feel like I'm kind of agreeing with Tom Nash here, where I feel like that's probably the lower probability of how this plays out.
Guys, can I add something? Because I heard the Fed, it's their fault and everything, but I just want to make a comparison. So when I go to get a mortgage, right? So the bank always tells me, oh, you have to be prepared for this, although the rates are low, but you have to be prepared for this. In worst case, you have to be able to absorb a whatever percentage, like 4, 5%, 6%, 7%. So that's like the base of, they won't give me a mortgage if I am not able to absorb that. But why? So if it's all about the Fed, it's their fault, why doesn't this bank in particular also have the same kind of requirements, like think alike? So that's just my question. Why do we not blame the bank in this case? Although I have to be prepared for it, but they do not, apparently.
It's because the bank did what they had to do. So, when you think back to what happened, there was with low interest rates, there was a significant influx of funding that came into the startups. Those startups, 80% of them, well, 50% of them nationally, but 80% of them, especially when you think about Techstars and YC, which both have relationships with Silicon Valley Bank, both of those are, I don't want to say that companies that don't go through that are not the cream of the crop, but they're essentially the cream of the crop. And so those companies that got tons of funding in 2020, like ours and others, we all put our money in Silicon Valley Bank. Luckily for me, we moved it out, but a lot of them kept their money in Silicon Valley Bank. And so, when those deposits skyrocketed, Silicon Valley Bank had to find a way to get yield. I mean, as Faith Tribe was saying,
So why not short-term treasuries then? So you're not you don't have.
So at that time, short-term treasuries were not. Again, you're thinking about zero interest rate times. Short-term treasuries were not the right place to get yield at that time. And so to Grant's point earlier, interest rates have gone up so fast that there was not enough time for these banks to pivot their strategies.
100%. And then I can ask a reverse question.
Dump a 2 or 5 year treasury? How can you dump a 2 or 5 year treasury that you took out in 2021 or 22 without eating 20 or 30%? Again, if anybody in the room, somebody has to know how much destruction there has been again just across treasury.
To Grant's
deals.
point, they had bought more, MBS, 10-year duration MBS, mortgage-backed security, which was yielding 1.56, and that was incredible at the time if you think about it. And so when they got this, they did not have enough time. They couldn't offload it because in 2021, suddenly, in 2022, rates start going up, and the value of those mortgage-backed securities is just plummeting. When are you going to take that hit? No one expected the Fed to go up by 15, 20x in a year. So I think,
But let me ask a reverse question to our esteemed guest. Okay, Credit Suisse, second largest bank in Switzerland. Who would have known? Why did the Fed offer 20 billion in reverse swaps to the SMB to bail out Credit Suisse in October? Why in 2018 in October did they bail out JP Morgan and every other hedge fund in the reverse repo crisis? I mean, if we're gonna play moral hazard, let's play the game. Okay, I'll fight to the nail for these startups that have never seen a bank in their life. The only bank that would accept their capital, their startup capital, okay, in a garage, right, was SVB. Why are we so willy-nilly bailing out the entire too good to fail or too big to fail enterprises and not stepping in here? I'm asking the question.
Well, yeah, I agree, and I think there should be intervention probably to help with the potential contagion, but at the same time, I'm just thinking there has to be something that the bank could have done differently. It cannot only be it's all because of the Fed. It's just
we should punish them, wipe out the equity, wipe out the bondholders, protect the depositors. It's very simple. Sorry, I'm not shouting at you. I'm just really frustrated. Moral hazard is moral hazard. You wipe out the people who took risk. I am telling you and everyone on this audience, every single startup that deposited money by force, the only way they would get funding was to put their money in that bank against a credit line or something. It was a condition precedent. Okay, it's not their fault.
I'm not saying it's the fault of the startup founders. I'm putting more blame on the Fed. On the bank as opposed to to only the Fed. The Fed has its part, definitely. I'm not saying anything about the founders, the customers or whatever, the depositors into the bank. I'm just saying that there has to be something that the bank, like we can look at right now and say, hey, this is the point where the bank fucked up. This is the point in which
the bank fucked up. You wipe out the shareholders. You wipe out the bondholders.
Yeah, I'm not
Case
talking about
closed.
repercussions. I'm just
Case
talking
closed.
about looking forward.
The San Francisco Fed should fucking open their bank and backstop the deposits right now, just like they did with the repos with JP Morgan, just like they did with the Swiss National Bank in October with Credit Suisse. They should do it now, or else we're going to lose an entire economy.
I agree 100%. We're on the same page there.
And so we print money to save this bank and other banks.
We're printing money to save Ukraine. Fuck, the whole thing is a printing mechanism. Are we still debating this? The whole thing is a Ponzi. The whole thing is.
Are you yelling at me or are you yelling at the whole room?
No, I'm frustrated. I love you guys. You're the only people who listen to me.
Well, don't yell at the people you love.
You're right. Kudos, touche. You're 100% right.
I think the most important thing is from this point. Sorry,
you're saying interest rates go back to zero again?
I just don't think that's going to happen. There's no way. And Grant.
Why not? Why you can't print money at higher rates and expect people to take it? Who's going to take it?
Grant, you got to export inflation, and that's why the U.S. raises rates. It's so that other countries take on some of U.S.'s inflation.
Let's do the math. 330 trillion sovereign debt globally. Around 180 billion unfunded pension liabilities. Around 200 billion corporate and consumer debt. That's a lot of trillions, okay? That's almost 600 trillion in debt. Any 100 basis points is 6 trillion in delta, okay? That's a third of the US economy. The numbers don't lie. So unfortunately, we've created a chaos. We've created so much leverage in the system that unfortunately, we have to accept a certain element of structural inflation. Maybe not 6 to 7, but definitely not 2. I think the status quo cannot survive without a 3 to 4% inflation. If these guys think they're going to take it back to 2%, which was that their, quote unquote goal, okay, interest rates probably have to go to 7, 8%. I am telling you, the system cannot survive that. The system cannot lose an American economy. To hike interest rates 300 basis points from this point onwards, okay, is an entire U.S. economy, an entire U.S. GDP per annum. The numbers don't work. The numbers don't lie.
There is one thing, Faith, that I find strange. I've been following this website called Trueflation, which tracks inflation on chain, and they've been pretty accurate, within like 10 to 20% of what the inflation rate would be. And this month, it's totally off. They have U.S. inflation at 4%, and they registered 6%. I don't know what's going on. It's the first time that it's ever happened. And I don't know why this reporting, it seems false to me.
Yeah, because again, this inflation thing, this was the comment I was making earlier. I know it's in every headline that we have inflation. Rent. I own 12,000 apartments. I can just tell you guys, our rents have not exploded. It's not like I've raised rents 80% or something. We have gradually raised rents over the last 3 to 5 years.
But Grant, isn't price stability critical?
Rents are still today in 50 cities in America, half of home ownership. So if you take the inflation headline out, or if you take the food prices, just go back to food prices over the last 70 years, there's actually not massive inflation on food prices when adjusted for the US dollar. Nor is there for rent. Now, the mortgage exploded. It killed housing, the higher interest rates. It killed business borrowing, and it's killing these banks that locked into 2-year terms on treasury bills that were promised at 2%. Are now at 4%. There's probably 40% of the value of that treasury bill has been destroyed.
But Grant,
Dr. Danish, just quickly, guys. Danish, we've finally finished the thread, so I just tweeted it after like an hour working on it in the background. So before welcoming Vinny on stage, and I know that Ryan is joining us in a bit again, in about 2 minutes. Danish, I'd love you to just summarize for everyone the thread that you've been dying to talk about, because you've helped us write it. So I'm just going to pin it above for everyone. We just tweeted it out.
So, I think the interesting thing is there's a macro and micro thing that has occurred. We had a situation that involved startups, involved SVB's own decisions, and a Fed that was playing, fast and loose with interest rates. And all three came together in this way to lead to this bank run. But the details here are what's insane. So this all started actually in 2019. As many people know, there was a giant influx 2019, 2020, 2021 in startup funding. Startup funding started going up like crazy. To give you guys some context, within 1 year, Silicon Valley Bank's deposits tripled. We're talking about billions and billions of dollars. Then, as their deposits grew, they had to get yield on those loans. I mean, any good bank would do that. In an effort to get yields, they tried to look in the market to get guaranteed yields. Remember, most of those deposits were coming from startups. Most of the loans that they were giving out were to startups. So they were looking for something that was a pretty good guarantee to counteract that growth in deposits. And so they went, and I know that these three words are not liked, but mortgage-backed securities, which were pretty stable at the time at 1.56%, 10-year duration. They put money into that, and everything was looking great. They have lots of deposits. They had a giant loan book, everything, and yield was looking good for that time. Fast forward to last week, and this is when it gets really crazy. Moody has a phone call with the senior executives at SVB. Over the last year, everything has collapsed, as many people know in the tech industry. Valuations have collapsed, deposits went down, and interest rates went up so fast that 1.56% yield was a lot lower than what you could get from bonds in the market. Bonds in the market, and so therefore the value of the mortgage-backed securities plummeted, right? Why would you hold a security that could lose money when there's a risk-free interest rate you can get from bonds? To what Grant and others were saying. And so ultimately, when Moody sat down with them, they said, we're going to give you a major downgrade because everything is looking like shit. So because SVB at that time was burning through cash, the stock price was tumbling, and they had to find a way to meet their losses. So, by the way, along the way, on February 27th, the CEO and the CFO of Silicon Valley Bank sold a large proportion of their shares. In the middle of last week, though, forwarding back to recent, Moody's, when they told them that they were going to downgrade their credit, SVB started scrambling. They began consultation with Goldman Sachs. The CEO, Greg Becker, actually flew out to New York, met with Moody's to discuss the situation, try to calm the whole situation down. They then, in a scramble, had to sell 20 billion worth of the MBS, which they sold at a giant loss, leading to a $2.25 billion deficit, which they now had to cover. So they went and they got, and this is where it gets crazy, they actually found an investor to at least cover 500 million of this, General Atlantic. But they were the other investors were they had other investors, but the timeline was so short. But when they went to General Atlantic to get this money, they were going to have the deal done by the morning before everything opened. But the disclosures were not complete. The information comes out, the downgrade comes out, the information comes out about the loss, and then Founders Fund somehow, I'm not going to say how, but Founders Fund, YC, Techstars reach out to all of their founders, and they say, hey, get your money out. When they say get your money out, there's a bank run. The bank run leads to collapse. The collapse leads to ripples throughout the entire ecosystem. That's what happened. Vinny, would love for you to weigh in here.
Thanks.
Yeah, I'd like to. I mean, I'm trying to piece this together in real time, as for everyone else is. So forgive me if I get any of the facts wrong. But my understanding is that they're sitting with, I think, some number 70, 80 billion worth of mortgage-backed securities, some large number of those. And the issue really is a solvency issue right now, because the value of those securities have dropped because of the yields and the interest rates going up. So what we really need right now, and I don't know who the other speaker was, but I agree, the shareholders should get wiped out, management, whatever, like wipe out all the equity holders, but depositors should be made whole. And the issue really, it sounds like it's a timing issue, right? So because the average duration, I think, was 3 years, from what I could gather on these MBS securities, then what you need is the Fed to say, we're going to buy those, we're going to put it on our balance sheet, which they've done before for other banks, we're going to make depositors whole, and we're going to hold those to maturation. And the Fed doesn't mark down their maturation holds securities anyway, so it wouldn't be a markdown on their balance sheet, because they'll just hold it out. And so it's a liquidity issue right now, solvency issue, but it's not like the money's gone.
But the mortgage-backed securities are worthless right now in a high interest rate environment, because they were at a 10-year 1.56 duration, or a 10-year duration 1.56 yield.
But the money doesn't disappear that's mark to market. If you hold it through to maturity, it doesn't matter. The money's still there.
Sure, but again, in the short term, how would you? I mean, as an investor, would you buy the distressed debt?
I'm not saying I should buy it. I'm saying the Fed should buy it.
Huh.
I mean, it's $80 billion. It's nothing for them, right? The Fed can go easily absorb $80 billion onto their balance sheet and hold it for 3 years.
As I mentioned, I live in the Midwest. Can you imagine the uproar that comes when people say that there was a tech bailout?
Well, it's not a bailout, right? So shareholders aren't being made whole. Okay, everyone's losing. All the equity investors and anyone who took risk equity in the business, they lose their money. Like, if you are a shareholder of Silicon Valley Bank, sorry for you, don't care. What I'm saying is the money is there. The mortgage-backed securities will mature and they will pay out. And the issue right now is a mark-to-market solvency issue, where Silicon Valley Bank, they can't liquidate that right now, but you could hold it to maturity and get all the money out. And the Fed.
What is the incentive right now for the Fed or the administration to weigh in right now? Because again, I always think that they could just let this be a bad situation. Is there a contagion that you think, Vinny, is going to occur? Are others concerned about?
Yeah, it's a national security risk to allow the technology sector to disappear and allow China to get the edge. That's the
Do you think that they'll see that?
Well, yes, but there's knock-on effects. There's not, like, you take 80 billion out of the startup economy, you're going to have a lot of companies folding right now. I saw a report, 65,000 startups banked with Silicon Valley Bank. So you're going to have total carnage. And it really is, at this point, a timing issue. And partially, by the way, if the Fed caused this mess, right? So we know this. And if they go absorb it and say, look, the Fed's not going to lose money on this. And they've done this before for other banks in the financial sector in 2008. They bought toxic assets at those points. These assets are not toxic. They're just underwater, and you have to hold to maturity. That's it. And because Silicon Valley Bank didn't have the solvency to pay out the depositors, and the money moved, they're basically the bag holders, and effectively. But depositors, these are all securities backed, right? So the depositors should still be made whole. If it's a timing issue, the Fed needs to absorb the timing of this. That's my take on it. I think we don't know what the repercussions of this failure will be. We don't know. The unintended consequences could be far more catastrophic than the Fed just saying we're going to backstop 80 billion.
So Vinny, let's talk through those repercussions. So a really simple example that I was mentioning for my own business at Resilient, we have vendors that have exposure. We were lucky enough to not have exposure. Again, complete luck. There's no easy way to say that. There's some level of survivor's guilt because we're a Techstars startup and we did not have our money in SVB, and a lot of our brothers and sisters did. So, one of the things that is absolutely nuts is we are actually looking through our entire vendor list, reaching out to the founders of those vendors and asking and making sure that they didn't have exposure to SVB. Do you think, well, I know that's happening across the country, but do you think that there's going to be a contagion effect where people are going to, as vendors lose business, As vendors become insolvent, they lose business, their vendors lose business, and there'll be a second, third, fourth order effect.
Yeah, I absolutely believe that. And not just the tech industry, right? So let's look at the wine industry, for example. Silicon Valley Bank basically banked the entire Napa Valley region, right? So you've got a lot of people with money stuck there who are wine farmers, etc. The wine industry, the supply chains, I mean, this is a big deal. And if they went, if basically they can't pay their bills, they can't pay their workers, like you're going to have an industry collapse in wine in California, which it's actually a really big deal. Like the wine industry is a big part of the sort of Northern California's industry. I think we don't know what the ramifications are, and all I'm saying is that if it's a matter of holding some securities to maturity, that this is something the Fed could take on, and if they don't do it, we don't know what the full impact of them not doing it is going to be. And the way M1, M2, M3, M4 money supply works, throughout the world and through the US, is that there's some lag effect, but then if money dries up in large quantities from one pocket and it doesn't flow faster through the economy, you're going to have it could even make inflation worse in some areas because it creates shortages.
Vinny, hey, it's Ryan. How's it, man?
Hey, Ryan.
So I like what you're saying. And in an ideal world, what you're saying by the Fed absorbing the timing loss is effectively you're saying the Fed should absorb the interest because timing is actually equal to interest.
Yes.
And if Fed absorbs the interest, then that's the equivalent of just giving the bank money. It's just a bailout. It's just another way of saying the Fed should bail out the bank. No.
The Fed's not bailing out the bank. Remember, so there's
bailing out depositors. It's bailing out depositors.
So, Rand, can I ask you a question? Yeah. Didn't we bail out a foreign entity, Credit Suisse, in October? Just please answer that. Did we not give swap lines to the SMB, who basically put a backstop for the outflows of deposits at Credit Suisse in October of last year? Yes or no?
We may have.
We did. 100%. Let me just
get to the point. So, Benny, I think what you're saying is that the Fed needs to step in here and help. Where the help means a bailout, not a bailout. The problem is that I think that we've seen two banks collapse in the span of 2 weeks from exactly the same problem. The first one was Silvergate Bank, and the second one was this bank. And I think that in the next month or 2 months or 3 months, we're going to see a whole lot more collapses, and particularly if the Fed increased the interest rates again on the 22nd of March. So I think if we start getting into that, it's a bailout for the whole banking system. Now, there is one way that the Fed can bail out the whole banking system by not actually doing anything, and that is just reduce interest rates. And
that doesn't solve
Run. In fact, I would argue reducing interest rates right now is probably the wrong thing to do. I think what the Fed should do is stop raising at this point, and then wind down the reverse repo facility that they have. But that's good, and then also stop quantitative tightening and maybe moving to some easing. But changing interest rates right now, don't changing interest rates right now will do too much damage to the economy in terms of what they've already done to contain inflation. So what I'm saying, Run, is, and keep this in mind, right? Silicon Valley's got a debt book as well. They've got a whole bunch of debtors out there, people who owe them money. Now it goes under receivership. They're going to start calling up these debts, calling up these loans. So if you're going to go to things like, for example, wine farmers right now who've running lines of credit and they've got to pay this up. You're going to go to, and by the way, not just wine, like there are multiple industries that bank with Silicon Valley Bank. If these lines of credit get called and people have to start putting up money because the receivership wants the money back, you're gonna trigger it's basically
so Vinny, yesterday on the space there was an FDIC expert who was actually worked at the FDIC and was mentioning about the receivership process. He said, at least one person saying it, Jason, he said that they actually won't do. I actually asked that specific question because I was worried about some of my friends. They're not going to actually be doing capital calls. They'll just continue payments until the whole situation is resolved. So that was the pushback. I had the same concern. Luckily, the current process is set up so that they're not actually doing capital calls.
That's good to hear in the short term. The problem is, if you look at, like, I think it was Lehman Brothers took 14 years to unwind and get all the money out. So
Randy, Vinny, Randy's got to mute your mic, man. Go ahead, Vinny.
Yeah. No worries. Sorry. So I was saying, Lehman Brothers took like 14 years for them to unwind and get all the money out eventually, and not everyone is made whole. So look, the time issue is really the question here. If it's a matter of 3 years on these mortgage-backed securities, the Fed has the balance sheet to absorb this and prevent a catastrophic event. Now, I know what Run's saying, that this will happen again, and we do agree that. I agree that there are multiple. Silicon Valley Bank was not the only bank playing this game. I mean, multiple banks playing this game. They're underwater, etc.
Every bank. Every bank.
But run. But they're not. Remember, the equity holders will take the hit. Okay, Silicon Valley Bank was at such a scale, and they were doing this, and because their portfolio was so heavily tech focused, they got hit harder than anyone else. So I find it hard to believe we're going to have the same scale of impact where banks can't raise capital. And the second thing is the regulators and the Fed, who have been giving the banks an easy run on liquidity. That's not the problem of the depositor. Like the way what I'm saying. The Fed's responsible here. They should have had tighter liquidity ratio requirements, etc., for the banking sector. But they let the banks run wild. It's their problem. They need to fix it. But equity holders should get wiped out for sure. But depositors should be made whole, especially because the assets are not toxic at this point. Yes, they're marked down, but they're not toxic.
What is the hole at Silicon Valley Bank? Does anybody have an idea of how big the hole is in terms of for depositors? Forget about the equity. Let's write the equity down to zero. What is the hole for depositors?
My guess, Run, based upon the numbers, I think it's somewhere between $10 to $20 billion.
That's the number I had. So I had a number of 20 billion. So
yeah,
it would take 20 billion.
20. But hold on. All right.
I don't know where you guys are getting that number. I mean, I think I understand everyone's like outrage and all these other things, and I can't comment on that. But if you look at just the financial statements, right? Like we're losing sight of like how a bank works. Okay. A bank takes in deposits. They loan those deposits out to individuals so that they can have cash. Okay. Banks don't have all the cash from their depositors on hand at any given time. What SVB has in terms of total cash and marketable securities is $133 billion. Okay. They have $180 billion in deposits. The difference is their loan book. They have a $74 million loan book, right? So, like,
Jonathan,
I'm looking at
180 billion pre-bank run, though.
Yeah, the bank was very happy.
So therefore, the 180 billion, and that's the challenge. Is also they have illiquid assets in terms of warrants, which is also being counted towards their assets. They have illiquid. They have again, what made SVB special for companies like mine is that they were willing to work with us when a lot of other banks wouldn't be. They were willing to give us venture debt when others wouldn't, right? And so this is not just about. So you can't.
No, I think that's great, guys. But like, and I don't see like the issue with everyone saying that this is going to turn into some catastrophe where depositors are not going to be made whole. Like,
it's a timing issue. No, it's a timing issue.
It's a timing issue, right? So I mean, like before, everyone's saying like basically there's a 40% loss in their mark-to-market book. There's not. The maximum loss they have in their mark-to-market book is 10 billion on interest rate risk. Okay, and they have 3 billion of that hedged. So they have a $7 billion net exposure from an interest rate exposure perspective. It's in their 10K. You go to page 66. It tells you exactly what their duration risk is, right? Their average duration risk is 5.6, 5.7 years. So they went out and they bought these MBS securities, which by the way do not have credit risk because they're all backed by GSEs, right? In order to make sure that when they had deposits yielding nothing, they were getting some sort of net interest margin. Like that's how banks work. Now, the fact they had unhedged risk of $7 billion, you could criticize them for that, no doubt about it, right? In their held to maturity book, but that doesn't cause insolvency. What causes insolvency is a bank run. If it's like Mark Cuban tweets out, well, if the Fed should buy all the securities, great. Fed buys all the securities, $133 billion in securities, takes them all off the book at par value, fantastic. That still means they're 50 billion short on their depositor base. right? Because they don't have cash and cash equivalents on their balance sheet at all times. That's not how banks work. You have to loan it out. So the loans that are outstanding, they would have to call those. They would have to be paid back, and then they could pay their depositors back. But in order to have like net exposure from an interest rate risk perspective, they'd have to have, according to my calculation, a 9 to 10% loan loss, which their current loan loss reserves are 636 million, not 7 billion, right? So they'd have to be off by an order of magnitude of significant amounts. Now, it doesn't, I'm not, like the people that are going through this, it's horrible. Like there was a bank run. Peter Thiel initiated a bank run. He called a bunch of people up. He said, pull all your money out of a bank. No bank can withstand that. No bank is sitting there with all of the depositors' monies ready to just hand them back to them. That's just not how banking works. So
that's right. But can I just make one comment on that? You can't initiate a bank run in an entity that isn't already vulnerable, right? Like you could call everybody you know right now and say, pull your money from JP Morgan, Wells Fargo, Bank of America. It would be harder. And the reason is the gap between the mark-to-market losses on the held-to-maturity portfolio and then the size of the equity. And that's the missing piece that I haven't heard anyone mention in the last 20 minutes is that the mark-to-market losses on those held-to-maturity securities was over 100% of SVB's equity. Whereas at Wells Fargo, it's like 20%, right? Bank of America, it's like 40%. And so the other thing to keep in mind is that it's only going to happen to the smaller sort of industry-focused lenders where the deposits are not as sticky, right? They're not diversified, like they're 100% all in. And so yes, Peter Thiel could initiate a bank run at SVB, but it's just not going to happen at most other lenders. I mean, there are a few others like Westpac and First Republic and Signature that are smaller and their deposits are less sticky and their cost of funding is going up. And they also have large mark-to-market losses. But the Silicon Valley Bank issue is quite unique in this instance. I think the idea that therefore other people are going to have issues is probably not right. And even if you wanted to initiate a bank run again at Wells Fargo, it's just not going to happen, not in this environment.
I mean, but look, I mean, if you just get back to the facts, $40 billion in draws, okay, for Peter Thiel to initiate that, okay, that's what, 37% of their total deposits? I mean, that's an enormous number. You know, like if you went to JP Morgan or you went to Citibank or any other bank out there and you said, like, I want to have a one-day withdrawal of 40% of your total deposits, I mean, that'd be catastrophic.
Right, but structurally, it can't happen at those lenders. SVB had particular risk because of the size. I mean, they made a lot of really stupid decisions in how they allocated to treasuries and MBS, right? And because of that, they were put in a vulnerable situation where they were highly concentrated deposits with a specific industry subsector, right? And those people got nervous because of the size of the losses relative to the equity. So yes, and again, there's no diversification. Like there are a bunch of basically dead people who have accounts at Wells Fargo. They never move their money. They don't care what interest rates are. You can move interest rates up and down. You can pay them a little more, a little less. They're never going to pull their money because they're small account balances. They're different people. They don't care who anyone else uses. SVB is basically a flock, right? And so if you scare one part of the flock, the whole flock is going to move because they're all connected. They're interconnected. Also, and they all talk to each other. Whereas the depositors at JP Morgan, Wells Fargo don't. They simply don't care. It's across energy industry, the home building industry, the healthcare industry. It's global. And also, it's totally
to be clear, the time series and the timeline here is critical. If there's no movement for 2 weeks, for the average person, it sucks. You're scared. You're worried. For a startup, that's payroll, that's burn. That there's all of these other things that need to get done, and that's what is even scarier.
And they don't have any reserves. Exactly. That's the issue. Mario, could you approve Pranav? He's very, very knowledgeable in the space, and I think he's requested to speak, and he's just texting me now. He's a friend of mine, and he can add a lot of color.
One piece of context.
Yeah, sure. Vinny, can you just DM me his username, Vinny? I'm just sorting out the panel.
One piece of context also here, and I mentioned this earlier, but wanted to repeat it, which is founders like myself who did business with SVB. Last year was a tough year for fundraising in general. So a lot of people started looking at their cash and said, okay, instead of just getting everything on equity, we can get some on debt to extend our runway. The largest venture debt provider in the country was Silicon Valley Bank. If you wanted to get money from Silicon Valley Bank, you had to move your money into Silicon Valley Bank. That last part is even more painful if you think about the founders that have been most affected. And I think that is another part of this story, which is you were struggling, you had line of sight of profitability. So you said, hey, because we have line of sight of profitability, we're going to now take on debt. And you took on that debt. In return of that debt, they said, hey, you have to put your money into Silicon Valley Bank. You put your money in Silicon Valley Bank, and now they broke your heart. That is an incredible.
Can I ask what the collateral was in that arrangement?
Warrants.
Did they make you collateralize
your VCs? Basically, if you have Sequoia and Andreessen Horowitz, they'll give you a loan. And if you have some crappy tier 2 or tier 3 shop, they generally won't. That's how SVB works.
That
was for 10 years.
I will push back a little bit. Again, we have great investors. My point is more around it was not just because you had good investors. They also took warrants often on that debt.
Yeah, I know. I used them twice for venture-backed loans at both of my startups. And I got lucky because I sold the last one in 2020, so I didn't get to experience the fun that happened recently. But I feel bad for those founders because a lot of them have no background in finance and wouldn't have seen this coming, right? And it's really unlucky.
They got a bunch of warrants against this debt.
Let's just like talk about one thing for a second, guys. Like I steer the topic to regulatory. Okay, we get told that regulators are there to make sure that we're safe, right, and protect us. Where is the safety and protection of people who've just lost money as depositors in a financial system that is regulated?
It's a damn good question, and I don't think there's a good answer because the Fed is the one that basically broke the system for these smaller lenders, right? The large lenders are mostly fine. The small lenders with non-sticky deposits where the funding costs are going up and the mark-to-market losses are larger relative to their equity are struggling right now. And the thing that people need to pay attention to is the central bank itself is actually losing money now because the cost of funding the central bank is actually higher now than the value that they're getting back on the assets that they're holding, right? The Fed actually holds a bunch of treasuries at lower rates as well. The difference is they can print their own money, and so they really can't become insolvent the same way a smaller lender is. But there's going to be some mark to market to that, to like the entire superstructure of the U.S. Federal Reserve System, right? And that's the scary thing that could happen in the coming years that people aren't even thinking about yet.
I'll click on that for a second. Ram Aluwania, he basically put out a thread yesterday, I don't know, the day before, where he estimated that the Fed's mark to market is $1.5 trillion less than what their balance sheet says, basically. And because they're holding it to maturity, they don't have to mark it down. And because they can print their own money, it's fine. So the Fed are probably in a bigger hole as a percentage-wise than Silicon Valley Bank.
That's correct. And Len Alden did a wonderful podcast with Peter McCormick just very recently. We went into great depth. She also wrote an article about it that showed how this is different than in the past because the Fed's always made money, right? Until very, very recently, because the extent of the interest rate increases were so dramatic that even the Fed is upside down on their balance sheet, right? There's a mismatch between the assets they hold and what they get paid on those, and then the liabilities that they have. So yes, the Fed could take on everybody's liabilities to make up for the fact that they're literally willing to kill the economy and the financial system in the U.S. to lower interest rates from 6% to 2%, right? Which they want to bring down the cost of milk by 40 cents, and they're literally going to blow up the banking sector. But they could actually do that, and they would just have to take over all of those losses.
Guys, I just wanted to share. This is obviously not breaking news, but I was mentioning about Techstars. Techstars internally just shared, and again, it's not that internal. Most founders that are in Techstars would know about this. They shared office hours, and I'm not kidding, office hours for help with this SVB situation 6 minutes ago. It's already, the entire next 2 days are already full. It gives you a sense of how big this contagion is. And Techstars has hundreds and thousands of startups, but still, they opened up office hours and it's completely full. And I bet you YC is going through the exact same thing right now.
Yeah, I mean that's stunning, and it's really sad for the tech community. Again, I think a lot of founders, there's just no way they would have known this was coming unless one of their investors who.
Why would I be paying attention?
Yeah, I know you're not. But there are some founders who got calls though a week ago from their investors. There are a bunch of people I follow on Twitter, including Raging Capital, who called out the balance sheet issues at SVB months ago, but nobody cared, right? Nobody pays attention until the contagion or until the problem becomes really, really acute. But the one thing I'd push back on is I think the contagion is going to be somewhat contained to this industry. Even wine, right? The largest wine producer in the United States is called Constellation Brands. They didn't keep a dollar at Silicon Valley Bank, right? So yes, a lot of smaller producers who had relationships because they made money in tech and they did IPOs and then they bought a vineyard, like they might be affected.
I will push
right.
back
And there's a bunch of startups that are going to struggle
I will
to pay
push back
people.
strongly. I'll give you a simple example. I can't name the company because I know the founder and I love the founder. They're incredible, but they represent probably 60 to 70% of the healthcare interoperability in the US. And they are part of that interoperability communications infrastructure. They are currently stuck. So it gives you a simple example.
Yeah, so somebody will give them a loan though. Equity holders and or bondholders will sell them.
I don't think that's how. So they're not profitable. They were in growth mode, and they had that. Well, what are they going to go raise on? What bank is out there doing venture debt at this moment?
Okay, so but I want to push back on that though, because during the early COVID period, people were like, "How is Airbnb ever going to make money again?" Because people are locked in their houses and they're not allowed to travel, they're not allowed to fly and whatever. And it turns out all the big private equity firms recognize that Airbnb is the best business model, just a commission business model, even though it looks like this slick tech thing, like it grows at 40% a year in normal times with 30% margins. There's always a lender. There's always a lender of last resort for really high quality business. So if you're right, and that business is really instrumental to the healthcare economy and interoperability, then there will be capital available for them. Let's set aside too just the fact that by Monday or Tuesday, there's going to be some notice from the FDIC about what their process is going to be for how they're going to liquidate the assets. The issue is not that there are no assets there. The issue is that the assets need to be liquidated in an orderly way so it does not create more contagion in the economy by basically dumping massive amounts of treasury.
The process is incredibly complicated. It can take months to a startup or like years.
Sure, but about the top 10% or 20% of startups that were growing before the banking issue, they're not going to have trouble getting capital from Apollo or Blackstone or BlackRock or somebody, Fidelity, Cotu, T. Rowe. Like these firms will
stage startups and growth equity startups. I'm talking about startups that are now
exactly
market fit, let's say seed or Series A stage. They're the ones that will really suffer.
Yeah, but how many employees?
It's not about the employees. It's about what they support.
Yes, it is, because the employees are 80% of the expense base for most seed stage companies. So how many employees do they have?
I'm not going to speak specifically to that company, but probably in the hundreds.
Okay, great. So they probably need 20 million or 30 million to get through that. That's going to be relatively easy for good companies to get, even when their bank is shut down. And again, I think some of the deposits are going to be made available on Monday, and then it will be staggered, I'm sure, as they liquidate that bond portfolio. They will make that money available. This is not going to be like a 2 or 3 year.
Mike. So just
Mike, if you don't mind,
the bond portfolio.
Respectfully disagree with you. This contagion is not going to get worse if it's not resolved by Monday by the Fed. And it's sort of, here's my logic here, which is, I bucket banks into two categories: systematically important banks. Those are kind of like your JP Morgans and Citigroups and Bank of Americas of the world. And then the rest are regional banks. And most small.
Is it me or Pranav drop out?
He dropped out.
Yeah, I think he's got a call.
I think he was silenced. He was silenced by the Fed. The Fed doesn't want you to hear what Pranav said.
We can hear now.
Pranav dropped out 5 seconds ago.
Most small and medium businesses in the United States use regional banks, and if there's a time delay in how quickly depositors of Silicon Valley Bank can get their money back, even if it's multiple weeks, not years. That's going to signal to most of these small and medium businesses across the United States to stop using regional banks and move those assets over to the systematically important banks. And that flow of funds is going to require this regional bank to then sell assets off their balance sheet, just like how Silicon Valley Bank had to. And that's going to then have a cascading effect on those asset prices, right? So most banks typically have a duration mismatch, even if it's short duration, if it's 1 year duration mismatch. That's going to have a bigger effect over the coming weeks as you have this flow of funds from regional banks to systematically important banks. So the way to avoid something like that, in my opinion, is the Federal Reserve says depositors will be made whole in a very, very short period of time, while these regional banks have to increase their interest rates on depositors to keep those depositors there. Otherwise, if you're if you're a small medium business or a high net worth individual at any regional bank, there's really no incentive to keep your money there, and you'd rather move it to JP Morgan or wherever else. That's kind of my general view on this.
And Pranav, can you delve into the reverse repo facility and your thoughts on that, and how, because like I'm very anti it right now, and I think I agree with you that the banks the way it's an interest rate scam right now, and this is why people aren't going to leave their money in, and that's why they were taking it out of Silicon Valley Bank.
Pranav, you're muted.
Hey, as Pranav is coming on, I wanted to share. I just received a message from an investor, an angel investor, and I know it's Christopher Deutsch. He is based out of Chicago. He just wanted to share with the group. He has 147 founders, and he's a full-time angel. And right now, he's running office hours. The one thing he wanted to make sure that we heard is that he wanted to push back to Mike, like I was, saying that the super early stage startups are going to die. And again, this is a guy that's actively investing right now. He's having his founders show up at his house right now in Chicago to decompress. These super early stage startups are going to die, and those were going to be the next Airbnbs. He said this guy is so wrong. What he's saying is so dangerous. And I
think that's funny. But look, can I just say one? Since it's directed at me, can I just say one thing? People always in crisis moments. I've seen this for the last 25 years in investing. They always talk their own book in the worst moment. And so, yes, I understand he's under attack right now. Like if I had my entire portfolio exposed to this, I would be nervous too. But I promise you in 6 or 12 months, we're not going to remember most of these details. This is the way it always works. And yes, I know it's acute now. Yes, I know people are struggling. I'm not poo-pooing that at all. Like that sucks.
Mike,
but the fact that let me finish my thought first. A 5-person startup not being able to pay its bills for a few weeks or a few months is not the end of the world. Sorry.
Where's the Elon? Where's the remind me of this feature for Spaces? I need that for 6 months from now. I disagree wholeheartedly with Mike here. I think Mike, that's what makes
a market. I love markets because we can disagree, and the facts will be the facts. If I end up being right, great. If you end up being right, great. I don't necessarily want to be right, but I think the best thing for the industry is for bad lenders to be wiped out. Like Silicon Valley Bank was going to fuck the tech industry eventually anyway. I met Greg Becker in person. Like, even though I took loans from them, I met Greg Becker in person. I thought he was a dick, right? A couple times. And so like, I'm not surprised. I'm not surprised that this happened to him because he was kind of a douchebag, right? And so now there's this fallout from something that happened because this guy's not necessarily a great guy. He wasn't as smart as he looked. He was getting paid millions of dollars to basically shepherd all of these firms' capital, and he fucked up. Like, what was he doing as a CEO if he didn't understand basic risk management? Like, do not put all of the client capital into treasury bonds and mortgage-backed securities at all-time low interest rates. I've been saying that for 5 years. You could be early on that, but you should have been diversified. There are plenty of banks, like a good example is Axos Bank in California, across the street from Silvergate. Silvergate also went out of business this week because they were 100% exposed to crypto. Axos is floating along fine because their cost of funding is super low relative to other online banks, right? They're highly diversified. They have low account balances. If all your account balances are large, then your FDIC insurance exposure is de minimis. Like 97, 98% of SVB's deposits were not exposed to FDIC insurance. And so the management of that bank should have understood that they shouldn't be taking so much duration risk. I mean, this is basic ABC bullshit. So like, don't tell me that it's my problem because I'm calling out behavior and saying that it's going to get better, right? Like, you could strongly disagree all you want, but it's just a fact that it's going to get better because there will be other banks that step in here to lend to tech companies. I guarantee you it happens every fucking cycle, no matter how much the kids cry and say it's never going to get better. They say this every fucking time.
You want to weigh in?
Yeah, I'm sorry. Go ahead.
Yeah, go ahead, Grant. Go ahead.
I was just going to say, I think
Ryan.
one thing we're missing here is, and this is going to be somewhat inflammatory to say, but the Fed is playing chess right now, and we're all talking checkers. And what I mean by that is there is an enormous amount of speculation in the market. We'll use venture capital as the first point. The intent of the Fed is to do exactly what they're doing. They are pulling the speculation out of the market. They are going to create intended layoffs that they need and want. And this is tech wreck 2.0. This is, 2000 happening primarily in the private equity markets and the venture capital markets. And if you look at the multiples in the publicly traded markets on some of these companies, it's absurd. So to the point earlier, if you look at where the money was going, 90% of those startups are not the next Airbnb. It was froth. It was speculation with a belief of no risk. 23-year-olds making mid 6 figures, 7 figures. It's unsustainable. The Fed is doing exactly what they want to do.
And creating the future, Ryan. I disagree 100%. They're also creating the future. The Airbnbs, if even 10% of them become Airbnbs, that is actually what moves our economy forward.
Statistically, it's
Mike, I'm going to make my point here too.
90% should have never.
Ryan, just 2 seconds. Ryan, hold on, Ryan. You get your mic a bit closer to your mouth. It's really hard to hear you. But go ahead, Danish and Mike.
Yeah. So ultimately, what we're talking about is the long tail phenomena that occurs in venture. This is why America is the greatest at creating companies. Is because that 1% or that 10% changed the world. That is actually why founders take this risk. And this commentary around 23-year-olds making 6 figures, they're making 6 figures because they are building the future and they have funding. And at the end of the day, this whole ramen noodle mentality does not lead to long. And by the way, 6 figures in SF is nothing. But
yeah, 6 figures. About to say, a Starbucks barista makes 6 figures these days.
Exactly. And so ultimately, this is the narrative I was talking about earlier, is that the biggest problem is a thought process like this, where people are not realizing that by hurting the innovation economy, it is a concern not only for the larger economy and the contagion associated with that, but actually a bigger issue of a national, like Simon has said, a national security issue. We're going to fall behind other countries, especially China, where there's a current race. How are we going to follow up on the Infrastructure and Chips Act when a lot of these startups can't build the infrastructure that is underlying the Chips Act, for example? How are we going to actually move forward? Right now, life sciences, health tech are taking a big, we just came out of a pandemic. We are now digitizing healthcare. How is that going to happen in this situation when 30% of the companies, let's say that, like you guys are right, maybe 10% of them will be able to get funding and be able to furlough for a little bit and be able to get funding. But what if in that 90% that died because of no fault of their own, that those 90%, do they deserve to lose? I mean, I don't understand the point that you're trying to make.
But you're overstating. Hold on a second. You're overstating the percentages here, right? Like in life, there's a Darwinian process of creation and destruction. It happens everywhere. It happens in nature. It happens in finance. It happens in startups, right? And I talked to a number of founders yesterday who had money at JP Morgan. I had to talk to a number of founders yesterday who pulled their money from SVB in advance, right? And so I'm not saying they're right or wrong or they're better than those other startups, but you're overstating it. Like not every startup is going to die because SVB got shut down by the FDIC, period.
But a significant portion that we're banking with SVB will.
I don't know if that's true or not, because we don't know how quickly a lot of those assets are going to be disposed. We don't know how quickly the deposits will be made available next week, and some portion of the deposits will be made available as soon as Monday, according to the liquidator. But for 3-person startups, that's significant, right? For 3-person, the ones that you're most concerned about, that's significant. The ones that have hundreds of millions in revenue and are late stage are going to get money from Apollo, Blackstone, BlackRock, T. Rowe, Fidelity, et cetera. I'm telling you, like, there's a bifurcation here. There's firms that have already
last time I heard Blackstone invest early stage at growth stage companies, and this is not something you're doing. Daphne, I'd love to hear.
Late stage pre-IPO, they'll do lending. They'll do private equity.
IPO is a very different stage. Daphne, I'd love to hear.
Yeah, thanks so much. So I've been hearing, and I've heard from 3 credible sources right now, that about 50% of the deposits should be available next week, and that's supposedly in addition to the 250,000. So I've now heard that.
Exactly. Thank you for that.
Daphne, how would those be available? Can you walk me through the exact mechanism? Is the FDIC going to be? Hold on, Mike. I would love to hear from Daphne.
Yeah. So again, I've heard this from different sources, and it's not confirmed. But one of the sources that I heard from was Goodwin, which is one of the top firms in the space. And what I understand from another source is that apparently they sold half. I mean, they were able to sell half of the deposits, so that those would now be available.
I'm sorry, they sold the deposits to another bank?
Yes.
Exactly. That's the same thing Binance and FTX were doing with failed crypto companies. They're going to offload some of the liabilities to other larger firms who want to bank those liabilities going forward, right? There, as you've mentioned, Dr. Denise, there are tons of opportunities to provide loans and to do stuff for a lot of these tech companies, and that opportunity doesn't go away just because Silicon Valley Bank fucked up. Right, so they're just going to they're going to transfer those liabilities, they're going to transfer those risks, and then they're going to sell off other assets to cover the gap even further. At the end of all of this, it might be you might get 70 cents or 80 cents or 90 cents on the dollar back. It's just going to take a little bit of time because they can't unwind all of those treasuries without crashing the treasury market, which again, that was what would cause ramifications for the rest of the financial system.
So one of the challenges through this now, again, Daphne also disclaimered that this was, not from any direct source, and it was through others, and it's not been confirmed. But it sounds like, and Daphne, I'm going to repeat it back: 50% of the deposits will be returned to holders next week. Is that correct?
I've heard that now from 3 different sources, including one of, a very well-known and respected investor who's been kind of talking to folks at, that are lobbying government. I heard it from somebody at Goodwin, and I heard it from a third person on Twitter who talked a little bit more about the mechanisms. His name's Mike Moyes. But I can't confirm it myself. It's just
Daphne,
3 separate good sources.
Go ahead,
50% of deposits would get paid back.
Exactly.
Not the, I think it was all deposits, but yeah.
So they just do it. They just do it, guys. They just do it per capita. It's 250K off the top, and then it's per capita on top of that. Remember, 98% of all of the deposits there are not covered by FDIC insurance.
So there'll be a 50% loss. That sounds convenient, but the other 50% gets apportioned amongst the holdings in the bank.
There's no 50% loss, Grant. They have other assets they need time to liquidate. This is just the amount they can make available immediately because they have transferred those liabilities to another larger lender who's willing to assume them. It's the same thing Binance was going to do with Voyager, right? It's the same thing that happens in other markets. You literally just transfer liabilities from one party to the other.
Over the weekend, I called up Kim.com and said, "Hey, can you take these?" And he, in 48 hours of due diligence, decided he would take those at some price.
Because these are good risks. These are, in a lot of cases, these are growing technology companies, as Dr. Denise
He wasn't
said.
even thinking about this on Thursday. By Sunday, he's decided to take a position.
Exactly.
Have you ever been in a boardroom? Have you been in a boardroom with a large bank? They're sitting around wondering how they're going to grow. If they find an opportunistic opportunity to add assets this quickly with good customers, they will take it. Even with a phone call, and especially if the phone call comes from the Treasury, the Fed, or the FDIC, they're going to take the phone call. Every large bank
We had a
in
former
America.
FDIC regulator on yesterday on the space and said that's highly unlikely because there's no incentive for a large bank to be taking on this, just to swoop up this this Silicon Valley bank, because they don't know, they can't do their due diligence in a day or two to like take on all these liabilities.
Do you remember 2008? They actually forced banks essentially to buy 3 or 4 large banks. That's happening again right now. This is much this is much smaller than that. Much smaller than that. Much easier to digest.
Incentive back then because all the banks held subprime. So if they let Bear Stearns full out collapse, then that would have hurt JP Morgan and the rest of them because they all held subprime.
This is exactly the same. Every single large bank has mark-to-market losses on their held-to-maturity securities right now. Bank of America's is 40% of equity. They can't afford any more drama either, right? Wells Fargo is 20%. So SVB was well over 100% of equity.
Yeah, but what's the amount of mortgage-backed securities on Silicon Valley Bank's balance sheet? Wouldn't it make more business financial sense to wait for like someone like Goldman Sachs to buy those in the secondary market under receivership at a discount? That's how the game's played by the big boys. They will buy.
They still get a discount just because they bought it over the weekend at the nudging of the FDIC. They still get a discount.
So this is just rumor.
What is the incentive? I don't understand the incentive. That's what's confusing. Is like
to expand your customer base, expand your asset base. It's the same incentive at all. I don't know why this is so difficult to understand.
Because currently FDIC is, so this then confirms the story from Bloomberg around FDIC chopping up the different components of the bank and auctioning them off separately. I mean, that's what it sounds like we're confirming right now. If that story is correct.
Yeah.
And again, I want to repeat, that Daphne herself said that she has 3 different sources that have said the same exact numbers, same exact information. But again, it has not been confirmed by anybody close to SVB or from the FDIC. So,
and by the way, Greg Becker sold $3.6 million in stock in the days before the failure. So to my comments about him being a douchebag, he just confirmed it. Only a douche would do that. Selling stock when you know you have a huge mark-to-market loss in your book and that you're experiencing a run on the bank, and then you sell stock. I guess he's trying to fund his legal bills. He's going to get sued.
Mike, did you try to get money from the bank and couldn't?
Me? I haven't used SVB since 2020 when I sold my last startup to NYDIG. So no, I had no exposure to SVB, but I'm pointing out that the CEO of the bank, who knew, right, had inside information that they were possibly going to fail, sold $3.6 million of stock in the days leading up. I mean, that's a smoking gun. He's going down.
Programs. Those are automated sell programs.
That's bullshit. Those automated sell programs have already been proven and disproven to be used above board ways, right? Like almost everybody puts them in place and then uses them on inside information. In fact, the SEC is thinking about shutting them down completely.
Those were in place for years.
Yep, and they've been used for years. I don't know how that adds to the point.
Daphne, just quick question. Sorry, Daphne, I've just got some journalists asking, who are your 3 sources that you mentioned? What can you share about them?
Well, one of them is Peter Kolchinsky from RA Capital. Another one is Goodwin Procter, which is one of the leading law firms in the tech and life science space. And the third one is somebody on Twitter, which, like I said, that one, it just is supportive, but they basically said the same exact thing. So I'm going to try to, I'm going to try to do is I'm going to try to find the third one and just retweet it. But the other 2 are people that I know and respect and trust. Nobody said it's a done deal, but those are 2 sources that I respect. I'm also going to say that I've shared all the information that I know, and I'm not a banking expert, but I just thought that this information is helpful. So I'm going to pop back down into the audience now and appreciate you guys having this discussion.
Hey,
the team just quick. Ryan, your mic, man, is still really, really bad. If you can fix it, but Daphne, you should be getting a DM on Twitter. If you can keep an eye out on that would be great. But go ahead, Mike.
Thanks.
I was just going to say that's super helpful because it seems like a very contrarian view right now. I don't know why, but it seems like a very contrarian view to say something simple like, hey, most of the assets are there. They're just not liquid, right? They're the wrong duration, right? For the immediate need, because there was an immediate need for cash because of the run on the bank, precipitated again by the mark-to-market losses, which exceeded the equity of the bank, which is different again than other banks. And so I think this contagion, it's a mini bank crisis. We had Silvergate go down this week. We have SVB go down this week. I think First Republic and maybe Signature and a couple of others are vulnerable. But if SVB has a workout plan in place this week where they chop up the assets, they basically offload liabilities to 2 or 3 other parties, and then they, in an orderly way, sell down some of the other assets directly, I really do believe that what she just said, Daphne just said about the 50% being available this week, is the most likely outcome. And I love that it's so contrarian because I think it's going to be so obvious in a few weeks that this isn't as bad as people are making it out to be.
Can we also just take a minute to just appreciate that we've had 2 major banks collapse in a week, including the biggest tech bank in pretty much the world, I guess. And the Bitcoin price has hardly moved.
Yeah, and I think that's actually a really important point, Vinny, because Bitcoin is sort of outside of the Fed system in a sense, right? Because you can hold Bitcoin in cold custody, self-custody. There's no counterparty risk when you do that. The end analysis of SVB is that even if the bank looks solvent and Moody's gives it a AAA rating a week or 2 ago, it doesn't mean that it actually is if you're holding a bunch of securities, the interplay in which you don't understand, right, in a rising rate environment. Bitcoin doesn't care about rising rates because Bitcoin in cold custody does not respond to Fed intervention in any way, right? The fiat price might change, but Bitcoin itself just continues to make a new block every 10 minutes. And I think it's a nice island of safety in this environment of Federal Reserve induced volatility.
Mike, not to push back, but you had just said that people are going to sell their own book in this moment, and you kind of did the same. Sorry, Simon, go ahead.
I just wanted to prove my point. I actually think it's consistent, right? I said people do that. I did it. I just think that your book right now is saying that, oh my God, the tech industry is going to crash. And I'm saying that there's going to be issues.
Someone that there's no
because then you draw in more attention, more capital, which I agree you should do, because I don't want to see innovation stifled in any way in America. I just disagree with the view that somehow 5-person startups struggling to pay their bills for a couple of weeks is the death knell of that industry. Sorry.
So I want to say something, Mike. I agree with you on one end that this isn't going to completely destroy the industry. I think when you hear from some founders that are saying this is like Armageddon for them, I think that they're trying to protect their investment. Trying to make argue for some sort of government bailout, but I don't see that coming, and I don't see it as bad as that. Secondly, the insider sales. Just so everyone is aware. Silicon Valley Bank reported earnings on February, looks like 23rd is when they put out their 10K, and then the insiders sold their stock on February 27th. So as of February 23rd, unless their 10K was totally fraudulent, they were allowed to make those sales on February 27th, and it was not a large bulk of stock that they sold. So I even though it does sort of look on the cover a little fishy, I personally wouldn't even draw a conclusion or make any insinuation towards the CEO that he did something, illegal or, knew some insider information, because they just filed their 10K 3 days prior. So he was within his rights after the earnings period in the window where he could sell stock.
Are you a lawyer and are you representing him? Because that's like the legal definition of just using semantics to try to defend.
But I've been in finance for 25 years, and
So
I
have I.
trade through the financial crisis, so.
Guys, we have Mark Cuban in the room. I'd love to hear Mark's thoughts on this. If we can get him up on stage.
Yeah, I've chatting to him privately, so just don't want to put him on the spot. But Mike, yeah, if I've sent you a DM, if you could join, it would be great.
While we're waiting, it's worth looking at so obviously the Bitcoin volume, going from USDC to Bitcoin is
perspectives. From a small startup perspective, it's going to be very, very painful. I'm seeing it, I'm having to fund payrolls for multiple of my companies that have done business with Silicon Bank. I think the unknown that will impact what everybody has said is what the advanced dividend is going to be. And let me just add, the term advanced dividend needs to be better explained in their press release. And I think it's something that people don't understand. And I know I did not understand when I started reading it, and I had to, be corrected in some of my tweets. But, how much of uninsured deposits are returned to companies on Monday, Tuesday, and Wednesday is going to drive the entire response on this. If it's 50%, 60% across the board, so if you had 10 million in and you've got 5 million back, then all of a sudden people are going to have some confidence that the system is working. If it's 10% or less, then people are going to question how the process is going to work. And so I think that's going to be a big driving factor. In terms of the macro impact, I went through this in 2000 and, I've stopped investing at some of the crazy valuations over the past 2 years. What we saw in 2000 in the public markets is exactly what we've seen in the private markets in terms of valuations. And so I think this is the chickens coming home to roost in some respects. It's going to be more difficult to raise capital, even for great companies going forward. So, that's just a lot of generalities, but that's kind of where my head's at.
So, Mark, in terms of the long-term contagion effect right now of this, as it affects not only the startups whose money is stuck in SVB, but the startups that work with them and so on, and the second and third order effects, are you concerned that this is actually going to have a bigger effect than people are currently, even on stage, arguing that it will not? Will it be all self-contained, or do you think there's going to be a contagion effect here?
Depends on the advanced dividend. So if nobody gets anything, then it's a huge contagion. Payrolls aren't made, vendors aren't paid, and those vendors, when they don't get paid, they can't pay their payroll. So there's a second, third, and fourth order that happens, every 2 weeks effectively for payrolls. And so if there's no money paid out in advanced dividends, we have a problem. If there's a material amount that covers enough, that allows enough of the startups, enough of the wine industry, enough of the companies' impact to pay their bills, and make their payroll, then I forget who said it, but 6 months from now, we won't remember the details.
That was me, Mark, and I think Daphne's important point here is that she's handicapping based on these three really good sources that up to 50% will be available this week, which was my view as recently as last night when I was looking at this. I said, look, there's enough assets here, and there are enough. It's a relatively small bank compared to the majors. There are plenty of majors who've long wanted a foothold in Silicon Valley. They've long wanted to bank the Stripes and the Squares and the up and coming tech companies. This is actually their opportunity. And the same way that Apollo saw when Airbnb was shut down during COVID, they're like, look, this is a 40% margin business with a great business model.
For sure. And I'm not going to lie and say it didn't cross my mind to say, okay, who's going to be desperate and where can I pick up some scraps and invest in good companies? Just like in 2000, buying Amazon and Dell and other companies when all the companies are getting hit, or, buying Live Nation in March of 2020 when, who knew how long the pandemic was going to run. But that only is going to, be available to a select few, because they're private companies, and not everybody's able to take advantage of that. So, it really is going to depend on how much the advanced dividend is. If it's 50% and you get that by Wednesday, okay, because Wednesday's the 15th and maybe payroll's a little late, but that covers payroll for at least some percentage. And then the next question is, how well do they communicate what's happening for the other 50%? If it's all uncertainty and we don't know any type of timeline and there's no ongoing communication, that'll create a smaller contagion, but still a contagion.
So Mark, two questions then. Number one, how are you playing? You just mentioned a little bit about how you may play offense with potentially picking up scraps for companies that are struggling. But can I also ask how you're playing defense for your existing portfolio founders that may have exposure to SVB?
Oh, I'm writing checks. It's that simple.
I mean, you're covering the bridge either way.
Yeah. So I'm only exposed to maybe $8 to $10 million. So it's not, for me personally, I'm fortunate. But like costplusdrugs.com deals with SVB. And so we had, I think, $3.1 million there. And so we're scrambling and opening up accounts and staying up late, talking to bankers to get accounts opened up at other banks. And, I'm writing checks on Monday morning, first thing, to make sure that payroll and payables are covered. And, because this costplusdrugs.com is, my baby right now. I'm not letting it go anywhere. And so, I'm playing offense in every way that I know how. But it's, I think it also was mentioned that there's complete uncertainty. Let me take a step back. Of all the things founders have to think about, when you assign a probability to bank runs, it's rare that anybody's going to assign a probability greater than 0. And so it's, I can't say you can blame anybody. And even SVB, when they're assigning probabilities to bank runs and high profile VCs telling all their companies to yank money from SVB, nowhere do you assign a probability that $42 billion is taken out within 8 or 10 hours or whatever it was. And so this really is a confluence of events that nobody would have predicted. And so those are the types of situations where you hope the government comes in. Now, I don't call it a bailout, and some people gave me a hard time of that, simply because I think there's good assets. And if you're buying good assets and that solves a liquidity problem, okay, that's not a bailout. That's, I think, like was mentioned before, just taking care of the liquidity side of the problem, and your risk is the interest rate delta.
So let's talk a little bit further about how you're counseling the existing startups in your portfolio. Are you telling them to evaluate all of their vendors currently? Should they have, fiduciary duty is to make sure your company is going to continue and you're not going to have interruption in service. Are they all looking through all of their vendor lists and saying, hey, who's got SVB and what should we do?
It's too late. It's too late for that. Yeah. And so, and again, shit happens. You couldn't predict the pandemic. And so you couldn't say, well, why didn't you have, have this done or that done? I just don't think that as much as some people might want to claim otherwise, no one's predicting this. I don't care who you are. I don't care how big a douchebag the CEO is, right? I don't know the guy. I know the SEC did change the laws on the terms of the automatic sell program, so it'll be interesting to see what happens there. I do think it's going to be interesting when we find out if any of the VCs that were actively telling people to withdraw their funding were also shorting at the same time. I don't know what the legal ramifications there are, but that'll be interesting. But there's nothing, sometimes people hit a 94-foot full court shot, and you just tip your hat to them, or in this case, you just, shake your head and go on about with your business.
Hey, can I just say one thing on that, Mark? And
sure.
That I think you're right that nobody within the tech landscape and not a lot of founders were aware of the issues here, because founders don't sit around analyzing bank balance sheets and trying to match the held to security maturities with the equity and trying to figure out the difference between those and the available for sale securities. But it turns out that there were a lot of people on Twitter, including, again, Raging Capital Ventures, who did a full analysis of the balance sheet within the last few months and pointed out that he thought that the Silicon Valley Bank was basically insolvent. Now, look, the central bank is insolvent right now, but of course they can print money. The problem is smaller lenders can't. So, I just want to push back on the idea that.
Oh, you just dropped it out. Go ahead, Mark.
Yeah, I was just going to say, I know where he's going, and I'm not saying nobody understood it, and I'm not saying that there aren't lots of analysts who look at banks and any company for that matter and look to see what their risk factors are. But the only way that there's a difference between their equity declining and their stock price declining and the idea that they were going to become insolvent. Well, they aren't. Insolvent's the right word, because for banks, as I understand it, you don't have to mark to market. So on a mark to market basis, you're insolvent, but on a legal basis, you're not, right? So that's part of the confusion. And so the issue wasn't whether or not they were insolvent on a mark to market basis or not. The issue was, would there be a bank run? Because many a bank has been underwater on a mark to market basis, but as long as there's no bank run, they could just hold to maturity and things would work out. And that's what's happened historically, right? Because when you look at the banks that have less than 25% of insured deposits, all of them at some level have that risk. But not all of them, as was mentioned earlier, are so concentrated. And so had, Peter Taylor, whoever, I'm not blaming Peter, but whoever, the idea that the bank run is a you could assign a probability to a bank run. I just don't see that as being realistic, and that's the difference here, and that's what that closed Silicon Valley Bank.
So, Mark, one question that comes up is, last week when Moody's warned SVB about this, how much does this come down to the leadership at SVB? If you actually look at the article from CNBC, they also mentioned that SVB actually got General Atlantic to put in $500 million, but then were unable to get the paperwork done. I mean, this is unreal. Before the markets opened, they couldn't get the disclosures done, and so everything fell apart. Is this just sometimes this kind of stuff happens, or does this now warrant the government to come in and shore everything up to fix it?
Well, I mean, look, all the above, right? General Atlantic was only going to put in $500 million?
Yeah.
That was a pimple on an elephant's ass relative to what was going on, right?
Yeah.
And so, it wasn't going to change anything. And as the price kept on falling, you've seen these death spirals in public company stocks before as they're trying to raise money selling their stocks. So that's not unusual. But again, it was the concentration of control by very powerful VCs, because by definition, think about the bigger picture here. So by definition, Silicon Valley Bank was loaning money to the investments of the biggest and baddest, if you will, VCs in Silicon Valley, right? So they had a huge amount of dollar concentration because they're bigger, better companies. And there's a huge number of them because these are venture capitalists that are very big. And so it didn't take many demands from the VCs to pull your money out to trigger this bank run. And so it wasn't like, It's a Wonderful Life and George Bailey is standing outside handing out coffee and there's people waiting in line and you just close the doors. This was a huge concentration of $42 billion in 10 hours. You know how insane that is?
Yeah. Mark, do you think this is the Fed playing chess and sucking the froth out of the speculative private equity and venture capital market?
Yeah, but they didn't see this coming.
Yeah,
no. Mark, I totally agree with you that the bank run was unprecedented. We never saw the scale of withdrawals and the fact that the tech community is so well connected that they were able to move quickly, get the money out. I mean, so many companies got money out Thursday morning. It was crazy. But so I agree with you. What I said earlier on, I'm not sure if you're in the room when I said this, but I think the Fed should step in and buy these mortgage-backed securities and just hold it to maturity.
Yeah, of course.
It's a no-brainer. That's what they absolutely should do right now.
Look, by definition, since you didn't have to mark to market, that was a tacit approval by the Fed that you should hold to maturity, right?
Exactly.
So the Fed should just step into the role that they were asking, that they tell every bank to take, right? Hold to maturity.
They're sitting under $1.5 trillion right now on their own securities on their balance sheet, and that they're holding to maturity and they're not marking down because that's their policy.
Well, yeah, some people would say two wrongs don't make a right, right? But still, at the same time, all you're doing is acting as a liquidity backstop. That's all we're asking for the Fed to do, right? Now, is there interest rate risk associated with that? Yes.
I think this happens so quickly. What we saw in the financial crisis, before a bank or broker was put into receivership, there was already a deal in the background in place, like a Bear Stearns, JP Morgan, or say like a Washington Mutual, JP Morgan as well. But the problem here is that this $2 billion, think about it. I know it's a lot of money, but Silicon Valley Bank just tried to do a $2 billion convertible capital raise and it failed on the market. And then the bank run just took speed and it was done.
To be fair, they did that during, just to give more context, they did that as Moody's was downgrading them. That it's not.
Now remember,
$2 billion.
if I read the numbers in the articles right, they were only short $956 million.
Exactly.
Yes, that's correct.
But again, in the middle of when Moody's was saying that you're about to get a large downgrade, and so I do want to on their credit, and so Mark, one more question for you on this, because the political ramifications are critical. You guys are saying now. Vinny was mentioning about how you could just buy the Fed to come in, buy the mortgage-backed securities, take it to maturity. But the question is, if this happened, wouldn't there be a good, beautiful narrative around, hey, they're bailing tech out because tech bailed them out, all about elections, all about the Twitter files, all about all of this other stuff that has come out recently about how the government and tech have been working together? Isn't that the real reason why this hasn't already happened? I mean, if this happened in any other industry.
No, I don't think that's the case, because the Fed, or the FDIC took it over on Friday, less than, 24 hours ago. And so you've got to give them a little bit of time. But you're right, there'll be battling narratives. And the interesting part will be, how the Democrats and the Republicans try to figure out what their appropriate narrative is, because they probably want to do the same thing, But the right narrative, I think, and this is just my opinion, is that the equity holders, the investors, if you will, the equity holders, the bond, let's limit to equity holders, got wiped out. And what was the market cap of Silicon Valley Bank a month ago? Anybody know? I mean, 100 billion?
100 billion-ish, yeah.
Yeah. So the right narrative is investors who weren't paying attention. The people who actually own the stock are the people who are supposed to be paying the most attention, and the funds that own them and the brokers that recommended them, they lost $100 billion.
Absolutely. And debt holders as well.
And that's what I said to you earlier, Danish. I said exactly the same thing. Mark repeated it. That's exactly the
other thing, Mark.
Right. So that's the narrative.
The other thing is that we already have we have precedent. Last October, the New York Fed opened up swap lines with the Swiss National Bank to bail out Credit Suisse's outflows to the tune of $20 billion. And in 2018, with the reverse repos, many would argue they bailed out JP Morgan and every other too big to fail bank. So we need to grow up. People got a lot of losses, bondholders, equity holders. You're making a VC community whole, no different to
Well, I would never say you're making the VC community whole. That would be the worst narrative.
I apologize.
Ever.
Just making the small SMEs that have their only deposit in America there.
Yeah.
Right.
No one feels bad for the Patagonia vest wearing VCs. I promise you.
Right.
It'll be
and why
really
they wear
hard.
them, I have no idea. But at the same time, all those employees and the second, the second level, right? The payables that they don't pay and the vendors that don't get paid and the employees they have to lay off. So the second order, third order, fourth order is what's at risk here. And that's what really needs to be paid attention to. But the headline needs to be 100 investors wiped out by $100 billion, whatever their market cap was a month ago.
Well, let me say,
because then people feel like, because then every day, regular people, if you will, horrible term, but feel like, okay, somebody got torched in all this. The people who deserve to get torched, that should have been the most vigilant, did lose their money.
It's not. So the market cap at the close Friday was $6 billion, and that's at a price of $100. So,
so three times that's $20 billion. Okay, so $20 billion. Yes,
exactly.
Okay.
Hey, Mark.
Okay.
What do you, Grant Cardone? How you doing?
Hey, Grant.
What do you think the effect of Roku is on Monday, having 280 billion over there, and the negative impact to other banks in the region?
So I have no idea on other banks to the region. In terms of Roku, it depends on what the advanced dividend is. So if the FDIC says it's 50%, it's going to be paid by Wednesday. Okay, Roku gets, half of it back, and then depends on how much they communicate from that. If they leave it open-ended, then that is a risk factor for Roku, but no one's going to think they're going out of business. So it just becomes as if Roku, the right way to look at it is Roku lent the FDIC, or lent, literally that's what a deposit is, lent SVB, whatever the delta left over is, that amount of money, and depending on the communication from the FDIC for advanced dividends, that's the term of the loan. So then Roku has it on their books as a loan with that term on it, with the FDIC as the guarantor, if you will, an indirect guarantor. I don't know how you would account for that. So I don't think it's a huge negative, but I'm not going to try to speculate on what the stock market does or how they respond.
And then, Mark, what is the lesson for people with big individuals or companies with big cash reserves? Where do and how do they protect it? I know there's the ICS mechanism, but where do guys and companies rotate money?
I'll tell you what I'm telling myself and everybody else. Shit happens, right? Because the reality is you have to be for a bank run like this to happen, you have to be in an environment where rates are rising quickly, significantly, and somebody has a term mismatch so they can't get liquidity, and then there's a bank run. That's just not going to happen again, or hopefully it shouldn't, probably because we're already at, a much higher interest rate level, and how much higher does the Fed have to go? 1%, 2%, 3%?
Actually,
right?
I might challenge you on that point, Mark. I think that next week, if this issue isn't resolved this weekend, you will absolutely see bank runs happen on other banks. So if
I'm not saying that. I agree with you. I think that's a possibility. Well, you're right. I'll change what I said. You're right in that Signature, and that's wrong to mention a name, but would any of the low insured deposit percentage banks, if the FDIC doesn't communicate well on their advanced dividends, and even what an advanced dividend is and what the payout and return is going to be for deposits, then all those other banks are at risk. But I don't think they have the concentration to be able to generate a true bank run, because I just don't see it being analogous to what happened to SVB.
But the other side of it, there is some PTSD right now. I mean, everyone
for sure.
Who wasn't with Silicon Valley Bank is thinking, oh my God, like Monday comes, if this bank's in trouble. I mean, as the hedge funds come in, they start shorting bank stocks, they can trigger bank runs, and they can they can make this happen because, oh, look, this XYZ bank is down 50% today. I'm taking my money out. And that can.
Well, then if you're the Fed, you just say, look, we're backstopping all these banks.
Exactly.
So the other side of it, outside of backstopping the banks and being communicative about dividends, how do you think, they're having an emergency meeting on Monday. I'm sure you heard Jerome Powell is calling an emergency meeting on Monday. Do you think that this changes the posture for the Fed in terms of rising of interest rates and even, switching maybe from a hawkish to a dovish posture on?
I have no idea. Right. I'm not smart enough to be able to figure all that out, and I don't model that stuff. I just try to help entrepreneurs run companies.
Mark, what about the USDC side? I know you probably got bigger fish to fry, but what do you see there?
I've got a lot of USDC actually, and I've seen what the pricing has done, and I'm not an investor in Circle, but I know Jeremy, and I hope things work out. But again, it just comes down to how the advanced dividend program works. Because once they're able to get access to that capital, then, and I'm sure Jeremy is going to be, distributing to a lot of different banks. So just to build confidence. So I think USDC will be fine, but it went from being a 99% assurity of it, being risk-free to, a 95% assurity.
There's 2 points here. The one point is whether it's USDC or Circle or banks, if there's sufficient equity in the entity that they can take a dilution and shore up the balance sheet or plug a hole, things should be fine. I think that is the case with Circle, most likely, and it's probably the case with some of the other banks. Depends on how deep they were in the losses. So I think it's probably okay from my perspective.
But if banks, I was going to say, but if banks are having to plug equity holes like that, then that's a reflection of bigger problems.
Well, that's the problem. The problem is the Fed's monetary policy was, post-COVID, it's just like they reduced the ratios required for deposits. They made it super easy for banks to just plug liquidity in the market. Then they took it all away in within months. And the banks are like, well, hang on, we were buying 3-year mortgage-backed securities on the hope that this stuff was good for 3 years, and now within within months, it was ripped away. And Powell gave no guidance until after he was,
Yeah, but remember, monetary economics is not a science. It's as much art form as anything. Going back to 2008 when, Bernanke used to wonder how he could do helicopter drops of cash,
Exactly, yeah.
And so, they guess as they go and they monitor continuously. And it's just like running any other business. You go based off of what until something changes and you have to adapt. And I just, we all can cast aspersions and look at models and look at, historical things that have happened historically and try to point to those as an indication of the future. But none of us are good enough prognosticators to really predict.
So you were mentioning that your job is to help founders and entrepreneurs build good companies. What do you suggest to an entrepreneur that was not involved with SVB? Sorry, this is very self-serving. Was not involved with enough not to have their money in SVB. But right now, would you say, hey, pivot even harder to profitability because the VC market is now going to slow down even more? Or is it, let's play offense and let's go?
Hey, I've been a pivot to profitability guy for the last 10 years. Unless you have a direct path for growth where that you're going to be able to grow and get to profit, and you have a direct path to profitability, you're not, I'm always, and this is why I haven't been big in Silicon Valley. I've never been a fan of raising 200 million to generate 100 million in sales. And so, I've always been a proponent of get to profitability and grow as organically as you can, unless you just have something that's so differentiated that you just have to move quickly and grab as much market share as you can, knowing it'll be profitable, knowing you can turn on the profitability at any time. And so I've been very, very forceful with all my companies, regardless of size, to get to profitability and to grow organically, because the VC valuations were so high, it's going to be very difficult for those companies to raise. And where they do raise, and particularly now since debt's going to be even harder to come by, when they do raise, it's going to be down rounds, and founders are so resistant to that, and that creates cultural issues within the company, et cetera, that it's better to be slow and give up growth and be profitable and control your own destiny. And that's been my position for a while. And that's why, I don't have a big hit in, with SVB, because, the deposits were there, like I said, the 8 to 10 million, but, we really didn't have any debt at all with SVB.
Do we see a lot of acquisitions in the next few months? Is that going to be the average?
Yeah.
Like, is that just a for sure that there's going to be a ton of acquisitions?
Yeah, cash is king. I mean, everybody is seeing it. A lot of people, I get, I should say, emails every day asking to buy stock in private companies at a discount, right, to the last round. They're just fast and furious in the secondary market. And to me, that's an indication. So I think, anybody with capital right now is going to be cherry picking companies that are cash poor because they didn't get enough back from SVB with their advanced dividend, or they can't wait. So I think that's going to be a big opportunity. I think companies that can't get the round done and they need capital, you're going to be able to name your price for a lot of companies, and then a lot will go out of business. And that's just the unfortunate reality.
Is this better?
It's worth pointing out.
Sorry, Vinny. One more question for Mark.
Go ahead. Yeah.
I'm sorry. I don't want to dominate all this. You guys are a lot smarter.
Yeah, I think they're enjoying it. Vinny, go ahead, man.
Mark, so one of the things that's worth pointing out to everyone as well is that there are already hedge funds and brokers that are contacting people who've been affected to buy the deposit. So there's an arb that's going on where they're saying, we'll give you 65 or 70% of the money that you have in, and we'll take the risk on collections. And, because they've done the math and, whatever. That is actually a viable option for startups or people who read the cash and, just take the haircut and move on.
It's an option for sure, but just realize, the ARBs aren't dumb.
I agree. Only if you did, maybe it's wait till Monday, see what that number is, whether it's.
You have to wait till Monday. You have to wait till Monday and see what that number is. It's like factoring anything else. When you're factoring your sales, when you're factoring, your inventory, whatever it may be, that's always the worst thing to do unless you absolutely have to.
Let's assume you get 50% back on Monday and then you're able to sell the rest for 60% or 50%. You're only down 25% on your cash. That's a lot easier to stomach than basically.
No, 25%. Think about that. 25% of your cash.
That's
Mark, my point is like if someone said, hey, you get 75 or 80% back of your cash, you can probably like cut costs. You can figure out how to make the company survive. But the money being tied up for years and not being able to access any of it is disastrous.
See, I would tell you that it depends on how well the Fed communicates or the FDIC communicates, right? So if there is a really in-depth communication where they lay out, so what was it? $73 billion is their loan book, right? And we estimate that there is a 8% failure rate, right? So we'll lose on 8. And so based off of that amount, that's 101% coverage between treasuries and their loan book. That's 101%, but we won't be able to sell them for an estimation because the term of their loan book maxes out at 6 years. That's the worst case. We anticipated 3 years. And if it gets below this number, we'll just cover it, right? The more in-depth their communication, the better decisions that everybody who is involved will be able to make. So it's the quality of the communication that's going to matter more than anything come Monday.
Hey, Mark, I had a question for you real quick.
Sure.
This is Adam Quabasi, a big fan of your work. I know we've engaged a couple times on Twitter, but I think one of the big problems here is a lot of this collapse was a product of human behavior and almost like a lack of confidence in the system. And it was, I feel like you need some sort of way for confidence in the system to be restored after this. And particularly, I think one of the big problems is the FDIC insurance of $250,000. I know you've talked about this and tweeted about this. That's great for, your everyday person that's putting $50,000 in the bank and, you're reassured. But 97% of these deposits at SVB were above that threshold. So going forward, what can we do to reassure, even your companies or companies you've invested
of course.
in to have confidence in the system and get things running again? Because right now everyone thinks that we're on the brink of another major collapse, and it's going to be very hard to turn that around in this macroeconomic environment.
No, I agree. $250,000 as the max for insured is insane. But, the reality is there's a de facto insurance just by the fact that the FDIC came in and didn't just let everything collapse, right? And so they have to be more clear on that, on how all that works. And I suggested to somebody, and I know this will never happen, so it's pie in the sky, that banks publish a daily index of their risk factors, right? So if Silicon Valley has only 2.75% insured deposits and 97% uninsured, on a mark-to-market basis, what's the ratio of uninsured to their assets, right? To the liquid value or mark-to-market of their assets. So in Silicon Valley case, it probably went from 1.15, then very quickly got down to 0.6, 0.7, 0.8, whatever it is. But if you're publishing that on a daily basis, at least companies can start making decisions based off their risk factors. But beyond that, there's got to be a policy that says, I guess if I was going to be truly draconian about it, I would say that they have to publish more stringent rules and requirements for the banks, and rather than the CEOs of those banks being at risk civilly, there's got to be criminal penalties. But that'll never happen, right? There's just too big a lobby for that to happen.
Mark, let me ask a question about, hold on guys, just about crypto. We saw what happened with Luna, we saw what happened with FTX, all the FUD around Binance, constant FUD around Tether, and now USDC depegging. What's next? What do you expect over the next few months, and what's your thoughts on the movement towards CBDCs?
So CBDCs, there's enough countries that are dabbling, so they'll be the proof of concept, and we'll see what happens there, right? So if that works out great and the efficiency's there, like people hope, then they'll become more prevalent around the world, and the U.S. will have to do something at some point. In terms of crypto in general, people might not like to hear it, but we're in a lull. We're in a holding pattern until there are new applications that create utility, so that people who are non-crypto have a really good reason to go to crypto. We've seen the adoption of DeFi and some of the value propositions there. We've seen NFTs and the value propositions for collectors and some other applications for NFTs. We've seen some applications with smart contracts that are good, but we haven't seen, we haven't had the Instagram, Snapchat moment that the iPhone had, where people like, okay, it's just a phone with a camera to, oh, okay, there's applications I really that I really want to use, so I'm going to buy an iPhone. We haven't seen that utility-based application or that general usage application. And unfortunately, and this is the real problem for crypto, most of the development is still being done on technical tools or finance-related tools or NFT-specific tools, and nothing is, there's some minor efforts to be, general usage applications or non-traditional crypto utility applications, but not nearly enough. And until that happens, crypto is going to be in a lull, and there's not going to be anything spectacular there.
What about Bitcoin as a mechanism for removing bank counterparty risk?
I don't see it. I don't see it at all. You could, I know you could hold your crypto in a cold chain. But you can also hold cash.
All my Bitcoin is good right now.
Yeah, all your Bitcoin is good, but it's still only as good as people are willing to pay you cash for, right? And so, people, if you have a lot of Bitcoin, someone's going to have to borrow money, or they're going to introduce the time value, their interest rates that they'd have to pay to borrow the money to buy your Bitcoin. And so, you look at what happened in Nicaragua, and until it just didn't take off because it wasn't easy enough. And so while I see Bitcoin as a store of value, I think it's a better store of value than gold. And I own Bitcoin over gold all day, every day. And some people disagree, some people agree. But it's still, its utilization really doesn't happen until it's converted to dollars or some currency. And so you still have all the risks of those currencies associated with it.
Yeah, it's separating spending and saving.
Let me read that bit. Go ahead, Simon.
No, just saying separating spending and saving is a mechanism.
But as long as, look, unless you can organically Bitcoin, so you can earn Bitcoin and spend Bitcoin in Bitcoin, it's always going to have to be converted. And so
that will
while
never happen until it becomes a bad currency and it goes down in value, because that's what makes you spend it. If it goes up in value, you always default to fiat.
yeah,
right?
of course. Right. But that's like gold. And gold, the narrative on gold has always been a hedge to inflation. It's not a hedge to inflation, right? You know, the easy money, you know, buy gold. You know, who's that old school actor that always comes on all the commercials, right? And so Bitcoin is in the same mode. I just think Bitcoin has more utility than gold. And look, even gold is all traded digitally. Nobody actually owns gold unless you own coins. And so, you know, there are two versions of the same coin. I just think Bitcoin is better, but I don't see it as the panacea against fiat.
I've just DM'd Bill Ackman to join, but I want to read out a tweet he just did. I retweeted it on my account. Let me open it again. I'm just going to read out the first two sentences. The government has about 48 hours to fix a soon-to-be irreversible mistake. By allowing SVB to fail without protecting all depositors, the world has woken up to what an uninsured deposit is, an unsecured illiquid claim on a failed bank. And they continues, very detailed thread. I've just sent him through an invite, waiting for him to reply. But if no one steps in, if the government doesn't step in, what could happen over the next few months, Mark?
Well, they've already said they've stepped in, right? That's the whole term advanced dividends. So they already said they're stepping in. The question is to what extent? And if what was mentioned before was true, that the first pass is 50%, okay, that's a little bit of breathing room. But, you know, if your payables account and your payroll account are only being reimbursed for 50%, you know, you still have a hole. So the question becomes, what do they say on Monday for the rest of it? And like we discussed earlier, I think the smart thing to do is to be the liquidity provider, to step in as the liquidity provider for Santa Clara Bank for deposits, because that removes all that contagion risk.
Mark,
Right, Mario,
Mark,
I think the biggest point that Bill Ackman was making was that if you don't fix this today, over and beyond what Mark just suggested, right, with the advanced dividend, then every single person is going to want to pull out of mid-tier banks and go into SIBs, basically go into systemically large banks. You are further and further concentrating the
for sure.
system. Right.
For
and,
sure.
And that's, yeah. And I think it's a tragedy because, as Bill Ackman says in that tweet, Mario, that he's a very financially sophisticated person and he has no clue, you know, what the systemic risk of each bank is on thousands of pages of filings. And so, lo and behold, how are the general populace going to gauge this? I'm telling you, this is really horrible. Go ahead.
The general populace is going to look at it like, oh, I can't, like Giannis looked at it. I can't keep more than 250K in any account, but the overhead and costs associated with that, it's going to cost you more to do that than you'll earn in interest. So it'll be deflationary.
And just
Mark,
remember back in
regardless,
2008, the FDIC limit was $100,000 only,
right?
And because of the financial crisis, they raised it to 250. So even if we go through another banking crisis here, there'll never be a situation where they have, okay, all deposits are insured. The government just is not going to do that, because the message that'll send to the bank management is they can take on more risky type of investments, and I just don't see that happening.
But depends. So, but what they can do is, you know, I guess in the last administration, they changed the rules in terms of it's $250 billion above which you have to adhere to all the Basel rules. And below that, Silicon Valley was just underneath that. So they can lower those standards again so that the risk mitigation is greater. And I think that needs to be a first step. And I'm guessing that that's what they'll try to do.
Mark, do you see a way where Silicon Valley could solve its own Silicon Valley Bank problem without the FDIC?
I don't know why they would, right? Because I think they would rather put the money to work elsewhere. Because again, if you think of the accounting side of it, those deposits that are held now by the Santa Clara Bank that's operated by the FDIC are loans from the depositor to the bank. So that's an asset by definition on the books of all those Silicon Valley companies. And so it really comes down to, you know, where am I going to put my money? I'd rather put my money in the best companies that need capital quickly than trying to take on the Silicon Valley Bank obligations.
Exactly. And then Mark, one question for you, because you were talking about the best companies. Let's talk about the best sectors right now, because this is obviously as many people know, SVB had a big interest in the fintech side, but also on life sciences. Are there certain sectors that you're like, hey, there's going to be more of an effect in these sectors versus others? Like, which sectors are you worried about within the tech ecosystem?
I think everything built around life sciences is huge upside, huge risk, right? And not just about, whether or not they succeed in trials and the like. I just think, the reason I started costplusdrugs.com, and I'll do my little sell my book here, where right now we sell 1,100 different generics. But what we do differently is when you go to costplusdrugs.com and put in the name of the med you take, we'll show you our cost, we'll show you our markup, we'll show you our pharmacy fill fee, and we'll show you the shipping so that there's complete transparency. In the entire life sciences business, in the entire pharmaceuticals business, in the entire healthcare business, there's zero transparency. So I think that the winners are going to be companies who differentiate through radical transparency. The more transparency you're able to offer, down to, hey, if you give Cost Plus Drugs enough business, if you're a Fortune 10 company and you buy all your medications that we carry through us, I'll give you a log on to my accounting system and you can look in every day at my inventory and my accounting. Can't change anything, but you can look to see the day-to-day changes in my operations. I'm fine with that.
In the pharmacy delivery side and pharmacy fulfillment side, totally agree. The question on life sciences, though, is as you were mentioning earlier, you have talked to all of your companies that you've invested in, companies that you lead, that, hey, we're going to pivot to profitability. How does a biotech company pre-FDA approval do that? They're relying on SVB and banks like that. Who's going to put in the money so that we can get more drugs, so that those drugs can then be provided to patients? Sorry, I'm a doctor, so.
But that's a whole different conversation, right? Because there's margin rights and the like. So I think there's money available. What did I read years ago? That of the single molecule drugs, 113 out of the last 116 through 2016 were funded by the NIH at their foundation, right? Yeah. And so going to the whole transparency element, if I'm a life sciences startup and I'm going to the NIH, I'm going to negotiate a little bit differently. I'm going to give up some of my upside and pull a page from Silicon Valley Bank, if you will, and give warrants to the NIH and give shares to the NIH in exchange for that funding, because I think the government needs to start thinking more about America Inc. and representing taxpayers as if they're shareholders and asking for rewards for the money that they invest, which, like we saw with the semiconductor industry, with the CHIPS Act, where they shared in the upside. I got no problem with that. I'm still taking their money if I'm a semi company and I'm bringing it to the United States. Sharing in the upside and being transparent about everything, I think is the new approach that life sciences companies and other tech companies need to take to get government money, so that they can say, and the government can say, yeah, it's tough for us to pick winners and we're probably going to pick a bunch of losers because that's the nature, but we're already investing through the NIH. But now we'll invest more because we're going to share in the upside.
Mark, I had a question for you, and then it leads into what you just said.
I feel like I'm writing a book here.
You should be taking notes.
We all have a lot of questions, Mark. Joe,
that's okay.
You mentioned
fire away. Why not?
You mentioned America Inc., right? And that's kind of my worry here. Is
right.
SVB is really important to tech startups. It's where innovation comes. It's what sets America apart. We lose a bank like this, we lose that structure. What do you see happens to America Inc. in terms of competitiveness?
Depends what the FDIC does. So if there is an unstated but implied insurance for uninsured accounts, which is what those advanced dividends will tell us, then nothing really changes. We just look at what happened with Silicon Valley Bank, and smart people like Bill Ackman adjust, and all companies adjust and where they put their funding, and the cost of capital changes for banks to raise deposits, and they'll adjust accordingly. And I don't think there's a huge impact on the tech industry overall. if there's no communication from the FDIC beyond, here's your advanced dividend, we'll let you know when the next one's coming. When it comes and it shows up at your door, then we have a problem. And then there's a lot of uncertainty. And we see that in global economics. And look, I'm way over my head here. I'm being very clear. These are all just my opinions, right? They don't mean shit. They're worth exactly what you're paying for them. You know, let's just pretend it's 11 o'clock in Dallas and I've had 5 beers, right? And we're just talking, right? But you see this on a global macro basis with China, with their Silk Road projects, right? Where they think there's needed investment in Africa and other places. And Africa is one of the fastest growing economies in the world. In India, they start putting money, even though they're borrowing and their debt to GDP ratio is worse than ours, right? But they'll put money there because that's how you develop relationships and how you build your quote unquote customer base. And so, you know, having confidence in the U.S. banking system is critical, not just to the tech industry, but to the global economy and to the U.S. as the reserve currency. And so, you know, I think Jerome Powell and Janet Yellen are a whole lot smarter than I am at this stuff, and they're considering all this, and they're just not going to take political steps. I think, you know, the politicians will do everything they can to screw all this up. But I think Yellen and Jerome Powell will do the right thing.
And in terms of other sectors, like fintech specifically, a lot of the rails were built on Silicon Valley Bank.
Yep.
You know, how do they respond now? I mean, are they?
That's a problem.
You know,
yeah, that's a real problem. Like, you know, just going through timelines on Twitter and you're seeing Etsy companies that, you know, can't get access to their cash. Right. The ripple effect is enormous there, you know, or there are payroll management companies that can't get access to cash. So payroll on companies that don't even bank at Silicon Valley Bank are going to have issues. So again, it goes right back to the FDIC taking over the liquidity of Santa Clara Bank. And I think that's going to be critically important. And again, we'll find out more. And look, if that advanced dividend, if they're smart and they set the advanced dividend at 90%, then, you know, we just said, oh, this was a fun spaces, but we really didn't need it.
Well, the chances of that are pretty low, though, right, Mark?
No, I don't know. I don't know. I think, you know, they're calling, you know, the Fed's calling an emergency meeting, so they know there's an emergency. You know, and so, you know, what is the marginal cost, right, of doing it versus not doing it? How much capital? So if there's, again, I'm just trying to guess off the top of my head, if there's $117 million in treasuries and mortgage-backed securities, and there was $173 billion in deposits, we know at least 42 million of those are gone, and they're only $1 billion underwater. So that's 131 versus, you know, who knows what's left in the mortgage-backed securities, but let's just say it's $50 billion, right? You put up the $50 billion and, you know, and then you have to say, what's the cost of taxpayers? And unless their loan book of $73 billion is really bad, then, you know, hopefully it's like AIG where the government made $23 billion, but it doesn't take 13 years. It just takes whatever the term of that loan book is. And then part two to that is you hope that the Fed, when they take over the loan book, they don't start calling those loans because that could have a cascading effect as well. So you let them play out to maturity and go from there.
Mark, so I agree with you, Mark, but you know, we all hope someone with your influence can just ask the following question. Why did the Fed, New York Fed, advance $20 billion for the Swiss National Bank in October to bail out Swiss depositors? Like,
you're
I
asking
want
me?
someone to like someone can just please answer that
That
question.
was just that is an ongoing dollar swap that they have of literally unlimited amount of dollars for other central banks who have borrowing needs that just need to plug a hole. That's been ongoing since the financial crisis.
Yeah, I don't know the mechanisms of the central banks, so I'm not the right person to.
So, Mark, I had a question. You mentioned earlier that you know, we talk about depositors and the issue there with Silicon Valley Bank, but you know, the bigger issue I think is the credit lines that all these companies have that they're not going to be able to operate their companies, make their payrolls and whatnot, and those credit lines are frozen immediately. But you mentioned your company, Cost Plus, whatever, that you're going to step in and help that. I think other founders should be doing that as well if they obviously believe in their companies and want them to continue.
Very few. Go ahead, Mark.
Yeah, I mean, not everybody is fortunate enough or blessed enough to be able to do that like I am. And it's costplusdrugs.com. You know, always got to be selling. And so, but you're right. The unavailability of the credit facilities is going to have a huge negative impact on certain companies as well, right? But at the same time, for the credit worth, if the FDIC comes through and for shits and giggles, let's say the advanced dividend is 100%, then the good companies are going to be able to get lines elsewhere. It's just a question of timing.
Ethan?
Yes, I'd love to jump in here. So my company, Perlara, is a PPC, like Cost Plus, our company. Hey, Mark, you're an investor in Perlara. Good to see you up on stage here. So yeah, I just wanted to kind of chime in here. As an SVB depositor, you know, this is kind of very disconcerting to see go down. But thankfully, we're one of the lucky companies that has less than 250K in deposits because we're sort of a cash flow business. We're an atypical biotech. Sorry, my kids are in the back here. But anyway, so I wanted to kind of comment on two things. One, like I also on the investor side, I got, you know, my inbox blew up yesterday with founders telling me, you know, our funds are safe and so on. But I have companies that, you know, have millions, you know, 15 million, one company is tied up in SVB. So I definitely feel the pain of the founders. So I guess the first question is like, where are we going to go on Monday? You know, if we're shopping for banks, where do we go? I was tweeting this the other day, like, should I be looking at credit unions? Like, I don't want to go back to the big fucking banks. Like I left those, you know, I left them in 2008.
No, you know,
I don't want to go back to them. Like, what are my choices?
Hey, you know, when the pandemic hit and PPP was in play, I was sending everybody to credit unions. But the problem with credit unions is they just don't have the big capital base, and there's just as much risk if one big depositor walks away than what happens. And again, it's all relative to size. But if you're looking for $50 million, you almost have to go to the big banks. But do your own homework. You know, big bank is all relative now. You know, what is Silicon Valley Bank was number 16. I saw one person
12.
say 19. You know, yeah. And so, you know, again, you're just going to have to dig in and try to make a determination. You know, personally, I work with Morgan Stanley. I work with JP Morgan Chase. I work with a couple other ones. And so I've got accounts in different places, and I'll call my banker and already have and said, open up accounts for these guys. And so I would just, you know, hedge my bet and open them at several different places, several different leading banks.
Yeah, this is great because this is the advice I'm getting from all the questions I'm getting for all the you know, my portfolio companies is like, where do we go? And a lot of them are in First Republic, and I'm like, or in Brex, and I'm like, why would you be affiliated with any startup, any bank that advertises itself as a startup bank? Like, isn't the contagion still out there? So I don't know. I want to shop around, but yeah, I'd love to hear more advice from people on options.
Remember, the flip side of all that is you're also dealing with the fact that once you go to one of those enormous banks, A, they don't understand your business, and B, they're going to forget your name in 3 weeks.
Hey,
Mark, can I have a question?
You talked about, Mark, the importance of the communication by the FDIC on Monday, but with the amount of distrust in this country right now with the government, over J6, COVID, the vaccine, et cetera, and the amount of divisiveness on the left and right, how do they communicate anything that doesn't get perverted by some group?
It's always going to get perverted by some group. You communicate the reality and the facts, and you know there's always going to be factions that try to distort it and use it to their own advantage. You know, welcome to the USA, welcome to the world, right? That's just the way it goes. And you know, as founders, as investors, as in mentors, we just got to give everybody the benefit of our experience, and you know, then it's up to the entrepreneurs / CEO to take it from there.
Mark, I had a question. Just it's theoretical, but what does someone like Tesla do? Who, for example, one of the companies is called Umbrella, and they make chips for the AI vision on the cars, and they're at risk of not being able to operate. What would you do if you're Tesla and you depend on these like smaller tech companies? Would you step in and
so
help
you're saying a vendor for Tesla is banks at Silicon Valley Bank, and they're at risk of not making payroll? Or?
Yeah, exactly. That's one example. I'm sure there's many. I'm just pointing out one.
Yeah, well, again, it just comes down to what the FDIC does, right? If that advanced dividend is significant enough, you know, like I'll give you a quick story.
What if they don't? Would Tesla ever come? Like, would you ever step in that situation with your own company?
No, I stick, yeah, for my own companies, yes. But like I had somebody, my very first company, we're in business 3 years. I was 25 years old, 26 years old. And I had some lady write out our accounts payable checks and write over her name, go to a drive-through, take the money and run. And 82 of her $84,000 was gone in about 15 minutes. And I had to call up all my different vendors and explain what happened. And they all understood and they were all willing to work with me. And I think the same thing will happen here.
So in terms of the larger sort of economic point here, and I know you're not a macro econ person, but just in terms of your own businesses, is this a 2008 Lehman dropping moment or is it not? I mean, because that's, I think, what a lot of people, regular people, as you were mentioning, are thinking to themselves.
No, because there was a lot of garbage then. Now it was backed by real estate, but the real estate was so, significantly overpriced that you knew that there were going to be haircuts. We don't know that there were going to be haircuts. There was just a term mismatch that created a problem when there was a bank run. And if the liquidity is provided to support depositors, it may be that not all depositors even take out their money, right? They may decide that the Bank of Santa Clara and whoever acquires it is a better place to stay. But back then, not only did you have, subprime, which was garbage, signature loans, but you also had derivatives like via AIG where they didn't even know what all their obligations were. And their balance sheets appeared to be effectively wrong. And so I don't think we're that here. You saw Signature Bank wind down orderly. No one's talking about losing any deposits there. And we know what the total risk profile is here. So I don't see this being anything like 2008.
Hey, Mark, don't you think this is a tech wreck 2.0 in the private equity and venture capital market?
Yeah, it already has been. Yeah, we're already from March 2000, was, June 2022, maybe, I don't know, I'm picking dates. But yeah, that's what I said earlier. The valuations are declining rapidly. Companies are having down rounds. That's one of the reasons the loan book at SVB was so big, because companies wanted to borrow rather than do down rounds.
Pets.com, how many of them are out there? That's the next question.
Yeah, they're, half of them.
Bingo.
So with all of this, with all of this wreckage in the tech ecosystem, is this going to be good in the long run?
Yeah, of course, because, the pets.com of the world are going to fail. The current equivalents are going to fail. You saw it in the crypto. Crypto is a perfect analogy because everybody was going to create a blockchain, and on every blockchain there was going to be somebody was creating DeFi. Then they were creating an NFT market, an NFT foundation, then NFT marketplace. And then, everybody chased total value locked and it made it look like you were bigger than you really were. But at the end of the day, there were no transactions on that blockchain that paid anything to the blockchain. And all of that dried up, and all the, since there were no real returns, all that money dried up. The investment is pretty much dried up. There's nobody chasing crypto investments right now. So it's the exact same thing's going to happen with a lot of these private companies where the valuations were obscene. And since the startups now aren't getting those same valuations and aren't getting funded, you're going to see better companies do better and worse companies not get created.
Interesting. Justin, did you have a question for Mark?
Yeah, and guys, Mark, I got about 3 minutes. Okay, so
perfect.
This has been fun.
No,
Justin, last question from your end. Go ahead.
Yeah, so appreciated. Now, there's going to be a lot of incriminations across the board after all the dust settles. What do you think will be the best defenses as to why things failed, whether it's, one of the executives at SVB or whether it's someone at the FDIC? So someone dropped the ball, obviously, or is this just an anomaly? What are the best defenses in this thing that really explain what happened?
Transparency. Because, look, business people make mistakes. So the SVB made the decision to go long-term maturities at the worst possible time. They're not the first company, the first CEO to make a bad decision in the banking industry or any other industry for that matter, and they won't be the last. If all CEOs made the right decisions all the time, the market would be 99 million. You know, there's a lot of mistakes made, and then whenever there's a mistake made, the responses to that mistake dictate the marketplace. And in this particular case, you saw a very clubby industry that where they're able to communicate very quickly, get ahead of it, and yank out the money. And so, you know, when does a bank run cause a bank to become insolvent? When there's no liquidity because of long-term holdings, or they made investments that fail. And in this particular case, there was a mismatch in term. And so that's how the story is going to be written. And, you know, there'll be case studies saying, you know, there's been zillions of case studies already written, don't mismatch your maturities, right? But in this particular case, it'll be revisited, and, you know, it'll be pegged off as a significant mistake that killed, you know, a $200 billion bank.
Mark, last question as we Ryan, go ahead. Final question. Go ahead, man.
Yeah, Mark, I know that your discussion has been very centered around Silicon Valley Bank.
Oh, shit. Yeah, he dropped out. Mark, I'll take the last question unless someone else has one. Man, I'm going to digress to another question I've asked every special guest we get. I've asked it to Elon. I've asked it to Mark, to Mark Andreessen, to senators. You know, you've been in this space, and I'm not sure about other spaces a few times. What are your thoughts on this live citizen journalism, as Elon coined it, that's happening on Twitter Spaces?
Oh my goodness. Look, in any community, building a community is always difficult. And let me preface this. I'm an investor in Fireside Chat, and I'm a big fan there because it's very interactive and tactile, but that's another conversation. But the challenge, when it's done well, it's amazing, right? So like this type of event, it's great. But what typically happens is it's very difficult for people not to try to come in and take over the communities. And so you get small groups of people that tend to dominate the communities. And you saw that on Clubhouse, and that's where it tends to go south. So where the communities are able to sustain themselves, and you guys have great roundtables like this, I think it's amazing. But the hard part is trying to keep it open while still protecting it from bad actors, if that makes sense.
Yeah, it does, man. I appreciate you jumping in. Feel free to jump.
I appreciate you guys doing this, and thanks for having me on. And hopefully we'll talk again soon. And hopefully come Monday, this will be a non-issue.
Thanks a lot, Mark. Appreciate you giving us the time.
Thanks,
also
guys.
trying to get Bill Ackman. I've just sent him through an invite. Hopefully he'll be joining us. And Ran, I hope you can try to come up again. Sent you through an invite. But shit,
22,000 is that our high mark, Mario?
We had this space. Yeah, we've had Elon got the record. I think he's over 100,000.
That's right. Yeah.
But I want to see if I
then
can get Bill. Bill should be good to come to bring in. Oh shit, Mark is on. Mark, you come back.
That was funny.
Oh, okay, I thought Mark came back on. I was gonna give the mic to Ran.
Was on, and when you said that we hit 22,000, but Elon hit more, he was like, "Well, then I guess I did."
Oh, okay, yeah. What was your question? Not sure if Mark's still listening, Ran, but what was your question gonna be?
I'm just wondering why we are narrowing this discussion to SVB. I mean, I know that we're talking about SVB today. On Monday, we were talking about Silvergate Bank. I don't think that SVB were the only bank that had mismatched durations on their assets and liabilities, yeah? And I feel that, we're talking about this because we're on a weekend. And when we get to Monday morning, unless the FDIC come out before the bell with some kind of great news announcement, I fear that we're going to get a bank run on 5 other banks.
Yeah, my feeling, Mark is definitely a glass half full guy on this thing. I was listening to it. He's super articulate, very quick. You could tell very few ums and ahs. The guy knows how to convey, his ideas.
Guys, has anyone gone through Bill Ackman's tweet? I want to try to get him on to discuss it. He's been in the space a few times, but never on stage. But has anyone read his tweet? Ran, have you seen it?
No, I haven't. Which one? The one earlier about asking for the bailout, or explaining why there should be a bailout. That one.
Let me pin it above for the audience as well. Not sure if Danish, Dr. Danish, you've seen it.
While you're doing it,
Not, I'm looking at it right now.
Mario, while you're doing it, I tweeted something a few minutes ago, and I just think it's just to take a little break and just say, if you've been in crypto, I've been in crypto since 2017, well, 2016, but if you've been in crypto for the last 12 months, you've been through Luna, you've been through 3 Arrows, you've been through Celsius, you've been through Voyager, you've been through BlockFi, you've been through Genesis, you've been through the DCG, you've been through FTX. It's like, come on, man, how many more can we take?
I tell you what I'm quite disappointed with is the lack of belief in free market capitalism and free market solutions here. I think that an industry that's meant to be free market is saying, yeah, we need the government to look after us. We've made bets, and yeah, granted there was some intervention because this is a Fed policy and a Fed problem. But it feels quite disappointing that we're all a bunch of Bitcoin people and all of our solutions are begging for the government to save it, even though they caused the problem.
In the short term, Simon, wouldn't you say that it makes sense for them to do something?
Of course, but we're perpetuating the same Ponzi scheme that got us here in the first place. We're never going to get any closer to a solution until the dollar's dead. And everyone's going to ride that Ponzi scheme forever because it's systemic. And we're just going to roll over, do the same shit. And I understand that, it's okay. I've come to terms with the fact that fiat is Ponzi schemes. And every 100 years, they just switch empires. But at least we've all got an exit from the system, which is Bitcoin. But I feel like the moral hazard and the culture of fiat currency is, a one-way bet and crying to governments every time something goes wrong.
Oh wait,
hold on, guys, hold on, Jesus. Name it quickly. Name it, Grant. I'll give you the mic. Then I want Name Redacted to give us a quick overview of the tweet by Bill Ackman. But go ahead, Grant.
Well, I just wanted to talk about what Bill Ackman's saying in his tweet. If what he's saying is true, the 2-year and 5-year treasuries, the rate on those will plummet on Monday, which could be good for housing. I mean, it needs to happen. But if you have a tremendous amount of supply going to those treasuries, the rates are going to go down. So a guy like me that depends on real estate, likes that.
Yeah, like Grant, you saw on Friday, on the move in the 2-year treasury Thursday, Friday of 50 bips, like down is almost unprecedented. The last time that happened was during the Lehman crisis. So what you saw there, and the whole reason we saw that was because of the Silicon Valley Bank failure. We had a huge rush to safety, a flight to safety, and that's why treasuries were down across the board so big, or the rates were down, I should say. You want me to go over that thread?
So I've just before you do that, Bank of England, we intend to, this just came in now, we intend to apply to the court to place SVB UK into a bank insolvency procedure. SVB's UK's other assets and liabilities will be handled in the insolvency by the bank liquidators. SVB UK has a limited presence in the UK and no critical financial system operations. Just want to update the audience.
Hey, just briefly to revisit what Simon was saying there, I'm just going to play this replay of the short clip we played yesterday. Gary Tan on CNBC, and this is again when the fire is tough, they go running to daddy, which is the government. Here's his answer to, well, can't just public companies recapitalize these investments and these Y Combinators?
I think the financial world does not have the capability to save these companies. Like, we will just wholesale throw out startup innovation in America if we allow these companies to die in the next weeks. And it really is a matter of next week. I have companies that are calling me saying, how am I going to make payroll? All of my legitimate cash that I was using to plan out to be able to even just run the business, was in a bank account that I do not have access to anymore. And so, what the FDIC really does need to do is take into account these people. These are the small guys who If we damage them, it hurts us all. And there will be a catastrophe. This is a national security issue because this is a lot bigger. This will splash across all of the economy.
The national security issue. Look, I get tensions are high, emotions are high around this issue, but Simon has a point. We often go calling to daddy to help bail us out, and this is a rough one.
So Justin, it's telling in the answer, and no criticism of anyone, by the way, because the system's bigger than all of us, and we act with what we're given. And at the end of the day, this is a problem with central planning and interest rates that has caused this issue. But it was all in Mark's answer. Is like, when I asked him, do you feel like Silicon Valley can sort Silicon Valley Bank's problems? He just said, why would we? We'd rather put our money towards something else. And so if the problem is big enough, they can solve it, but they'd rather have higher returns somewhere else than relying on the market. So it's just a psychological destruction of capitalism that we have created in this debt-based Ponzi scheme.
Well, hey, just quickly, before you answer, Dr. Danish, Wahid, go ahead with the
No,
with the
I
news.
mean,
You sent me a message.
just mentioned the news. I will tell you what the market reaction is. I'm looking at the spread bettors, weekend spread bettors, not hugely liquid, but there's been a very big spike in stock markets, Wall Street, Germany, Hong Kong, U.S. tech, everything. So some news in the last 10 minutes just spiked all the spread bettors.
Who has that news? Come break it right here.
The only pushback to what Justin and Simon were saying is that this is essentially picking winners and losers in an artificial, this concept of like, well, this is just how, the system works. And this is, they're going back and crying to daddy and all of that stuff. Ultimately, when you look down to the companies that trusted Silicon Valley Bank to hold their deposits, or trusted getting a credit line from them, or trusted getting loans from them, this breaks the system because they don't know where to go. This is part of the biggest problem. If, of course, shareholders, they should be wiped out. But people that are holding their money in a bank thinking that it's the 12th largest bank in the country that has been focused on startups, and actually, the startups were not involved in the biggest mistake that they made, which was getting long duration mortgage-backed securities that has nothing to do with the startup balance and portfolio that they have, that they're holding their deposits or loaning out to them. I think for those startups to be wiped out, if you're not a crypto startup, if for example, as a startup, you want me to keep my money in something that I can't pull back in real time, you're running payroll, you're running day-to-day operations. For those startups, they have to work within the fiat system today. Those startups don't deserve, if there's no dividends that come out in the short term, they will die, and they don't deserve that.
Well, wait, we discussed earlier in this space that the maturity mismatch is not the main reason for why this is happening. It's the reason in the headlines, but underneath it's a lot more complicated than that. So we can't just say that's the main reason it's the Fed's fault.
But I think on that note, and Mark hit this on the head, right? 50% of these companies probably didn't deserve the money nor the valuations that they're seeing. So this is a flush out of over speculation in companies that never should have received that money in the first place. And that's why half of them will go out of business and the valuations will come back to reality because they were not real.
But Ryan, the point that I'm making is that the half, so first of all, 90% will go out of business regardless. They're startups. And so ultimately, the point is, that we're now doing a flip of the coin instead of a performance-based survival, which, by the way, merit is what runs this country. That's what makes America incredible. And so the fact is that this is not being decided by merit. This is being decided by poor performance from a bank that was being used to hold deposits. And I wanted to make sure that it's clear that this is a random act that has occurred to these startups. From the startups' perspective, this is a random act. This has nothing to do with.
Yeah, what the point is Mark already said that.
Let me just follow that point, Simon, please. Let me just follow up. The one point Mark made was that those that I'll use the term loosely, deserve to survive this will, because either the investors or opportunistic investors that are not in those companies will step in and backstop the ones that deserve to survive, and the ones that don't will have that come to Jesus moment and will not.
Well, he also said that he was in a different situation than others. It depends who your investors are. It depends on your stage, and I think that's a large part of those companies. And by the way, I'm getting like crazy DMs in the back from investors who are fighting what Ryan's saying, because you're assuming that the investors have access to their money right now. Do you think LPs are going to be wiring over money right now? If not, which they won't, just as a heads up, it's going to be difficult. It's different for Mark. He can just take it out of his other bank account and send it over. For traditional investors, they have to pull this money out of LPs, and the LPs are slower to react than the VCs will be. And so this is an entire ecosystem concept. Tone or Simon, I can't remember who was talking. You guys can jump in, but it's just this is a very different situation because of the way that the investment community is. The investment process in startups is structured. The VCs don't have a big bank account they can just pull from. They have to do capital calls to their limited partners. Those limited partners in this environment may not be as open to supporting startups when there's so much uncertainty. I think everything will hinge on Monday, sounds like.
Do you think that is part of the Fed's intent here, is to get that froth out of the market? And this is by default, some of their actions are actually creating the environment they intended. We all knew a credit event needed to happen, and now it's happening, and everybody's surprised.
I can't speak to the Fed's intent, but does anybody else want to weigh in? Do you think that this is the intent of the Fed to wipe out the froth in the market? I mean, it seems like I think
it's a stretch. I mean, let's be honest. The bank run that happened was also reasonably unpredictable. The speed that it happened. I don't think the Fed was targeting and trying to destroy Silicon Valley Bank. That's not what they did. But I think it's it's the result of their actions for sure. The whipsawing of interest rates, the lack of guidance, and Powell's flip-flopping before he got reelected, etc. But I don't think it was intentionally going after Silicon Valley Bank. They're not trying to take out tech this way.
They're not that smart.
They're not that smart, and this is in no one's interest. Like, nobody out there wanted this to happen. This is devastating.
The Fed has a choice. It's inflation or depression. That's what we've created with this debt-based Ponzi scheme. There's more debt than money, and so you have to create cycles. And central planning has never successfully managed those cycles.
Yeah, but
you choose between inflation or recession. That's it.
They don't want runs on the bank. Runs on the bank undermine them as regulators. It undermines the financial system. They don't want to break the financial system. They're trying to tame inflation. They're trying to squash demand. Now, the unintended consequences.
Of course, so you'll roll over until it breaks, but it's going to break.
Exactly. But the unintended consequences of what they're trying to do means the system will break. I would tweet saying that last year, something is going to break, and I think something did break. And I think they have to fix it.
It's all politics.
You're
working towards your 4-year election cycle. You're like, I might as well roll over the Ponzi scheme, allow the next politician to handle it, because if I try and actually do something, I'll get voted out.
Simon, I don't think you're looking at this from an adversarial perspective. Okay, Powell's a Republican. He basically, blank face lied about his policy agenda to get reelected as the Fed chair in 2021, and literally, I think 6 weeks later, he started jacking up rates. So he was printing money. He was letting, whether it's Yellen or Biden, believe that he was just going to be a loose monetary policy chair at the Fed, and they can have whatever budgets they wanted. The moment he got elected, everything changed and ended. And he's a hardcore Republican. So I don't believe that you can assume that everyone's on the same side in the political space. They're definitely not. Yeah, they're not.
Sorry, Vinny, I'm just going to go to Matt quickly from one shark to another and trying to get Kevin O'Leary as well. So we have 3 sharks today, which will be a record on the show. Matt, good to have you.
Thanks for having me. I'm loving the conversation, sort of. But,
Matt, I wanted to start with some basic framing. Do you have any portfolio companies that have been affected by this, and what are you telling them?
I mean, absolutely do. Well, let's take a step back. I think when the crisis first started, end of Thursday, we started talking to different portfolio companies. It was clear what was going on. The problem is that speed, and there was nowhere to go. It's not like these portfolio companies, startups have multiple bank accounts. And with Silicon Valley Bank, if you wanted, if you wanted a line of credit, you had to keep payroll. You had to keep everything with them. So most of these companies didn't really have a choice to have alternative bank accounts. We stepped in by allowing companies to move their proceeds into us very quickly, into our bank accounts, thank God. And we're able to help. But, I have over 100 direct-to-consumer investments. So I can tell by who's communicating and who's not. The 60% that communicated right away, mostly okay. The other 40%, so I still haven't gotten updates from some. So I think the biggest issue here, let's talk about what we know and what we don't know. What we do know is that SVP was providing lines of credit to companies that couldn't have got lines from the JP Morgans of the world. That credit has evaporated. No matter what FDIC does with those advanced dividends, those lines are gone. So that means that the runway for a huge swath of startups has evaporated overnight. And that's going to have cascading effects. They weren't able to raise equity anyway. I suppose it might lead to a bunch of distressed sales, and I don't even think distressed rounds. So that's going to happen no matter what percentage is paid out. I think that's a story that's not being addressed, is lots of layoffs are going to come just because of that fact.
And Matt, which sectors, so, you mentioned DTC, obviously DTC will be affected significantly since they have relied on these lines of credit for their livelihood. But outside of direct to consumer, what other areas do you think are going to be affected more? So, because, as Mark had mentioned earlier, we were talking and he said, not everybody can pivot to profitability, but that has been the mantra for the last year. What do you do with those companies that can't right now?
I mean, that's the irony is, you had VCs funding growth during the pandemic when acquisition was cheap, saying, chase growth, don't worry about sustainable business models. I just had this course at Harvard where we bring up all these DTC companies from around the country. And now the VCs are saying, no, we want sustainable business models. We want vertically integrated supply chain. I don't know how you do that when you're a startup, right? So the reality is it was already impossible. That's number one. So pivoting overnight isn't going to work. I think it affects a lot more sectors than we're realizing because so many different funds, their capital with SVP. I saw a 46-page document that you'd need a microscope in order to read who was on it, but there were a lot of big fund names there. All those funds are going to seize their term sheets, and they're going to invoke this as the reason why they're not going to execute on ones that were already out there. So it's not just companies that had money with SVP that are in trouble. It's everybody that was trying to negotiate a deal that maybe has 3 months of runway. Those deals just went up in smoke too.
And also, as people are looking at vendors, I'm sure you're asking all your startups to say, hey, let's do a vendor review, make sure everybody's solvent. Are you doing that right now actively, or is that
100%? Yeah, we're trying to talk to every single company in the portfolio. You're also giving people breathing room because it's a crisis. So look, the advice that we've been giving is very straightforward crisis management advice that everybody in this call knows about intuitively. Right, number one, show up and communicate. You're not show up and communicate. What's your plan? If you were thinking about in terms of years, now you need to be thinking about in terms of days. 3, you list your credit, and then 4, figure out what the silver lining is. I don't know. Is only the strong are going to survive. I just got an email a little while ago. I won't say which company, and there was so much hopium in this email. I said, "Oh my God! I mean, this company is not going to last, more than a month." Basically, talking about how they're going to shop, to get a line of credit from JP Morgan, to replace the one they had at SVP, and just all sorts of delusion. So I think that's the biggest challenge. A lot of these startups are going to think, okay, I'm going to go talk to other banks and try to replace that line, and there's no chance because those banks rejected those lines when money was free. They're not going to do them now. So the thing I'm looking for is who's facing the reality of it and doing whatever is necessary, and who's allowing delusion to creep into their decision making.
So on that note, you kind of alluded to it, but I'm going to ask, do you think this is good for the ecosystem?
I don't think it's good. I think it pulls forward what was going to happen inevitably when the consumer spending dried up, right? Consumer spending is 70% of GDP. It was going to happen inevitably. America is a house of cards at the moment, laboring under a pile of unsustainable debt. So it was going to happen anyway. But it's not good because there are a lot of great companies here. So it's going to be a brutal Darwinism rather. But I wouldn't say it's so.
And the question of us other speakers, Matt, the system is showing that it's starting to break. Do you think the Fed will reverse their hawkishness? Could they even reduce interest rates, or it's not enough?
I don't think it's enough, to be honest. I mean, I don't have a crystal ball,
Jesus.
but I don't see.
When does it? When would it be enough?
When
what should happen for them?
When they confidently believe inflation's heading towards 2%, right? I mean, just to mirror their language. I don't think it's going to be seen as enough because I think what's probably going to be happen if we look at what market pulled up, and I was reading about that as well with advanced dividends, they'll distribute some of those proceeds. That'll be enough to put a Band-Aid on this crisis. And then it'll be a slowly unfolding car crash, right? With the credit lines scrambling to try to find money. I assume special situation funds right here around the country are licking their chops right now. Some kid is working over the weekend on a deck to raise, a couple $100 million to pick off some of these. The Thrasio type aggregators. I'm an investor in Thrasio actually, but I have no insight into this. But I presume companies that do roll-ups are going to be looking opportunistically. But I think the Fed's going to do enough to put a Band-Aid on it. But not enough to reverse the damage.
So is the contagion effect from this going to be seen 5 years from now? Are we going to look back at this as like the Lehman moment in the startup industry or in tech? Or do you don't think that that's the case?
I don't think so. I think it's going to be one of those massive snowstorms that we all think we're going to remember forever, and then we can't put our finger on when it happened. But in the time being, it's going to stop everything.
Hey, Matt, can I ask a question? If there was no FDIC and the government expressed that there's no help here, do you think Silicon Valley could solve its own problems for Silicon Valley Bank if they had to?
Probably not.
Can I jump into this? I do think there is a chance that one of the big tech companies steps up. I mean, Amazon's been wanting a banking license for years. I think the regulators and FTC and whatever else may get involved to say you can't do it. But Google, Amazon, Microsoft, I mean, Facebook even, they've all got the money to take this in and absorb it. And it would give them a lot of banking coverage. So it's
exactly. Everyone wants a free lunch. That's it.
Well, it's not a free securities to maturity. That's not the issue. So the question not I don't think previously a $20 billion technology giant, and it's part of the ecosystem. So I don't think it's outside the realm of imagination that one of the big guys this weekend steps up and says, "Okay, we'll take it on." The real question.
By the way,
they won't while FDIC can solve it. So they're
FDIC can't solve it.
Matt, do you think? Hey guys. Hey Matt, do you think that that's the case, that this could still be an acquisition target? There's a lot of talk, and there was a Bloomberg article that highlighted that there's a high likelihood that they're going to chop it up and sell the pieces. Or do you think that there's going to be a savior that comes in on Monday? What is your perspective on the market in terms of for SVB?
If I had to guess and make a bet, I actually think it's more likely that some acquirer were to step in, and I'm sure there's frenetic negotiations happening somewhere in the world about that. But that's why I'm kind of looking past that. So let's say that were to happen. There's been a fundamental change in behavior that happened overnight. If you look at the role that SVB played, you could say they were an enabler or they were a facilitator, right? Regardless, these lines of credit throughout the entire ecosystem that these companies depended upon that they literally could not get from any other bank and will not be able to get from the successive owner if somebody were to step in. that's sort of what I'm focusing on. I have a pretty good sense, because the portfolio is so wide, of how many companies were sort of dependent upon those lines to extend runway in an environment where they just couldn't raise capital and wouldn't have been able to for at least 12 months. That's gone. So I just think that we're not focusing on the fact that we lost a market participant that fueled behavior. And what happened?
Oh, Matt, I think you're dropping. I think you're dropping out. Yeah. So I've just got another message here. We talked about some Chinese institution buying up Silicon Valley Bank. Here we've got another tweet from Genevieve saying the $790 billion Abu Dhabi Investment Authority eyes buying Silicon Valley Bank. Could we see a foreign player come in and buy up Silicon Valley Bank, or regulators won't allow that?
They won't allow it.
They won't allow it. And think about how JP Morgan was treated by the regulators after they took over Bear Stearns. Nobody's going to put themselves in that position again. No way.
This is a good segue for Jason. He's on the UCC of Voyager that is experiencing Binance trying to acquire Voyager right now. It's got objections from the SEC, DOJ, the agency that's I forget the name of the agency that does the national security checks. Jason, you able to comment?
Jason's not on stage, Simon, but Joe, you did send me a message about, there's a lot of, so just glitching, it's been glitching for a while. But Joe, you did send me a message saying that you could give a bit of advice for any founders, any SPV depositors to get through their FDIC payments. So maybe you can give us an overview. I know there's a lot of founders here listening to this.
Hey, Mario, what's up, my man? Good to hear from you. What's up, Rand? Yeah, for sure. So as a depositor at SVB and a founder, just a quick note to any other founders out there, like if you wired anything after, it looks like the wires stopped around noon Pacific time on Thursday. So if you are holding out, even if it says approved or sent in there, I wouldn't hold out. It's probably not coming. And also it sounds like, the FDIC, so I did just tweeted it out. If you are a founder that has insured deposits, you might as well go to the FDIC website and fill out, I think it's called the deposit claims. And what you want to do is, it's called the Declaration of Independent Activity. So if you're just a standard C Corp, Delaware C Corp, whatever you are, go ahead and fill that out. So at least you're getting in line in some way. There should be some automation that's in place there, but you might as well go out and fill some of these forms so that you can at least get on Monday that $250,000 of insured money, which I think will go a long way for a lot of the startups of, that seed to Series A, size. And so what it looks like is, for SVB, which is kind of crazy. I mean, they were trying to sell this 1.75 billion in equity to shore up their Basel requirements, which, I'm not sure how old everyone is in this space, but basically there's a capital requirement ratio for banks. Silicon Valley Bank, based on their size, the Basel minimum was 8%. So they have to hold with a buffer of 2.5%, at least 8%. Of the deposits on their books. So if they're looking to kind of fill that $1.75 billion hole based on those requirements, it's really, there were, tens of billions of dollars sitting at that bank, and they were only trying to fill a small hole. So this was just a pure run on the bank, and can happen to any bank out. Is the cascading effect could be pretty detrimental. But if you are like a founder out there, you want to DM me, ask how to kind of get a hold of some of this FDIC, these forms and everything else. And I'll be posting out when there's a couple other forms that will come out, which you need to fill out, which is basically a proof of claim. And the other one is called a claimant verification. Once those are published, I'll tweet those out.
Yeah, cool. And anyone that wants to know more, just DM Joe. He's on stage now. Handles JOE Vez, VEZZ. Danish?
Yeah, so, I wanted to go and do a little bit more of a deep dive on Bill Ackman's Twitter thread. It was interesting and compelling. And I think that, we heard from Simon and Justin and a few others about whether this would be ill-advised and whether we'd be supporting the Ponzi scheme, in Simon's words. And so,
and would love, and Matt is back. I know you DM'd me about Matt. He just came back. So Matt, I'm not sure. Did you read? because we're going to go through it now. Did you read Bill Ackman's? Hold on, he's connecting, and I'm still trying to get Bill. Everyone, just if anyone wondering. But Matt, did you read Bill Ackman's thread? Because we're about to.
No, I didn't. I'll do it while you're talking. And
Cool.
by the way, I texted Kevin.
No, all good, Danish. Yeah,
Right.
Kevin would be great. I'm not sure if Ron, have you guys texted Kevin as well? Oh no, Ron's dropped out. Damn. But yeah, Danish, do you want to summarize Bill Ackman's tweet for the audience and for Matt as well? Matt would love your thoughts on it.
Yeah, it started with reiterating that, this failure that occurred with Silicon Valley Bank will obviously affect the long-term horizon, similar to what Matt was saying, that there's going to be a long-term effect of it. But, he actually represented a different point of view. Instead of just letting it fail, perhaps if private capital can't provide a solution, his words, a highly dilutive government-preferred bailout should be considered. And he was very clear through it. His main point was that shareholders' interests should be wiped out. That's okay. But in reality, if SVB is indeed solvent, it would be a good time for the government to restore the capital of all the depositors and essentially make this into something where they end up owning SVB. And sort of similar to what they did in the 2008 financial crisis. And so, Matt, would love your thoughts on whether this is a good move. Should there be an upside for the government in this? Should they look at this as a bailout?
Yeah, I mean, I look at more as in what results should we be seeking. I 100% agree with him. Actually, I think the government should be solving for making depositors whole. As Mark was saying before, the collateral here is pretty strong, right? So for, I'm not going to say relatively insignificant amount of money, but considering the consequences of all these deposit holders losing all their money, there's not a moral hazard issue here, because we're conflating, were these worthy companies or are valuations inflated? Like, what does it have to do with, Silicon Valley Bank mismanaging, a maturity issue, right? So I do think the government should step in, make depositors whole, alleviate the crisis. Doesn't change what I was talking about before. You still have a paradigm shift that's going to hurt these companies because those lines are going to disappear. But I don't know why these, deposit holders should be penalized for something that they had nothing to do with. So, and we've spent a lot more for a lot less in this country.
But, if we do that, again, thinking about the narrative associated with it, this is another bailout, like a legitimate bailout. Again,
no, it's not a bailout. A bailout is when shareholders get off the hook for things that have gone wrong. This is not a bailout. We have a banking system that's regulated, okay? And you have to, if faith in the system is lost, we all lose. So the regulators have to make sure the depositors are protected, and they set the rules in terms of liquidity ratios that banks are allowed to have, et cetera, et cetera. They've screwed up with the rules. It's on them. And a bailout means that the shareholders get their money. The shareholders are wiped out. It's done. Well, this is not a bailout. This is protecting capital in the system.
So
if I could jump in for 1 second.
Yeah, Matt, go ahead, please.
So I 100% agree. It's not a bailout. It's actually, a victim compensation fund, because the entity that you were entrusting with your payroll and whatnot, went under through mismanagement. However, I think the government, having worked in the government in different capacities, and back in the day, I oversaw the redevelopment of the World Trade Center. I know government's mindset, they're going to be worried that they've effectively increased that $250,000 threshold by, 33 times, whatever the ratio was, right? And that's what's going to make them hesitant and probably too slow. The biggest challenge here is that time is of the essence because of the payroll issue. I'm sure all over the country right now, you have boards that are meeting and saying, wait, as I'm sure a lot of people know on this call, liability pierces the corporate veil when it comes to wage laws. So, directors are going to be facing potential liability if you continue having people work for you and you don't have a line of sight to how you're going to pay them. So speed matters a lot here. And I think the government's going to contort itself worried about the precedent that they've effectively increased that FDIC limit from 250. That to me is the biggest impediment.
So Matt, you're talking about speed.
Guys, just quick. Let me just update, and then we'll go to Slayman. Just 6 minutes ago, California, nothing major, but just worth noting. California members of Congress to be briefed on Silicon Valley Bank failure by the FDIC. So I just wanted to update everyone. Because of the, let me quote, amid jitters about the downfall of the Silicon Valley Bank. Slayman?
Yeah, thank you. So Matt, just a question based on what you and Vinny are saying, because basically what you're saying is that the government should help in this situation to keep trust in the institution. The other side of this is the trust of the people, because an average person will be thinking, I'm already struggling. Again, the government is, I know you're not calling it a bailout, but again, government funds are going towards these Silicon Valley individuals, and money is going directed to them as opposed to people who are actually struggling. So that's that's another optics issue that needs to be considered now.
Yeah, I think there's an optics issue. I don't know how you sell it in. That's about how do you sell it in? How do you explain to people that this isn't, fat cats. This is people that are going to be, laid off because of the contagion. I think the bigger issue, remember Janet Yellen the other day was saying, we are looking at several banks when she was testifying in Congress. She didn't say a specific bank. So the challenge is they have better line of sight than anyone here on this call as to who else might be in trouble. So they're thinking bigger precedent more than just this one incident, where we're focused on this one incident. So Monday, I think, is going to bring a lot more hysteria around, who might be next. And they probably have a much better idea than we do about who might be next.
But does not make it worse, though. Does not make it worse. The bigger it is.
Guys, this is a regulatory failure. Okay, this is a regulatory failure because the way that they set the accounting rules on mark to market, the way the liquidity ratios, the required ratios for banks. I'm South African born. I lived there for many years. South Africa's got some of the strictest rules around capital management and liquidity ratios. And I don't think we've had a bank failure in years. If any, it was probably a very tiny one. The big banks are all secure, and I think we're still one of the best banking sectors in the world. And it's because the rules there are very strict. In the US, because of COVID, a lot of the rules, since 2018 with the reverse repo facility, to 2020 because of COVID, the rules just keep getting looser and laxer and laxer. This is a regulatory failure. This is not...
But Vinny, just based on what you're saying, I mean, that makes sense. But based on, again, this is based on the conversation I've learned in this space over the last 2 days. The main preface that people have been arguing is that, guess what? People were using this bank because of a variety of reasons, but a number of the factors were that they weren't able to get credits in larger banks, so there was more risk. They also used the bank again for risk purposes. So now the risks come to fruition. You've lost out. So why do
I'm not saying just let's be clear. I'm not saying that everyone should get back $1 on the dollar. I'm not saying that. What I'm saying is that there are in the instance of Silicon Valley Bank, there's, I think it's $80 billion worth of mortgage-backed securities that they still hold. The issue here is the timing of those. They sell them right now versus wait till maturity for about 3 years. It's about $8 to $10 billion differential there. Now, this is something that the Fed and the regulators can just put on the balance sheet and hold it to maturity and only have to deal with the time consequence of money in that effect. So the money isn't lost. The problem is there's not enough liquidity in the system, and that's a regulatory failure. Because the liquidity is not there, no bank runs on 100% deposits to reserve ratio. No bank in the world does that. Maybe there's a couple of like religious banks, but no one runs on that basis. It's not profitable to do banking in that way. What I'm saying is that the regulators fail to ensure the banks have sufficient liquidity and allow them to invest too far down the curve, and then not mark their losses to market when the losses started incurring. Because what happened was, just to make it very clear, when the Fed started raising rates, the losses were small, 100 million a year, 50 million a year, whatever. And as the rates get higher and higher, quicker and quicker, it kept getting worse. Now, because the banks didn't have to mark to market because of the rules that were set by the regulators, the banks didn't want to take losses. So they just left it. They said, well, hold to maturity. That was the big mistake. This is a regulatory mistake. And I'm not a banker, by the way. I mean, I've worked in banks in my early part of my career. I'm not a banker. And I don't understand this world as well as some other people in banking, but I can tell you now from the outside looking in, this to me looks like a regulatory failure. This is not, and this imprints on the entire banking system, because if one bank fails, or two bank fails, and 3 and 4, all of a sudden you have the entire system collapsing on us. And
Vinny, what you said makes a lot of sense. Like I'm not disagreeing with anything.
Hey, Solomon, I wanted to jump in with some additional information. Sorry,
go ahead. Go ahead,
Mario wanted to share it with everybody. Mario's going to post it to the top. But we had earlier heard from Daphne and Matt. I'll go to you with a question on this. We had heard from somebody who runs a startup out in the Bay Area who had 3 sources who had mentioned that they had heard from those sources that SVB was going to, obviously $250K was going to be unfrozen on Monday. They've said that publicly. But that 50% of the remaining balance would be dividended to depositors within 1 to 2 days of Monday. with money market accounts actually being 100%, and the remainder will be dependent on future recoveries. Most recovery will be within 3 to 6 months. Matt, do you think that this is the appropriate response?
Before you ask Matt the question, I just want to be clear. It's always important. We have not confirmed this information. It's just that I've shared the tweet above. Anyone that was in the space earlier, you've heard the person that talked about 3 other sources, and we did have 2 DMs as well with the same information. So that's why it's worth sharing. But I haven't retweeted it. I haven't tweeted it either. So it's not confirmed, but it's just worth a discussion. Go ahead.
Yeah, and the real discussion, Matt, is that enough of a response? Is that the right? Let's say that is what is going on. 50% within 1 to 2 days. So obviously the 250K that's insured by the FDIC plus 50%. You had mentioned earlier that are we setting a new precedent? And so Matt, would love your thoughts on whether if this is true, which again we don't know if it is. But
I'd like to jump in real quick. When the moment.
Hunter, just give us a second. We're gonna hear from Matt first, and then Hunter will go to you.
We'll go to you right after Hunter.
I mean, my quick reaction is that it is actually, an intelligent stopgap measure because it takes care of the most immediate problem, which is we got to make payroll, right, while they get a handle on the situation. So it sounds like they have the latitude to set the percentage on the advanced, dividends that they could distribute under their own regulations. So I actually think that would probably be adequate to put their, finger in the dam.
And where would you? This is a really sorry, Hunter. Give me one more second. I have a follow up from Matt. Matt, which bank should they put that money in?
that is, and I don't want to mention a bank on this call.
But would you go to one of the big banks, or would you go? Vinny, give us a second. Sorry, I just want to hear from Matt on this. Matt, where would you have them put it? Like in a bigger bank? How would you counsel them on where that money should go?
It's like hopscotching, right? But I would grab that money as soon as possible through an intermediary if necessary. That's the role that we played the other day, and then JP Morgan, right? I mean, pick the top one with 3 trillion assets.
I got interrupted there as a phone call came in as I was speaking. What I was going to say is, I think the result of this situation means that if you have more than $250,000, you should be moving it into one of the big 4 banks. Because they're literally too big to fail right now, and that's what has and that's a consequence of the government not stepping in to backstop this. So if SVB does fail,
that's Bill Ackman.
Yeah, if SVB does fail, we will see a massive migration of capital into a consolidated position in the top 4 banks because it doesn't make sense to put it anywhere else if you're at risk, and that's what they aim to contain right now.
Yeah, I've just got a question for Matt, actually, just based on what you guys have just said, because if what Matt, and this is very much linked to what your work. So if what Vinny's saying is right, that everything is going to be saturated into the larger banks, and if Silicon Valley and these smaller banks were avenues for innovation, technology, there was more risk, as been mentioned here. Is that going to basically have a significant impact on innovation and technology in the United States?
Absolutely.
I mean,
just a Matt, and then Vinny, you can talk about.
I'll give you my short term and my long term reaction. Short term, there's going to be a lot of great companies that were pursuing innovation that were pre-profitability or not profitability in sight that will suffer dramatically and may go under. That's a short term big hit to innovation. But if you think about a lot of the companies and the business model for Silicon Valley Bank, I'm not sure that was a sound business model. The extent to which they were letting people borrow against illiquid securities, maybe not focusing enough on what's the mark to market of those, of that equity, and just the way they were conducting themselves. I'm not a big proponent of that bank, so I'm not sure that a little more adulting in the room in the banking system is bad for the U.S. economy long term. So my answer would be no. It's not a problem. But I mean, obviously, we don't want everything concentrated in those banks. Here's the bigger problem. We're all talking on this call about, that we think that there may be a flight to the top banks. If that becomes conventional wisdom or prevailing to do in America, what's going to happen to all these other regional banks over the next week?
And also the small, First Republic is another one that people have been talking about. Pacific Northwest is another one that people are talking about. Are we going to see a bank run contagion here?
Depends what happens this weekend. Depends how the thing concludes. Everything hinges on what the outcome is by the time the stock market opens on Monday morning. Literally, they have to have a decision before then of what they're going to do, and it has to be a plan. Because if there isn't one, I guarantee you this will not be the end.
Do you think it really does hinge though on what they do at this point? You have everybody in this country is now watching the news and hearing these headlines that a bank can go under, which is news to them, right? People don't focus on as this is something a risk that they need to mitigate. And I'm not 100% sure
So let's start off with the predominant banks in Silicon Valley. I'm not going to mention the names, but Silicon Valley Bank is not the only bank that did this, by the way. There are lots of other smaller tech banks. Some of them are listed, some of them are not. And it's very easy for hedge funds to run the trade here. Short the stock heavily, create a panic, bank run ensues. Tech guys are very, they're fast moving, so they'll move the money out. And the hedge funds don't care. They'll just short it down. So you can have a situation where people are nervous enough, there's enough PTSD in the market that they'll be running the banks one after another. And unless the only reason they wouldn't do that is they go, oh, the Fed's going to step in, it's pointless. The short doesn't help because everyone feels
we had Mark Cuban on earlier. This is not like 2008. There is no underlying asset like subprime that all these banks are holding that's going to cause a contagion.
Matt, do you agree with that? Sorry, I want to get another point of view on this as well. Matt, do you agree that that this is not like 2008?
I do, but I don't, because I think America has got like a subprime issue, right? If you look at all these entities that were able to raise cash, at inflated valuations, right, that wouldn't otherwise gotten that credit, but for this particular fact pattern, this is exposing or maybe picking at a wound that has been festering. That is the bigger problem. So maybe this is
a startup subprime issue, you would say?
because and now these valuations were going to reset anyway, because it was already impossible to raise valuations based upon a multiple of top line. But now that's just been accelerated. That's the part, to me, it's the pulling forward of the reckoning that was going to unfold over the next 12 to 18 months anyway. It just pulled forward dramatically. That's the 2008 comparison, I think.
The issue, guys, just before I continue, guys, everyone, just hold on for a sec. Before I give the mic to Hunter, just want to say for anyone requesting to speak, because I'm seeing a lot of great names and journalists in the audience, you could DM me because we cannot see the requests. Just a reminder, I haven't done this reminder for a while. And I've got a question, Hunter. I know you've been waiting for a while, but my question that goes to you, Matt, and everyone else, Ryan. Was this expected? Because it seems to have caught everyone by surprise, even more than 08. So I'm just curious if that was expected. If not, could there be other unexpected failures or collapses in the next few weeks?
I would say the trickle down here is now that all of these
We'll go, Ryan. We'll go to Ryan for Hunter first, and then we'll go to you, Ryan. Go ahead, Hunter.
So yeah, I mean, just to put it in perspective, the SVB story, to answer your question, it's much bigger than what they're reporting it to be. They're hiding it because what you have to look at is the political aspect. The Biden regime is currently out trying to get their new insane budget bill pushed through while touting how great the economy is because of their economic policies that are, quote, already, quote, working, which we all know is baloney. But to put it in perspective, nearly every single tech startup either got funded by or through Silicon Valley Bank or kept their money there. So when we actually look at it, and I'm glad Grant Cardone is on here, because if these people actually wanted to make real money, they would have put it in one of his products, because he's actually beat out a lot of these other things with real estate. But no one's talking about that because they've made phony investments. So do I feel that there's like a lot of stuff going on? Yes, but people need to realize that, like, if you look at Western Alliance Bancorp, that's also, it's the secondary market that's going to, everyone is talking about this event that just happened, and no one is looking at the downfall of what's going to happen in the secondary market. Every single one of these companies are not going to be able to meet payroll, any of their other aspects that are going on. So when you really consider this from a global supply chain perspective, there's a lot of stuff that's about to go down the pipeline. And my only message to people is this is why you have to look at the fundamentals of these companies and see where it's going. Because look, at the end of the day, people need to get paid. And when they're not going to get paid through their direct deposits or whatever, and granted, the FDIC, the Fed's going to do an emergency meeting. I mean, look, could we have expected this? Yeah. Anyone that looks at it and see how we're sending hundreds of billions of dollars over to the Ukraine should be seeing this, right? So that's my only message to this whole thing. Everyone's looking at, the big news stories, but look, listen to the real value players at the table. Grant's been on several times. Vinny is speaking truth to fact. Simon's made some great points on this call. And at the end of the day, people need to realize and ask the real questions of what's really going on and what's the modus operandi between why, the Ides of March. That's what we're in right now, the Ides of March. So people need to take a step back and say, what's really going on? What's actually happening? And who are the real players at the table? That's what we need to be discussing right now.
Yeah.
I have a question,
Ryan,
Matt,
do you agree?
sorry, can I just ask Matt a question? So based just off what Hunter has said, I mean, he said he's made it sound very gloomy, that's the Ides of March. But if that's right, I mean, this was the 16th largest bank. So we've got banks which are much more smaller, probably partook in a significant more risk. So is it right that this is actually going to be much worse for the other banks?
I go back to somebody before who was saying that this is a regulatory problem, when you think about it. And I think that is right. I think I would say it's a regulation problem when, that these banks were did not have to mark to market, right? And as a result. And so this is not the only bank that was in that situation. So I think that's 100% right. It is a regulatory issue fundamentally. And so presumably there are others in the same situation.
100% there are others in the same situation. This is the problem, right? Any bank, so here's the issue. Any bank that's basically on a mark-to-market basis is negative relative to the equity in the holding company or the bank itself is insolvent, technically. Just because they haven't marked it down doesn't mean they're not insolvent. And because the rules allow them to carry that to maturity, doesn't mean they're going to survive to maturity if there's a bank run, because they have to pay out the depositors. So this is the issue.
So if it's going to be a contagion effect, Matt, is it the Fed's fault?
Well, I think it's more the failure of the political establishment to allow that change in the first place, right? That's the bottom line. To me, that's kind of academic at this point. That's what was going to happen. There'll be a lot of recrimination. We need to change that. Regulatory. That doesn't deal with the fact that you have all these companies out there in America who won't be able to make payroll unless we do something about it.
But when you say it's a regulatory issue, you mean overall, not for that specific bank. So that, again, doesn't that allude to the fact that other banks, smaller banks, are going to have similar, if not worse, issues?
Yeah, the only reason why I hesitate to say that is because I think you do literally have to go bank by bank and analyze their balance sheet. So I don't want to say that there is necessarily contagion because each fact pattern is different, right? But theoretically, there's a whole cast of banks that obviously were subject to the same, allowances on mark to market.
Matt, who's next on the docket there? You think something like City National might be in trouble? Some of these niche banks?
I think the challenge is you name names like out of ignorance, then you're just putting somebody in a bad position. So I'm not going to name any banks. I think everybody does do their own research. Yep.
Exactly. One of the other big questions, and Ryan, I'll go to you next, is what does this actually, so, Hunter was speaking a little bit about the broader decision-making on the administration. Does this change policy in any way? And Ryan and Matt, would love to hear you guys' thoughts on this. I mean, does it actually change policy? Interest rates and even administration's policy. Go ahead, Ryan.
I don't believe so. And the reason I say that, I think Mario or you asked the question, did anybody see this coming? I mean, it's been a known fact for 12 to 18 months that the Fed would go until something broke. Now, this isn't something broke. This is the beginning of something broke. It isn't, granted, was Silicon Valley the target? Probably not, right? But there was an intent to break something. Now, to take it a step further and to piggyback on Cupid's comments earlier, the valuations that are in the market, whether that be public or private markets, are extremely overinflated. So you have to start thinking about the books of every investment management company out there, even these private investments that are now going to be marked to market at their true valuation or wiped out. What is the impact to the overall equity values in not only private markets, but public markets? There's your contagion, right? Because now if I'm running a book that's $1 billion and all of a sudden I'm marking it down to 750 million, what are the impacts there? And so on and so forth. So is it a bank contagion? No, but is it an investment contagion? Absolutely. And I think fully intended by the Fed to get the froth out of the market.
Matt, how does this change your portfolio? I mean, I'm assuming you're overweight startups. I don't want to tell people what your portfolio is, but I'm assuming you're overweight startups and, since you tend to be very pro-entrepreneur, but one of the questions is, real estate, how does this affect, the other industries now that we're looking at? Are you concerned about a contagion effect to other industries? Real estate in San Francisco is probably not looking good right now, but we'd love your thoughts.
I mean, how does it affect well, I've been pretty publicly with gloom and doom anyway for a while now about the mountain of debt, right? And $1 trillion of consumer credit card debt. The fact that that auto loans are the canary in the mine, right? The number of Americans who are behind 60 days or more is like up 30% year over year. So I've already been living in this reality. I just didn't know what was going to be the first domino, and it doesn't really change because I've been retrenching and I've been focusing on trying to shore up the companies that we really believe in. I frankly have been long early stage companies more so now than ever, because if you can survive this gauntlet in this economy, even more so going forward after this week, then you have something special to offer, and valuations have been reset. So I've been very much less interested in Series C's and B's, which are legacy inflated, and much more interested actually, I know this sounds counterintuitive, in startups and anything early stage because they're actually priced correctly.
But that's a good question. It's the same question I actually asked Mark earlier, which is, for the companies in your portfolio that are doing well, are you asking them to play offense now, where they go around trying to grow through either acquisition or just pumping money in because other people don't have it?
Honestly, my advice has been it's about timing and sequence. That while we are predicting what's going to happen, it hasn't happened yet. Now, of course, we're all in the spaces and it's starting to happen. So it's not the moment yet to be opportunistic because there hasn't been the reckoning. So it's more been about extend your runway, keep your powder dry, run solid businesses, assume you're never going to raise money on as a multiple of top line again for at least 2 years, right? But now is not the time to be opportunistic. It's a time to be prudent and be prepared. That's been the advice. And me as an investor, a lot of great companies. So it's just making sure we have enough dry powder to support those companies to get through this period of dislocation so that then they can play offense. But I don't think it's time for offense yet.
What about dumpster diving? Is it time for dumpster diving and going and acquiring startups that might be struggling with a liquidity crunch?
I mean, I don't know. I hate to look at it like that, right? Because I'm not like mercenary and predatory. I'm not a special situations fund, but I think it's about, when you're an investor and you're as active as we are, you have a pretty good sense of everything about the company, what makes it great. So just because everyone else loses faith, that becomes your own opportunity. So I have been preparing for months now for this reality and making sure we had capital to support the ones we want to support.
There's a question here from the audience member. I'm going to read out the question. There's a much larger monster hiding in plain sight, derivatives and swaps, which are kicking the can for FTDs and naked shorts, synthetics positions, which need to be closed. Any thoughts on this from anyone in the panel?
Yeah, I can touch on that. So what I was going to speak to earlier compared to the 2008 financial crisis and why this is different so far is that in the financial crisis, you had AIG as the behemoth, where basically you had these large hedge funds buying credit default swaps on the subprime mortgage index. And AIG was sitting there as an insurer writing them. They were writing these CDS to the tune of billions of dollars, tens of billions of dollars. This little office in London was doing this. And when the chickens came to roost, and these subprime bonds started failing, AIG was suddenly on the hook for tens of billions of dollars to Goldman, Credit Suisse, Citibank. I mean, you name it, the who's who of banking. So that is why the Fed had to step in there. And, AIG didn't file bankruptcy. You just woke up on a Monday morning to the Federal Reserve announcing that they now hold 80% of the equity of AIG, and they had to do that because if they let AIG fail, the entire global banking system would have collapsed. So we're not at that sort of situation right now. We're talking about Silicon Valley Bank with somewhat liquid assets of mortgage-backed securities. There will be buyers of those. In the subprime 2008 financial crisis, there were no bids for these subprime mortgage-backed securities that these Lehman or Bear were holding. There were no bids, so the Fed had to come in and step in, or the whole banking system would have collapsed. And then the derivative side of the credit default swaps with AIG was just another monster that they didn't even know was like in the background. And in 2008, all these fires just kept popping up. AIG was the big one. We're not. There's no comparison here. This was a bank run. No one could have expected it. I don't see the Fed at all coming in here and just taking on the mortgage-backed securities that Silicon Valley Bank holds. The private market, the secondary market, there's bids for that. The problem here is that the Federal Reserve raised rates so quickly that all these banking institutions and private institutions already held, these mortgage-backed securities and other treasuries, with long durations, but the interest rates spiked so much on those that they're all sitting on these, mark-to-market or hold-to-maturity losses, right? But the problem of why Silicon Valley Bank collapsed was because there was a bank run, and then other people can address how that took place. But I do not.
Good point, Name. I was going to ask Matt, in terms of the...
Before you ask, Matt, I know you sent me the message you sent me, Dr. Danish, message we got as well. I'll read it out. It hasn't been confirmed, but if anyone in the audience can give us clarity if this is true or not. So the message we've had from 3 people so far there in Wellesley, there's a line at First Republic Bank of people withdrawing funds. We haven't confirmed this, but we have 3 DMs. Could be 3 different people the same person trying to spread FUD. But if anyone has more clarity or has more information on this, please do DM us. There's a lot of people in the audience. So if we don't get any DMs, it means we cannot verify it. But Danish, go ahead, man.
Yeah, I mean, that's again, speaking to the contagion effect. If the longer we wait, the harder this gets. I was going to say, Matt, in terms of kind of finding a safe haven for where cash should sit, some people have said, well, look at Bitcoin right now, look at other cryptocurrencies, or specifically Bitcoin has held up while other people, have not. What are your thoughts about where cash should sit right now?
Well, on Wednesday, I would have said a bank, but I guess that doesn't work. So if you're asking me personally, professionally, I'd say one of the major too big to fail institutions is where I'm keeping cash. I'm obviously a believer in crypto, but I wouldn't call that a safe haven at the moment. So I'm purely in cash.
Mario, so we know that one stable coin, USDC, they hold a good chunk of their money at Silicon Valley Bank. So I could see contagion continue to spread or start up again in the crypto field. So I don't know if you want to talk about that, but they have 8% of their cash is now frozen at.
They depegged.
It's less.
They
Depegged. They're back up to 93 now. So they were down to 8.7 to the dollar. Now they're up to 94.
That's not like an immaterial depegging, though, right? If you believe something is $1 and it's supposed to be effectively $1, a digital dollar, and it's depegged by 7%, I mean, it's not insignificant.
Yeah, but I just want to make sure that the audience understands it has nothing to, it's nothing similar to what we've seen with Luna, for example, or other algorithmic stable coins. They are backed, and I wouldn't be surprised if they get out of this and they get bailed out. One of their biggest investors is BlackRock, so it's just good to keep that in mind. But it is pretty major. The markets did correct, but then recovered pretty quickly. It depegged really heavily, still at 9.4, which is really bad, but still it went all the way down to 87. I think that showed a lot of fear, and it's picked up in recent last few hours. But Danish, go ahead, man. And bring up Tone as well. Can you hear me, guys?
I can hear you.
I can hear you.
Hey, Mario.
Cool. Yeah, go ahead. Go ahead, Graham.
I know the focus has been on, crypto and startups in Silicon Valley, but there's trillions, at least $4.5 trillion worth of commercial real estate debt. Blackstone just defaulted on their Finland, which was commercial book, which was $500 billion. And then the last 2 or 3 years, and I brought this up before in these rooms, all that money sitting on adjustables, most of which, not all of it, maybe probably 80% of it is sitting on adjustables, which has exploded, making these aren't zombie companies. These are cash flow companies. I'm not even talking about across the office and the retail stuff and the strip centers, but even across the multifamily stuff, the cash flows. That cash flow is getting destroyed because of the Fed's actions. If this bleeds over into commercial real estate, and Blackstone's already had problems this year, but you got KeyBank, PPIM, Blackstone. I mean, some massive groups that took big positions the last 2 or 3 years because of the real estate. I'm just wondering how that starts affecting that exposure as well.
I mean, I think it's all the same. Like what Matt said earlier, when you have such quick rate increases in a Fed tightening cycle, we've never seen, an aggressive tightening cycle like this in history from the Federal Reserve. And you have rates, mortgage rates jump from say 3 to like in the 6-7%. I mean, this is going to cause a lot of damage. It really is unprecedented. And what Ryan said earlier is he's correct. The Fed's doing that. They're going to keep tightening until something breaks in the system. Crypto has broken. I think we can all agree on that. Whether it continues, who knows? But it probably won't stop with Silicon Valley Bank. And then one other thing Matt said, which I agree, is the real contagion here is with the consumer and the amount of trillions of dollars of debt that the consumer has on, say, credit cards, auto loans, and you are starting to see those defaults picking up quickly.
So, on that note, Matt had mentioned
for all asset classes. Sorry, go ahead.
Yeah. So, I had asked Ryan earlier about what the administration could do. Obviously, we've talked a little bit about what the Fed could do. Matt, will this lead to a change in policy from the Fed or the administration? Are we going to see a pivot from the Fed? First of all, I think, I'd love to get your thoughts on what the pivot looks like, but especially from the administration on the political side.
I don't think it'll lead to pivot. You asked me what the administration could do and should do. To be perfectly honest, I think it should be at a level with the American people, right? I mean, they're $1 trillion of credit card debt, savings rate has plummeted. The only way that inflation is going to get under control if the unemployment upticks, right? Once it does, then the whole cycle starts, right? And then you can't keep up with those payments. You have negative equity in cars, right? So, but we're talking out of two sides of our mouth. The job market's incredibly strong, 3.4% unemployment, but then we're trying to get inflation under control, and those things are at odds, right? And the only way it's going to happen is eventually as unemployment ticks up at least another percent. So no one's really leveling with the American public that it's time to put the credit card away, stop spending, because once that does, now you erode 70% of the GDP. But that's what's going to happen. And I do think this event, again, we can connect the dots, right? They're a little attenuated, but I do think this event is probably the beginning of that happening, because inevitably this is going to lead to companies shutting down. It's going to start with it's going to make people a little bit nervous, potentially put their credit card away, and then the dominoes start to fall. But that's the most important thing. No one's leveling with the consumer.
So one thing I want to say on the Fed,
isn't that the main concern of the consumer, or basically the average American, that you've got this situation happening? Everybody knows that the situation is very bad for Americans at the moment anyway. When you put all of those factors together, what the main concern people have is this the start of, for example, never mind 2008, but even like a greater depression?
So as far as the Fed pivot, Grant and I both commented on this. We saw almost historical move in treasuries in Thursday and Friday. Like there was a major rush to safety there, flight to safety in treasuries, with the 2-year falling 50 bips in 2 days is pretty unprecedented. The last time we saw that was in Lehman. But as far as a Fed pivot, you had the forward pricing of rate hike expectations fell dramatically as well. So the market is now only projecting half of one Fed hike, like one more. Prior to Thursday, the market was still pricing in 3 more full Fed rate hikes. So as far as a pivot, I think what we'll probably see in March, because it's sort of already done, is maybe a 1/4 point hike, and then that will probably be it for this tightening cycle. But I don't see a full swing back into QE or rate cuts yet. Not yet.
What about quantitative easing?
No, not yet. Way too early.
Matt, do you agree that there won't be any QE?
Not even close.
And is it just largely because of the fact that we're still in a hyperinflationary period? Is that what's driving it? And we had the good jobs report. Is that why?
Yeah. You got to understand something about the payrolls number. Payrolls is sort of like a little bit lagging. And when you have these economic cycles, usually the unemployment is sort of the last part of the cycle where spikes and layoffs and whatnot, and that's usually the end part. Matt can maybe talk about that more, but no, there will not be QE as a result of there might be a quarter point hike and then a pause, and then wait for things to sort of play out, unemployment to rise, and then we'll see what happens if it becomes a full-fledged crisis again.
So
Yeah,
Matt,
I think
go ahead.
a quarter point hike and a pause would be, victory. That I think is potentially optimistic, but I totally agree with you. We're stuck in like a headline vortex and we're all very close to it, but nothing has fundamentally changed yet. About what is the battle that they're fighting, right? Bringing down inflation. So I don't see much changing. I'd be happy with a quarter point hike and then a pause, but that's not what I'm expecting.
And so tell us what you are expecting.
More than that. It's like I don't know if this is fundamentally going to change the Fed's behavior yet, because it's going to take time for this to cascade.
Is it because the Fed is using outdated data, like Name Redacted was mentioning? They're using employment. Employment is a lagging metric. Is that partially what's driving this?
I do think that's true. I think the Fed is relying on outmoded data. I don't have the solution. There's smarter people on the spaces who do, but I do think they're relying on lagging indicators rather than leading indicators.
Ryan, do you have a solution? I would love to hear your thoughts.
I don't have a solution, but I do have a question for Grant. And, I think I've shown my hand a little bit where I do believe that we're in, a scenario of just overinflated assets across the board, including residential real estate. And, I feel like this could be the beginning of that, like I said earlier, come the Jesus moment where, valuations come back to reality. And I'd love to know if Grant has any perspective. I think he's already expressed his view of, the commercial side, but how does this not leak over into residential, and, or does it not? And get a little perspective there from an asset valuation.
And Grant, before you take this question, and by the way, Ryan, your mic is still a mess, so if you could work on that, would be great. So there's two things I want to do. First, I want to share that we have photos now from First Republic Bank. Not sure where this one's located, but there are people lining up at the First Republic Bank, which shouldn't be too surprising. We do also have a letter from the Isaac Pollock, which is the managing director at First Republic Bank. Dr. Danish, do you want me to read that out before we continue the discussion? It's a pretty long one, or should we just
go ahead?
it?
I think it's worthwhile getting to the other side.
All right, I'll read out the letter from the managing director of First Republic Bank. Also, as a follow-up to our conversation, so I'm not sure if this is confidential, but we have the right to share it. Also, as a follow-up to our conversation, giving all the stock market noise around regional banks this morning, I am attaching our latest 8K and summary notes below for added insight. This is a remarkable business moment for us, given the struggles at our competitors, but we do expect noisy market conditions for an interim period of time. FRB summary notes. First Republic Bank has consistently maintained a strong capital position with capital levels significantly higher than the regulatory requirements for being considered well capitalized. First Republic has a long-standing track record for exceptional credit quality. Non-performing assets are only 6 basis points of total assets. Since 2000, First Republic's average annual net charge-offs have been just 1/10 those of top US banks. We have a very strong liquidity position, including a strong and diversified deposit base and ample access to additional sources. This includes over $60 billion of available unused borrowing capacity at the Federal Home Loan Bank and Federal Reserve Bank. First Republic is well diversified across geographic markets and the business sectors we serve. Last 2 points, our deposits are 30% consumer and 63% business deposits. Within business deposits, no one sector represents more than 9% of total business deposits. Consumer deposits have an average account size of less than $200,000, and business deposits have an average account size of less than $500,000. Technology-related deposits represent only 4% of total deposits, which is very different to what we saw with Silicon Valley Bank. First Republic's very high-quality investment portfolio is stable and represents a modest percentage of total bank assets. The investment portfolio is less than 15% of total bank assets. Of this, less than 2% of total bank assets is categorized as available for sale. Isaac Pollock, CFP, Managing Director of First Republic Bank. Your thoughts, Danish? You want to kick this off?
What you'd be saying if you were worried about a bank run.
And then two, to answer Ryan's question, do you think there's going to be a contagion in real estate?
Well, I think prior to this, and if you've been to any of my rooms that I've been talking about real estate, there's already BlackRock last March, last March wrote off $1.7 trillion way before the Fed was just starting to push. At the same time, I let go of 4 big deals that I've never let go of 4 deals in my entire career, but I let them go because per year. They were all using adjustable money to pay premiums on the real estate to edge guys like me out because they had an endless bank of money and they could raise forever. In the last 9 months, they had to deny redemptions. They're starting to default on deals. You've seen it across the massive groups, not just in office and retail, by the way, which are the favorite walkaways. But now that money that they were paying 3% for, they're paying 7% for. And so that basically squeezes out their chance of making money in these real estate acquisitions going forward. So, yeah, there has to be an adjustment on those price values. The fact that BlackRock wrote down last March before any of this noise, they wrote it down. To me, they see it coming. And I just wonder if BlackRock's trying to squeeze a Blackstone so they could actually acquire them. That would add $500 billion. They're worth about $1 trillion. But if they could buy them on sale, I don't think the problem here is housing, single family housing, because small investors will step in and buy those houses and fill them up with renters. But it will definitely, to me, there has to be something happen to the big groups, the top 25 multifamily owners in the country, and all the guys that were doing those big development projects of 300 and 400 units around the country that was so popular. Like Austin, Texas has got 34,000 units coming up today with no jobs coming in. So
I've got a question.
They were all planning on 2 things: 3% money and rent growth. And you're not going to have the 3% money, and you're not going to have the rent growth. The last thing I'd like to say is that regardless of what the Fed does with the 0.5 point, if money comes out of banks, if guys like me are like, okay, I'm going to start buying treasuries Monday morning because I want to be protected, then you can't keep the interest rates on treasuries up. They're going to fall regardless of what it does, because the amount of supply that will move to 2-year and 5-year treasuries.
Thanks for that, Grant. Just going back to Mario's letter, what he read out, and so this is a question to you, Matt, because what he said was about 30% of the money in the bank is from consumers. So obviously he's trying to dispel the notion that when people are lining up to get money out of the banks, it won't have as much impact. So the question is, A, is he right in saying that? And the B question is, would that then influence larger companies to start taking their money out?
And just before you answer, Matt, I do want to mention two quick points that are a bit unrelated. So Bill Ackman replied he'll possibly be joining us in a bit. He's just a bit busy now. Also, another point, there are people messaging us, like if your ATM, like Bank of America ATM, you can't withdraw cash, or instances like this, we're getting DMs. First, it shows how, people, the average Joe starting to get a bit concerned, but there's no reason to be concerned. That's not related to what we're talking about here, and there is no contagion to the big banks, so not to be concerned there. And I think it's just worth mentioning for all the DMs we're getting. But Matt, I'd love you to answer Slayman's question about the letter I've read.
Actually, I'm going to let somebody take that. I want to just follow up real quick on Grant's point. I do think on the residential real estate side that the buyers and sellers have been in a stalemate effectively, because there's been no selling pressure, right? Because unemployment has been, holding low. But if you locked in a low rate and you have no selling pressure, what are you trading up to if you're going to swap out your mortgage from 3% to 7%? As the consumer begins to unwind, then I think this incident that we're dealing with right now could be the start of creating that selling pressure and the start of that housing correction. Just putting that out there. I actually have to jump. 2 things. One, I'm going to be on CNN at 5 p.m. with Jim Acosta talking about this topic. So if anyone has insights and then you want to DM me, I would appreciate it. 2, quick plug. I have a new book, Burn the Boats, where I talk about crisis management, similar to this, pandemic, 9/11, other topics. But thanks for having me. I will try to jump on after I do CNN.
Thanks for
Thanks, Matt. Also, Matt, just feel free to, you can pin it above or just send it to me. I can pin the tweet above for the audience as well too. So if they want to join you on CNN or check out the book. Also, if you do hear back from Kevin, he hasn't responded to me. It'd be good to have him as well.
Yeah. He told me he was at a birthday party for a kid. I said, "You go to birthday parties, Kevin?" It's sort of off. but thanks for having me, everyone.
Thanks, Matt.
We're going to be talking all day and night, I'm sure. So I'll join you.
Thanks,
later.
all, Matt. Appreciate it, man. Appreciate it.
Wanted to go back to Grant. Grant, what do you think about Matt's comment around the consumer and how this affects the consumer, which will then affect real estate? Are you not concerned about that?
I don't think the consumer is the issue here personally, but they can stop spending. You know, KKR can't stop paying their mortgages. So I don't have to go buy a home. These guys have to finance their projects, or the project stops. And once the project stops, the jobs stop. The Fed is not going to stop employment. It is the ability to sell your products and services that will stop employment. So when the construction job stops, the jobs will stop. But the Fed has never been successful at stopping inflation in the history, not even back to Volcker. It took 10 years. And if it takes 10 years to pull up a business plan, that wasn't successful.
So that's fascinating, right? Like, if we believe that this is all occurring, so do other people agree that the Fed actually is not the solution here? That the Fed is actually acting out of pocket and that's causing so much trouble?
The Fed is creating this problem, in my mind.
Grant, tell me why you think the Fed is actually
the inflation thing, because the inflation, we're probably already on the other side of the inflation thing, except for the stock market being overly inflated. Housing, if you look at housing over the last 100 years, it's only gone up 1% a year. It's not highly inflated. The mortgage on a home is double today with 7% interest rates. The rents, so the rents aren't inflated yet. You guys just think the rents are inflated because you live in San Antonio and the rents went up $300. But if you go anywhere else in the world, go to Sydney, Australia, and the rents are still cheap in America particularly for what you get. So if the rents are half of a mortgage, and let's say the average rent's $1,300 and the average mortgage is $3,700 before all the other stuff they add on to a mortgage, like the insurance, etc., then rents have a long way to go. Food prices have actually come down over the last 6 months. So I'm like, where's the inflation? We're 20,000 people are online listening to one another for free today without any ads. I'm more worried about the deflation than the inflation.
Interesting. Namer, I saw you unmute. One question actually to follow up. We're seeing the cost of rising interest rates. I don't want to say SVB again for people that are just joining. SVB Bank collapsed not just because the rates went up, but because of poor decision making at the bank. I want to be clear that we're not absolving them of this. But name redacted. Do you agree with Grant that it's not working? The Fed's policy not working to curb inflation?
I do, and I think you know they can raise rates, but the only way inflation is going to come down is basically a recession. They're basically making it the cost of money higher. So what Grant said as far as the BlackRocks, Blackstones, whatever, and the cost to borrow, it's not advantageous to them now. So that's why you're seeing less demand there, in say, the commercial real estate market or whatnot, and a lot of these projects, being on hold. But I think it's not only just the Fed policy that created this inflation monster, it's government policies. I mean, the Fed we've had since the financial crisis, basically zero interest rate policies, ZIRP and QE, pretty much the entire time. They had a couple instances where they tried to raise rates, and then you had this, sort of a crisis in the financial markets in 2019, just before COVID. And then after COVID, you saw the government and the Fed do $750 billion of QE, back to zero interest rates. And then the government printed trillions of dollars and just handouts. And that's the only way to solve the inflation crisis is through pretty much a recession. And that's why.
Or just let prices roll, redact, and people quit buying those products and services and they're like, okay, I'm not going to eat eggs. I'm going to move to some other product right now until, the supply of eggs resolves itself, and then let the market handle it. If houses are expensive, people will quit buying them.
Exactly. And that's where we get back to the fundamental economics here of like that invisible hand in the market. And it will eventually correct itself. But I think the policymakers and the Fed exacerbate it. They make this worse. But people will just do what things will correct naturally at some point.
So do you think the Fed's going to reverse policy now?
No.
So you agree with Matt earlier? The Fed is not going
to. Way too early to even be discussing that. Just because we have one bank run in a collapse, I get it. It's a big deal, but you got to remember back in 2008, we were seeing a possible collapse of like Citigroup, AIG, causing the whole system to collapse. We're so early on in this game. I mean, it's that they're not going to reverse straight to QE right now. They won't say it, but they needed something to break. Okay, in order that's what's going to solve the inflation problem, is the system breaking to some degree.
And Grant, we can't hear you clearly. You're kind of cutting. Your audio is a little bit rough. Go ahead.
Can you hear me now?
Oh, much better.
Since 2004, they've attempted 25 rate increases, okay, before they had to go back and reverse. 25 times they've attempted since 2000 to reverse their stance, and every time they failed. And I like, how can supply push to treasuries Monday and Tuesday and rates go up?
I mean, you saw what Powell said, I think, in the last Fed meeting, when he was asked, God, I forget the question, but he was like, well, are you worried about, inflation getting out of control versus the economy or something in the system breaking? And he said that from a risk management point, that they are focused more on fighting inflation. They would rather have something in the markets break, because then they can do a cleanup job on that with some sort of bailout or whatever they need to do, because that will solve the inflation problem. However, what if they go back to, if the system breaks badly enough and they go back to QE, infinity, we're going to be having this conversation again in 5 years. And it's just, the cycle needs to stop of the Fed, causing all these bubbles and busts pretty much. And then the government policy needs to change too, of just printing out, giving handouts to everyone.
Well, it seems like there's a bailout imminent. It's, at least if we believe what we're hearing from our different sources, it seems like there would be some form of the money is going to go back to, some of the money is going to go back to dividends, some form of dividends back to the deposit holders. But the bigger question is, if this happens at Silicon Valley Bank, and let's say, I'm not going to name other banks, I guess we're not doing that, which is a good idea. If another bank falls, should this now be the policy? Are we making a policy change at the FDIC where 250K is not the whole amount, and now suddenly it's 50% of your deposit? I mean,
well, they did
be a broader policy change
in the financial crisis. They did change policy, because again, back then the FDIC insured limit was only 100K. So to give consumers and businesses confidence in the banking system, they rose the limit from 100K to 250K, right? So, I mean, if we have a banking crisis, they'll probably do that. But no, we gotta fix the wording here. There's no bailout that's happening of Silicon Valley Bank, in my opinion. Okay, could be wrong, but I doubt it. This is not a situation where I would see the Fed step in and buy all their assets. Okay, it's already under receivership, and the assets that Silicon Valley Bank hold are not illiquid. Like, there will be buyers in the secondary market. So as far as the dividends or whatever going out to these depositors, all that's going to come in the form of that FDIC was able to find buyers for their assets. But that's not, the Federal Reserve is not going to be that buyer. They'll find other buyers for these mortgage-backed securities.
Ram, do you agree with this point of view?
Those buyers
Sorry, Danish.
could those buyers be from foreign nations? We've received a number of messages. I don't know if it's been covered yet.
Sure, it could be anyone. A sovereign wealth fund, of course, that is liquid. Anyone that has liquid assets that is willing to bid on the mortgage-backed securities, and they will get them at a haircut to the current market prices as well. Or the FDIC's job here is to find the best price and to do an orderly liquidation of this bank and wind down. But yeah, it could come foreign. I mean, they're gonna sell these assets to the best bidder, right?
But isn't that like a wider problem now that essentially it's another example of America having to basically go to foreign aid in this situation in terms of the banking sphere?
I don't think so. I think it's just they're going to go to the secondary market and sell these assets off to the highest bidder. It's not that we need a foreign sovereign wealth fund to do this. They're just there'll be domestic institutions bidding for these. Believe me. Like, I guarantee you, Goldman has most likely, and other savvy banks have brokers have already sort of sold some of their own holdings ahead of this, and they're simply going to go buy back, at a little bit of a discount and play the arbitrage there, right?
Yeah, I'm happy to chime in here. So
yeah, Ram, I would love to get your thoughts on this.
The focus won't be on the mortgage portfolio. There's a liquid secondary market for that. The questions are going to be around two portfolios. One is the credit facilities offered to venture firms, one, and then the second is the venture debt portfolio. These were business lines that were unique to Silicon Valley Bank. There is no liquid secondary market for that. That said, you're right. Like, over the weekend, major banks have analysts that are going through the data room and they're looking to price whether they want to be in those business lines and what their willingness to pay is. And overall, we're still going through fog of war. I do expect a strong level of recovery, even for uninsured depositors. The FDIC and the banking regulators are focused at the top of the masthead around the public's perception of safety and soundness. As I shared earlier, the FDIC is not going to want to see uninsured depositors have a loss. But anyway, those are the two specific portfolios that are in question. And it's not clear that someone would want to buy that at 100 cents on the dollar. Venture debt is a loan to an unprofitable tech company. You're taking arguably equity-like risk, but it takes the form of credit risk. So anyway, that's a quick take.
Yeah, I would agree. I would agree with that. They'll find buyers for those loan portfolios as well, but they'll be at a discount because there's risk there, right? But yeah, I think that's accurate, and I think it'll be an orderly wind down. I don't think the Fed needs to step in here and guarantee anything or buy anything. There will be buyers for all of this. It's just going to take time. But
just a quick update. Guys.
Depositors,
go ahead. I'll let you finish, Naim.
I would be shocked if depositors get 100% recovery here, because there are already sort of losses at the bank. But it's not going to be wiped out either. They're going to get 60, 70% is my guess.
So just quick update, two things. First, Britain. So back to Silicon Valley Bank in the UK. The UK and Britain's Finance Ministry and the Bank of England are working together to minimize the disruption that could stem from a collapse of the UK arm of Silicon Valley Bank, which has been seized by US regulators, the ministry said on Saturday. That's from Reuters. Talks were scheduled for later on Saturday to discuss the issues faced by British tech companies affected by the collapse. The ministry said in a statement, quote, "The government recognizes that tech sector companies are often not cash flow positive as they grow, and that they rely on cash on deposits to cover their day-to-day costs," the statement said. So that's just a quick update there. Also, just got a reply from Bill Ackman, who's in the midst of family stuff. So if he gets a break, he'll try to join us as he considers this, quote, important stuff. So we'll keep you updated if Bill can join us. Otherwise, Doctor, I'll give you the mic back.
Yeah, so just
Mario, I have to jump, but thanks for having me on. I'm going to head out to the movies, but if you guys are still going tonight, I'll come back. But thank you.
The Kobesi letter, did you have something to add?
Yeah, I I've been, the space has been glitching, so it's been dropping me, but I mean, I think Redacted was talking about this too. I think there's a lot of incorrect information just being portrayed on the Fed front, which is something that we're experts in, have studied for years on end. And I mean, I guess the first thing I want to make clear is that the meeting on Monday is not an emergency Fed meeting. These are routinely scheduled meetings. This has happened before where people think it's an emergency meeting because it's a macroeconomic or microeconomic event. It's completely normal. So I think that's been said a few times just to clear that up. But I also think that inflation is a multifaceted issue that is being oversimplified. I mean, the Fed has been half of the problem with inflation, but it's also, there's two dynamics here. There's supply side inflation, there's demand side inflation. And supply side inflation has been historically bad over the last 2 years, beginning with supply chain issues, spreading to geopolitical tensions and other potential economic warfare on the horizon that have all pressured inflation from coming back down. So even if the Fed were to raise rates to 10%, there's no saying that supply side inflation will alleviate and allow us to maintain inflation at a 2% run rate. And I also think that a lot of people are kind of discounting an aggressive Fed going forward. I don't think this means that we're bailing out anyone right now. I don't think this means that a Fed pivot is guaranteed. And at the end of the day, the Fed still has a whole nother part of the picture here, which is your everyday American that's struggling with 40-year high inflation. If they pivot right now and start lowering rates or stop raising rates, you're going to see a lot of damage on that front. So I don't think it's that simple to just say the Fed pivoted and then now we're going forward. Okay, it's all hands on deck to save the situation. I think there's a lot more to it, and I don't think a 50 bips rate hike is even off the table this month.
What? So you're saying that we're still nothing has changed in the posturing or the Fed planning because of this? Because one, they also had a very
I wouldn't say that nothing has changed. They'll definitely take this into account, but I don't think this also. I mean, there seems to be a growing consensus out there that all of a sudden the Fed is just going to pivot now, and that's just not. It's not a linear thought process like that. There's a lot of different factors at play. There's also a lot of data coming out in this next few days, including CPI and PPI inflation. So you can't just say that this is the event, the whole system is collapsing, it's over, the Fed's going to start pivoting and lowering rates. That's just not a fair conclusion to make, and it's actually pretty dangerous to make as an investor because you're taking a view that could easily be refuted or even not followed through over the next 2 weeks.
I mean, it's interesting. Ram, would love your thoughts on this. Do you agree with his thought that there is no that this is not going to be a sentinel moment that actually changes the Fed's positioning? Potentially, it will affect it, but it's not. Us making that assumption is ill-founded.
Overall, I agree. I'd love to get Michael Cantro's take on this as well. But we certainly were in the higher for longer camp. It's a consideration, right? When there's risk to the banking system, regulators take notice, and you can be sure that their conversations at U.S. Treasury, FSOC, the Council of Economic Advisors, no question about it. But so far, these two bank failures have unique idiosyncratic circumstances. Right? Silvergate was highly focused and levered on the crypto banking sector. They had primarily commercial depositors, as did Silicon Valley Bank. Unlike stickier retail depositor money across a broader, spectrum of, the United States, right? SVB is concentrated on the West Coast. So there are very kind of local circumstances around those banks, also including around how SVB managed its treasury. So I don't think that they're going to pivot or adjust Fed policy on this. The Fed and Powell has been very clear, especially in his prepared remarks. I think markets get confused when they focus on the Q&A, which is oftentimes 45 minutes of the press session. But in the prepared remarks, Powell's being very clear that they're focused on two things. One is getting inflation down to 2% and inflation expectations, not 2.5%, not 3%, not a glide path, 2% full stop. So they'll focus on that up until one of two things happen: either a slowing of the real economy, at which point, of course, they'll ultimately pivot, but that means you've got something like a recession. Or the second is a financial market dislocation, a breakdown in market infrastructure. We haven't seen that yet. That we'll see what happens in the weeks ahead. We've got a VIX approaching 30, but we haven't seen a breakdown in how money markets work, treasury markets work, repo markets work, or the municipal bond market work. Obviously, we had breakdowns of that during the COVID period. But I'd love to hear Michael.
Yeah, I wanted to ask Michael. Michael, I want to get your thoughts on how this changes, your belief on what the Fed is going to do. Do you think the Fed is going to act on this? How do you think they're going to act? Do you think there's going to be a change in consensus estimate? Cantor, I would love to get your thoughts.
Hey, great space. Thanks for having me up. I agree. I totally agree with the prior two speakers. That doesn't mean the market, which has obviously already had a big swing and is now pricing in a rate cut, which, again, I don't take anything the market projects out 6 months or even 3 months as something that can't change on a dime as new information comes in, like a CPI report next week or whatever. So, I think we got to all be careful about what the market's pricing in at any given point because it's been an extremely myopic backdrop. I don't think this is a game changer for the Fed for the reasons that, again, we're just made. When the Fed bailed out LTCM, there was not any inflation problem whatsoever. They weren't in a tightening cycle fighting an issue that we have today that we haven't had in a very, very, very long time, and that's important too. Over the last 40 years, any Fed bailout really hasn't taken place with a 40-year high in inflation, and we're now next Thursday is the 1-year anniversary of that first rate hike, and there's been such a big debate on Wall Street of how long these rate hikes take to impact the economy. And this is a prime example of highlighting that it does take a long time. These issues, didn't show up overnight. I mean, yes, the loss of deposits are ultimately what cracked the story or created the problem. But obviously the problem was all these assets that were tied to fixed rate treasuries from years ago. And so we have, it has been a historically record period in time, and it's been 16 years between today and the last time we had a Fed tightening cycle. We had commercial banks in a tightening cycle, tightening lending standards, and an inflation problem. Which was back in 2006, 2007, which, and those three conditions have literally preceded every single recession. Fed raising rates, lending standards tightening, and...
but I mean, we're already in a recession, no?
No, I don't think we're in a recession. To me, recessions are about labor markets, and labor markets are clearly not in a recession today.
So just want to make sure that we're all saying the same thing here. You're saying that because we still have record low unemployment, even though GDP growth the GDP growth aspect of it is no longer relevant because of that, in your opinion?
Well, GDP's never been the arbiter of recessions. The NBER for forever, which they call a recession, but I mean, and here's the simple reason why. In the first half of last year, you could have, and people argued, we had a recession, which created this entirely stupid, idiotic debate around, they changed the definition of recession. No, the reason you can't have GDP being the measure of recession is exactly because of what happened the first half of last year. In the first quarter specifically, GDP was negative because our imports in the U.S. economy were booming at a time where exports were falling off a cliff, which is ultimately a trade that makes it a negative, and that's why GDP was negative. Were we in a recession in the first quarter of 2022? 1,000% no. And so that's why you can't use GDP, and it's defined as a broad decline in the economy across industrial production, across labor, across again a number of things, income, which we don't have that yet. So no, we are absolutely not in a recession. I do think we are heading into recession because, again, we have those three variables that have ultimately caused and have preceded every single recession, which are a Fed tightening cycle, a commercial bank tightening cycle, and an inflation problem.
So how would you think about portfolio strategy right now in terms of thinking through, and I know that's not exactly what you do, but just if you were looking at a broader strategy, are we in a position right now where people are, just generally about the tech market and the tech ecosystem, it's obviously taken a hit. LPs have put a lot of money into the VC market and have committed on a long-term horizon. I mean, are people just completely overweight venture right now just because of what's going on? Is this a bad time, or is this the best vintage year possible?
Yeah, I mean, that gets more granular. I'm a portfolio strategist, but I don't focus deeply into the nuances many of you do within the tech sector. This is traditionally, historically, and extremely consistently companies that are not profitable. Again, we're talking out the next 12 to 18 months in the public markets are not where you want to be. Those are the unprofitable companies. Obviously, if we're getting credit concerns starting to build as we digest the lags of these commercial and central bank tightening cycles, plus the drag of inflation that is happening on consumers, this is not a time to be taking on risk. Our broader view. So again, I'm the strategist at Piper Sandler. Our broad view this year has been equities are going to be bouncing back and forth, going nowhere, probably at least the first half of the year, between markets hoping the Fed's going to pivot and we're going to get a soft landing, and markets being afraid of inflation and the Fed having to hike more, and a recession coming down the road as a result of that. Ultimately, I think that back and forth ping pong in the markets that we've seen now for a few months is going to break once employment starts to deteriorate more broadly. But to say, well, the Fed's going to bail out or we're going to cut rates now because one bank, which has a more specific and quite transparent issue today, is like saying last year or even early into this year, look, all these tech jobs are getting lost. Why isn't the Fed cutting rates? Because it is very compartmentalized. If this obviously spills over and becomes a broader systemic issue, that'll change things. But I think that depends on what happens in the next few days, to some extent.
And what do you think is going to happen in the next few days, Ram? I'd love to get your thoughts.
Well, just to build off that, I believe short duration investment grade bond exposure is going to do very well. Right now you can get after tax returns through qualified dividends on bank preferred stocks. Now these are well capitalized banks that you have to do your credit underwrite on them that are 6% plus. That's pretty interesting. So you're getting paid to wait. But there are also other short duration bonds, like in the ABS market. Not only qualified purchasers can access this, but these are bonds that deliver monthly P&I. They're amortizing rapidly. So, if spreads widen, as I expect they might, particularly if you see a dislocation, then you can continue to recycle P&I. So you benefit from reinvesting those, the proceeds from the P&I on the front book. And ultimately, when the Fed does lower rates, then those bonds will rally in price. So I think that's a good opportunity. Just overall short duration, high quality. At the same time, though, like what we saw on Friday is a significant dislocation, right? The VIX hit 27. You had all manner of bank stocks trade down, not just the regional banks, which do have some issues that we've been discussing today, but also banks that have really no exposure to this whatsoever, whether that's like a Charles Schwab, for example, down 40%, or Morgan Stanley, which is a wealth management business. I think there's some opportunities tactically around that. And then the third bucket is when alts, and I'm probably most excited about alts. I'm sure Grant can talk about this as well. But I spoke with a private equity real estate investor, and they're seeing opportunities to pick up dislocated investments. For example, you had people that took out variable rate debt, and they already invested $25 to $35 million in, say, a multifamily property. They can't honor the debt. And so those kinds of dislocated opportunities will reward investors that have cash and provide liquidity into this locked market.
Grant?
Yeah, those guys. So let's say it was a $100 million project. They raised $20 million. They have $80 million worth of debt on the project. the developers or syndicators on the deal can't come up with a new adjustment for the market. So they're like, hey, look, I mean, they're called hope loans. Like, hey, Grant, would you take me out for 10 or 12 of the 20 million? And in the next 7 years, once you hit your return plus 15, then I could share on any upside above that. So if you have cash and you have a particular asset class that you're looking at, I mean, that's some of the stuff we're trying to buy right now, and our entire portfolios where some of the big groups have to liquidate in order to start hitting their redemptions. You got to remember, they can't sell their hotels, they can't sell their office right now, they can't sell their retail, but their multifamily would produce some equity. Hey guys. Also, Mario, my brother Gary Cardone is saying, he's in the audience down below, and he's very much international exposure.
Yeah,
he's saying that we're being too myopic. We're being too myopic and talking about America too much, when in fact Europe is completely bankrupt across every industry. I don't know if he's being a drama queen. He has been.
I'll send him an invite as well if he wants to come up. Grant, it would be great to have Gary. And Danish, before you do that, I just brought up Alex, if you don't mind, Doctor. Alex, I've brought you up just to discuss the tweet that you've done. It's got 500,000 views. And I'll read out what you said, and I'm going to pin it above for everyone to have a look at the screenshot you posted. My post-hire employees, this is a dumpster fire, from regulators to SV investors doing nothing to bail out their companies from breaching contracts. Can you give us an idea, Alex, what you guys are going through, what other startups are going through, how your investors are reacting? Just give us an idea of what's happening on the ground. I appreciate you joining.
Yeah, no, absolutely. So thanks for having me. So first off, we do not bank with Silicon Valley Bank. We use Rippling as our payroll service provider. About 1,000 employees across the U.S. and Canada on Rippling.
Alex, you're dropping in and out.
Alex,
you're glitching. Yeah, I think you dropped out. I'm not sure if he's still on stage. I'm trying to find his tweet. By the way, yeah, Alex, I'll let you fix your mic. I'll give you a minute or so, just because you're outside. I think connection's playing up. So I'm just going to mute you, give you a minute or so to fix your mic. Dr. Danish will go back to you in a bit. But I'll go to Chris. Chris, I know you've got a couple of things to say and a question to ask as well.
Yeah, thanks, Mario. So before I talked about gender, I was actually an investment guy for about 18 years in Canada and the US. And so I
appreciate you coming on.
Yeah.
Go ahead. Yeah, if we could, we'll keep the question quick, Chris, because I do have a few people wanting to come up as well. Thanks a lot for coming.
No problem. So in 2008, what a lot of people don't understand, what led to the domino effect where all these banks were going to fail one after the other, were these instruments called credit default swaps, which were essentially insurance contracts. But unlike insurance contracts, which would require capital reserves, these were traded on the derivatives market. And when we had Bear Stearns fail, followed by Lehman Brothers, what happens is AIG, for example, had been writing these contracts, earning premiums every time they sell them. But when Lehman Brothers went under, they were then on the hook to pay out billions of dollars to people who had bought these credit default swaps. They don't have that kind of liquidity. So then AIG would have failed. And all these other banks as well were writing these same financial instruments. After that, I know the Fed and the government put in place some requirements to not have this happen again. But is anyone aware of what these capital reserve requirements are? Because this was something that no one had known about. These were little corner offices of these huge firms writing these contracts day in, day out. And that's what was going to lead to the total and complete failure of the banking system. And it's always something you don't expect that hits you. And I know there's going to be more of that with this crisis as well. But does anyone have any info about how these CDSs are currently being regulated?
I can chime in on that. I was at Merrill Lynch in the 2008 crisis, and it was upfront and personal. So those risks are off the table, right? The generals fought the last war. They put in regulation. Dodd-Frank, which was passed in 2011, addressed a lot of this. So some of the fixes they did is, one is they moved derivatives from an over-the-counter market to a centrally cleared market. So ICE, for example, major clearinghouse, is where interest rate derivatives are netted and settled. So the counterparty is no longer bilateral. It's not AIG versus Merrill Lynch. It's everyone faces off with ICE. That's one. The second thing is you had the Basel 2.5 regime, which introduced tier one capital requirements and raised the capital requirements for banks. So banks went from 25 to 30 turns of leverage down to, call it like 10. Incidentally, there's a proposal out there for Basel III to increase the tier one capital requirement to 15%. By the way, I think that's a good idea. It will lower, the return on equity that a bank can generate. But there are also other rules that were created as well. By the way, Lehman, of course, was an investment bank and not a bank also. So it's, it's a very different comparable to kind of the issues we have today. But I don't think you're going to see any kind of derivatives blow up in this market.
So I wanted to.
Thanks, Ramaju. Yeah, I want to go back to Alex if you don't mind, Danish. Alex, your mic is good now?
Yeah, I'm good now. Hopefully you can hear me.
Yeah, I can hear you, man. Go ahead.
Okay. So as I was saying, so we use Rippling as our payroll provider. They debited our bank account and then early Friday morning, of course, payroll was not deposited. And they sent out an email talking about operational issues with their bank without even identifying the Silicon Valley Bank risk. So the head of HR came to me. I was aware of what was going on the previous day and immediately jumped to the conclusion that they used Silicon Valley Bank. We checked the routing numbers, confirmed it, and went into crisis mode. My frustration with Rippling is they just were not transparent. And I went at it with Parker eventually online later in the day when he was pretending that was the plan all along. And so them have making us whole and making payroll by Monday for all of our employees. But it's a really tough situation for sure.
So the issue was that Rippling is using Silicon Valley Bank to hold payroll.
Alex, you're muted.
So yeah, they're basically a custody of our payroll for about a 24-hour period.
Exactly.
So
what did you want them to do, Alex? Well, what do you think that they should have shared that, hey, we're in trouble with it because of SVB? We use Rippling for our payroll. We got some message from them. Do you think that was in response to you calling them out, or did they do that beforehand?
So the message they first sent out was, conveying basically the known lie that Silicon Valley Bank told them, and they passed it along. And to me, I think that was an immature decision. I've been there, done that when I was younger, and you should filter out crap from your partners and not pass it along to your customers. And so Thursday night, if they truly were making plans to move to JP Morgan and building the infrastructure, which was the discussion later in the day, they should have communicated to their customers Thursday that this is what we're going to do. We're going to honor the payroll if that was the plan, which I do not believe was the plan Thursday. And there wouldn't have been a crisis. That's what we do when we communicate. When we screw up or something's our responsibility, we just come out and tell you, this is what we're going to do. Even if it's going to be a little messy, this is what to expect. But they left us to expect
Conrad. One second, Alex. If anybody knows Parker Conrad in the audience, please do ping him. We'd love to hear Rippling's point of view, Alex, just to keep it balanced.
Yeah,
but
for sure.
This is a very big deal for people that don't understand what we're referring to. Is the fact is that Rippling is used on the back end for a significant number of startups. When you are about to pay payroll, even if your bank is not SVB, you're using Rippling. You send your money to Rippling. Rippling then takes that money and sends it to your employees. When Rippling takes custody of your money, they put your money in Silicon Valley Bank. They did. And so what Alex, Alex, I'm sorry to paraphrase what you said, but just so that, not everybody's a startup founder that's listening to this, and so, what you're saying is what was told to you is like, hey, everything's fine. But in reality, you expressed the concern to them that, hey, 1 second, why are you guys doing this with our money? Is that a fair estimate of what you're saying?
Well, it was more like they knew the risk on Thursday, that they were with Silicon Valley Bank. Everyone knew what was going on Thursday. To act like you didn't know that there was going to be a bank run on Thursday, I'm sorry, you shouldn't be running an organization. It was clear as day it was happening. And they knew if they were going to move to JP Morgan, they should have communicated on Thursday to their customers. We're not a small customer of theirs. And they should have communicated across the board. But even on Friday morning, talking about, our bank is telling us they're going to make payroll by the end of the day. It's an operational issue. come on, it's not a good look.
And do you think that this is a common situation I know this is a common situation for many startups, but wanted to get your thoughts on, does this lead to a contagion effect in your opinion? We've had a lot of, we've had Mark Cuban, we've had another shark on the stage. Wanted to get the founder perspective. How is this affecting your business today?
Yeah. So before addressing that, just one other thing I want to mention about payroll, why it's so sensitive. Making payroll as an employer, you have a personal responsibility if you're the owner of the business. You've got legal exposure. A lot of our employees in California are two litigious states. Us missing payroll, which we missed payroll on Friday. Rippling missed our payroll. There's legal risk.
And you weren't even connected to SVB, just to make sure people understand. This had nothing to do with you making the decision to keep your money in SVB. This was completely separate.
Yes, exactly. It was funded on time from our side. Payroll was not made. And so when I went to our employees at, I think about 10 a.m. To tell them the situation, I've learned lessons from the past. Be abundantly transparent. Tell everyone the absolute raw truth at all times, and you will advance your success. And so I told all of our employees globally what was going on and not to expect payroll today, even though at the time we're still being told payroll is coming. And want people to be prepared. And then at the same time, we were working through how we were going to address, essentially double funding payroll. Was Rippling able to deliver it through their new banking connection, or we're going to have to do it manually and do a bunch of bank wires? But that's what we were trying to figure out. At the same time, trying to put pressure in every way possible. And that's why I took Twitter.
So some of
Alex and Danny, question to both of you actually. Just to what you just asked now, and then you can carry on. So when you explain this process where somebody isn't even using a SVB bank, Silicon Valley Bank, but is using, as the example you gave, how many people? What's the factor of the number of people who are using what you use in terms of Rippling?
Well, I think Rippling has pretty significant scale. I don't know what's their average employees are there. Imagine that payroll number that was caught is in the hundreds of millions of dollars at the very lowest level of Rippling scale, just for that payroll period. So we're talking about a significant impact. I have no idea who any of the other smaller payroll providers that are tech-enabled services use. They use Silicon Valley Bank, I would assume so. But there are custodies or intermediaries that I'm sure use Silicon Valley Bank that are holding funds for other businesses. But to answer the question
around the contagion effect, I know you were about to get to that, but just to remind folks, if all of the fintech companies, which is what Alex is referring, not all, but like the large majority of the rails in the fintech company, whether it's around payroll, whether it's around transactions, whether it's around credits, whether it's around BNPL, buy now, pay later, if a lot of them are using Silicon Valley Bank, what happens to the broader industry? And then Mario, will go to you. Go ahead, Alex.
Yeah, I'm just going to mention first Parker Conrad. We've sent him an invite to join. If anyone knows Parker Conrad, it would be great to have him on stage. He's the CEO of Rippling. In the meantime, before giving the mic back to you, Doctor, and Alex, I just want to read a quick piece of information here. There's an article came out from CNBC. I'll read out the 3 key points. The heading is Investors Implore the Government to Step In After Silicon Valley Bank Failure. 3 key points. Voices from tech and finance are increasingly calling for the federal government to push another bank to take over the failed Silicon Valley Bank to protect uninsured deposits. Their main concern is that a failure to protect deposits over $250,000, which is far majority, could cause a loss of faith in other mid-sized banks. Some observers called out the irony of the venture capital community, calling for government aid after many VCs spurred their portfolio companies to withdraw money after SBV. We know the rest of the story. So I just want to give that quick update. We'll keep sharing new information. But I'll go Alex, to Alex. Go ahead.
Yeah. So Alex, how are you thinking in tech industry at large now?
Yeah, so I think there's 2 parts of the contagion. There's financial contagion, but then there is the kind of the economic contagion that has nothing to do with other fintech businesses. Like to point out, we have received countless emails from tech companies changing their ACH payment information. These are biotech companies. These are SaaS businesses, all different types. Some could be critical infrastructure for many businesses. They're not for us. But I think there is an immense fallout that the average person has no idea how much infrastructure our small companies or mid-market companies that bank with Silicon Valley Bank that may not have another banking relationship and are essentially insolvent today. So that's a big risk factor.
Like for sure, there's a lot of loss, damage, and pain, and it's absolutely awful for the sector. I guess my question is that systematic to the level that it rises at a government intervention? I'm not sure.
And Ram, we can't hear you clearly. Could you get closer to the mic?
Yeah, sorry. Is that any better?
A little bit.
Yep.
All right. So look, like we talk about this word contagion. In 2008, the contagion mechanism was credit contagion. So if Bear Stearns blows up and Merrill Lynch has a loan to Bear Stearns, the Bear Stearns loan is worth zero. Now Merrill Lynch has an impairment. And we saw that in crypto, of course, with DCG, Genesis, BlockFi, Voyager. You had this credit contagion loop. Here, you have destruction that's unnecessary towards startups that didn't do anything wrong, and they thought they were making good decisions, unbeknownst to them, right? But this is public confidence is the primary risk factor that rises to systemic level. If people lose confidence in their banks, that's what the major market prudential regulators will focus on. I do not believe we're at that level yet.
Yeah, no, I agree with you. But one thing I will point out that I've heard from my network and also from my personal bank, there's a significant move out of regional banks. Some of the ones that have been killed in the stock market on Friday, I know for a fact there's a bank run there from some of their largest business customers. So I do think this week we're going to see regional banks struggle with massive inflows going into the big banks, JPM, Citibank, Bank of America.
Darren, do you agree with that? And actually, Ram, I want to get other people involved as well. Darren, do you agree with that premise that we're going to see small commercial banks or local banks really struggle as people flight to quality?
Yeah, I mean, I would just say that the run on the banks was real, right? There was just a flood of phone calls that were happening, telling everybody to pull money out of Silicon Valley Bank as soon as any of the rumors started, and whether or not that was the right move to take, that was what was done. So it was certainly a wildfire effect down the telephone line to wire out everything that you could from Silicon Valley Bank on Thursday. And then, I think the other thing is this just kind of highlights the IntraFi network. So if you're not familiar with the IntraFi network, they have a patent that does FDIC insurance above the $250,000 limit. It doesn't look like Silicon Valley Bank was a part of that IntraFi network, but I think this whole FDIC insurance is really going to be put to the test because this is one of the largest banks to go under, right, since 2008. So FDIC needs to come together, negotiate something. I'm just hearing rumors, but that's just my take overall.
Michael?
Yeah, I just think the starting point for this is also really important from a behavioral, human psychology perspective, because I speak to institutional investors all day, and the one throwaway comment everyone has made, and we all just kind of sit around the table and agree, oh, we're not going to see an 2008 crisis. We're not going to see a banking problem. That's not where the excesses are. That's not where the problems are going to show up. And I agree, again, with all the comments were made before. This is not 2008, or it's a different problem for sure, and it'll have different outcomes, and we'll see how it all plays out. But just the perception and pricing or mispricing of risk has clearly been so grossly off, and I think that's just a broader problem with the whole equity markets and financial markets in general, is that risk is just so grossly mispriced because, again, it's been 16 years since we've seen the onset of a real cyclical recession. And, when people were looking for risks, no one was really looking within banks. So this is, how, even if this goes away in 2 days, obviously there's going to be a mark left on sentiment And I think that this is not a capitulatory event in investors. This is a wake-up event that is going to roll into and affect psychology of investors going forward, as things, again, from a macro perspective, likely don't get much better because of all these tightening cycles that are starting to get digested finally.
Yeah, and want to make sure to Aaron to get your thoughts on something. I just got a message on the back end about USDC. Is there any update? Is it repeg? People are saying it's repeg right now. Is that correct?
It's rebounding actually pretty hard on the decentralized exchanges. We're kind of sitting around, depending on where you're looking, around 94, 95 cents.
Yeah, it's at 94 by the looks of it here.
Yeah, so that's pretty epic. It's a really positive outlook. I actually think the USDC depeg kind of talks a lot into what some of the other conversations that were happening on here were, which is that the market psychology, right? Like we get on here and we talk about fundamentals and all these numbers and how this works, but the markets now, we've provided a lot more access to retail. They don't always act as rational. They look at something and they get scared. They hear something, they get scared. I was on this space when it started. I crashed out because it was 6 a.m. in the morning when I got off. And between then and when I got up, I got 3 messages asking, "Hey, I just saw this bank collapsed. What does that mean? Do I need to take my money out?" And I'm in Spokane, Washington, right? And these people bank with Chase and like Wells Fargo, and that's like a really scary thing when I have people ask me that all they know is that a bank collapsed. So like shoring this up and getting that market psychology, saying, "Hey, no, everything's okay. This is a one-off event. You don't all need to take your money out of these banks," is going to be a big play in how we solve this. I do have a question though I know there's at least 2 other founders on here. With this happening, are you guys doing anything or gonna put any plans or redundancies or backups in place in the oddness that this maybe happens ever again? Just kind of curious there.
Yeah, I mean, Tom, if you want to weigh in, you can. I can tell you what we're doing. We're keeping our money in FDIC insured banks, but most of it's in a large bank, and the money that's not in a large bank is capped at $250. Tom?
Yeah, thanks, Doctor. I wanted to just follow up on what Mad Scientist was saying and give everyone a little sneak peek of behind the scenes what was going on Thursday. Good friend of mine, he was a VP of finance at one of my previous companies. He's now with a growth stage company. I'm talking could have IPO'd if the Fed didn't raise interest rates last year. And I asked him, how did it go down for you guys? He says he was making a board deck on Wednesday, saw the news, slacked the CFO, and by Thursday afternoon, they had all their money out, right? And if you just think about that, he goes, we got lucky. There are only a few people authorized to do the wires of that size. What if one of them was on vacation or if the other one was on a flight? And I think that's what we're seeing with all these other small mom and pops.
So are you changing your strategy right now in terms of where you keep your money?
Thankfully, I'm not running a company right now, but I would absolutely be changing my strategy.
Alex, what are you doing?
What would that strategy be, Tom?
Yeah, I think the same move they made and a few of other friends made is to go to the big 4s.
Yeah, we already bank. We bank at Wells Fargo, primarily right now, and I personally use Citibank. And on the business side, we're gonna do a little bit more diversification with Citi as well, just because of my relationships there. But we also use floating rate accounts for diversification, and ladder treasuries. So, I mean, I think there's a lot of things you can do to still have a single banking relationship, but diversify your risk. There's no reason to keep a large sum of money in deposits.
I agree.
Go ahead, Rob.
There's alternatives to FDIC insurance. There's also SIPC insurance. So you can open up a securities brokerage account, invest in a Vanguard money market fund that today is yielding 4.5%, which is higher than what most banks offer. And you can also do wire transfers off of that brokerage account, and you can select a high quality custodian that isn't in the business of lending. So there are good alternatives out there in the securities market.
We use one of the big four, but I did an experiment. I typed in Silicon Valley Bank in my search box, and it's amazing how many wires I've sent through Silicon Valley Bank. Even related companies run by Stephen Ross is using Silicon Valley Bank, and I hope my money's not locked there, but if you just do a search in your inbox, it's crazy.
Yeah, we were actually running some searches out of the accounting system on ACH payments, and it was rather alarming.
Yeah.
Jason, I think you sent a message to our team in the back talking a little bit about your experience with Voyager.
Yep.
Could you weigh in on USDC and all this other stuff?
Yep, absolutely. And I'm an investor in that fire site that Mark Cuban mentioned, and I realized that was sent through Silicon Valley Bank too. But yeah, I'm the chair of Voyager Credit Committee, and finance, got confirmed last week. USDC is a big part of it, and so the depegging is concerning. The lawyers and stuff on the back end don't really have an update, but watching this USDC closely as $3 billion of Circle's cash was there, but supposedly 60% of it or 70% of it was in short-term treasuries through Silicon Valley Bank, and they were the custodian. They were able to get out $2 billion supposedly. That $3 billion and 60% or 70% was in short-term treasuries. If that's the case, then Silicon Valley was the custodial, and so they should be able to get a lot of that cash back. But we don't have any facts to see the actual numbers at this point. That is how much is in short-term.
And sorry,
it makes a big difference for the deal.
Sorry, not to change the topic, but just received. Mario actually shared this with me. There was an investigation. The Shaw law firm announces it's investigating claims against SVB Financial Group and encourages investors with losses to contact the firm. I don't know this law group. I don't know if people are aware with this law group. We'll post it up so that people can take a look. But shareholder lawsuits are already beginning, which I know that nobody's surprised by.
Yeah, I mean, that game is to be first and file the first thing so people join your class action. I remember being a public company, and that's whoever was first won the game. So that's what that is about. But yeah, so the Voyager, Binance, UCC, and the debtors are watching it. It did come back from 88 cents to 94.95. So that's a positive. And obviously, we don't know what the FDIC is going to do until, I guess, they officially announce it.
Yeah. Well, what have you been hearing, Jason?
We haven't heard anything from the FDIC. I know people earlier were saying, well, why is the FDIC going to, save the banks? But honestly, behind the scenes, we haven't talked to Circle. I mean, remember, Binance is a separate company, and so it's them buying the company. But we haven't seen anything else other than watching what you guys watch. I haven't heard anything directly from them, saying, hey, we're good. What I did hear was that most of that was in short-term treasuries for Circle through Silicon Valley Bank, which was a positive.
Yeah.
So maybe it's overplayed, and maybe it'll be back to 1-to-1 later today or tomorrow. But I don't want to say that because, UPOD, under promise, over deliver. I mean, I hope it's that. We've been through a ton in this situation at this point, so hopefully, just hoping for the best right now.
Yeah, I mean, absolutely.
I just emailed 3 founders who I wired money to in the last 2 years through Silicon Valley Bank, and also related. I did an opportunity zone when I sold part of Benzinga, and it's related, which is Stephen Ross, which owns all the real estate. I wired to Silicon Valley Bank, which I was shocked that was the bank they're using. But
so it tells you a little bit about how it's not just the tech bank; it's a bank across many different industries.
That's what I'm saying. That's why, when I did that little search just now, and I would have bet $1 million that was related wouldn't be in there. Now, who knows if they used it as just a way to receive and then transfer, but it tells you it's not just the tech world, So, I mean, Stephen Ross works with, obviously, Matt Higgins and all that stuff. But
are you worried about contagion risk?
I am, for the sole fact that 250 is the FDIC insurance limit. And so even if you have Arkansas Credit Union, people are going to start saying, hey, I'm not going to put it in a bank. I'm just going to buy T-bills. So that's the contagion I worry about. But a guy who's been in the banking sector for 12 years tells me that I'm over worrying, and it'll be fine next week, and this will be overplayed, and the other regional banks will be fine. That's his
Michael, sounds like that guy works with you.
But doesn't so
Yeah.
the longer
his name is Tim Melvin. He's like traded for Stanley Druckenmiller, and he literally the last 12 years all he buys are credit unions, and he's really good at it. And I actually bought a couple banking credit unions last week, or after when their stocks were down 40%, and one came back 20% because he thinks the contagion thing is way overplayed, and he's been through everything. So, and this guy studies these banks like no other. So I trust him. But the point that you guys are raising is that if people are afraid to put their money in banks because this can happen, they can just buy T-bills directly on Treasury Direct. Then maybe you're not going to use credit unions anymore.
It might not be a rational decision-making process. This could be a behavioral issue. Michael, do you agree that this could be are you really not concerned at all?
No, that's not my point. I think the higher certainty outcome of this going forward is this is going to accelerate people who've been lazy to move low yielding savings accounts into money markets and treasuries, something that's been happening at a more glacial pace. And regardless of what happens from a systemic basis, if this gets solved tomorrow, my guess is that you're going to see that transfer accelerate as people either worry about this, or this is what makes them wake up and realize, oh, I could have been getting an extra 2-3% more elsewhere. So to me, this really is this accelerates a major headwind on banks' profitability going forward. As they're going to have to be more swift at raising their fund their deposit, what they're paying on deposits.
Interesting. Ram, do you agree?
Well, yeah, I absolutely agree. I think, look, there's two sources of funding if you're building a business. One is your bank and you get a loan, and that loan is funded by deposits. The second source of funding is capital markets. Obviously, there's private capital markets like private equity and venture. There's public capital markets, which means you issue a bond. So there's a shift towards capital markets. Capital markets are a winner and a beneficiary here, for the reasons Michael identified, right? So imagine if, mom and pop are shifting over to treasuries and T-bills and Vanguard money market funds because they do today offer a better yield than deposits, one. And two, you have more trust and security in them. And three, you get the convenience and benefits of being able to debit and use wire transfers. When I was at Merrill, one of the leading products, which has now been adopted across the brokerage industry, is something called a cash management account. You had a securities brokerage account, but it was linked to check writing and wires, debit cards, and credit cards. So what does that mean? So if you see a shift in movement from deposits to investment in securities, that has significant implications. Incidentally, Bill Ackman mentioned this in one sentence in his three-page long tweet. But it's a very key idea that we should track going forward, right? His point was that, and I agree, is that if deposits shift to capital markets, then that hurts credit extension. It, of course, hurts the banks. And it's a really important question that we got to stay focused on.
And that's going to happen.
The question.
Oh, sorry. Just real quick. That's going to happen at a time where banks have already tightened lending standards, and this could exacerbate that issue going forward.
So someone sent me a tweet from Sahil Kapoor, and it was about this the Silicon Valley Bank situation. They mentioned that in 2018 we rolled back some parts of Dodd-Frank. It was a GOP-led bill. It was actually, if people remember, Senator Warren went after them because they said it was dangerous for consumers. And interestingly, it was bipartisan. Trump signed it into law. And just to kind of give some context of where this came from, in 2018, President Trump signed a bill that lessened the regulatory scrutiny for many regional banks. Greg Becker was a strong supporter of the change. And the specific change was that it reduced how frequently banks with assets below 100 billion and 250 billion had to submit to stress tests by the Fed. So this is actually very important. If somebody can share that, that'd be great. one of this tweet by Sahil Kapoor. If anybody has a comment, I think some people like Molly who are in the audience retweeted it. Would love to get the thoughts on, is this potentially part of the are we just harvesting the seeds we sowed with deregulation of Dodd-Frank?
I can certainly chime in there, as having been at a small community bank called Cross River, which powered Coinbase and a few others. So community banks are subject to lighter standards than big banks, and that's what you're referring to, right? Big banks are subject to an onerous, labyrinthian, Byzantine set of rules and regulations, such as the CCAR process. And their whole staffs of teams and tens or hundreds of millions of dollars, if you're Citibank, spend towards this. And these big banks have massive advantages. The bulk of deposits are held at the top 5 depository institutions. So those large depositories have excess liquidity. This is why JP Morgan and Bank of America pay out, even now, close to nothing on your deposits. Community banks, meanwhile, have the opposite problem. They don't have much liquidity, and they are reaching out into middle America and these underserved markets, whereas the big banks are more online and on the coasts. So I actually think it's a good policy that community banks have a lighter standard. They're also less systematically risky. That said, SVB was a top 20 bank. They should have been subject to more rigorous, treasury management oversight.
Molly, do you agree that? So I wanted to. I saw that you retweeted. Yeah. I would love to get your thoughts. Is this because we deregulated Dodd-Frank?
I mean, this is so not my wheelhouse, and I'm like very, very. I'm barely read in on it, but I certainly think that we have seen this week a bunch of events that happened that it's funny, nobody likes regulation until the things happen that you're trying to avoid through regulation. And I think we saw that this week or the last couple of weeks with the train derailments, and then also this. But the specifics of it, I just don't know enough.
It is fascinating, though, that we are right now. I mean, what you just said is kind of interesting. Again, I will put my hat out there and say and speak my beliefs that often regulation is more administrative overload, and it doesn't always pay off the way we think it will. It always has these like second, third order effects, but so does deregulation. You just mentioned the train derailment. No matter where we sit on the political spectrum, clearly deregulation also has its costs, and we're seeing it right now.
Yeah, I mean, I definitely think that there's a lot of really stupid regulation that's problematic, but you definitely see you can't make a case for regulation until you have these kind of catastrophes. So I do think, which is not to say that there's, I think that what's happened has been terrible, but all of these things, the 2008 crisis, we didn't have, there were regulations were a response to these crises. So I do think it's just, you can't make that case unless you are faced with these crises. And that I just think is very interesting.
Michael, do you think that we're going to see regulation change? We're going to see a return to the old Dodd-Frank?
I think it's too soon to really have a solid answer, high conviction answer. But yeah, I mean, regulation swinging from one side to the other is nothing new, but I think it's premature to have a high conviction view on that right now.
What about you, Ram? What do you think?
Just we are in the old Dodd-Frank. There has not been a deregulation. This is a very specific call out to a very narrow set of banks and circumstances. Like, here's a quick recap. Look, VOCA rule still in force. Prop trading illegal. Non-banks like Amazon cannot acquire banks. There's a whole set of rules in play. Bank regulation is slow to change. It's a decade and glacial in place. It starts in Switzerland with the Basel Committee. It's on 10, 15-year cycles, and the trend is tightening. The trend is more capital requirements and more regulation. So I'm not worried about deregulation of banks. That's not happening. The real issue isn't the regulate. The real issue is we had 14 years of quantitative easing, ultra low interest rates, and regulation requires banks to have high quality liquid assets, things like treasuries and mortgage-backed securities, so you can honor depositor withdrawals. But what do you do if you're a bank and interest rates are 2%? That's the primary issue here.
So I think it's multifactorial. I think taking it, just blaming it completely on the Fed and not admitting to the fact that at the same time that we were doing quantitative easing, at the same time that we were pumping money into the system, at the same time as we were reducing interest rates, at the same, I mean, this all happened at the same time. We deregulated it at the same time when perhaps we should have had a deeper conversation. Michael, I'd love your thoughts on Ram's point.
Yeah, well, I agree. It's not to blame the Fed is, I mean, this has been going on well before we had a central bank in the United States in the early 1900s, and it's human, blame ourselves. It's human behavior, fear and greed, and that's the part of the market cycle and the business cycle that doesn't change over time. But one of the things that I think one of the most important things is not just that we had low rates for very long, low rates, but it's how long we had low rates for. And Taleb and plenty of other people have written about, when crises occur is when you have an extended period of time where things are constant and then they rapidly change. And that's exactly what we've just gone through right now. So there's going to be a lot more problems coming out of this, not necessarily just in the banking sector, but it's still very early on though.
Yeah, I agree. Just to be
go ahead, Ron.
No, just to be clear, like what I was getting at there was like it's a backdrop condition. Like clearly there were bad management decisions at Silicon Valley Bank, no question, right? But yeah, I agree. When there's sudden changes in prices, that throws off the apple cart. But no, I agree.
Aaron, what are your thoughts on this? Aaron's not there. Oh, there you go.
Sorry, I was literally responding to a DM. I was actually taking a look and I was just kind of curious, right? Like, so I'm obviously in crypto. Most of my founder friends they're okay because most of them live on chain like we do. We treat banks like we treat the centralized exchanges, where like if we need to use a bank, we transfer in via their centralized exchange or through some other intermediary, which usually happens fairly quickly. But I got a message from one of the VCs that we've been talking to in our round, and he was just saying that he was checking in on the companies in his portco, and they were like, "Yeah, we do bank with SVB, but we have a bunch that we hedged into ETH, so we're gonna be able to make payroll for about 3 months now." And I was like, "That's a really interesting way to look at a way to use crypto as like." Kind of like a fallback for all of this. I don't know if I would hedge into ETH if with your treasury. I'm not recommending that. But, DAI, USDT, heck, even USDC, if it comes back, because it looks like it's going to.
Yeah, well, most startups can't do that though, right? Like,
yeah.
Most startups that are not in the crypto space, please do not put your money in crypto money. There's a lot of regulations around it.
Yeah, be very careful kind of doing that, not saying that you should, but
no,
I thought that was kind of a funny
so just so people who haven't raised VC funding are aware, I've gotten the reason why I was even on this space in the beginning is because I messaged Mario and I said none of my investors have ever reached out to me as much as they have in the last 24 hours. It was there was a lot of investor love, but also concern. Just, hey, did you have any exposure? That was the first question that I think most founders have heard, as many of the founders will agree to. Scott, thank you for joining us. Do you have something to add?
Yeah, thank you.
Scott, there's a lot of background noise. I'm gonna mute you for a second. Can you get to a place where there's less? Darren, did you have something else to add?
Yeah, I would just add that I'm a full service investment manager, deal with a lot of high net worth clients, deal with venture capital funding and portfolio companies and all of that. I had the unique experience back towards the end of last year working with an HOA that had significant reserve funds, right? So well above the 250,000. They had it all at one, single location. And, it's not, something that you run into every day where you think about, hey, is my cash at this one bank safe? But it was something that I had brought up to that HOA, the community, saying like, hey, let's look at some options here. So back in November of last year, we looked around at, different offerings. You could have brokered CDs that you're spreading across, 6 or 7 different banks, and a lot of paperwork, especially with, multiple signers on bank accounts. Like the ease of transaction definitely, facilitates just working with one bank. And I think that's why a lot of startups or founders only just use one bank. But, through all of that research, it led me to find the IntraFi network. And this isn't like a plug for them at all. It was just a service that we found that allows you to go above the $250,000 limit, but then still have FDIC insurance. That they have a patent on it since I think it's 2011.
So what was really interesting is, as we were discussing with Mark earlier, Mark said something really poignant. Mark Cuban did. He said, as a founder, there's a lot of risks, but one of the risks that nobody priced in was the risk of a bank run. Scott, wanted to get you to weigh in. Sorry, I hope your audio is better now.
Yeah, I was in a jacuzzi. I just shut off the jets.
All right,
so
perfect.
Yeah, so I'm curious how they were even allowed to just load up on 10-year bonds. Like there were no oversight. Obviously, if the rates were going to shoot up and you had to force to sell, it was going to be a gigantic loss. Like there should have been some oversight where they were forced to buy, shorter term bonds or a mix instead of just loading up on the 10s. That just doesn't make sense to me how that was even allowed.
I mean, at that time, their big issue was that their deposits grew 300% over the course of 12 months. They had to park that money somewhere to get yield. So I think that was the challenge. And at that time, with a zero interest rate environment, that seemed to be the prudent decision for them. Of note, I just received a very interesting article. I'm going to try to pin it to the top, but it's a Fortune article. I wanted to kind of jump in. Not breaking news, but it's some news. SVB CEO Greg Becker, and this is on Fortune.com. It came out a few like an hour ago. SVB CEO Greg Becker lobbied the government to relax some Dodd-Frank provisions, and specifically by lobbying Trump. And so, again, this is not good for the poor founders who are going to be worrying, because as soon as this becomes a partisan issue, suddenly a deregulation versus regulation issue, suddenly the administration will be less likely to weigh in. Again, likely the administration may not even need to weigh in at all. Just want to be very clear. This is not about spreading anything. It's more around the fact that now this issue that we talked about a few minutes ago is now starting to, the larger corporate news networks are starting to talk about it. So on Monday, the head of the Federal Deposit Insurance warned, FDIC warned a gathering of bankers in Washington about a $620 billion risk lurking in the U.S. financial system. By Friday, 2 banks had succumbed to it. Whether U.S. regulators saw the dangers brewing early enough and took enough action before this week's collapse of Silvergate and much larger SVB is now part of the national debate. But the point that they're making is that the same thing that we were talking about earlier, that after the 2008 crisis and the Dodd-Frank regulatory overhaul, this was a partial rollback under President Trump. Specifically, Trump didn't do it. It was a bipartisan. Again, there's no politics from my perspective here, to be honest. But Trump happened to be the president who eased oversight of small and regional lenders when he signed a far-reaching measure designed to lower the costs of complying with regulations. So a measure in May 2018 lifted the threshold for being considered systemically important, a label that imposes requirements, including an annual stress test. And it used to be 50 billion. Now it's 250 billion in assets to be considered systemically critical, to then actually have to do annual stress tests. Scott, did you have something to add there?
But yeah, so, I see a lot of people looking at banks and their unrealized losses, so to speak, on these bonds. I'm more curious to see how many of these other banks were highly allocated to these 10-year bonds? Because that's where you're going to see the trouble.
That's fair. Michael, what do I know we spoke about this a little bit. What do you think the ramifications of these stories? Do you think this is the new narrative? I'd love to get, again, I know you're an investment strategist, but would love to understand how this actually affects, our question about policy. Clearly it's now entering corporate media, so it's interesting.
Yeah, and just to add to the last comment, it's not just 10-year treasuries. A lot of these regional banks have boatloads, and again, just look at the names that are down the most besides SVB. Boatloads of fixed rate mortgages or hybrid mortgages that have the same problem. Obviously, they're even longer duration. From my perspective, from just a blanket statement on investors, obviously this is a ding to confidence in a market that I would say a month ago was about as confident as ever that everything was great and problems would not arise. And this is why the narratives of soft landing and then no landing, or the debate around, is the Fed's tightening cycle even having an impact? Are we still a rate sensitive economy anymore? I mean, literally, these are questions that are coming out of people because people just didn't see investors didn't see things breaking yet. And again, I go back to the fact that it's been 16 years since we saw a real tightening cycle on commercial and central banks. And you go throughout history, how many times have things blown up within the 1 year period of a Fed tightening rates? It doesn't happen. It takes a lot longer. And so, yeah, I think it's just,
are we tightening too fast?
Are we tightening too fast? I mean, I think you have to look at that in a relative context. Obviously, on an absolute context and coming from zero and from a percentage basis, obviously it's yes. The answer is we have tightened very fast, but you always have to think about the tightening cycle with respect to the economy they're tightening upon. So if nominal GDP is 8-9%, you could, I think it's debatable. If nominal GDP is 2%, then absolutely that's black and white. So you got to look at these things on a relative basis, or you can look at it in the context of how much money's been floating around for the last few years from all the stimulus. In that same context, it's not really the speed of the tightening as much as it is ultimately how high. Well, actually, I would say the most important variable is going to be going forward is how long rates stay high. Secondarily will be how high they go. And I think the tertiary issue is how quickly they've tightened. But again, this is the first time in history, and we'll see how it plays out, but it's not a positive. It cannot be a positive that the Fed has raised rates alongside central banks tightening lending standards. Usually, you go back in history, the Fed raises rates, usually when the economy's pretty good, not as late as they started in this cycle, and they slow down the economy, and right towards the end of their tightening cycle, banks start tightening lending standards because they see the economy getting worse. And then when the Fed's easing in a recession or when jobless claims are rising, every time banks are tightening lending standards, financial conditions are tightening, even while the Fed is cutting rates. So that's all down the road potentially, but I don't think it's the speed as that's been the issue. And again, the first hike was 25.
It's the fact that they're doing both together, which is unusual.
It's unprecedented, and it's unprecedented to if the Fed does another hike, or even the last hike was unprecedented. But again, it's not usually these things take time to play out, and then it kind of hits one after another, industry after industry. The tightening of the Fed and commercial banks is going to hit us at the same time because they tightened at the same time, and they both have about a 12 to 18 month lag. We're literally 12 months now on the Fed.
And Michael, what's interesting is that, we have Jeremy up here now. So Jeremy, the team mentioned that you're an executive at a $3 billion credit union and that you had something to share with us about the liquidity issues that their financial institutions are seeing right now. Jeremy, could you weigh in on what Michael was saying about the unprecedented nature of tightening at the exact same time as hiking and how it's affecting, credit unions like yours and just financial institutions in general.
Yeah, thank you for giving me time to speak. Yeah, I think that's the unknown here, that depending how it goes next week could rattle a lot of small to mid-sized financial institution. And someone said it earlier, which I totally agree. The too big to fail banks are going to be fine because the government's never going to let them. But you have a lot of mid to small credit unions and community banks, regional banks that loaded up on, someone just said, mortgage-backed securities, treasuries, whatever, because they had to do something with this money. And now they're raising deposit rates drastically and fast. And I would just say, go out and look. The institutions that are offering, and you can Google it and find, that are offering these 4 and 5 and 5.5% CDs, it's because they have liquidity issues. And it's going to magnify if the Fed, I believe, if the FDIC doesn't ensure the depositor, the SVB, are taken care of. Because personally, I just texted my investment broker and said, hey, I need to move some money out of one of the credit unions because I'm over the 250 mark. I don't think that credit union is going to go under, but why risk it? And I think that's the question to ask everybody, and ask is, if this consumers start doing that more and more, these small to mid-sized credit unions are going to really struggle.
Absolutely. So you are concerned. So I've asked this question at least 30 times, but I'm going to keep asking people that are experts this question. You are clearly concerned about a contagion effect.
I think I am if the Fed doesn't do the right thing. And again, I think I'm concerned because as a consumer,
Jeremy, in the last 12 to 24 months, when has the Fed done the right thing?
Well, that's another conversation. But yeah, no, I agree. If this is handled poorly, and it'll happen quickly, but why would the consumer put any of their money at risk when they have other options? And so my question is to FIs is, what are you going to do? Are you going to sell your mortgage-backed securities at a loss, and take a hit? There's a lot of places out there that don't have the capital. My institution is well capitalized and we would be fine, but we don't have to do that. But there is going to be this trickle-down effect where I don't know where it's going to stop.
Jeremy, what would you said you need them to do the right thing. What would the right thing be, according to you, in this situation, though, specifically?
I'm just a small FI guy, but to me is to ensure that they guarantee dollar, all deposits, and say, look, we're gonna back Silicon Bank. We're gonna make sure no one loses their money. It might take some time. Just back in the financial crisis, it just took time for everybody to get their money back, but eventually you got your money back in most cases, right?
Robert, do you agree with that? Thank you for joining us, Robert. Do you agree with that from a policy perspective?
I think this whole thing is a tempest in a teapot. It's not. There's nothing systemic about it. There's no contagion. This is basically one, maybe a few other similar institutions that have just super concentrated on that particular market, PE, VC world, and this is a classic management failure. They at a time when the industry and all the tech sector, Silicon Valley was hurting just in the last year, and we could see it coming. I think that there was this extend and pretend mentality where all the lines of credit got drawn. It's typical, just like happened in 06, 07, 08. All the lines got drawn, so their growth pops up. They had a 50% growth in NII, in net interest income. So the management's they're thinking they're riding high on the hog with this tremendous growth because people are drawing down their credit lines, when what they should have been doing is really realizing they have super concentration risk and saying, hey, why are these people drawing down their credit lines? But anyway, the reason I say it's a temp. And, it's not that much. And even if you haircut that, 40, 50%, which is, what I think people saw in the market as IPOs dried up, you're looking at maybe, 30, $40 billion haircut on that portfolio, maybe a 10 billion haircut on the MBS and the treasuries. And so you're talking about maybe 50 billion max of a loss on 210 billion of deposits. So insured depositors get 100% payout. That's 75 billion get 100% payout. FDIC advised that everybody insured is going to get full payout, and then they're going to do a little coupon, a dividend. I heard earlier in the call people talking about a 50% eventual on the uninsureds. Yeah, I see that. I see maybe 65. So 65% payout.
Robert, can I play devil's advocate for a little bit because it'll be helpful?
Before you do that, Danish, I've gonna just give an update on USDC. Okay, someone needs to mute. There's a bit of feedback sound. Let me mute everyone. Jeremy, that was you. Yeah, so just a bit of an update. I'm going to read it out. I've pinned it above as well. I've retweeted it just for now so everyone can have a look at it. And that was by Jeremy, who's the CEO and co-founder of Circle. TLDR, while USDC can be used 24/7, 365 on-chain, issuance and redemption is constrained by the working hours of the US banking system. USDC liquidity operations will resume as normal when banks open on Monday morning in the US. As a practical matter, our teams are well prepared to handle significant volume built on the strong liquidity and reserve assets discussed below. As a regulated payment token, USDC will remain redeemable 1-for-1 with the US dollar. It continues. What just happened? Silicon Valley Bank, a venerable, should be vulnerable, I guess, and trusted partner to the US innovation economy, has just suffered a classic bank run, much like those we saw during the financial crisis in 2008. Not the best comparison. Few traditional banks have sufficient liquidity to withstand such a run. Silicon Valley Bank suffered significant losses, which led to the situation where they were forced to sell long-duration assets to meet redemption demand. The settlement period on these assets caused a short-term liquidity crunch, leading to the FDIC stepping in to administer the bank yesterday. Silicon Valley Bank's fate is being decided this weekend by the FDIC, and it's our hope that they will find a resolution or a solution that protects customers' assets 100%. It's a bit more there. Let me have a look if there's much more. No, not much more. I'll read out the rest of it. I think it gives a good overview for anyone that joined a bit late. Continues. What is the impact on USDC's reserves? USDC is 100% collateralized with a combination of cash and US Treasuries. Sorry, go ahead, Doctor.
No, go ahead. Keep going.
Cool. Let me jump in if it's not worth reading.
No, it's definitely worth reading because it kind of makes my argument against Robert, which will make my life easier. So go ahead.
Perfect. You're welcome then. Specifically, USDC is currently collateralized 77%, $32.4 billion with US Treasury bills, with a 3-month or less maturation period, and 23%, $9.7 billion with cash held at a variety of institutions, of which Silicon Valley Bank is only one. US Treasury bills are the most liquid assets in the world and are direct obligation of the US government. These reserves are held in custody by BNY Mellon, and active liquidity and asset management is managed by BlackRock. Anyone can view the entire liquidity ladder. The link is there if anyone wants to check it out. A bit more information.
So Mario, I think that's good.
Goes through, yeah, I think that's enough, and then continues about the what we can expect with the Silicon Valley banks and FDIC, which we've already discussed. But everything is in that thread there, and I think that goes in line with the we're seeing at the USDC peg again. It's at 95 now, still 5% down, 4.8% down. It's improved a bit since the tweet went out. So some good news there for the crypto space and for the space in general.
So Robert, you had made a comment around, well, it doesn't really affect the general economy. It just affects a few, VC-backed startups and some PE and some wineries. So I will push back and say that right now we are in a race against China to innovate across every aspect of the economy. And these small startups become the big companies that we now know that represent most of the market cap of this country. So of the stock market currently. The FANGs. So, they were all VC backed at one point. So, the point of, hey, where are we, if people are not made whole on deposits, we potentially could be hurting in this race, especially when we should be doubling down as we are competing directly with China. Do you disagree, Robert?
No, I agree. That's on a long-term impact. I agree with that. I mean, and hopefully the portfolio, by the way, the FDI took control of the bank. It's now the depository insured National Bank of Santa Clara. So SVB Financial doesn't own this thing anymore. There's nothing it can sell off. The FDIC now can either part it out by selling the loans or the security portfolios. So I know there's a lot of folks that there's a top-down macro impact here, but there's also a bottom-up causation. And Doctor, I think that you're absolutely right. It does impact. Now, just hoping that other institutions will pick up the slack here. and they will continue the funding and liquidity for the Silicon Valley.
So another sort of follow up on that is I up in the top, I actually posted and shared a Fortune article that is speaking about how during the Trump administration there was deregulation of Dodd-Frank that reduced stress tests that changed the threshold of systemically critical banking from 50 billion to 250 billion. As you may know, Silicon Valley Bank was just underneath that. So walk me through, do you think that change in regulation at the same time as us doing quantitative tightening, at the same time as rate hiking, do you think that we made a regulatory error at that time?
I think that the QE and the macro policy, the Fed policy, absolutely sucks, and it goes back to policies on energy and all that. So there's a lot of things in play here. But back to the regulatory levels, the going to 200 billion on systemic or with the certain levels of regulation, the regulators were clearly asleep at this one. SVB did submit its resolution plan in December 2022 to regulators, and I think they're all sort of behind. I mean, the folks here on this call, the traders and the macro folks, they're way up on this. The regulators are way behind. That as of June 30 last year, people knew that things were locked up. The IPO market was seized up. Valuations were tanking, right? So it took a while for the regulators and management, frankly. Management's, they're saying, well, maybe it'll come back. Maybe it'll come back. But no, it didn't come back. And so they got eventually, their loan loss committee meets at the end of the year. And all they do with SVB is they put up 400 million in loan loss reserves. That was, way up from last year's 100 million of loan loss reserves, but nothing close to what was required when the market is saying, now you might have a $30-40 billion haircut to your loan portfolio. So here they are at, a $600 million provision, 0.9% of their assets, of their loan assets are in provision for loan losses, while the market is saying, dude, you need a 50% haircut. So regulators were clearly, management is the blame here. And regulators, who are slow anyway, they're not as fast as the guys on this call. They were clearly asleep at the switch. Now, if the Fed and the regulators should have been in there, FDIC in particular, should have been there right after they posted their June financials saying, what's going on in your loan portfolio? And then flipping over to the macro side, what's going on with your treasury portfolio, your MBS portfolio? Because they're getting hit too. So you had, and there was a great comment by somebody earlier, Vinny maybe, saying how, or they were saying how, there's this kind of tie-in requirement for all the folks that were doing loan lines to also have tons of deposits at SVB. That is a big problem.
Well, you had to hold your deposit account in.
So
to get
access to regulators should be all over that. Say now when you have a really concentrated, and this is why I say tempest in a teapot. I went through, oil patch days when you had all of South Texas. The whole industry was in carnage. It wasn't a national thing. They were having their trouble. This is, I think it's localized.
Hey, Robert, so sorry to interrupt.
Yeah, I'm just going to jump in. A couple of things I'm going to share. First, there's a tweet by David Marcus. If you could pin it above, Doctor, that would be great. Ron is with us as well. Ron, I'll give you the mic in a bit. But yeah, just give me 2 seconds. I'm just going to mention 2 breaking news and I'll give you the mic. So David Marcus, CEO and co-founder of Lightspark, said the following. I'll read it out. Hearing rumors that the FDIC is blocking Goldman Sachs from buying SVB, Silicon Valley Bank, on the grounds that it would create too much concentration with our largest banks. If true, just please make sure you mute me out, guys, when you're not speaking. If true, they really need to understand that not finding a suitable buyer over the weekend will result in much greater concentration in Goldman Sachs than letting one buy it. And this will happen across industries. As businesses and people move balances out of smaller banks in fear, the same thing will happen to them. Do the right thing, protect deposit holders while you still can. So I've invited David Marcus to come on. Also, another piece of information, let me see where it's at. That's from theinformation.com. There's a piece you can just Google it, theinformation.com. I'll read it out, and that's in line with some of the messages we've been getting. At least one Wall Street firm, again, please mute your mics, some feedback sound if you're not speaking. At least one Wall Street firm is sensing an opportunity in the panic around failed SVB. Traders from Jefferies are contacting Startup founders with money stuck at the bank offering to buy their deposit claims at a discount, according to several people with direct knowledge of the matter. They're offering 70 cents to the dollar. That's the company's called traders from Jefferies. They're offering 70 cents to the dollar for deposit claims. One of the people said, although that price is likely to change. The team is having conversations with startups over the weekend, according to a person familiar with the matter. And we've had a family office contact us. They wanted to come up on stage saying the same thing. And there's another one here, another Reuters piece. Reuters piece said hedge funds are offering to buy the deposits of startups stranded at Silicon Valley banks for as little as 60 cents on the dollar. Semaphore reported on Saturday, citing people and also Oak Tree's doing the same thing. So there we go. We're seeing a lot of institutions step up and take advantage of the situation. Rand, what do you think?
Yeah, so that's actually why I jumped back on. A couple of things have happened. The first thing is just to comment on the David Marcus piece. So remember, the FDIC is not the Competition Commission. They don't get to make a decision as to whether this would create a competition scenario or an anti-competitive scenario in the United States. That's not their call. Their call is to protect the banking system and to ensure that the banking system is stable. That's the first thing. So I do believe it. Maybe those rumors are going around, but it's certainly not their call. I think more importantly, I don't know if you guys have spoken about it, is a statement that Jeremy Allaire issued a few minutes ago. I wasn't on the spaces. Have you guys discussed that statement?
We have not.
Sorry, I was muted. Yeah.
Okay. So Jeremy Allaire has broken his silence. I'm going to just pull over my car and I'm going to read it to you guys just so that you can see. So he says as follows. He says, let me just go to the beginning of it. He goes, this is a time of heightened uncertainty for the USDC economy. Remain committed.
Oh, we've read. Sorry, no. Yeah, we've read this already. Yeah, we have read this, Doctor. Yeah, we went through it earlier.
Yeah.
Yeah. So
that's the USDC statement, Doctor, just for the audience. The USDC statement earlier. Yeah. Go ahead. What are your thoughts on the statement? And by the way, Vivek, welcome to the stage. I'll go to you in a bit. But yeah, go ahead, Ron.
I mean, look, I think he has a point there that banking transfers take over a certain amount of time, and that any banking transfer that was initiated before the cutoff should actually be processed. So that's I think a big positive. And I think that the last statement in the last line in that statement where he says, that the circle remains basically on the line for any shortfall is also quite encouraging. So I think I'd be surprised if USDC doesn't return back to
it's
peg.
almost there. It's at 963 now, so it's only 3.6% down from peg. The bottom was at 87.8.
Yeah,
that's how bad it was earlier in the morning.
There's going to be a big hurdle, because when it gets close enough to peg but doesn't necessarily hit peg, you're going to see a lot of people running for the doors. Because they're kind of going to say, look, at 1.5% down, let me just get my money and get out. And then you'll get another little drop down. I remember seeing that with the Luna collapse. And I know it's two very different things. But, when Luna collapsed, or when Terra collapsed, it went down, went back up, almost touched $1, and then went straight back down again. Now, I'm not saying that USDC is going to go back down again, because I actually think that USDC is back. But there's probably going to be one more big layer of resistance around 98, 98.5. But I'd be surprised if this doesn't get back to peg by Monday when the banks start trading again.
So thanks, Ron. Vivek, thank you for coming up. Quick question for you to get started. I know that you've been a tech CEO. You come from this world. What are your first reactions to SVB going down, especially from the life sciences sector? And what do you think, from a policy perspective, led us here?
Yeah, can you guys hear me? I'm in a car, but Mario sent me the link, so I'm popping on. Good. Yeah, I mean, look, so I'm coming in mid-discussion, so I apologize if I'm saying things that have already been said or I'm helicoptering in here. But, I think one of the big lessons is, look, we've had money raining from on high, like manna from heaven from the Federal Reserve. And you know what? When the musical chairs game stops, when the music stops, somebody's left standing. This time, Silicon Valley Bank was left standing. That's what happens when you have to raise rates after years. I mean, decade-plus long period of pumping money into the system. That's really just what happened. I think the music's going to stop several times over, and the next person's going to be left standing. I actually want to be pretty clear in coming out, because I think this is the nascent debate here. And I think, I'll be curious where the other presidential candidates land on this. I'm against a bailout. I do not think that there's any room for proper public funds being used, taxpayer money being used, to bail out, I think, private risk takers that have been taking that risk. That was a mistake we made in the aftermath of the 2008 financial crisis.
Vivek, can
And
I ask you a follow-up on that
Yep.
part specifically? Are you,
Yeah,
when you are saying bailout, are you referring to the shareholders or the deposit holders?
Yeah, it's a good question. So deposit holders covered by insurance, obviously insurance and already contractual guarantees that exist must be honored. But I would put it into both categories here, actually, both for shareholders and even for depositors, because people need to understand part of the higher interest rate you get with a higher risk place where you deposit is indeed taking that risk. So we have insurance maximums. We have absolute maximums that are set for a reason up to which your deposits are insured. I think that is an unfortunate reality of the market actually correcting for itself. But if we don't actually allow the market consequences to follow from the decisions that people make, then we don't actually have a market at all. And so I just think that you'll hear fancy words like moral hazard bandied around. What does it actually mean? It means that people, including institutions, including depositors, need to face the consequences of the choices they made, because then next time around, we actually have that as the backdrop conditions from which people learn. And I think the 2008 financial crisis took that to a next level with the shareholders of the banks themselves getting bailed out. But I think that we should do what we did not have the discipline to do last time around, which is actually to let the creative destruction of capitalism work itself through. There's also a side story to this, which is, I'm going to be very clear about this. I'm not claiming it's the main story. I'm not claiming it's the most interesting part of the story, but I always think that when there's a catastrophe that happens, there's always lessons to learn from it. And I have personally, just because it's one of the issues I've been most focused on, taken a look at the ESG commitments that SVB has made, the way it's done its hiring, the people it put in its risk analytics departments, the kinds of commitments it's made for its balance sheet capital. It was just in January of last year that they pledged $5 billion to sustainable finance, in their words, to make for a healthier planet. I think if they had been worried about a healthier planet, they might have done better focusing on a healthier balance sheet. And I'm not going to say that I'm going to shoehorn everything into just being an ESG linked issue because that's something that I'm focused on. But because I'm focused on it, I think it also bears merit to be able to say that here's an institution that lost its way in a lot of different ways. But this is, again, one of them in terms of the kinds of people they put into risk analytics and risk management roles, where they actually qualified versus filling, diversity targets. I think there's increasing, you should look at some of the posts from some of the people who are in their risk management divisions. I think that the same thing with respect to the capital commitments that they've made for things that had to do very little to do with their corporate mission of being a bank. The use of ESG factors in credit scoring and the kinds of loans they made. That's at the margin. I'm not saying it's the main part of the story, but I am a believer in learning lessons from failure. And I think there are a lot of lessons to learn from this one, and that's an underappreciated one that belongs on the list as well. But the main point is, let's not make the same mistakes we made after the 2008 financial crisis by buckling to anti-capitalist intervention. This was a bank that it's exactly what you'd expect after low interest rate environments and pumping money into the system. When you raise rates, there's going to be some people who ultimately are left holding the bag when the music stops and there's no chair left for them to sit on in the musical chairs game. There's going to be a couple of them with it.
So Vivek, not sure if you can hear me because you're cutting in and out, but quick question, like it's a nice narrative what you just mentioned, but what would it do to the trust of the people and businesses in the system? That's probably the Achilles heel that everyone's worried about. And if there isn't that level of support or a potential bailout, what's the other side going to look like?
Well, I think it's incumbent on other banks to be extra transparent about what their current liquidity status is, about what their solvency is, about what their reserves are. I think part of the issue with SVB is the asset side of the balance sheet was basically made up, right? I mean, it's a bunch of warrants that they hold in a bunch of companies that are themselves illiquid and poorly valued. So though they had assets supposedly in excess of their liabilities, that asset part of the balance sheet was really just inflated in ways that shouldn't have been believed. And again, this is a 2008 lesson all over again with respect to their baskets of mortgage-backed securities that were dramatically misvalued. I think that puts a greater burden on other banks right now, as we're seeing, by the way, stepping up and providing real transparency to shore up public confidence. But I think this idea that we shore up public confidence by using the U.S. government and the taxpayers' money as the backstop public fisc is a siren song, and it's wrong for two reasons. One is, I'm not even sure that actually does shore up confidence. That actually signals the fact that we think that this is systemic enough so as to be so serious as to require public intervention, you could equally have the opposite impact on even the psychology of markets itself. But the second and deeper point is that even if a banking institution is going to fail, let it fail in the way that the rules of the road were set up to actually follow, or else you do get the fancy term is moral hazard, which is knowing that every time if you're going to be bailed out, it actually incentivizes people to take the kinds of risks and inflate their balance sheet in the kinds of ways that Silicon Valley Bank did, because you know that Big Daddy, Uncle Sam, is going to be there as a backstop. And Uncle Sam isn't some third party. It's all of us, right? It's the taxpayers who put up money who didn't participate in any of the upside when the times were going good. But when times went bad, somehow are there to backstop the downside. And you want a formula for creating populist backlash in this country? And, a lot of people in elite circles like to use the P word, populism, like it's a bad word. No better way to do it than to justify it by actually using the money of everyday citizens to backstop downside risk without allowing them to have ever participated in the upside during the go-go years or the good times. So on both counts, I would be against it. Yeah.
I wanted to go back to a comment that you made, and it's kind of interesting because, I've heard you speak before, and you mentioned your perhaps adversarial or competitive relationship with China. SVB, 50% of startups that represent the innovation economy had their holdings as deposits in SVB. And these are not just any startups. These are YC, Techstars, Founders Fund, all of these like top tier investor startups. They're the ones on life sciences and tech, the ones that had their money in SVB. If we truly are in a race against China, is it not incumbent for us to save those companies because they represent our best chance?
And just to add to Danish's question, in addition to that, if you don't save this bank, other banks will be less forward going when it comes to taking risk with these innovative companies, and so therefore America may be left behind. So if you answer
because if it's really about merit, which is what you talk about a lot, Vivek, shouldn't this flip of a coin and 50% of startups are screwed, not because they did a poor job or because they took too much money, because they had the wrong bank? Is that not the wrong way for us to choose our winners and losers?
So look, I think in retrospect, it was a bad mistake for people to have trusted Silicon Valley Bank. I mean, I yesterday checked in with a lot of the startups that I had founded, et cetera, make sure that what was the exposure. It's not like every startup actually did choose to bank with Silicon Valley Bank. And I think a lot of the startups that did deals with SVB for these, warrant heavy, structured finance specialty deals that then had the implicit understanding that they were going to bank with SVB. I think there is some adverse selection actually with startups that did those kinds of deals that weren't necessarily the highest quality businesses that then actually were beholden to, not all of them. I think there are many high quality businesses that did too, but I just think that in the market, the idea that these are somehow the clients of SVB are the people who are going to save America, I reject that idea. I mean, I respectfully reject that idea. I'm glad you're bringing it up, but with all due respect, I say that that's actually not the way I look at it, because I think that part of making good decisions is being financially prudent and understanding that you don't, put all of your money in, let's say, a stable coin, which is what we've seen a lot of nonprofits and startups do. And so that think that there's free money in the arbitrage of holding a stable coin. Well, it turns out the reason you were earning a higher yield is because you were taking a risk on the other side. Same thing with respect to SVB. All right. You do a specialty deal with a bunch of complicated warrants that don't look dilutive today, but actually are dilutive. Well, a lot of those startups, actually, if they'd gotten higher quality money from somewhere else that didn't require them to bank with the institution as a condition for taking equity capital, then, I think actually a lot of higher quality startups did say no to those kinds of Silicon Valley Bank deals for that reason. So I think this idea of coddling the American, startup ecosystem.
Did we lose Vivek?
And you have to be prudent in it. And so the idea that we're going to coddle that startup economy by somehow saving a bank who's completely lost its way is, I think, a misguided way of going about it, or else we create the incentives for future banks like Silicon Valley Bank to do the same thing. Because what do you know? Uncle Sam's going to have your back when push comes to shove. In contrast to having high quality businesses that, if we do want the kinds that are actually going to compete effectively with China and others on the global stage, great. Let's have the disciplining function and teach people, as I often say in our culture, whether it's in our culture of commerce or whether it's in our culture more broadly, hardship is not the same thing as victimhood. hardship is what teaches us who we are at times, and we can actually toughen up from that experience and be hardened by it. And you know what? I think many of the competitors to those same startups that had overbanked with Silicon Valley, I think are going to be better off in their competitive position that they occupy in the market because their competitors made bad decisions to go by the wayside. Sorry, folks, that's capitalism. Let's own it, and let's actually be strengthened by it. So I'm not dismissing the points you're raising because they're actually good points, but I'm being very clear about what my views are on them.
No, that's
because
fair.
I think that's the right way forward.
Another part of this is the regulatory and policy perspective. In 2018, under the Trump administration, there were rollbacks in Dodd-Frank. I'm sure you've heard this. It was in Fortune a few hours ago, but that story has now come out, and Silicon Valley Bank happened to be one of the banks that lobbied for this very hard, changing the threshold for annual stress tests from 50 billion in assets to 250, and they were just underneath that. If you were president, would you bring those back?
I got to admit, to be really honest with you, just getting out a bunch of speeches this morning. I'm in a car on my way back home, so I haven't seen that particular story. But let me just speak to what I don't love about what you just described, or the part that smells rotten to me is just the irony of lobbying for the very change that then created the conditions for your own demise. I would admit that doesn't sound good. So that's just a real-time reaction right there. But I think that of having the top-down measures from a Dodd-Frank perspective, look, I think that these are, I draw different distinctions between community banks versus national banks at a large scale. These are complicated banking law-related issues. I think one of the things that Dodd-Frank and a lot of our banking regulations get wrong is we actually treat credit unions and community banks in the same swath of regulations as we do the large banks. That actually creates a competitive advantage for large banks. There's a reason why it's actually very difficult to start a startup bank in this country. I actually am opposed to a lot of those one-size-fits-all regulatory regimes, but those are on more technical grounds. And so if I'm going to answer about Dodd-Frank here, it's going to be I want to give a higher resolution answer than we're able to right now. But broadly speaking, I would say that top-down, one-size-fits-all regimes without drawing distinctions between regional banks, community banks, credit unions, and even large national banks being covered by the same regulatory regime is, I think, mostly a mistake. But the part you said smells pretty bad to me, but it's also an ironic reminder of the fact that crony capitalism goes in both directions, both in terms of the public being there to save the private institutions like Silicon Valley Bank, which I hope doesn't happen here, but conversely, Silicon Valley Bank and the likes of them playing games to create the very regulatory types of relief that are specific to them that, again, create the kinds of situations that play out like we just saw in the last 72 hours.
So in your opinion, what's happened with Silicon Valley Bank obviously is a Michael Cantro, who's on the stage. He's chief investment strategist at Piper Sandler. He was mentioning that, we've had such an unprecedented period where they've done quantitative tightening and rising rates, and then I'm added deregulation, all three at the same time. What is the role of the administration in this and enabling something like this to occur? And is it completely separated from the administration and them not stepping in earlier with all of these rate hikes? What is the role of an administration to something like this?
Well, I mean, I look at bigger picture. I'm not even going to peg this to this administration. And I'm a critic of the Biden administration on a lot of things. I think many of you know that. I'm not shy about that. But I don't think this is one that I pin at the feet of just the Biden administration. It's a 15-year culture in this country of a Federal Reserve that actually, now I'm going to get into some stuff that you're not going to hear from a lot of other people. It's a little bit contrarian here, but look, we had 4% GDP growth per year in this country since nation's inception all the way through 1971, 1972. In 1971, 1972, the U.S. went off the gold standard. The dollar floats. We have a volatile dollar, but the Federal Reserve, even under Paul Volcker, it had a narrow mission, which was to stabilize the dollar. Okay, that was Paul Volcker said it, others said it, all the way till about the late 90s, around 1997. Around 1997, we had the academization of the Federal Reserve. And, I think there's a long story here, but the managerial bureaucracy took over the Federal Reserve. What they started saying is, no, we believe in this thing called the Phillips curve. One of the biggest myths in American finance is this idea that unemployment and inflation are necessarily a trade-off with one another. And so that began, and I think set us on a 25-year journey ever since then, that had a Federal Reserve that tried to play God, that tried to play God by saying that now we're not just preserving the dollar as a unit of measurement, but we're actually using the dollar, we're using our own role to somehow play God with respect to creating inflation and unemployment optimization based on a flawed concept. The Phillips curve is actually based on British data in New Zealand in a different era that's completely inapplicable to today. But what they say is actually every time wages start to go up, they assume that's a leading indicator of inflation and then raise rates in actually in a way that tamps it down, when in fact actually wage growth and employment is often a trailing indicator, not a leading indicator. And so what you have is you have a Federal Reserve in this country that's fundamentally hostile to wage growth and to actually even to employment, because every time you do see any sign of wage growth or employment, you have a Federal Reserve that takes that as a sign that it needs to tighten policy. So macro, what is the point I'm making? The point I'm making is the Federal Reserve, when it expanded its remit, in the late 90s, and I think that you saw this in the run-up to the 2008 financial crisis, but you see it in the aftermath of the 2008 financial crisis, is playing far too great of a role in whipsawing financial markets and the economy. And we need to go, I think this can be among the wake-up calls to hopefully restore a world in which the Federal Reserve's role is a narrow one, which is to preserve the dollar as a unit of measurement, probably pegged to a basket of actually hard commodities. And I think that that is something that actually will be good for restoring the kind of GDP growth that we had in the pre-1971 era. And by the way, if the United States was growing at 4% GDP since 1971 instead of less than 2.5% as we're growing today, we'd have like an extra $20 trillion to play with. All of our problems would seem small by comparison. And so, this is part of a bigger vision that I have of unleashing the American economy. This is just one element of it. But I do think that unleashing the American economy is a key part of the American revival. And certainly my presidential campaign, I'm going to be, laser focused on and putting a spotlight on in the coming months.
Hey, Vivek, sorry to interrupt, but breaking news, everybody. California Governor Newsom just came out and made a statement on Silicon Valley Bank that over the last 48 hours, I've been in touch with the highest levels of leadership at the White House and the Treasury. So a very interesting contrast to what you were saying, Vivek. Do you have any initial thought on the fact that Governor Newsom is now taking this to the White House? And
can you say again?
Talk about him running as well.
I didn't catch the news, so can you say that again? I did not. Just so everyone hears you. What was the breaking news?
The breaking news was that Governor Newsom has now come out with a statement about SVB, saying that he is taking the matter to the White House and the Treasury, the highest leadership at the White House and the Treasury, for a resolution.
Well, I think Gavin Newsom tries to do anything that generates a news cycle. So I don't know. I don't have too much more substance to go on there. But I do think that in the 2008 financial crisis, it was a Republican administration, George Bush and Hank Paulson. And of course, that was much larger scale. So I don't even try to draw a false comparison between the two. But I think the principles, in my view, are the same. If a bank takes the kind of risk and engages in the kind of asset inflation that leads to its failure when times go bad, they have to be, and even the people who deposited beyond the maximal, insurance maximums, they have to be held account to their behaviors, because that's how capitalism works. And so, this time it's a Democratic administration. 15 years ago, it was a Republican administration. This isn't a partisan issue. It's an issue about actually the discipline about letting capitalism work as capitalism without actually, letting a small group of people enjoy the goods enjoy the benefits of times going good in the go-go days, but actually, I would say federalizing the costs when times actually go bad. I think that is a formula for justified populist revolt in this country.
What would you do as president to avoid the next Silicon Valley Bank? And then I'll go to Ryan for a question. Go ahead, Vivek.
Yeah, I think a more narrow remit for the Federal Reserve is, I think, actually pretty high on the list, because I think the Federal Reserve is the backstop and actually created a lot of the conditions for these failures, both in the head up to 2008 as well as today. I also just think that a presidential agenda, this is partially related to what you said, but I think it's even a bigger picture and more important point right now, is you have a debate in this country between entitlement spending or higher taxes, even in the Republican Party, within the Republican Party, and also between Republicans and Democrats. And I think that completely misses the point. We need to look at the third option that we've somehow forgotten in this country, which is growth. GDP growth itself should be our main source of deliverance. Stop playing small ball with, the kinds of questions we're talking about with bailing out Silicon Valley Bank, or spending or entitlement cuts, or does it have to be about raising taxes? all that small ball compared to actually, if we can get back to 4% plus GDP growth, which we were on for most of this country's history, and I think that there are ways to do it. I'm a big fan of abandoning climate religion and a lot of other opposition to GDP growth in this country. The anti-growth agenda, if we can run a train through that anti-growth agenda, that's actually how we provide deliverance to this country. And anyway, just want to say, as I popped in, I'll listen in for a little longer and then pop off. But thanks, guys. Mario, thanks for hitting me up and having me. You guys do great discussions all the time. And I'm going to give a shameless plug to everyone on here. My number one goal in the next stage is to get a good spot on the debate stage. So if you like what you're, like what I'm saying, if you don't agree, great, that's cool. We can disagree. But if you like what you're hearing or want those ideas advanced, if you go to vivek2024.com and it's even $1 or $5 donation, number of unique donors is how we, break the managerial class within the Republican National Committee. So if people go there, I appreciate it. Vivek2024.com. Mario, thanks for calling me on. I'll go back to listen mode in my car, and great discussion as always, guys.
Thanks, Vivek.
Thanks, Vivek.
Okay.
Appreciate it.
Vivek, Ryan, would love to hear from you. Saw your hand was up. Would love to get your thoughts on what Vivek just mentioned and others. Welcome to the stage.
Thanks, Mario. Ryan Merkett here, startup founder, investor. I just want to quickly touch on what Vivek was saying around, we have to let capitalism play out. Technology is the second, highest industry for driving growth for GDP. And so, if we're going to let capitalism play out, it's probably not a great idea to let 50% of the startups that are backed by VCs to die out. I don't think that's great for capitalism. I definitely don't think it's great for our fight against China and other countries that are fighting us versus technology. But anyway, that's all I have to say.
Well, Ryan, Vivek made an important point, and it's a point that we've been asking throughout this space. Because I get that a lot of people are like investors, they in Bitcoin and so on and so forth. But most people listening are just the average person, and their question is this: those banks decided to take the risk. Those startup companies decided to partake in that risk. Why does the average American need to pay for that risk that they took while they're already struggling at this moment?
Because technology powers everything around us right now. If these guys go down, look out Stripe, look out payment rails, look out everything that that we use every day and we enjoy, right?
Ryan, can I push back on that for a second? Sorry, just want to make sure that that's clear. The point that's been made is that for Stripe or one of the other companies, they'll find financing. So they don't run the risk of companies. The companies that won't be able to bridge are the ones that were going to fail anyway. They were zombies, walking zombies. But I mean, I don't agree with that. But Ryan, what do you say to that pushback?
We don't know who the next Stripe is going to be, who the next Google is going to be, who the next Apple is going to be, right? Like we're losing out on that next 10 years of innovation, right? If we lose these companies. These are not just the zombie companies. That's where you're misunderstood. These companies are companies that have been self-filtered by VCs and accelerators who get thousands of applications, inbound cold emails every freaking week. And they look and they talk to them. They find out who are the next Bill Gates going to be, and then they go and invest in them. Like these are not just the companies that are starting up a little account. SVB doesn't open accounts for bullshit little companies. They open accounts for companies who are killing it and have VC dollars from VCs who knew how to pick the next winners. And so when we totally fuck these companies, we're going to be fucking every single startup that has been essentially been picked as the next winners for the next 10 years. And so look, I don't like bailouts either, but this is not just your normal bailout. These are companies that have been self-filtered through a mechanism that has been deployed over the last 15 years that has worked to pick the next unicorns and companies that drive jobs and drive paychecks and drive taxes and drive everything else. So, I mean, we're missing out. We fuck these companies. We're missing out on companies who have $2, $3 million, $4 million in funding who could be the next companies that are going to take on China, who could be the next companies that are going to take on Europe and the next, biotech, healthcare blitz that's happening right now, right?
Ryan, just to push back on what you're saying, I mean, capitalism is about market force, right? And boom and bust is part of the market. And a free market is a cornerstone of capitalism. What you're essentially almost advocating for, and I know you're not, because I know this is like a red alert for Americans, but it's almost like a non-capitalist society where you're funding innovation. Everything becomes part of the government. The taxpayers paying for everything. It's kind of, isn't it counter to actual capitalism?
No, I mean that's look, you can have bits and pieces of socialism and capitalism working together. I think we have that already. We have Medicare, we have Medicaid, we have all kinds of ways the social nets already provide for Americans. I mean, like, we can have institutions with more regulations in the banking environment that don't have this kind of shit. We can have, how about we reduce lobbyists, right? Like, how about we don't let CEOs go and lobby our government to reduce regulations so they can play fucking craps with our deposits? I mean, how about we start there, right? Like, we can have capitalism and we can have bits of socialism. We can have them working together. There's other countries who are doing this well, right? What the problem we have right now is that a lot of our banks are playing craps to get more profits so they can go get more value on their stock they own with their executive plans, right? So I mean, like, let's put more regulations in place on who can go lobby DC, right? Like, CEOs have no business, banks of CEOs have no business going to DC and lobbying to have less restrictions on our deposits. Like, that's bullshit, right? Like, I think we can all agree on that. And so, you know, I think there's a way to make it happen without going full Chinese socialism over here, right? Like, or communism. I think that's an argument that's BS.
Jason, Jason, you got your hand up if you want to answer, but if you can even, I'm guessing you're going to ask about answer about the same point anyway.
Yeah, no. So I was just going to say, I'm being a former FDIC. I think we're conflating the concept of like moral hazard and like what the moral responsibility is of certain deposits. And for somebody like Ryan or anyone that needs to make payroll, there are people being hurt. There are always people being hurt if you have an uninsured deposit. But one thing I think it's important to understand that's going to be a big game changer over this weekend right now with that report of maybe Goldman Sachs trying to go to the FDIC and acquire is the FDIC doesn't want to hold any of these assets. And that second part of the Newsom statement that you shared, Doctor, really reveals, like, when it talks about everyone's working with the FDIC to keep up the tentpole of the economy. So like, there's no like moral judgment going on at the FDIC. Their goal, and if someone wants to come in and buy these deposits, they'll happily sell them. Now, they do a screening process, just like they didn't really have time in this scenario to figure out who might be able to buy it, but there's definitely a race right now. And I think if FDIC, if they can figure something out before the doors open Monday, that's the best scenario, because then they'll avoid like Silicon Valley banks like franchise value dropping, and it could still actually be a deal. So I think, you know, when we talk about saving it or like bailouts, like IndyMac Bank was bought, but, you know, it turned into One West from, you know, the former Secretary Mnuchin, who went and bought that. And that was done with loss sharing, meaning 10% of the loans on a loss share purchase and assumption agreement. You know, that was for the loans, but for the deposits, you know, I don't think it's as black and white as like, are we going to be capitalist or not? I mean, a capitalist society kind of relies on the banking, relies on us being able to have the banking system work. And I think that we're really on a precipice right now, like for people like yourself, Ryan, where it's not even about like the moral judgment of whether to save you and your specific deposits. It's the job of the FDIC to do that. And it also is a top 20 bank. So that makes it even more important. And I just think it seems like we're trying to make this judgment as to whether it was farmers or if it was entrepreneurs or whoever, like who's worth more to the society. And that's troubling, just because I think that that's clouding the issue. Like it's not whether a bailout, a private firm should come in and bail out. Now, if the FDIC and Marty Grunberg, who's the chairman and has been at the FDIC ever since I was there, he's been there the longest serving, FDIC board of director ever. He's been a little bit anti-tech, and he did try to kill the Square charter. He protested that. So if when they say the FDIC is pushing back on like Goldman Sachs owning it, and if he screens out some of these private companies from being able to come in and make this deal a done deal by Monday morning, that is a little bit of a problem. So I don't think it's fair to pose to Brian that like whether it's like a moral choice or capitalism or not, because the FDIC wants to sell this stuff.
Jason, I don't think it's about a moral choice. I think from the way Vivek framed it, and he framed it quite well, was It's not an issue of a moral choice. It's an issue of American people having to bail out banks, having to bail out, startup companies. I mean, they took the risk on. So why does the average American who can't even afford to put the electricity on have to bail these people out? That's
to be fair, the risk. We haven't, again, as Mark Cuban mentioned, no founder had thought that a bank run was part of their risk profile. I mean, this is a never event. It never happens unless it happens to you.
But Danish isn't something that we've heard on this space over the past couple of days is that the reason why a lot of startup companies went with Silicon Valley Bank was because the risk factor, they were willing to take on that risk factor, which major banks weren't able to. So they were aware that a major bank wasn't able to take or wasn't willing to take the risk on, and hence why they went to that bank in the first place.
Well, it also had to do with the fact that a lot of these Silicon Valley Bank secures its loans with warrants on equity. A lot of banks are not set up to do that. And so this concept, sure, they were riskier and liquid assets for the long run. It's the thing I was going to say to Jason was that, Jason, I hate to say this, and I don't mean to say this in the wrong way. There are certain account holders that actually should matter more. People that are working on critical aspects of the economy. Innovation, we are in a race right now against an adversary, at least one, if not multiple. The one solution that we have that is the most American of solutions is innovation. That's what we do best. If we don't save the heart of our innovation economy, which some people might say, oh, well, look at Miami. That's great. A lot of people in Miami also had SVB, but it's largely in Silicon Valley. It is the Bay Area. That is the heart of American innovation. And if we let that go, then we are going to take a big step back. And I think that, again, to expect folks who have bank accounts and deposits, by the way, they're building their company. A lot of the people actually didn't have lines of credit even. They just had deposits in there. For them to just go by the wayside, I do think that it's, yes, are we taking money out of other people's pocket? Possibly. But we're doing it for the good of everyone.
I definitely concede that with you, Doctor. I definitely, what I would just say is the Silicon Valley Bank is a unique bank. Okay, let's just 97% had more than $250,000. It wasn't for grandmas and other people like that. So it's a unique circumstance, and I guess I'm just a little more bullish about the abilities of not a bailout from the American people, but of a private company like a Goldman Sachs coming in and doing the deal with the FDIC to get all this stuff back. Because I am with you there. And I do know eventually there are always judgments about who might be more vital to a society. But in terms of deposit insurance, though, it really should be up to $250, and then decisions have to be made. And if it's going to help the safety and soundness of the banking system, and like you said, a race with China, then that does add importance to it. It is a unique bank.
But also not downplay the defense, right? Defense Department and what they do down in Silicon Valley. There's a lot of research labs down there, and they're building, weapons and all kinds of things for our government. And a lot of the startups get acquired by these larger defense companies, and this could really hurt the channel or the pool of those startups that are going to be helping our national defense in the next 10 years. So, this could be a national defense issue.
Yeah, but let's put a scale on it.
Mario,
I mean, the scale here, the loans at SVB, only $75 billion. The rest are treasuries and MBS. There's a very little in what they have on balance sheet for warrants. But innovation is only $7 billion of loans. So it's not a big macro U.S. deal here. And I don't think, justifying competitiveness with China or using competitiveness with China justifies a taxpayer bailout of the uninsured depositors. I think the private market should be doing that. There's lots of folks they know this sector really well. They should come in and look at that loan portfolio and start picking it off. This is a mark-to-market problem that has led to a liquidity problem. And by the way, this bank just reported its 16% capital levels. It survived all the capital stress tests. Just 2 weeks ago they reported this. Although what the problem was, embedded in their assets 9 months ago was a lot of carnage that they didn't own up to. It's a management problem, and it's a regulatory problem for being asleep at the switch. Our Fed is much more interested in wokeness. Why is Janet Yellen over in Ukraine talking about, their pensions? They're totally asleep at the switch. They should be given back to Nash's comment. Once you meet your 16% capital level, regardless of your size, you don't do the higher stress test. But that doesn't mean the regulators can't jump in and find these super concentration risks like they should have been doing at SVB. SVB is a super concentration risk.
So, as Robert, you said 7 billion. So, what percentage of their portfolio was on tech?
Oh, well, so they have 50 billion, what they call global funds, and that's tech funds. So, but the total loan portfolio is 75 billion out of
in venture debt.
What's that?
Yes. Yeah. In venture debt, right? Line of credit.
That was their loan. Their asset side is loans to that sector. So what they classify as innovation was 7 billion. But I mean, embedded in the global funds is all kinds of tech stuff. Well, if you assume their whole loan portfolio, take out the wine, they're about 70 billion of kind of tech related, which you could say is a super concentration. They're basically their entire most of their loan book is related to the Valley, right? So, but then their deposits is a big thing. So,
Robert, do you agree that the Valley is
just before this? Let me get it a bit more exciting for you, Danish. I just took a bit of a break, and then someone sent me through this piece of information from Axios. Silicon Valley, that was 15 minutes ago. Silicon Valley Bank paid out bonuses hours before seizure. Let me read out the first two sentences. The bank on Friday paid out annual bonuses to eligible U.S. employees just hours before the bank was seized by the U.S. government. Axios has learned from multiple sources. And then it continues with what to know. The bonuses were for work done during 2022 and were previously scheduled to be distributed on March 10th. That day ultimately coincided with the bank's takeover by the FDIC. So, yep, I'm not sure how common this is.
But Mario, in fairness to them, they haven't. The bank has not paid out dividends, and they haven't bought back any of their stock. But yeah, bonuses, and their CEO is making $20 million a year, right? So, but on the surface, their growth was looking good. They got a lot more loan volume, a lot more deposit volume, but deep embedded in their loan portfolio were the problems, and they couldn't own up to them. They should have had a $10 billion reserve on these things. They only had $600 million.
And Robert, just to your point, because I think you kind of inferred that point anyway, because Mario mentioned this earlier that other companies have already come in and offered 65 cents to the dollar, 70 cents to the dollar. So why not just let the market solve this issue as opposed to doing a bailout?
Totally.
And Americans pay?
Yeah, let capitalism ride this, and they know these assets better than the government and the taxpayers. Let them do it. And I think again, FDIC did take this asset. It's done. The change of controls happened. Now they're probably going to be doing loan level sell-offs, and it'll probably be, I don't think it'll be as bad as people. I mean, look, there's lots of carnage and bad financial and monetary policy going on right now with it. That did contribute to this, but I think this can be resolved pretty well. Maybe where you get 65 cents on the dollar to the non-insured depositors.
And Danish, wouldn't that Ryan or Jason, isn't that what capitalism is? You let the market solve the issue. I mean, what I'm hearing here is if the situation allows it, forget capitalism and let's innovate so we can deal with China. So, I mean, in a capitalist society, isn't this the best way to go about it?
No, because in a capitalistic society, it's about setting up winner, let the market decide who the winners and the losers are. Here, and, respectfully to Vivek Ramaswamy, who was on the stage earlier, and he is a presidential candidate and he does have his talking points. But, as somebody who talks a lot about merit, I will disagree with him that just, if the point is that YC, Techstars, and all the top tier investors, their startups are using SVB, they are clearly not the worst of the startups. And so, it was not a selection of the worst. It was a random selection of people that happened to use SVB for their banking. And as Robert has laid out, some of them had loans, but the large majority of them did not. And so, if you're holding your deposit in a bank, that should not be in a specific bank. That should not be the reason why your
company fails, that is an exceptionally not merit-based reason for it to fail. All source, did you want to weigh in here?
Yeah, so I just wanted to provide a kind of like two comments, right? The first one about the tech startup and kind of like the Defense Department and modernization. And I think one of the things that are very important to understand, yes, there's a lot of tech startups that start with Defense Department contracts for modernization. But if you really look at the prime, companies that lead a lot of these modernization aspects is your Northrop Grumman, your Boeing, your General Dynamics, and then through their subcontractors of other very high level, maybe not as commonly known, but there's other that fall much up in the modernization aspect. And so there's a well-established change within the Defense Department of who can provide modernization, such as SAIC, KBR, et cetera, right? And so the tech startups that kind of start up, if they have a very valuable product that is appealing to the Defense Department, I think this is kind of the conversation that a larger company, Defense Department contracting agency would probably buy it out. And that is very, very, very common of bigger companies buying smaller ones. So I wouldn't be so concerned about the tech startup from a national security point of view. But one interesting thing I think that has not been brought up, and this was an article, and I'll share it on the Nash from The Information, Kate Clark. And what she talked about is actually how SVB's fall is actually causing panic in China. And the reasoning is that Chinese tech startup companies have a very hard time.
Also, just sorry, bro, I'm gonna interrupt you just for a bit of breaking news. So Bill just tweeted, let's see if he can join us or he's still busy, but he just tweeted from a source I trust. And let me retweet it as well so anyone wants to read it. Silicon Valley Bank depositors will get approximately 50% on Monday, Tuesday, and the balance based on realization value over the next 3 to 6 months. If this proves true, I expect there will be bank runs beginning Monday a.m. morning at a large number of non-SIB banks. No company will take even a tiny chance of losing $1 of deposits as there's no reward for this risk. Absent a system-wide FDIC deposit guarantee, more bank runs begin Monday morning.
It's not logical. He's talking his book. Bill Ackman always talks his book. It's not going to happen. His argument about money being pulled out of regionals is bogus.
So what about what about Signature? That's the one that comes to mind, Mario.
There are isolated super concentration issues that the regulators should be all over. And yes,
for Robert, they power the innovation economy.
Yeah, no, that's fine.
Signature powers all of Web3 now, and Silicon Valley Bank did before that.
This is where the cycle of life here. Let the next banks come in and stop, pick it up, pick where they up. The competitors, the SVB has competitors, right?
It does not as much anymore. That's the point that we're making. Their competitors, in crypto, for example, their main competitor, Silvergate, is gone. Is no longer
that was
deposits.
FDX carnage, right?
Yes, that was FDX carnage. But at the same time, this SVB situation is not. Again, when a bank is doing stupid practices, that is not always the fault of the deposit holders.
Correct. This is not a deposit issue. I'm totally with you on that. That when you have these, what I think are illegal tie-in arrangements, where you do a loan, but you got to put all your deposits in there, including those over the $250K insured deposit risk, that needs to be looked at seriously.
So, Robert, what about First Republic? It's a bank that both tech people and regular people use, right? First Republic, and I'm not naming these banks to start FUD. Right. God, no one go and take their money out of the bank. It's not, or do it. You do your own research. I don't know, but I don't know what the right answer here is. But what I was going to say was that you've got all of these banks that work with small businesses. That are in the communities. People are going to start asking questions, and I think the Bill Ackman, while sure he might quote his book, I think ultimately we have to ask the harder question, which is, how is it if you were sitting there with money in Signature Bank right now, would you not even consider it? Really?
Well, I think these are unique features of that space in that area. It's not a bunch of banks. It may be a handful of banks. So I think it's a lot of people want to go to the macro and the contagion argument. I don't see that. There's a lot to be learned from this. This is a mess, but it's more a regulatory mess and a concentration mess.
I do think the 50%, Doctor, is really positive out of that statement from Ackman that Mario just read, because the advanced premium was unknown. So that could mean, if Ackman's correct, that like on Monday or Tuesday, 50% of your uninsured deposits for these startups will get their money back in the form of an advance dividend.
And I just posted it up in the Nest actually. So yeah,
I've just sent him a message to see if he's free, because I know it's a weekend. He's busy with the family, but it'll be good. There's a lot of people concerned. I'm getting a lot of DMs after this tweet, so be good to get a bit more. Clarity
you know what supports that, and I think it's going to be over 2/3 payout on the uninsured depositors. They have tons of treasuries and MBS that are pretty darn liquid. Still, maybe not priced right, but it's not going to be. It's like about 100 billion of that on the books. So even if they take a 10% haircut, you still have $90 billion on that. So that goes a long way to pay out uninsured depositors. I think it's going to be like I would expect that 50% coupon or dividend they're going to do on Monday. That will help with the payrolls of all the customers and depositors. Insured depositors get 100% right away, and they'll. Oh, you know what? I forgot to mention. This is a kind of this entity had 8,500 employees. We have to talk about, they don't have jobs anymore. I mean, a lot of them, a couple thousand might be continued to be working the branches. Now those new branches are going to be renamed, depository insured institution for Santa Clara. But 6,000 people are going to lose their jobs right there in that area. That's a problem.
Matt, thanks for coming on. Just quick question: can you share with us the DM you sent me about the facilities, the lending terms that you're seeing?
Yeah. So, hey everyone, Matt Cohen, founder and managing partner of Ripple Ventures here. We're seeing a lot of pretty predatory financing options for companies who need it, because what we're hearing is large banks are not willing to lend lines of credit for companies who have multiple $1 million payrolls coming up in the next few days. And so the terms that people are offering on the receivership certificates, so the non-insured portions that will be paid out over the next 3 to 6 months, range anywhere from 30 cents on the dollar plus 12% equity, 12% interest, plus maybe an equity kicker on the warrant, and up to tens of maybe $10 to $20 million lines. So there's some pretty aggressive terms out there: 12% interest, equity warrants, 30-cent dollar coverage on the collateral side. People are really trying to squeeze what they can out of the companies who aren't going to receive much come probably Monday beyond the insured portion.
How would you value something like this, Matt?
I mean, what we're telling our companies is if they're being shopped this, they need to call us, and we'll provide our own lines of credit with way better terms. And we're not talking in the millions that these guys are, but if someone really needs $10 million to make payroll in the next week or two, they have to furlough employees, because these terms will become more aggressive if they start to miss any type of payments over time. And, you can furlough an employee and then bring them back. But 30 cents on the dollar, first of all, doesn't give you much coverage anyways. And secondly, you'll probably get squeezed even worse if you start missing payments. So we're trying to tell companies to do furloughs for the time being, and then try and rehire those people when more capital gets released back to them.
And so you guys are off. What percentage of your portfolio has been affected? If you don't,
not much. Like I said, we're a Canadian fund, so 50% of our capital is deployed in Canada, 50% is deployed in the U.S. Of the 50% in the U.S., we're talking less than 20% of our U.S. portfolio is affected. The ones that are the most affected are the ones that have, shorter runway duration and also higher payrolls requirements. And so we're scrambling to try to figure out how to get them through the next couple weeks or months if need be. But the rest of the ones have such low burn that we can bridge them for 6 months, if not more, and we think they'll be fine. It's the ones that I'm talking to that are not our portfolio companies, but that have multi-million-dollar payrolls coming up in the next couple weeks, and nobody's really throwing them much more than pretty aggressive terms like these. And so we're trying to find better options for them. And they're not our portfolio companies, just friends of ours.
When you're saying finding them better options, you're talking about traditional
investors. We're talking about investors. Like, what kind of investors out there are willing to put capital in?
Equity investment or debt? Just want to make sure we're speaking.
It's going to probably be structured as convertible preferreds. So I would treat that as debt.
Yeah, debt to equity convertible. Yeah. Okay, perfect. And then And when you're looking at the situation, does this tell you anything? Is this just something that happens in terms of when an emergency hits? They're opportunistic,
Of course,
capitalistic, opportunistic folks. Yeah. Because right now, Bill Ackman's tweet clearly, this is, I don't know if anybody's noticed being up here on the space or listening down in the crowd. We have heard this number 50%. It would be incredibly sad if everybody's hearing from the same source and then coming back to the same. So this has not been, just want to say this, this has not been verified by any sources at FDIC or at SVB.
But we've had enough. I know that a lot of people would doubt what Bill Ackman has tweeted, but we've had enough sources, in my opinion, to at least start taking it seriously, and a few credible sources already. Like I'll see when Bill joins, we'll be able to ask him if he can share his source. But we've had a few so far.
People saying it. No, I agree.
And guys, if I could, maybe this is a good turn to ask Jason. So Jason was a part of the AnyMac wind down in 2008. I wonder what's like is there like a general rule of thumb, like the first week or two, like the first advance cut that people would get, or no? Jason and I were talking about this at length over drinks last night, so it's fresh.
Oh, hey, Marshall. Took me a second. What's going on? So basically, I mean, the key to all of this is the FDIC is going to want to sell the stuff and get it off their books as soon as possible. And if the type of dividend that they're talking about, which would be for the uninsured deposits, depends on a lot of factors, how they're valuing things. Chairman Greenberg's probably talking to Fed and Powell about, the treasuries that are on the books, things like that. So they're all trying to understand, what the possibilities are, what's on the menu. And this is not a bridge bank scenario.
I'm just going to jump in and interrupt, just because I know Bill doesn't have a lot of time, so I do apologize, Jason.
Oh, yeah.
Bill, good to have you. I appreciate you making the time on the weekend.
Sure. Important subject.
It is, and I think the timing is pretty perfect. So maybe if you don't mind giving us a bit more clarity on the tweet, if there's anything else you can elaborate.
Yeah, look, I think it's highly likely, based on at least it makes sense, and also the source that I spoke to, that there will be a distribution to depositors, uninsured depositors, early next week for something in order of 50 cents on the dollar, and the balance to come with the progress of the liquidation, estimated 3 to 6 months, and you sort of get what you get. And depending on how well it's done, if it's a fire sale, it's more likely, high 80s, low 90s. And if they do it better, it's probably, mid to high 90s.
So Bill, hey, nice to meet you. I was going to ask you, how much of, I know you make a lot of investments. What percentage of your portfolio would you say has been affected by this?
None of our, my day job is in managing, Pershing Square, and I invest in, very well capitalized, Hilton, Universal Music. I would say really no impact there. I have no direct exposure to Silicon Valley Bank. I'm an active I'm more an investor in venture capital funds, and I'm an investor in, startups personally. And I'm sure some percentage of those have some exposure. So I probably have some indirect exposure, but it's not material to me. I would say what would be material to me would be this, we're kind of long America. So, if the government does the wrong thing here, I do see a, domino effect, beginning shortly. And I think that could have a pretty negative effect on markets, capital markets. I mean, we'll be fine. We're not a levered participant in the capital markets. I just think it's bad for America, bad for our competitiveness, bad for, I think of the, our startup community, our available, it's one of the important competitive advantages of our country, and an important driver of growth is the kind of startup ethos and community. And this is, has become a, pretty important part of it.
So there's been two narratives that have been spun, Bill. One narrative is kind of what I was mentioning and you just mentioned, which is this is too important to fail. We can't fail the innovation economy, especially because we are currently in a race for innovation with an adversary. But there's another part of this, which is, hey, there's nothing to worry about. There's a very low risk of contagion effect. This is not a big deal. I've read your thread that you put in, but I'd love for you to explore why you think that is misguided, thinking that this couldn't lead to a contagion effect that could then affect the average American.
Sure. So, I would say no one has had to think about, am I an insured depositor or an uninsured depositor? And people have operated as if this is not an issue. And effective Monday, if people who banked with SVB find out they're only getting 50 cents and they're not guaranteed to get their money and it's going to take months, that's kind of the crossing the Rubicon moment for uninsured deposits. And if you're a corporate treasurer at any company, you're CFO of a startup, you're CEO of a startup, you're a venture capitalist, you're an investor in growth companies, one of the demands you're going to require is that they keep their money in JP Morgan or B of A or, Citi, that you sweep all your cash into US Treasuries. And, you're allowed to fail in the startup world, but this will be not a place, post SVB, this is not an allowable point of failure, right? Because it's, again, it's totally asymmetric, right? Maybe there's some convenience factor. I don't know enough about SVB and the kind of user interface, but I assume it's very good compared to some more traditional banks. But that's about it. It's not like you're earning massively more return keeping your money there, right? So you're not earning an incremental return, and why take any risk, sort of whatsoever? And that's, and the most sophisticated depositors are generally the largest depositors. That money will leave very quickly. And so, you can just line up, the banks in the country and take a look at their exposures. And, there's just no incentive to bank, once, the depositors here, if they're not made whole, immediately. And in fact, everyone's going to leave, there's sort of a hierarchy of banks. You can rank them. You can look at which stocks went down on Friday, but the same thing's going to happen on Monday. In fact, the stocks will go down. People will, they'll run for the exits, and you have a classic. It's like it's before we had FDIC insurance, right? The introduction of insurance way back when was to solve this problem. The problem is they've created two classes of banks. They've created the too big to fail, so-called, SIFI banks,
the big four,
and then it's more than the big four, but it's it's a handful of banks, and the rest of the banks. Why would anyone bank? And if you think about how important kind of the community banking system is, it's often, you're not going to get a loan from B of A for some small project in Iowa, right? If you're a small business person, right? You need a relationship with your local banker, but if you can't keep your cash there, right, they want to have access to low cost deposits that will affect their ability, to make a working capital loan to, or mortgage to someone buying a small industrial building to open a factory, right? We need this sort of network of community, and regional banks to finance not just growth companies, obviously, but to finance kind of mundane businesses, restaurants, et cetera. We can't have all of the deposit capital flow into the big banks, and that started happening on Friday.
So before you came on board, Vivek Ramaswamy, who is a former tech entrepreneur and is current presidential candidate, he brought up his opinion on this, which was that we should just let capitalism do its work. And this is part of the normal capitalist cycle of the boom and bust cycle. And that this is just something that we should let happen. There should be no form of bailout. 250K for those people that not even the 50%, 250K, which was promised on the FDIC. We should not have a repeat of 2008. We should not be bailing anybody out. We should not be bailing the quote unquote elite out. And so that is one approach. In your thread, you actually recommended a completely different approach. What do you think we should do here?
Sure. So I like Vivek. He's a friend. I actually, in effect, helped launch his campaign with a tweet. As I said in the tweet, I don't agree with him on everything. And despite the fact he's a very smart guy, where he's correct, is the equity holders of, Silicon Valley Bank should get smoked. Okay, the holding company bondholders probably should get smoked. Just whatever capitalism says, and I can tell you what I would have done differently if I was the FDIC. You don't protect. And the word bailout, I think, it was a mistake in my initial tweet on this a couple days ago, using the word bailout. By bailout, I didn't mean bailout equity holders, bondholders. I meant protect the depositors. The banking system does not function if people don't trust banks. And your typical depositor, who's got even $1 million account at a bank, doesn't have the time or energy, resources, or often the financial acumen to figure out whether the bank is safe or not. They have to trust the government. They have to trust the rating agencies. They have to, because they got other things on their mind, right? Once you say, okay, depositors are at risk, then depositors have to be, really careful about where they put their capital. And that is a world in which the default decision is you just go to JP Morgan. And JP Morgan, I'm sure all the big banks are calling around to their clients and saying, hey, if you have money elsewhere, you don't feel comfortable about it, we'll happily set up a new account for you over here. And so there's the system. The deposits are draining and began draining over the last couple of days from smaller banks into bigger ones, and ultimately we'll end up with 3 banks. And I just think
and that's obviously awful for the economy.
It's a disaster.
And so as we look forward, sounds like what you're recommending is the FDIC make everyone whole.
Actually, what I'm recommending, the smart strategy here, the FDIC should think like a distressed investor. What they should have done is they should have announced that they were guaranteeing deposits. Hold on one second. Sweetheart, I'm just on the... Okay, that's beautiful. My daughter, by the way, just learned how to poop in the potty, so just wanted to make sure everyone knows that.
Congrats, that's a big...
Awesome. She said... She's very excited, jumping around. And by the way, this is about kind of like the next generation, right? If we screw this up now, it's not going to affect me personally, but it's going to affect a lot of...
She's so proud of her deposits.
That's awesome. All right, so her question was, how do I stop myself from sucking my thumb? That's her last big problem. Don't put that in your mouth. Okay. All right, sweetie, go to mommy. Okay.
Mario, I think you're gonna crash, because it says connection issues.
Okay. Yeah. Okay, I'm sorry. Where was I? Okay, so
we were just talking about how.
Yeah. So what the FDIC should have done here, okay, is they announced that they're guaranteeing deposits, okay, and then they manage a process over the weekend where, first of all, some combination of Sequoia, GA, Andreessen, pick your list of favorite venture capitalists, and the more the merrier. Form a consortium. They also team up with someone who knows something about banking. I'm happy to participate in that, that kind of scenario. And the bank gets recapitalized with a fortress amount of additional equity. The underlying, securities are sold at market prices, and they're liquid. You put the assets in, short-term U.S. Treasuries earning 5%. And you replace the senior management of the bank. You get rid of the board of directors, and you reboot. And by the way, there's a real franchise value here, right? This is a 40-year-old institution that's built relationships with a network of, very successful venture capitalists, growth companies, and you move forward.
Let's see if we can get him in, and I think it's a good time because all of us want to get a bit of a break. So, it'd be good to have Bill. Yeah, Bill, get back.
Sorry about that, Bill. You're back.
Yeah, it happens when we go on for a long time, after like 10 hours or so, and we get a big audience. You know, we had Mark Cuban earlier. Now, of course, with you, we had a big audience come in, so it does crash. But you can hear us, yeah, Bill?
Bill, you're muted.
Can you hear me?
Yeah,
Yes,
we can hear you now. Yep.
Okay, so what I was saying is I think the right approach here, they announce, and they could do this on Monday or Sunday night. They announce they're guaranteeing deposits. The bank is they're going to run a process to recapitalize the bank. A group of the top venture capitalists get together, and I think the more the merrier, with a number of leads, maybe proportionate to the assets that they manage. They commit. We decide on we figure out how big the hole is, right? So we sell. The FDIC manages the sale of the MBS portfolio, and the kind of 3-year, whatever it is, 3-year duration treasury portfolio. And by the way, the decline in yields over the last 2 days, as people are dumping, pulling their assets from banks and putting them into short-term treasuries, is actually helping the situation a fair amount by bringing down yields, increasing the value of their assets. You sell into that, and then you have the most liquid one of the most liquid large banks in the world, where you got $20 billion in short-term U.S. Treasuries earning 5%. You've got the balance of the portfolio in, I think, pretty good. When I took a look at the bank, about 55 billion of it was, these loans to venture capitalists and growth private equity people, and it's basically a loan that they use, as for sort of working capital, where they fund investments and they call capital from their LPs, once a quarter or something. Those are very safe loans because they're ultimately backed by, a bunch of pension funds and high net worth people who commit to make investments in these various funds. And so I think the asset side, can be very quickly made to be fine. And it actually shouldn't be that hard a bank to due diligence. But I think, the process of liquidating those assets will create a hole in the balance sheet. And then you fill the hole, you overcapitalize the bank, and you go forward. But it doesn't work unless we're in a world in which the FDIC is guaranteeing deposits. And I think, you can have some threshold. I mean, if you move the 250K to, you should take a look at what's a reasonable amount of working capital for a company to keep in a bank. And, you could say 25 million or some number like that. The FDIC moves up to $25 million. And then the bank is back in business. We punished the equity investors who didn't properly oversee the institution they were a shareholder of. So the old equity investors get smoked. The new investors, should make an attractive return. And the FDIC, you give them a pile of warrants, for their stepping in as kind of the lender of last resort, as the guarantor, and life goes forward. And by the way, that could be announced on Monday, and you give this group a sufficient time to do due diligence. It's not going to take very long. In fact, if it's a bunch of venture capitalists that know these assets well, it should go pretty quickly. And I think a week later, you could announce a transaction.
And Bill, in the interim, this sounds incredible. And honestly, if it turns out to be this way, it was broken here that Bill was mentioning this. But, one thing that in the interim, or even from now moving forward, Silicon Valley Bank was such an important institution. And even when we got wired a check from an RVC, it came through SVB. So it's such as you mentioned, they were involved in providing a credit line for the VC before they could do the capital call on the LPs. On the LP side, from an LP perspective, how do you see this loss affecting the venture economy?
Well, it's a black eye in the venture economy. If LPs are okay losing money because they understand that venture capital, not every investment works, right? And some vintage funds do better than others. But what they have zero tolerance for, I would say, is losing money because the sponsor put the money in the wrong bank account, or their underlying companies, took credit risk on something they should take credit risk. People want to take the risk that they intended to take, right? The risk of investing in a venture capital fund, the risk of investing in a startup is, the underlying businesses fail, and you don't have enough successful ones to make up for the losses, plus an adequate return. That's what people signed up for when they signed up for venture capital. They didn't sign up for, whoops, the money disappeared because the bank I kept it in failed. That's not a acceptable outcome.
Yeah, and taking another step back further, we've never seen, and Cantro on the stage mentioned this earlier, but I'm going to mention it one more time, which is we haven't seen the Fed ever do something like this, something so unprecedented, where they had quantitative tightening, rate hikes like we've never seen before, and at some level, the Fortune article that was in the nest earlier, but now that we're in a new space, it's not there. The Fortune article, where they showed that we actually deregulated and reduced the burden for stress tests for small to medium sized banks. All three happening at the same time. Which of those do you think that the Fed is at fault here?
No.
Hey, can I just correct that? It's the third variable wasn't QT, but sure, we can add that. It's commercial bank lending standards being aggressively tight.
Yeah.
Yes, commercial bank. Yeah, go ahead, Bill.
I think none of that is responsible. This is a case of basic banking 101, right? Your principal job managing a bank is making sure that your earnings on assets exceed your cost of liabilities, okay, and you're match funded, okay, meaning there's no scenario in which you find yourself with long dated fixed. Basically, buying. I think what happened here fundamentally is there was a huge inflow of deposits because of the massive amount of money that went into venture capital funds and that ultimately went into startups, and SVB couldn't find places to make loans, so they bought treasuries. But rather than buying short dated, and they bought treasuries actually, and worse, they bought mortgage-backed securities. Now, the credit quality of these instruments is effectively, it's all government guaranteed, but they took duration risk, right? And when you buying MBS, when rates are where they were at the time they bought these securities, in front of a big rise in rates, is catastrophic in terms of you've actually taken an enormous amount, not of credit risk, but of duration risk, and that's what went wrong. So that was a basic management failure of the bank, and the reason why it happened is likely they wanted to continue to generate earnings, so they would meet their guidance. And if they took
Bill, are they alone?
If they took all that capital and invested it in short dated instruments that better match their funding, they wouldn't. There was not enough. There was spread, if you will, between deposits and what they could earn on really short term instruments. So that's what drove this failure. This was a management failure, and it was a board oversight failure of this institution.
But Bill, to play devil's advocate, are they alone in this practice? Do you think that this is a common practice across many smaller banks?
No, I think they had a couple of problems. One, I think they're not alone. I'm sure there are others, but I think of big banks, I think that this was, we did actually kind of you can fairly easily, there's a ton of data on banks and look for where the problems are, and they're clearly an outlier in terms of this exposure, but they had a particular risk that I think is not present at almost every other bank in the country, which is they had such an industry, they had correlation killed them, right? All their clients are basically in the same business, and they don't have a real, if you think about stability of deposits comes from, Bank of America having, 50 million Americans having a savings account. Right. And often at levels, less than the FDIC guarantee. Here you had, I think, a very large number of business accounts, where the amount invested was in excess of, the FDIC guarantee. And that money, again, I'm not a client, but I assume the user interface is really good here. And it's incredibly easy to wire your deposit out somewhere else. And so the moment the storm came, and also you had a community connected on Twitter, right? So, when Peter Thiel says, okay, pull your money, and, there's one story on that, everyone in the community learns immediately. And so, boom, you're done. And I think that feature, feature is unique of this institution. But now that it's happened, Okay, the world has woken up, and it's unfortunately absent the federal government stepping in here. I think the most probable outcome is we wake up on Monday morning. If these depositors are going to lose money or lose access to their money, you're going to see capital flight, very rapid capital flight from, at a minimum, the smaller institutions, but also ones that have exposures to the same, space, growth equity, private equity, venture, and this, I'm not going to name names for obvious reasons, but that's not a good outcome.
Bill, I was just thinking about sort of the second order effects of that, what you just mentioned, which is
go ahead.
Which is, the second order effects of depositors having to wait 3 to 6 months to get half their capital back, and the flight of capital from regional to the systematically important banks. If you set that precedent and you have a whole bunch of failures of regional banks, what does that ultimately mean for the economy, in your opinion, in terms of where does unemployment go in that scenario? Is it too early to quantify that?
I think it's hard to quantify, but at the absolute minimum, it's going to massively increase the cost of capital for these smaller institutions versus the bigger institutions. And that's going to increase the cost of capital for everyone they lend money to, right? So the point here is, in order to keep money from going to the bigger banks, they're going to have to pay more in their deposits at a minimum, right? That's the best case outcome. They pay more in their deposits. They need to earn, they don't have the same economies of scale of big institutions, so they need to earn an adequate spread. It's just going to increase the cost of capital kind of system-wide for businesses that rely on community banks and regional banks for financing. It's going to put a lot of, it's going to put a stress. It's going to make a lot of projects not viable. It's going to have very significant economic effects, profound economic effects, actually targeted at, the not big companies. Big companies have access to capital markets. They can issue bonds, et cetera, and they can certainly get the attention of the big banks in terms of making a loan. But it's, again, the best case is it increases the cost of capital for all these smaller banks around the country.
Yeah, Pranav, we're going to go to Michael Cantro for a follow-up. Michael, question for you: do you agree with Bill's concerns, and do you have a question for Bill?
Yeah, yes and yes. Bill, this is probably the best advertisement to all of America that there's alternatives to low yielding savings accounts. So this probably just speeds this transition out of low yielding savings accounts anyway, regardless of how this plays out. You started to talk about, before the space broke, about what you would have done. And then when we came back on, you continued that, and I don't know if that sounded like what you thought was going to happen. Given the last tweet you just put out, that they're going to, it's going to take 3 to 6 months till there's any clarity. Obviously, that creates a lot of uncertainty between now and then. But what if that's how it plays out? What needs to break to get something to actually backstop this entire thing? And when do you think that could happen?
Well, it depends on whether the FDIC and the Treasury and the control of the currency are listening. Okay, and I think if I were there, I would be. And I'm sure that why did I tweet this out this morning? Because I woke up and I'm like, okay, the government's doing the wrong thing again. It could really destroy the economy and cause a lot of hardship. And what do I think they're going to wake up and say we have to guarantee deposits. And what's interesting here is this could be a money-making, if the FDIC is smart about this, okay, if I had the ability to guarantee deposits, right, as a fund manager, right, I would step in, I would guarantee deposits, and or forget fund managers, just think the FDIC, step in, guarantee deposits, everyone can breathe, okay, and then say, okay, this is an amazing franchise, and you bring in a consortium of investors, to take over the franchise. And by the way, you can have a competitive process because now you've got, once you guarantee deposits, everyone can breathe, right? But you can't just guarantee SVB deposits. You have to say, okay, we're going to guarantee deposits everywhere. It's a bit like during the financial crisis, the government stepped in and guaranteed money market mutual funds because there was a run at money market mutual funds, kind of very similar thing. And the one fund broke the buck, right? This is a break the buck moment in banking, right? You have uninsured depositors getting back, if it's true, and again, I hear this from a good source, I don't know it's a certainty, but it sounds credible that you get back something like 50 cents, and then you get back in a managed liquidation of the bank, whatever they get, and depending on how good a job they do and what interest rates are, but that kind of process doesn't yield the best outcome, right? The best outcomes yielded here preserving the franchise value of Silicon Valley Bank. And there is real franchise value. Now it's deteriorating dramatically, but with the right collection of investors, something happening promptly, you can restore the institution. You've got to get rid of the board. You got to get rid of the senior management team. You got to bring in a new team. But there, I'm sure, a lot of very talented, loan officers, relationship managers, people who know what they're doing in the bank. And it was not their decision to, buy a ton of Fannie Mae, Freddie Mac, MBS. So this is a solvable thing where the government, actually ends up profiting because they take a nice chunk of the bank for free, if you will, exchange for managing this process. But what shouldn't happen is what, Fannie Freddie was initially like this, and then the government decided sort of to keep the whole thing for itself, and then you put all this $5 trillion of credit risk onto the balance sheet of the U.S. government. I mean, that's another topic for another day. But that is an institution that is, recapitalizing on its own, and it should be an independent public company. But different.
Looking ahead, Bill, looking ahead and trying to figure out what the Fed will do in response. Do you think this changes the Fed's posture or their decision making about rate hikes? Whether their posture will become more dovish? Do you expect any of this to affect that?
It may. I think the Federal Reserve will be reluctant to put more stress on the system. I mean, what happened, people get used to, a certain state of play, i.e. rates on a continual march downward for the last, 40 years, basically. And then rates staying at a very low level for a period of time. And then you have a generation of people who've never experienced, a rapid rise in rates. And so they organize their life accordingly. And I would say the person who made the decision, or people made the decision, or the mistakes here were made by people who said, look, there's no world in which we see rates move up massively in the next X number of months. And by the way, the Federal Reserve had that same point of view, right? The inflation was transitory, et cetera, et cetera. Now this is, people say the Fed's going to raise rates until something breaks. Okay, something is broken, okay, in a pretty profound way. So I think there's a decent chance, 50 basis points was in the cards, a week ago, and now people are saying 25. I think there's a decent chance the Fed actually does pauses here and sees, and doesn't, they're concerned obviously about inflation, but this is actually extremely deflationary, blowing up SVB and 65,000 small businesses. That's deflationary, and it's going to scare business people. It's going to make them hesitant. It's going to scare consumers. Like if you can't be confident that what you have in the bank is what you have in the bank, you're going to stop spending money. So the Federal Reserve is looking for a way to really shut down the economy. This is a pretty rapid version.
It's a good way to go.
Yeah, Bill. What if that doesn't happen?
To be clear, they're not looking to shut down the economy. It's slow the economy, I should say.
Yeah.
This is going to do it. Yeah.
But what if the rate hikes? And as I prepared to ask this question, Bill, I'm getting videos of people lining up in Los Angeles at the First Republic Bank branch, under the rain, and being video after video for the last few hours. So my question to you is, if the Reserve Bank does not stop hiking rates, what could happen? What could we expect to see?
I think. Well, look, I think the government has no choice. I've not seen those videos, but it doesn't surprise me, right? What would you do? People are acting rationally, not irrationally. The people who took their money out quickly from SVB, SVB the last couple days of the week, they're fine. And the people who were quote loyal, and said, oh, that you shouldn't worry about this, are now, I'm getting texts from entrepreneurs saying, "What should I do?" And in various banks, I heard Jefferies is buying, deposits, SVB deposits 70 cents on the dollar. I think that's a disaster, right? And I respect institutions. Again, I don't know if it's Jefferies, but I heard various entrepreneurs, hedge funds, and some banks are offering to buy deposits, but that is
Jefferies was one of them. Yeah, I can confirm that. We've had a few send us that information.
Yeah, so I'd heard that as well.
Bill, what are you telling them to do?
My advice is, well, we'll see what happens on Monday, but I think you can't take risk. I do not think it is prudent to take the risk to put your deposits at risk. And if your deposits are at risk, you have to move them to a place where they're not. And today you can get approaching 5% in the U.S. Treasury money market fund. It's totally liquid. It's very convenient. You can often, and that's a lot more than you can get in a typical deposit account. It's a little less convenient when you're writing checks. But you know what? You can keep $250,000 in a bank account or the minimum there, and then keep the rest in a money market account. And that's, I think, what the world is heading toward. And it's unfortunate because the system of low cost deposits and a nationwide banking system is very important for the economic progress of the country. And the people responsible for overseeing that system. I mean, I blame absolutely SVB management. Okay, I blame the board, but I also blame the government. Right. This is a big obvious situation for the FDIC. I'm sure they had people there monitoring or whatever, but this is, they're responsible as well, and they need to fix the problem. And the fix is simple. The fix is simple. Guarantee the deposits. Then people can be calm, okay, and then manage a process to recapitalize the bank, and let the bank go forward.
So Bill, you're saying guarantee the deposits up to what point? 100%? 100%, no matter the amount. Somebody had 10 million in there.
Yeah, you have to. Yeah, you got to guarantee the deposits no matter the amount, because.
And then what about across the country and other banks?
Yeah,
you're saying raise the minimum to $1 million.
Yeah, is that the new precedent?
You have to do it. I don't think we can. What you could do is you could guarantee deposits at every bank. And then you could say, we're going to be reducing the limit we're going to be increasing the limit from 250 to some level, 25 million, whatever level that's appropriate, where people can feel comfortable dealing with banks. Maybe it's 50, maybe it's 100 million, right? But people are not going to take risk on deposits after this failure if there are losses here. And by the way, the ultimate cost of that should be zero. Okay. The government should be, we should be able to charge deposit insurance. SVB could have paid a lot more in deposit insurance and still have been a very profitable bank. So we should, banks should have insured deposits. So they should pay the cost for those insured deposits. And the FDIC, the control of the currency, should monitor banks, not just on the credit risk of their underlying assets, but the making sure that they don't find themselves in a situation with short-term liabilities and long-term assets, fixed rate assets.
So as you look ahead, Bill, one of the things that you've mentioned now is the impact of this. If we don't do the right thing and we don't shore up and make people whole, we don't, specifically as it comes to the deposits, I want to be clear about your words, not the shareholders, but specifically those who have deposits at SVB and other banks like it. There's going to be potentially a contagion effect to other smaller banks. What about in terms of sectors? Obviously, this is going to be slowing down growth of the tech sector. This is a stop sign right now. But when we're talking about other sectors and the contagion effect into other sectors, do you think that there will be an impact from this into real estate, into travel and leisure? Are you going to see a lot of this get affected? I know that you have more exposure to those industries.
Sure, it's going to have a general economic effect on pretty much. It's going to hurt the smaller businesses much more than the larger businesses, but that will have a general economic effect in slowing the economy and affecting consumer confidence and affecting business confidence. And all of these things affect the economy generally. And by the way, I'm less familiar with, kind of European, Asian banks, operating outside the U.S. This can have a global impact. But I think a world in which people can lose money in a bank sanctioned by our government, right? A bank that has FDIC insurance today, now again, only for $250,000 accounts, but where the government is responsible is they should be on the hook for guaranteeing deposits. They should charge an adequate fee for that deposit guarantee, and they should also properly monitor these institutions to make sure that there's no risk of to the depositors. That should be their job. And when there's a problem, they should step in. They should smoke the shareholders. They should smoke the bondholders. By the way, if there's an impairment, SVB I think has holding company debt as well. They shouldn't get a free ride here. They're earning a return in exchange for risk. And by the way, those shareholders are sophisticated enough to understand. Anyone who invests in the stock of a bank is someone who should understand the risks inherent to a bank. They should be monitoring their institution, and if they should be appointing a board of directors that's sophisticated enough to understand these risks. And if the bank blows up under their watch, they should suffer. Right. So the people making moral hazard arguments are correct, but it should not apply to depositors. Depositors don't have the capability. The vast majority of depositors don't have the capability, the time, the energy, and it's just an impractical world if you had to form your own assessment of the creditworthiness of a bank. Right. This is something you should rely on the government for on the deposit side. Hold on, I'm just going to close the door.
No worries, no rush.
Go ahead.
How sustainable is this bill? Bailout. So, it's become the norm now, and I agree that the alternative could be a lot worse. But how long can we keep this going on for?
But again, I don't view this as a bailout. I view this as how a regulator should manage a banking system. Banks will fail. Banks will make mistakes. You want banks that take risk. There's certain kind of risks they shouldn't be taking, but there are other risks. The nature of banking is inherent to risks. Bad things happen. You should build in adequate capital cushions. So the loser here are the shareholders and the bondholders who invested in the institution. But the losers should not be depositors who, some guy who's, I got a text from a contractor, who did woodwork, at my house. And he's like, what should I do? I have to worry. What should I do? That guy should be focused on his business. You shouldn't be worrying about losing money in a bank, right? That makes no sense. And there's the whole deposit insurance regime was a brilliant idea of the 1930s. It just hasn't been modernized and scaled up to a level that's appropriate.
And if we don't do the right thing, Bill, what are the long-term effects we'll see for innovation in the US for the tech sector?
Well, I said this almost tongue in cheek, but if Russia or China wanted to cause significant harm to the US's competitiveness and the innovation economy, they would have done a cyber attack on SVB. And if they could blow up the bank, it's sort of interesting kind of thought experiment, right? Imagine if there was a cyber attack. It took down Silicon Valley Bank, and they took a massive loss as a result of, a cyber attack. FDIC steps in. Do you think they would smoke the depositors in that case, or do you think they'd step in and guarantee the depositors and allow the bank to recapitalize itself? So the question is, if it was Russia, I think everyone would agree it's a certainty our government would step in and guarantee depositors and save it, right? And again, maybe not save the shareholders, but they would save the depositors. Should it be any different if it's, a ignorant management team that makes a mistake? I don't think so.
Yeah, often self-inflicted wounds are the worst. And so, no, I understand the analogy. My biggest worry is the worry of our competition on a national stage. I mean, this is a real national security concern. The concern around the fact that the infrastructure, so across all of fintech, many companies use SVB as their banking partner for their transaction rails. People have brought up USDT or UST and the impact that will have. We've talked about the the broader impact of this on the innovation economy, is this another nail, or chink in our armor as it comes to competing on a national stage against our greatest adversary, possibly, which is China?
Yeah. So for sure. And again, I think ultimately the government's going to do the right thing. The question is whether they figure it out by Monday. I think they'll have no choice by Wednesday or Thursday. So I think, hopefully they figure it out by Monday. And by the way, the damage is much greater if they wait to Wednesday or Thursday because of, the other thing, think about it. It's not just technology companies, right? Think about all the innovative, biotechnology companies, developing, life-saving drugs, developing life-saving technologies that can't make payroll, come this, Monday. And once these, that is, catastrophic. Catastrophic.
Yeah, Bill. Hey, Bill, if this idea that you would turn deposits up to 25 million insured, or whatever that number might be.
I mean, I think
what would that?
I think you have to make it unlimited at this point. And then the question is whether there is some level that once you get everyone safe and comfortable, and the government decides they don't want it to be unlimited, they want it to be at some limit. But I think I think it can be effectively unlimited as long as deposit insurance premiums are paid, guarantee premiums are paid, and there's proper oversight. I don't think you should be I don't think you want consumers or business customers of banks worrying about losing money on deposits. These are often,
And just in line with that, because Friday I got a phone call from my banker. He initiated the call and wanting to tell me, "Hey, we're good," which I thought was interesting because I've never gotten that phone call in 20 years. And the idea that if you raised it to what does that influence the confidence in the dollar around the world?
Your mic, your mic is gone. But I think it's the influence on the US dollar.
Your mic we can hear from you while we're waiting for Grant. Go ahead, Andy.
Yeah, I guess I wanted to just say a couple of things. One, as it relates to the FDIC guarantee, it's important to recognize that this bank had 97% of its depositors uninsured, which is extremely unusual across the global banking system. And as it relates, and so that's a very important difference versus the rest of the system. And I guess the second thing that I'd ask Bill,
Andy, does that mean that they weren't insured for the 250,000?
They were not. They had a bigger account than the 250,000. So they are at risk to receiving less than 100 cents on the dollar because of the $250,000 limit, which, by the way, is a congressionally determined number. The FDIC doesn't just pick that up and say it's okay. They're putting the whole faith and credit of the U.S. government at risk when they make that guarantee. But as it relates to the idea of unlimited FDIC insurance, I think it's very important that you recognize that there is a very big cost. And that very big cost is if our banks were 100% guaranteed by the U.S. government, no one would finance the U.S. government when they issue bills.
Well,
and Bill, that's basically the
Bill, what are your thoughts on that? So I'm on 1 second. Bill, do you agree with that concern that Andy just brought up? That's a good concern.
Well, first of all, the notion of unlimited, I think it doesn't need to be unlimited. That's sort of number one. I think there can be limits. I'm saying when you're in the midst of a crisis, you need to make it unlimited. It's a bit like the mutual fund crisis. You can't tell people, look, we'll guarantee 98% of your balance in your mutual fund account or 90 cents on the dollar. That's not going to stop the panic, right? You got to tell people they're totally comfortable regardless of what they have.
Right. And the question is,
and then you can later, after the fact, you can say, okay, what's a sensible level for people for business balances, where you keep your capital. But I think there are many reasons why you buy treasury bills versus keep your money in a bank account. Often bank accounts pay less than treasury bills, so that's a reason to obviously buy treasury bills. Banks offer convenience and help. They're easier for payments, etc. But I'm not particularly concerned about that risk. And there's also a global market for Treasury bills. But I think there's time to figure out what an appropriate level is. But $250,000 is clearly too low. And while I agree that SVB is an outlier at 97%, but if the statistics I've read are correct, I think there's something like 50% of the depositors banks around the country are uninsured, or at least effectively uninsured because they're in excess of the $250,000 limit.
So as you're looking forward, we talked about what the right thing to do is. We talked about what would happen if they did the wrong thing. I don't know if we explored that enough, Bill. Again, if they don't do the right thing, SVB falls, people are not made whole. There could be a contagion effect. You have brought it up on the smaller banks.
Okay, it's not just smaller banks. It's every bank. I mean, the other thing that's kind of seems wrong to me is the government's effectively said, look, we've got these systemically important financial institutions, and we're going to bail those out. Okay, so you can feel comfortable as a counterparty dealing with those institutions, and we have a precedent for doing so, and this is what we're going to do. For everything else, it's $250,000. That to me seems wrong. And if you think about this administration, they're totally opposed to. It's hard today for one company to acquire another, any kind of scale, right? You see, almost every decent-sized transaction is being challenged by the FTC. Here's a way. Okay, SVB is allowed to fall. What it will do, it's already having this effect, I'm sure, is it will massively concentrate the banking system in, the top 3 or 4 banks in the country. And that's the outcome of an announcement that people are getting 50 cents on the dollar on Monday, right? And I don't think that's a desirable outcome. And again, I think it's important to, at least this, until technology replaces the system, having a network of, if you live in, somewhere in Idaho, and you got a farm, you got a local banker who meets the farmer, assesses his, character, creditworthiness, the quality of his land, and, makes a decision to lend him money, to buy a new combine, right? For working capital. And he makes a decision not to make the same loan to the farmer across the street because, his soil is not as good or he's not as good a farmer. That can't be done by 3 major banks, right? That's done by a local banker. Someone you walk into is the bank and you sit down with your banker and they understand you. They know that you're getting divorced. They know what's going on in your life. I think it's actually a pretty good system. That basically begins to go away on Monday if what happens is people, don't feel comfortable keeping their money in a local institution. And I think that is definitely bad for America.
Bill, I'm just wondering how you think about the politics of this situation specifically, because what you're offering is a very nuanced perspective. And I wonder how many Americans truly understand that. And especially because the bank is called Silicon Valley Bank. And I wonder if most Americans just associate what you're talking about as a bailout of big tech in some ways.
Sure. So I think, look, the obligation of our, leaders is to be good communicators. And if they're not good communicators, they should hire good communicators to explain. And I think the explanation is pretty straightforward here. This is what the government's doing is protecting depositors. It's not bailing out investors in the institution. And the depositors here are, for the most part, these are small, fast-growing businesses that have raised capital from venture capitalists that are employing a lot of people who are, giving up. Generally taking less cash compensation in exchange for more equity compensation. And they're often the best and brightest and most motivated, people in our country. And, these are companies that become the next, Google, the next Tesla, the next SpaceX, make your list of companies that wouldn't exist without our system of venture capital. And these are companies that employ, hundreds of thousands of people and that have made life safer, easier, better, cheaper, cleaner. Every country in the world would love to have a Silicon Valley, right? It's, I would say, one of the most important drivers of our economy and our competitive advantage. And frankly, our competitive advantage, from a national defense point of view. Think about all the startups in AI, right? Do we want those to become bought on a distressed basis by foreign companies? Do we, or to raise capital from from places where where people are not friendly to the United States, or to move offshore. That would be obviously a bad outcome. So again, I'm not a member of the community, which will make me able to make the case for the community. But I'm a huge believer. Whenever I'm disappointed or depressed about our country, I need to get optimistic. I call a friend who's a venture capitalist, and I ask them what they're working on, and that's what gives us all hope.
Bill,
You mentioned
just
earlier
wanna ask
about
a
the tech
question,
replacing.
Sorry, Bill.
Suleiman,
Sorry, Dan. Just one
wanted to touch base about something, which was you mentioned a sentence, and just so you know, Bill, at least 20 people have messaged me separately about that sentence, which was tech replacing the system. And right now the system is showing all of its flaws. One, do you think that this could be a moment that catalyzes, because this is happening to the innovation economy, that this could catalyze the movement of the tech of financial system to a tech-based financial system because of what's going on?
Yeah.
Do you think this is a catalyzer?
For sure.
And what do you think that system that the new system would look like?
Look, if relying on centralized financial institutions, there's a risk inherent to that. If you can replace a centralized financial institution with a system that the whole sort of crypto blockchain economy, I think that's sort of the mission, right? And so there's merit to it. The problem is that the community hasn't served itself well with FTX and others. But I do think, yes, a world in which you don't have to rely on regulatory oversight and regulatory capital requirements, where it's built into the blockchain, and you can know for certainty that your capital can never be taken from you. But yes, of course, it motivates you to consider alternative systems when the basic one, which is which our government and our regulators oversee, fails you, for sure, of course.
So the question I have before we go to Vinny and Sleiman, could this be so 08 financial crisis was a catalyst for Bitcoin? Could we see this as the catalyst for Bitcoin to decouple as a store of value, or is that wishful thinking?
I don't own any Bitcoin. I think it's a kind of a brilliant construct, but you worry about it. Will quantum computing disrupt Bitcoin? I'm not smart enough to know, but I'm still, my approach is to be really careful where we keep our capital. I deal with, I keep my personal assets in one financial institution, and there I keep really a minimum amount of assets in cash and the balance in a U.S. Treasury money market account, where I buy U.S. Treasuries directly, and that's how I kind of run my business, because I'm sort of credit paranoid, and the nature of my business allows me to operate that way. But if I were, a small business person in a community that didn't have real presence from one of the big banks, what these smaller banks offer is a real, there's a banker you can talk to and sit down with and get advice from, and that's a valuable and important service, a help driver of our economy. I'm able to avoid that. Although having a banker you can talk to I still think is a valuable thing. So I do think the system is a good system. Occasionally we make mistakes. And if we make mistakes for political reasons, there'll be long-term political implications, right? This will be a disaster, in my view, for the Biden administration if this thing goes down poorly on Monday. Because the president ultimately will be, he's the, our leader here. So he's ultimately responsible. So if his regulators and his, kind of let the country down, he'll take the fall.
I've got Sleiman and Axu. Axu, I'll let you ask your question first, and then I'll get Sleiman afterwards. Axu, do you want to go with your question, if you don't mind?
Yeah, for sure. Hi, Bill. In your post today, you mentioned that in the absence of government intervention on Friday, basically SVB's 40-year franchise value was destroyed. And you mentioned that had the government guaranteed deposits on Friday, perhaps even Pershing would have been interested in participating in an equity injection. So I was just wondering if you could dig into that a little bit more. And do you think that there is any franchise value remaining? Do you think there's room for private intervention, or is it purely on the government at this point?
Yes. So I think in the path we're on now, all the franchise value will be destroyed. But if very quickly, things are resolved differently on Monday, I think the franchise value can be preserved. Right. I think the key is, guarantee of deposits, and then an appropriate process where kind of well-known. And again, I think the venture community, GA's, story about General Atlantic investing $500 million, I think, instinctually that sounds like the right thing, right? You want the people who got exposure to the institution, who trust the institution, have relationship with the institution, and know it best to kind of lead a recapitalization of the institution. That's a sensible, approach. And I think if it happens, again, you protect the depositors, you let the bank continue to function. People can draw on their, credit facilities they have at the bank. It, continues to operate. It could just, we'll look back and it's a hiccup. The key after that is one, sell the long duration assets, turn them into treasuries. You can get a nice, attractive yield. That kind of stabilizes the bank immediately. Then you figure out, what the hole is. I think that transaction, they've got a mark-to-market loss in their MBS and 2-3 year treasury portfolio that's more than sufficient to wipe out basically wipes out the equity capital of the bank, and maybe impairs some of the bondholders. You may want to preserve. This is a case where actually protecting the bondholders may make sense, because these are people you may want to borrow money from in the future. So I think actually bringing in sufficient equity, keep the existing debt outstanding, protect the bondholders, I think is actually a sensible solution. And you raise a fortress amount of capital so that this thing is clearly safe. And then you bring in a best-in-class leadership team that actually, I think one of the problems with this bank is it thought of itself a little too much like like its customers, right? And I think it should be run more like JP Morgan. It should be entrepreneurial. It should understand the space at which it operates in, but it shouldn't be making stupid loans to get cheap warrants on startups. And hopefully it's not doing stuff like that. But I think the new leadership team should be a very mature, banking savvy team. I think in that case, I think the community would be supportive of the institution, and you keep all the relationship managers and the rest of the employees who weren't responsible for this stupid mistake, and life goes forward. I think the bank's fine, but I do think the watershed moment is you have to do this. You got to change the whole FDIC deposit regime. So we can't have runs on banks in the United States. It's frankly embarrassing. Okay,
But Bill, hi. I think we're of like.
Hey everybody, it's Brian Sullivan. I was wondering.
Go ahead, Brian.
Hey, thanks, and thanks, Bill. I appreciate it's Brian Sullivan of CNBC. Appreciate your take and being on this space. Just a couple. I want to get your take on two things. I mean, and maybe this was addressed earlier. If it was, I apologize, everybody. Is there any kind of an estimate of the value of the privately held, private company stock, the warrants that they took? I mean, they took, unlike with most venture debt, they were taking, warrants on some of the early stage stock. And I've spoken with a couple of people today, and the estimates of what the value may be are all over the place. Wonder if you had a thought on that. And then also, the FDIC chair last month gave a speech where he said there's $620 billion in unrealized losses on banks' balance sheets. St. Louis Fed had a report a couple of months ago on that. I mean, I'm not saying we should have seen it coming either, but it seemed like there were some high-level warnings that just went completely ignored.
Okay, so two questions. So I don't know the value any warrants held by SVB. And, I'm speaking from a high level perspective, having not done a detailed analysis of the bank. I was cautious about the bank enough so that, an investment I made a couple months ago, I insisted that when the founder wanted to put capital in SVB, I said, what, you pick a B of A, JP Morgan, pick another bank. I have some concern. Okay, and that was just instinct based on what's happened to the tech sector, and he was appreciative that I gave him that advice. But this institution needs to be set up in such a way that you never have that concern again. But the fact that there are mark-to-market losses on securities held by banks, that they, as long as they have the ability to hold those securities to maturity and they don't comprise a massive percentage of a bank's balance sheet, it's not something that should create systemic risk. I mean, I think there are, perhaps some other banks that have, disproportionate exposure, but I do think SVB was an outlier. And the reason why it was an outlier is something unusual happened, right? Because of the sector in which they operate, and because of the growth of venture and enormous amount of capital that flowed into startups. They were hit with an overwhelming amount of deposits in a short period of time, and because of the pressure to generate results, my guess, they put them in what they thought to be safe instruments, and they reached for yield, and they didn't think about the fragility of their deposit base because it's a 40-year-old institution where this never happened before.
Were you afraid of the bank's balance sheet when you said go JP Morgan, B of A, anywhere else? Were you afraid of the company itself, or just the
I'm just a simple guy. I'm like, why? The advice I've always given for years is I just, the nature of the business you're in. I just took in a pile of money. This company raised, it's actually a company that we're helping restructure the tennis industry, and I don't want to have to think about any risk. I'm chairman of the board of the business. I don't want to have to think about any credit risk in the business. We got other risks that we want to focus our energies on. That was the instinct. And I don't know the SVB well, so I just go with the institutions I know well and I trust. But again, the community here, this is an institution they know well and they trust. That screwed up. But it looks to me like it's a CEO mistake, right? And it's a board oversight mistake, and it's a chief risk officer mistake, and it's an asset liability manager mistake. I don't know how many employees they have, but I'm sure it's into the thousands, and I would say the thousands didn't make a mistake. So, and I think my guess is they've got a lot of lending to early stage, and by the way, looking at their balance sheet, they don't have a ton of assets as a percentage of their assets exposed to early stage startups. It's a relatively small part of the balance sheet, and I would guess they have better expertise at doing this than other banks. And I think it's a good thing. I think it's an important part of the venture growth ecosystem to have a bank that understands their needs. It's a bit like banks that understand farmers' needs. It's important for agriculture in our country. And people develop particular expertise in handling a community of borrowers. It's kind of good for America. So,
and not to forget
go ahead, Danish.
Hi, thanks. Yeah, so I mean, obviously, Silicon Valley Bank, they bank the wine industry as well, which is pretty. It's pretty important to Northern California in particular. Bill, one thing I will ask is, I've been on this Twitter Spaces this morning for quite a few hours, and we were discussing what is the failure here. And my view on this is it's a regulatory failure. And so the mischaracterization of calling this a bailout, which is what people are trying to do, the ones who are opposed to resolving this, in a way which I think has minimal impact, is a problem. It's the theme and narrative they're trying to build around it being a bailout is wrong. It's a regulatory failure, and if we don't fix this, you're going to lose faith in the banking system, and we're going to have bank runs all week. And you've said this as well. What's your take on the narrative that's forming around the bailout?
Yeah, I think people don't actually understand the system, understand the facts, and also where the notion of any government capital or credit being used to save a private institution is a mistake. And look, I'm a capitalist. I'm a free marketeer. I believe government intervention should be limited. I think government's, too big. I think there's a lot of waste in government, but there's some very, very important functions that government serves, and among them is the management of our, deposit taking, banking system. And another bad outcome from this, politically, is if some, the Elizabeth Warrens of the world use this as a way to say, whoop, banks, you need to hold more capital. We need more regulations. And the answer to that is really no. The banks are actually, as well capitalized as perhaps they've ever been in our country. This is an issue of, yes, at first it's a management and board failure, but also it's an oversight failure. And so it's unfortunate. It happens. People make mistakes, but you make mistakes, you learn from them. I call that experience. But this mistake, asset liability mismatch and liquidity issues are, kind of banking 101. So I would say it's a bad mistake. The people should, suffer the consequences, and the people are the management, the board of directors, the regulators responsible for not properly overseeing this one. But the punishment should not be borne by a bunch of 65,000 apparently growth companies, startups that are providing a good friend. A woman runs a startup that provides pediatric advice for parents on, like, you text a picture of something on your child's 3-year-old skin, and they give you an answer pretty quickly on whether you need to go to a dermatologist or how you, interesting startup, Sequoia backed, very talented entrepreneur. And unfortunately, she has kept all of her capital at Silicon Valley Bank. She doesn't know what to do, right? I mean, should she be out of business because of a decision made by a CEO or an asset liability manager or investment person at this bank? And because a regulator wasn't paying attention, is that the right? Is that punishing her appropriately? No. It makes no sense. So I just think once you think thoughtfully about the circumstance, I think it's really hard to politicize. There are no fat cats making off here. The investors will lose their money, and the people responsible should be held accountable. It's a bad look for the CEO, the CFO, and a bunch of other officers selling stock in the last couple of weeks. The SEC will have its view of that. But this does not need to be a crisis, and we're heading to a crisis. We're in the midst of one, and we're going to know it for real. Unfortunately, I think in the next, we only have. When I wrote my tweet this morning, it was 48 hours to go. There's now less time.
Less than 48 hours. Slyman?
Right.
Yeah, Bill, I just wanted to ask a question from a different perspective, because I think a lot of people on here are like tech people, and so we're getting one perspective. But the other one is, look, from a normal person, an average American, the way they view it is this, that, what's happened is when people deposited money or took credit from that bank, they took a certain level of risk. Now, and also we've seen from certain sources that a lot of people, what they did was to get credit, they then did their deposit for that specific bank. And so if you have a scenario, and if you really live in a capitalist society, a free market society, these people should not be bailed out. They took the risk, and the average person who's actually struggling should not have to basically compensate for that risk. So what's your answer to that, from that specific perspective?
Sure. So first of all, you should ask your people who ask that question, say, well, what if you woke up tomorrow and the bank where you have your business account is, you no longer have access to it, and you maybe have access to half of it, and the rest is this uncertainty. And by the way, it's a regulated institution. It's got a BBB plus, investment grade rating from Moody's and S&P. It's been around for 40 years. Not a fly-by-night operation. Do you feel like that's an appropriate outcome for you? How would you respond to that? So I would ask them that question. And two, I think this can actually be a costless rescue, in the sense that, again, they actually had a fair amount of equity capital. They have a pretty transparent for the most part, relatively low risk, asset side of their balance sheet from a credit perspective. They made a really big mistake on rates. You can kind of quantify that and fairly easy liquidate that collateral. You can figure out what the hole in the balance sheet is. And there's real franchise value here. I mean, this stock was, probably obviously stupidly, but it was, I don't know, $700 a share or something not that long ago. There's certainly implied franchise value there. You've seen the impact it's had on the community, and a lot of people actually, to their jeopardy, kept their account with the bank kind of out of loyalty. That gives you a sense of the franchise value of an institution. And, while someone else, maybe, there'll be a bid for all of the loan assets of this bank, it's not going to be a great bid because not very many banks have the capability to analyze each of these individual loans or the kind of the expertise to manage a loan book like this. So the bid's going to be, much lower than it should be. And then there's going to be a loss of access to this, kind of capital, which is going to increase the cost of capital for, startups and growth companies, which is going to make, it harder for those businesses to succeed, which means less innovation, which means, less healthcare, less, which means the advantage goes to China. The advantage goes to our global competition. And I think that's bad. I don't see how we win, from that outcome. And so it's, again, I think it's pretty straightforward. It's deposit guarantee, make everyone feel safe. It's a process, and you run a competitive process so that you get the best. Get the best outcome. You figure out who the right investors are. And this thing's back in business in a normal way. I mean, one of the things that I haven't read an article about. It's not just the people who have deposits here, right? It's people who are relying on access to a working capital line. People who, if you post a letter of credit on a lease and it comes from SVB Bank, and the bank defaults, now you're in default on your lease, or you have to post a letter of credit for some obligation, and typically you have to put, dollar for dollar capital into a bank to support a letter of credit. Well, now you don't have access to that letter of credit, and you don't have access to the account. So it's going to have very profound. It's interesting when there's like a bank failure. It's a bit like the Lehman moment. People don't understand. Everything seems calm because it's the weekend. It's like, okay, the birds are still chirping. The people are still walking around. Everything's fine. And then, it wasn't long after Lehman for people to realize what the implications are. This is absolutely a Lehman Brothers moment in our history. And
so Bill, Bill, you brought up over the weekend. It seems like most of these events are somehow timed or managed to release over the weekends. How long do you think they've known there's been a problem? And do you think that they, really made it apparent on Friday afternoon so that they had the weekend or they could buy 72 hours?
I think they've known they've had a problem. They had to have known they've had a problem for a while. Because, the obvious problem is, as the Federal Reserve keeps raising rates, the marginal attractiveness of keeping your money in SVB versus putting the money in U.S. Treasuries, obviously, so you're starting to see flight of deposits. I'm sure again, I don't know the specific details. I'm sure they saw the flight of deposits. They understood every minute the mark-to-market value of their mortgage-backed security portfolio and their Treasury portfolio. So, they absolutely knew this was coming, and that's why, you do not want to be selling stock into this if you're an officer of this company. And 3 weeks ago, whatever it was, that's not a smart strategy. So clearly there's some people here who are not thinking sensibly.
Bill, why wouldn't the Fed just step up and go and buy the mortgage-backed securities and provide liquidity immediately?
The issue here is not you can get liquidity. The problem was, they're sitting from an accounting perspective, they only mark to market, they're held for sale securities. And so those are the securities they sold and took a cash loss, but they had already recognized the mark to market loss there. The problem is the held for till maturity portfolio, which under the accounting rules, they're not required to mark to market. So those are held at cost. And if once you sell those, okay, they're no longer held for sale, and you got to mark them on the proceeds you get from their sale, and that's why they didn't sell them. But the embedded loss was there, and I think as long as they believed they had deposits, I think they probably had the view that they could hold those to maturity. But deposits were leaving, obviously, and they saw the writing on the wall. And there's only so much they can borrow from the whatever Federal Home Loan Bank or whatever, the Fed, wherever they borrow from. And at a certain point in time, they had to actually sell the held for sale portfolio, and that sort of was the wake up call for the market.
Well, I know it's a Saturday, so I wanted to just interrupt and ask you how much time do you still have?
Not much. I think I'm overstaying my welcome in terms of my parental responsibility, but I think it's an important conversation. I hope someone in our government is paying attention, but I'm happy to answer a few more questions but I think we've covered most of it.
Sure, we'll take maybe two more questions. Cantro and Wolf. Cantro, do you want to ask the first question? And then I'll wrap it up with the final question.
Thanks. I'll make it quick. Just coming back to the Fed. So, Bill, you mentioned a couple things that kind of caught my attention regarding around that. You mentioned the Fed, or something's broken and perhaps the Fed should stop now. However, if the FDIC backstops everything unlimited next week, and if SVB was a outlier, as you put it, should it really, and putting aside your inflation view or whatever, and my inflation view, whatever, if you're Jerome Powell, should you really stop given those two, if those two things happen, or if it's true, it's an outlier, and if the FDIC steps up and makes everyone calm, as you say?
Well, I think that'll go a long way to calming things, but I think a calming, and that's a pause moment. And then a recap where this thing's kind of back in business. I think that's a confidence builder sort of moment. My view is the economy's actually is much stronger than the Fed has up until more recently kind of recognized. I think inflation is here to stay, not at 5%, but certainly, but not at anything close to the 2% levels that the so-called target that they're pushing for. So our, if you will, house view is the world is a structurally different place, and the outcome of that is we're going to have persistent, 3% plus, 3.5%, possibly 4% inflation, for the long term. It's a different world when you decouple from China. We've had this massive subsidy. From globalization. We had a massive subsidy, frankly, from technology companies that were underpricing products to build market share. There's, I think, a restored focus on profitability. That subsidy, I think, is quickly going away. I think the war in Ukraine, obviously, is an overhang. The incremental cost of defense globally is going to be inflationary. I think, I think the list, sort of goes on. So I think you're going to see persistent inflation at, let's say, I hope it's something more like 3%. I think that's a more kind of realistic target. And the Fed, if you look at the kind of core inflation numbers, we're closer to 4 than 6. And we might even, there's indications that we're getting to middle threes, middle three, approaching 3.5 in terms of levels of inflation. So 5% inflation, 5% Fed funds is restraining, is starting to hold back the economy. I think actually the problem with is that I think what doesn't make sense to me is where the kind of longer term part of the curve is. And I think the longer term part of the curve has a big impact on the economy. And I think rates are, the longer term rates are too low. And I think we're getting closer to where short term rates have to be. But I do think the Federal Reserve is going to be, Jay Powell is going to be concerned about causing something else to break. I think it's really important how this thing gets managed. If it gets managed poorly, they're definitely not raising rates, and they may be forced to lower rates. And I think that is something they don't want to do because of their fears about inflation. I'm going to give the mic to Wolf for a final question. But before that, I did get a video. Not sure if anyone's seen it or it's just leaked. I've just tweeted it from the CEO of Silicon Valley Bank, or now former CEO. Sent a message to employees last night. I've just tweeted the video. Should be up any second. But Wolf, I'll give you the mic for a final question to Mr. Ackman before I wrap it up.
Sure. Thank you, Mario. Yeah, a lot of questions and a lot of people flooded my DMs with good ones. But one question which I think is pretty important here is just, Bill, how important is Monday? What if the Biden administration does nothing on Monday? What would you ideally like to see happen on Monday to contain this from blowing up and really overtaking a lot of other banks?
I think, by Sunday night, or certainly before markets open on Monday, I'm aware of large borrowers from other non-SVB institutions that have set up wires to go out first thing Monday morning. It's just a prudent risk management thing. And I would, every day you wait, you start destroying other franchises and you increase the risk that you're going to have to do multiple rescues. So I have to believe they're focusing on that. And so I think hours matter. You don't want the market to open and see, regional bank stocks, smaller banks, banks that have concentrated exposures to certain sectors, plunging. And people now know that if you're late to take out your money, you could get stuck. That's the lesson from Friday, right? So you're going to see faster movements of money come Monday, absent a pretty dramatic and aggressive statement from the FDIC and our Janet Yellen and others about what we're doing to preserve, our banking system. I mean, that's what we need. We need to restore confidence. But anyway, look, I think I appreciate your questions. I think it's a very interesting, forum. I also say I'm not guaranteed to be right about anything. I'm just giving my own personal assessment. I think this is really, really important. I see enormous downside in terms of what I hear the government's intending to do on Monday. And I see basically de minimis, if any, downside to a clear the air, let's protect depositors moment for our banking system. And let's get this institution back on its feet. Let's, there are thousands of people, 65,000 companies backed here, 65,000 payrolls this week. What's the average number of employees at these companies? We're going to be well into the 1 million+ people at just, if these are just small startups that are going to be impacted in the very, very short term. And then I think about the implications for our, long-term competitiveness. It's hard enough. My last point here is the environment for being a founder, startup CEO is a very different one in terms of access to capital, versus 18 months ago. And all of these companies are focused on, extending their runways, getting to profitability, and at a time where, we could be heading to a more challenging time economically. The last thing they need is to wake up on Monday and find out they don't have access to their deposits. That is going to be a very bad moment. So let's hope the government does the right thing.
And Bill, last comment. I ask this for every special guest we have. It's unrelated to the topic, and that's what you think of. I know I've seen you in the spaces and when we were covering the FTX story. I'd love to get your feedback on what Elon's building with Twitter Spaces as a way to cover breaking news live. Would love your objective thoughts on the experience on the panel and also in the audience.
Are you talking to me? Is that a question for me?
It is. Final question.
Yeah, so I'm actually a huge fan of Twitter. I think and I have to disclose a little bit of a tiny conflict here, as I threw in a small investment into the Twitter going private, with Mr. Musk. So I'm a tiny owner of Twitter. I did that more, in the spirit of free speech, as opposed to something where I was expecting to, make a profit. Although I think it very well could be a successful investment. But we've gone through a period of time where people have lost a lot of confidence in media, and challenging period to figure out truth. And I do think that having a place where a very a constitutional understanding of free speech is allowed to take place, and where everyone is given a platform to be a publisher, if you will, of news, I think is really a remarkable thing. And I got interested in Twitter. Really, I signed up, let's say, in 2017 when actually Steven Pinker said to me, that this is how he gets all of his, knowledge by following certain people on Twitter. I'm like, okay, that sounds pretty cool. And but I didn't tweet. It was really not until the pandemic, or the kind of very early days of the pandemic, and I don't know, late 2019, early 2020, I got worried about the pandemic, and I started following epidemiologists and interesting people, and developed kind of my own view on what would happen in the pandemic. That I realized how powerful this form of media is, and I think the Spaces thing is really cool. I've used it generally. The only one I've been on before this was just kind of following what's going on in Ukraine. And I found it to be a very useful way to get. Actually, when I pay attention to Twitter, and my wife will tell you that I spend a little too much time here, I always feel like I'm reading the newspaper, days, often, occasionally weeks in advance of the news, and I think that's a pretty powerful thing. And then lastly, a lot of people made fun of Alon here for the price he paid, but any business where you can replace 80% or eliminate 80% of the employees, not to say that he did it in the best way, or 75% or whatever the actual numbers are, there's been more improvements in functionality and the technology of Twitter in the last, since he's owned it, whatever it is, 5 months or something, than there was in the previous, 5 years of my being, kind of a quote unquote a member of the community. So I'm bullish on Twitter, and I think it's my guess is it will end up being a profitable investment. But I think more importantly, there's a place people can go and hear all sides of an issue where there isn't going to be government. If you haven't already followed, if you will, the Twitter files, the notion that the government is working to suppress certain kinds of content is a really frightening prospect, and I feel a lot more comfortable that that's not going to take place, certainly in this form of social media, and that's why I find it a better source. And by the way, I follow people who have completely. I try to follow people who are smart, whether.
I think Bill just got a call. And talking about the Twitter files, we've been covering it here live, and I think most of you know that. And while waiting for Bill to give us back.
The Spaces thing is really interesting. I've never actually spoken in one, so kudos to Mario for organizing and wait for government and do it anonymously. I think that's also a good thing. All right, guys, I really appreciate the time. And
thanks a lot, Bill.
For doing this.
Appreciate it. Thank you, Bill. And we're gonna and Bill, by the way, if you're in the audience after this, we're gonna play the video of the former CEO of Silicon Valley Bank now once you jump off. So I appreciate you coming on, and thanks a lot for giving us your time. Matt, good to have you on the panel as well. Hope this CNN interview went well for you. So for everyone now listening, we're gonna stream we're going to Matt and other speakers for their feedback. Slayman's gonna stream. It's a 2-minute video of the CEO of or former CEO of Silicon Valley Bank, and that was I've tweeted it as well. You can see it above, it's pinned above, it's on my profile as well. It's a message to employees, and it was sent to them late last night. We just got it, and we've tweeted it for everyone to listen to it. Slayman, do you want to stream the video for us, or at least the audio?
Yeah. Hi, everyone. It's with incredibly heavy heart that I'm here to deliver this message today. I want to acknowledge how hard the last really 48 hours have been on all of you. and I care so much about all of you. It really is just so incredibly difficult. I'm trying to look past that and focus on two things. One, I'm focusing on you. I'm thinking about the ultimate outcome of what this could be despite this incredibly difficult time. And two, focusing on clients. Now, as you heard this morning, I'm not making those decisions anymore, which is really hard. But I am working with the FDIC, trying to figure out how can we come up with the best outcome for our clients, as well as our employees. Now, I know when that message went out this morning, I can't imagine what was going through your head and wondering, about your job, your future, etc. My goal at the end of the day is to figure out how to preserve a small portion of the franchise value that we've spent so much time building, and hopefully find the right partner at the end of the day that the FDIC can work with to have this institution continue in some form or fashion with many of you who I appreciate over so many years. Now, there's no guarantee that something will happen. We don't know exactly what the results will be. So I've got an ask, and it's a completely unfair ask. My unfair ask is this. Can you guys just hang around, try to support each other, try to support our clients, work together, which may be again, a slightly better outcome than where we are right now. I know it's an ask, but I know you guys, if anybody, are the right people to ask to be with each other, to be with our clients, to try to come with the best outcome we could think of in this situation. Thank you, and my heart is with you, and it's really hard for me to deliver this message, but I so appreciate all the things you've done for me and for SVB over so many years. Thank you.
So that was the message.
So Wolf, what do you think? I'll give you the mic, and then we'll have I think Matt's feedback as well. But Wolf, the mic is yours. Maybe feedback on the video and the interview we had with Bill.
Well, I don't think there's too much to say on that video, right? At this point, it's saving face for his own brand and, wherever he moves on to next. And you can be sure, right? Unlike many of the startups which will be failing, I do believe the CEO will find a landing spot. So it's a bit of a publicity campaign. I guess he's working with regulators, going back and forth, obviously relieved of his position. A lot of this does fall on their C-suite, ultimately, right? There were a lot of decisions that were made there that are very difficult. Now, one of the things that I did want to dig into, and we don't have to start it just yet, Mara, I'll turn back to you in a second if you want to hit a couple of hands, was the role that the VCs play, right? Driving the fear-mongering, and then now we see them trying to kind of pick up the pieces at a discount, right? And what role do they play, as well as who knew about this early, right? Monday, Tuesday, who got the tip off and was able to get money out. So I think there's a lot of pieces, but with that video, it's just, it's a bit of publicity at that moment. I don't think that there is too much to take away from it in terms of safety, security, reassurance, things along those lines. But yeah, okay, I see your message, Mario. So we can just go to some of the hands, maybe get some thoughts on the video, as well as people have other topics that they want to lead into. I have a couple off the top of my mind, but we can roll with Ram first and throw it over to him.
Just quick reactions on Bill Ackman's guidance. And of course, to recap, Bill Ackman is saying he's looking for system-wide.
Your mic isn't great. I'm not sure if you can fix it.
Sorry, 1 second. All right, is that any better?
Tiny bit better, yeah. Go ahead, man.
So what Bill is saying, he's saying, look, we need system-wide deposit protection covering all banks and no caps because it's an emergency moment. So what I want to do is just lay out procedurally what's required to accomplish that. Second, it's worth saying that this is a high leverage moment. So Sunday night, what the FDIC shares with the public is going to impact the behavior and psychology of depositors across banks.
So I'll jump in just very briefly, Ram. The mic is really, really bad. So I'll give you a minute or two just to fix it. In the meantime, I'll go to Matt. Matt, I know you were on CNN just earlier and you were in the space, gave us your time. How was the interview with CNN? What do you think about the interview we had with Bill Ackman and of course, the video that didn't have much substance?
Yeah. I mean, what are you going to do, right? The video is fine. I mean, as far as those things go, the CNN interview was interesting because they asked me to keep it really basic. So, it's understandable and digestible. So kind of hard to explain, two-year maturity treasuries, so mortgage-backed securities, and how this all plays out. But an interview is fine. What I've been meditating on a bit, like you look at what the Fed chairman said on February 28th, right? I just want to read something that I was looking at from Chartbook before I went on. Tell me if this is redundant. You've already talked about this while I was gone. But this is an interesting quote on February 28th. The chair of the FDIC warned, the combination of a high level of longer-term asset maturities and a moderate decline in total deposits underscores the risk that these unrealized losses could become actual losses should banks need to sell securities to meet liquidity needs. So this is on February 28th, right? So take that, put a pin in that one fact in terms of who knew, when, what. The second thing, typical bank in the United States, whatever, in terms of the number of accounts that have 250,000 or less can range from 30% to 50%. Why did the FDIC, why those laws exist is to prevent exactly the scenario that there's a run on the bank where people panic, right? Now you turn to SVB and they have 3%. So you combine that with an awareness from the FDIC on February 28th that this exact scenario could happen, with the very foreseeable scenario where 97% of the people are uninsured. So the first signal that, that there is this dislocation, money would be pulled out. We start putting those facts together. Actually, what happened was completely foreseeable. What could have been done, what should have been done is another question. But I've been thinking about that all day. Couldn't address that on CNN, obviously, but.
Hey, Mario. So here's some quick reactions on Bill Ackman's proposed approach to getting a system-wide guarantee. One is it's beyond the statutory authority of the FDIC to do that. So what the FDIC would need to be doing this weekend is consulting with FSOC, Financial Stability Oversight Council, which is a division of the Treasury, as well as the White House, and also Sherrod Brown, who's the head of the Senate Banking Committee, and Patrick McHenry, who's the House Financial Services Committee leader. All to say is that I understand the argument he's making, but procedurally to expect those conversations to assemble and then conclude is unlikely by Sunday night. I think what is more likely is that you see the FDIC work vigorously to ensure that the unsecured general creditors, those above the 250K, are made whole, and they're going to work towards that. One point I disagree with Bill on is that the regulators are not asleep here. And I think one of your guests pointed out that the regulators have pointed out that there's a $600 to $800 billion mark-to-market loss on the Treasury portfolio. The Federal Reserve knows that. Bank supervision examiners know that as well. Note that SVB was put in receivership midday on Friday. That doesn't happen. So they were watching withdrawals. They're focused on it. Bill's ask, I understand his thought process. It's not going to happen by Sunday night, though.
Ram, is it even acceptable that it happens to have unlimited, to make it unlimited in terms of the funds that are going to be secured?
Fantastic question. I would say at this point, this is not systematic risk. This is isolated technology companies on the West Coast. However, look, there's some lines around the block at First Republic. So if this becomes a question of public confidence in the banking system, then there needs to be intervention. And I also agree with Bill's point that this is a decisive moment. This is not a wait and analyze moment. The question is, what's the best hand you can play as a regulator?
And so that's the question, really, because you've got a scenario where I understand a lot of people are here are saying, you know what, we need to keep trust in the banking system. But then others on the other side, and you probably heard this argument a lot, is that specifically these types of banks, there was significant risk and people partook in that risk. So why are people having to basically bail these people out? That's the issue, which I feel like it's not being answered well enough at the moment.
Well, they're not being bailed out currently, nor is that proposal on the table. And Bill Ackman is not suggesting that either. He's simply suggesting that the FDIC, maybe not simply, he's saying that the FDIC announce full, complete deposit-wide coverage. And that absolutely would stop all bank runs. It doesn't require taxpayer funding or bailout. It does create moral hazard risk.
I want to pop in here. Oh, yeah. Go
ahead, Wolf.
Yeah, I was going to drop it back to Matt real quick also on this topic and just talk about the role that these VCs did play in the entire situation, because it does sound like they really led to the panic that kind of ensued and has, really caused a lot of this hysteria to culminate into where it led. And now, right, coming in and buying up these pieces at 60, 40% off in different areas. Is there a responsibility to be held by them? How should the government treat these venture capitalists that kind of were able to sow panic and cause really the largest FDIC insured bank crash, right, in the second largest of all time?
I don't know. That's why I was going back to what I just read a second ago. If you think about the underlying purpose of the $250,000 guarantee, it's to prevent this exact scenario. So if you're looking at the health of a bank and you're saying, wait a second, 97% of people will not be impacted by the guarantee, and the public policy of which is to prevent a run on the bank, and we've already identified the risk that would trigger the run on the bank. I'm not saying they were asleep at the wheel. I'm saying it's very foreseeable. So I'm not sure what levers they could have pulled to address it. But when you start reconstructing it, back to the VCs who had their money. At the end of the day, they're deposit holders, right? So they have their money in a bank. They have every right to get panicked that that they may not be able to get their money out, and they did what humans do when there's a run on the bank. I look at the bigger picture is that given the relative percentage that most banks have of insured deposits, and when you start reconstructing things, it was foreseeable. So maybe there wasn't a lever to pull for the FDIC, but certainly now that we look back, somebody could have predicted this.
Well, on that note, real quick,
Matt, I think there was somewhat of a lever to pull, and I think Ron, correct me if I'm wrong, but you were talking about the mark-to-market losses that were out there. That looks a lot like the LDI issue that the Bank of England had to deal with last fall, which is you had a bunch of people holding duration or long duration assets that had huge mark-to-market losses and triggered a margin call. It's kind of similar here. Banks have medium to long duration assets that are depreciating in price as a result of the Fed's hikes or aggressive hikes. And this should have been foreseeable, at least for the Fed, right? So you could have taken the same course of action here as the Fed as what the Bank of England took.
It's well known. The regulators saw this for months. You've seen public commentary around it. People in the New York capital market sector have known this. There's research firms that have talked about this as well. Even the Fed has a negative $1.5 trillion mark-to-market loss on their balance sheet. In the 1980s, the banking system was less than well capitalized due to exposure to Latin American banks. But banks have the magic trick of lender of last resort, FDIC insurance. So long as they can hold to maturity, then those bonds pay back to par and they can make money. It's just quelling the bank run risk. The bank run risk is what obviously forces the crystallization of the mark-to-market losses. I think the question for me isn't so much around the VCs. The VCs have to act in their fiduciary interest, and it's either your first money out and live or your last money out and you might die. So that's a prisoner's dilemma. Hard to fault them for that. My focus and attention is around financially motivated players that have an interest in defaming a banking institution and causing a bank run and are protected by free speech. We saw that with Silvergate. We saw defamation of a banking institution, which caused a bank run through defamatory and false comments around the bank. And there was also clearly pre-positioning around Silicon Valley Bank. And now there are other banks. There's some record put open interest on Signature Bank right now. So I think we need to address what's the right balance between First Amendment, which I'm a big believer in censorship resistance, but also those which have a financial interest in seeing the demise of an institution should not have a free license.
But let me ask you, where would you draw the line? If you have investors out there who simply just amplify the information, right, that another institution has a similar risk, it's not mark to market, on their balance sheet, where does one draw the line? And number two, that's not going to change in the next 48 hours. So we have to assume that market participants are going to do exactly that and start amplifying similar fact patterns.
Absolutely right on the second. On the former, I think you can apply existing laws around insider trading and the standards around that.
Oh, that's true. Oh, yeah. No, I thought you meant more public policy. But yeah, of course, to the extent to which existing laws apply. I just was thinking bigger picture.
But, it's like stock price manipulation or acting on material non-public information isn't permitted. But you can't, banks can't really defend themselves because, Amazon.com or Google cannot buy Silicon Valley Bank. And the reason why is a law called the Bank Holding Company Act, which prohibits the commingling of commerce and banking. Right now, it makes no sense. Internationally, you can commingle commerce and banking. JP Morgan started as a water company and then became a bank over time. And that law should change. That's a good public policy prescription. Imagine if we had Web 2.0 big tech companies. As much as I want to disrupt them, I'm also a big fan of their services. They have tens and tens of billions of dollars excess cash. They have technology. They have distribution and reach. They would strengthen and revitalize the banking system. But our current banking laws make it very difficult for a bank to raise outside money. If on our Twitter space today, we want to go buy SVB, we couldn't. We'd be deemed a bank holding company. We'd have to exit our private equity and venture capital businesses due to current law.
Could there be a discussion that's prompted from this about potentially raising the number that the FDIC insurance is set at, Matt, which has happened in the past?
I mean, that's one. That's kind of, isn't that sort of what Bill Ackman is suggesting in the interim? It seems a little antiquated. I think the bigger issue is, again, back to there could be a restriction on the relative percentage of concentration of your assets to make sure enough people are insured, as deposit holders to prevent a run on the bank, because that's the whole purpose of having the insurance in the first place. If anybody's interested, this is a slight change of topic, but in terms of thinking about how all the different companies in America are navigating the uncertainty right now, I have an interesting case study in crisis management that I could share that you may have read about. Camp. Did anybody read the CNN article about what they did? Well, anyway, for those who don't know, Camp is a toy company / family experience company, and they had all their cash with SVB. On yesterday afternoon at 3:00, they sent around an email saying basically all of our money is with the bank. We're creating a code 40% off with the code Bank Run. With clever, branding and sort of record time, and they sent it out to everybody. I got this email like 10 times within, an hour. So I wanted to check in with the CEO to see why he made that decision and how it played out. And he told me, he said, look, all my money is with that bank. I have no idea when I'm going to get that back, including payroll. And so I was faced with a choice. What's the one asset I have left? And it's our brand and the affinity our customers have for us. So it was my one asset left that I could count on. So I decided to go out and appeal to the community for help. And so fast forward, they have recovered through sales half of the amount that they had on deposit with the bank in 18 hours. Just think it's an interesting case study in crisis management. I've different anecdotes I'm getting from different CEOs about how they're handling it. I talked to somebody else about that fact pattern. They said, yeah, but they're likely to get their money back. That doesn't make any sense. And I said, okay, when you got to make payroll, when are you going to get the money back?
Name or Dak, would you like to jump in here?
Yeah, I wanted to comment on the free speech aspect, or I guess rumors that could go around about banks. This did happen during the financial crisis. I was on Wall Street at the time, and I remember when Charlie Gasparino worked for CNBC, it seemed like he was the one getting most of the inside info, not in that way, but like if so-and-so needed to do a capital raise, like a certain bank or whatever, and it would happen, it was common that he would come on late in the day during the market hours and with, I'm hearing a source telling me XYZ is going to raise capital, and the market would literally tank 1% to 2% within, 10, 15 minutes. This was very, very common for this to happen. And there was a lot of, sort of fear mongering about who's next after Bear Stearns leading up to Lehman, with all these banks constantly having to do capital raises and mark down their holdings of subprime mortgage book. So, it's irresponsible, obviously, for anyone to be spreading those things. And I don't know of a way that could be stopped. And back then in the financial crisis, social media wasn't really as big as it obviously is today. But I mean, yeah, I would expect to hear a lot of that stuff. And, I don't know what regulators or anyone could do about it, but I don't know. Videos of people lining up outside banks are definitely not going to help this situation at all. As far as what Bill Ackman said, it was Ram earlier. I don't see much happening by Sunday. What I would expect, I think, would be, maybe a joint statement from maybe Powell and Yellen getting up there and sort of, putting out their resolve to back up the system, and that they're watching things and sort of try to give people more confidence that they're on this. But I don't expect any sort of, Fed-led bailout, because like I said earlier this morning, there will be buyers for these assets that the FDIC will be liquidating. So I don't think that's a problem compared to 2008, where there was no bid for these subprime holdings. That's about it.
Yeah, certainly. I'm personally in agreement with you there. I don't think that there's going to be a Fed-led bailout. I think that would cause a crazy situation that we don't need to get fully into here. But I do see a couple more hands. So I'm going to pop over those.
One more thing. I missed most of when Bill was on because I was tied up with something. But did he give his opinion of what the Fed will do this month as far as raising rates or anything like that?
Well, he did not, but he clearly, Bill, I love Bill because he clearly wants to make a play at this bank. I don't know how many of you heard that or.
Well, everyone's going to try to do something. Everyone's going to be bidding on the book because they're going to get they're going to get good, prices on these.
Yeah, I mean, what I heard him say, and this is my Louisiana understanding of what he said, but smoke the investors, smoke the board, and get a handful, 10 or 12 venture capitalists to fund up, recapitalize the bank, and take it over and pay the government out over, I guess, the length of the 10-year treasuries these guys tied up into. I thought that they had tied into a bunch of 2 and 5 years, but it sounds like they tied up into a bunch of 10 years. I don't know how you go. That's not their assets, is it, Name?
No.
10 years.
I mean,
and it can't be the loans they made. So
I thought the major.
What would their assets be?
The HTM, the hold to market cuts or marks were like about $15 billion. Ram, maybe you know more on that, or Matt. But I didn't see their treasury book.
Were 80 billion as well. I think their MBSs were 80 billion.
Yeah. So the bulk of their investable or securities was mortgage-backed securities, commercial mortgage-backed securities, and that's where they had the.
Yeah, but how would you sell? How would you sell those?
They would just literally sell them in the secondary market, or they'll have the banks like Goldman, the big banks will bid on them, but it'll be a down bid.
They'd be worth 60 cents. They'd be worth 50 or 60 cents.
I don't think they'll go that low, but I mean, I don't know. They'll be sold to the highest bidder, right? But it's not going to be 100%, in my opinion.
Right, but but if I can go get a treasury today for 5, why would I buy? These have to be 2-year 2% yields, 2 and 3% yields. Why would I buy that?
Well, that doesn't matter. The value of the bond will be priced at like 80 or 75, whatever, right? It'll be marked.
Okay, but why not just move?
It'll be marked at the.
What's the upside though?
Well, the upside is you're buying it at a discount to par, right? Because every bond that Treasury that's issued is at 100 at say 5% on a 2-year. But these old treasuries they have that were at 2% or whatnot, those are trading at what, like 70 or whatever. So those will sell at 100% most likely because that's easy.
Right.
Yeah,
they
no
tried to sell. They sold the same tranche of 20. I think it was $21 billion for a $1.8 billion loss. Right. So these will clear for a lot less. That's the arb.
Darren, would you like to pop in here?
Yeah. Thanks, Wolf. I listened to Bill's comments, and I think on the back end of what he was alluding to of what we needed is something that. I've already done a lot of research and written about extensively before. So back in December, I wrote an article called Safety, Liquidity, and Yield. And I wrote specifically about how deposits over $250,000 can be FDIC insured. This was, research that I had done on the back end of a client who had come to me with, $1 million in the bank, wanted it to be FDI insured because it was a homeowners association reserve fund. And that was one of the stipulations is that it had to be FDIC insured. but they didn't want to, spread that across 5 or 6 different banks. And so through that research, I found what's called the IntraFi network. So IntraFi was started by a man named Mark Jacobson, who is a former chief of staff of the FDIC, an inventor of 13 different patents related to IntraFi's FDIC insured deposit placement services. And, it's right now it's about 52% of banks are a part of the IntraFi network. But I think that they have the scale and capability to be able to include 100%. And, that is something I think that would satisfy what Bill's looking for. And, it's something that just people aren't talking about right now. So
pop off in regards to Bill. Bill actually put out a tweet, which I think is going to answer a lot of questions, because since I got on here, the number one DM that I've gotten is ask Bill about any exposure to SVB. Bill just put out a tweet saying that he does not have any exposure to SVB Financial, nor does Pershing Square. He said that he's personally an investor in some of the less well-known, mostly seed stage venture and biotech funds and some early stage startups, which may have exposure to SVB. Collectively, his venture exposure is less than 10% of his assets. That is a tweet directly from him. Hopefully that clears up a couple of questions that were out there. I heard someone else starting to speak as I was starting that right there. Go for it, Ron.
Yeah, I can just elaborate on Darren's point. I'll give you some background on IntraFi. And there are a couple other solutions out there in the market. I do agree they're intriguing. First off, let me explain what it does. So what IntraFi does, it enables a bank with excess liquidity to provide liquidity to a bank that needs liquidity. That's one. And then the secondary benefit is if you're a depositor, you can get higher than your FDIC 250K cap. Now, the primary users of this solution are community banks. And now Promontory, of course, is founded by the former head of the Office of the Comptroller of the Currency, the National Bank Regulators, acquired by IBM. And there's another solution in the market like this called Stonecastle. In fact, my co-founder is talking to them this weekend. We're trying to learn more what we can do there. But I think that is a very intriguing idea because the big banks have excess liquidity. The community banks need liquidity. And if there's a way you can maximize deposit coverage under current law with technology, that could be an interesting opportunity. By the way, the last solution, which is available on the market today for retail depositors, is called maxmyinterest.com. I'm not a user, I have no affiliation. But again, it allows you to, spread your deposit taking risk across a number of institutions.
And I've used the insured cash sweeps before, Ron. So they are real, and I think they can take them up to as much as $140 million with a community bank. So they're basically every day they're moving every 30 days between banks at the $250,000 levels.
Yeah, Mercury Bank also offers something similar. This is something Jason and I got into last night, where these like online only banks will, to Grant's point, sweep your deposits to 4 other partner banks, so you could have $1 million worth of FDIC insurance, et cetera, et cetera. So there are products out there, but I'm not sure about the limits.
But, hearing Bill talk about an unlimited amount up to $25 million or even unlimited, I just wonder, and I got cut off when I was asking it because my phone had some problems, but what that would do to confidence around the world about the US dollar, or would it be negative or would it be positive saying, okay, we can go there and our money's protected?
Speaking of fun people to hear from, welcome Doug Bonepart to the stage. What's on your mind, Doug?
Hey, Wolf, how are you? First of all, thanks, guys, for hosting the space. Not every day on a Saturday you get a room filled with so many smart people. I think I have more of a question. I can't help but thinking about the power of communication, and this room is a great example of how powerful communication can be. You're listening to, again, really smart people share their thoughts and creative ideas of everything from how this can be resolved to what government should do. So I guess I really have more of a question, which is, if we don't see any action at all by Sunday night, and I would agree there's probably too little time for the mechanics of and mechanisms of DC to probably put anything together, as we've heard. What level of communication, and is this an opportunity to step up level of communication, whether it's the Fed or just the U.S. government and whichever entities are going to step forward and communicate. What can we expect? I mean, it's kind of silence throughout the weekend, and then what? We wake up on Monday morning. So that's my question, and I just wanted to get everyone's thoughts to the extent they're willing to share an opinion about that. What do we anticipate that level of communication being by Monday? And what impact can we expect that to have? Will it quell fears just to see leaders come out and address this issue and simply say we're working on it, or provide greater details as to what is being worked on or is not being worked on? It's kind of, in my mind, it's free. It's free to communicate, and probably has more of an ability to calm people down, hopefully, than continue to spook them. I think silence is deafening here.
Yeah, I think if you remember anyone around in the financial crisis, it was every week. The market closed Friday, but everyone expected something over the weekend. And those like Sunday press conferences by Hank Paulson, especially the famous bazooka speech. I mean, they were out. All they can do is sort of, instill more confidence with their words, and basically, I mean, we should still know from the financial crisis that the government, the Federal Reserve, is not going to let the banking system collapse. They're not going to come rescue every single bank, like the smaller banks necessarily, or just backstop everything, but they will not let a wider contagion happen. At some point, if this does spread, they absolutely will step in, but I would expect Sunday there should be some press conference of some sort with Powell and Yellen, just to instill confidence that, like, hey, we're here, we're watching it, and we will not let this spread, that sort of thing. That was very common back in the financial crisis with Paulson, Geithner, Bernanke. Very, very common.
Yeah, and you kind of took the bait, and I was hoping, Naeem, that you would kind of take that, because I was ripping off of what you had said earlier. You would expect that, and hopefully that does happen, because you, in this case, do have a bit of history here. I was around to watch all that unfold, but you do have a bit of history here of how powerful that level of communication can be. Clearly a bigger megaphone than this awesome space with 12,000 plus people. So kudos to the hosts for getting everybody in here. And if anybody else wants to share what level of communication they believe they're going to see by whether it's Sunday night or Monday morning related to this issue, I would love to hear it. I'm a big fan of there being a lot of value in that.
I've got a different take.
Sorry, Rob. I was just going to say, I guess it depends on what kind of communication there is, but any communication that does not say that depositors are going to get their money back in very, very short order should, in my opinion, have a very negative impact just to all the regional banks, right? And the points Bill made was, at the very least, it should increase the cost of capital for regional banks, where they say your deposits earn X percent more than putting it into one of the larger banks. And I don't know if that's the risk reward small and medium businesses want to take. Sure, I might get an extra couple of 100 basis points keeping my money here, but if there's a, even a 10% probability that there's a chance that money might not be available to me for several months, that's not a good outcome, right? That's just bad asymmetry to the downside for any depositor at any regional bank. So I think, my view would be a communication that very clearly says that depositors in this case get their money back very quickly is a good outcome.
Yeah, I would say that if you look at the levels of problem, the primary problem is the deposit holders, the 97% that aren't insured. And then if you look at it as a political problem, what's creating the headlines? All the jobs, companies are going to go under, they can't make payroll. So I would think at a minimum by Sunday night, early Monday morning, a communication around the amount of the advanced dividends and the process for how those funds are going to be released. I cannot imagine we go into the week without that being communicated, because that at least, puts a finger in the dam and say, okay, these companies won't go under because they'll have access. I presume that number will be around 50%, given the strength of the collateral in the form of the bonds. So if that doesn't happen, I just can't conceive of a scenario where we let the week go on with endless headlines about all these companies going under, 65,000 companies.
Yeah, here's a different take. I think first there's timing, there's the who, then there's the what. The timing will have to be around Sunday, 6 o'clock before the Asian market opens. Now, the who should only be the FDIC and not Powell, not Secretary Yellen, nor the White House. Think back to the 2008 crisis. One of the worst mistakes that former President George Bush made was he had a national address talking about the banking crisis after the failure of Lehman. So what happened is you had a Wall Street Journal headline article became a local Main Street headline article, and that actually created a lot of run on the banks and financial institutions, wealth management institutions. I think what you want to do here is convey that the FDIC is on it. There was an issue, they identified it, they addressed it, they resolved it, and the system works. What you don't want to do is elevate or escalate by bringing in, senior policy leadership here. On the content of the message, I believe the FDIC should say that a full amount of general unsecured creditors will be made whole.
Got it. Thanks, Ram. Doug, any other thoughts or any other questions you had?
No, just very, very grateful to get some answers from all of you. I think I heard what I wanted to hear. I think communication is warranted, and I hope it's something that does provide depositors with some degree of confidence, constantly torn in a number of directions, of course, feeling bad for the businesses and folks on payroll who might not be getting paid. We've heard this over and over, I'm sure, throughout the course of the space. And then obviously the other side of it being some bad decisions being made around risk and perhaps some questionable actions you've seen. I would love all of this to be cleared up. I'm sure investors, broadly retail investors who see sell-offs related to getting, spooked with '08 vibes. Clearly not '08 vibes, but I can share with you, as someone who's been with their clients through the Great Recession, through now, when you're an advisor and you're telling people, look, we may or may not be in a recession or whatever that next recession is going to be, it's not a 2008. That's not to say the next thing can't be as bad or not as bad. It's just saying, hey, it's not going to be a global banking crisis here. And then what happens? Boom, you get something that's pretty analogous to that, a bank failure, all those allusions to 2008. If I'm not the only advisor out there for sure, thinking like, geez, we just spent this time talking to our clients about, preparing ourselves for whatever may be next. And it's not going to be '08. And sure enough, look, you got the 20th biggest bank in the country failing. And now everyone's scratching their heads, losing confidence. Not great. That confidence needs to come back. And I hope it's through effective communication, which all of you provided some great examples. Wolf, Mario, thanks for hosting the space. Everyone have an awesome night.
Thanks, Doug. Quick question to actually just bounce off that right at Matt, and then I'm going to bring in Tom. Matt, there's a lot of stuff going around specifically around Wells Fargo. They were showing users earlier in the day zero balances, negative balances. They claimed it was a technical issue. There is rumor circulating about them having significant amounts of money in SVB. Do you have any concerns around Wells Fargo? This type of panic and worry does tend to spread pretty quick.
I mean, I would just be reacting to the media and the things I'm seeing on Twitter like everybody else. So I don't have specific concerns, but I also don't have specific knowledge.
I would just say that, compared to '08, you have to look at the differences here where you had these banks were just sitting on a bag of billions of dollars of deteriorating assets that were literally going to zero, these subprime bonds. And then the derivatives based on that, it was really just got out of control. This is not what we're dealing with now. This was a bank run. We can debate and dissect like how that happened, but they had a $15-20 billion hole, but so do these other banks, right? Every bank is sitting on mortgage-backed securities and treasuries that they bought at low yield. It's just a matter of like, is there going to be a bank run? And I don't see it. But it could be wrong, but it's different than '08 as far as like they're not sitting on 50 or $100 billion of an asset that could go to zero, right? Because that's what happened in '08. That's not what's happening here.
Understood. Thank you. All right, Tom, want to hop into the conversation here?
Yeah, sure. And thank you guys for putting this together. I know you guys have been grinding it out all day. Kudos to you guys for doing this. One of the worst takes that I've heard so far today is that somehow this is just part of the natural course, and 90% of startups will fail, or 90% of YC companies will fail. So this is just speeding up that timeline. I think it's just so absolutely ridiculous to put out comments like that. These are real people with families, employees of these companies. besides the fact that who knows what's going to happen with any startup, right? So many startups that went on to be huge companies almost failed along the way. So it's just really disheartening to hear those kind of comments being thrown around. People risk their lives, their careers to start these companies. They raised equity capital, and they now need to have access to those funds to run the course of their business.
I completely agree with you. I mean, there's this sort of, there's a conflation of these two ideas that maybe we think, the year of free money drove up these valuations. Say what you will. Obviously, that's very true. People don't realize you're talking about your favorite brand on Etsy in a lot of cases, or companies you love. I mean, I'm not going to name names, but I have a pretty broad portfolio. So when I look at the exposure across a lot of those consumer names, I just think the public isn't aware. But you have to separate the industry from the role of simply somebody putting their money in a bank and expecting that money is going to be there at 9 a.m. on Monday morning, which every business and every individual in America has a right to expect, and we're led to believe based upon our trust in these institutions. So if this was the restaurant industry or some other sector, but I think as it's tech, there's this feeling that somehow the underlying, valuation inflation over the last several years, that it's related and it's completely independent. Now, there's a bank that was serving that sector, right, that took on a lot of debt, right, and extended these lines of credits, and maybe that doesn't make any sense, but that's unrelated to the fact that those who had deposits with this bank are victims in this case, right? I mean, so I totally agree with you. I think it's just unfortunately the nature of discourse in America that everyone's always looking to blame somebody else, but at the end of the day, when we wake up and the stories come out over the next 72 hours, everyone's going to realize there are two people removed from knowing someone affected by what's going on at SVB.
Yeah, sometimes even less than that, right? A quick note that I want to throw in here, and then I'll bring it back to yourself, Tom, if you have any other questions, and we can go to Darren. This was tweeted out by Charles Gasparino, who I think we're all familiar with, and he was talking about a little bit of a scoop here, saying that the CEOs of new financial firms are imploring the Federal Reserve and the FDIC Gov to cover deposits far greater than $250,000, predicting limits imposed at SVB will cause a run at many banks, particularly of businesses that use deposits for funding needs. We could see something Sunday night, he said he's being told, though it's far from a done deal or an easy sell to regulators. The bank run scenario is possibly the biggest systematic risk in the whole SVB fallout, and the impact won't be at money center banks, but rather among regionals, financial executives say. So that's a developing story that is coming out right now. But basically, yeah, they're pressing for a much higher number on that. Yeah, go for it, Nate.
Yeah, I would follow Gasparino because he's very plugged into Wall Street, and this is just like I'm getting PTSD from 08 here because it's the same thing. He usually is the one who gets the good leaks from sources and whatnot. So I would definitely follow him.
Yeah, agreed. Tom, did you have any other comments beforehand on the topic that you were covering?
No, good. I'll add comments here and there. Thank you, Wolf.
Perfect. Darren, you were sharing something earlier, got bumped off. Do you want to bring that back?
Yeah, Wolf. I think, what I mentioned on IntraFi, I won't bring that up again, but I think kind of shifting topics is with, in the venture space, a lot of these, founders would take loans from Silicon Valley Bank, and in their terms, they would say that they would exclusively use Silicon Valley Bank as their banking partner, right? And that's one of the reasons why most of these companies were holding deposits above the $250,000 limit. I just, maybe this is just a question to pose to the group or whatever is, what is the legality of Silicon Valley Bank putting in their terms and conditions, the requirement to have an exclusive banking relationship with Silicon Valley Bank and not the ability to have, other banks that could hold their deposits?
There is a prohibition against bundling and tie-ins. That's a well-known regulation. And SVB, of course, has a compliance department. And what I don't know is this, was that expectation of tie-in contractual or was it a quid pro quo? Right? So this happens all the time in investment banking, for example, right? So, you get the coverage, you do the equity IPO offering, you do follow-on offerings as well. And, if you do a securitization, for example, it starts with getting a credit facility on the loans that you're looking for financing on. And then the expectation is that the bank that gave you the credit facility will ultimately do the, securitization. But a lot of that is just a kind of informal expectation as opposed to contractual. So it's a good question. We want to see whether that was contractual or was a quid pro quo. But I doubt that SVB would have required that, and compliance would, of course, would have evaluated that.
I mean, this is probably not hard. Somebody out there is probably a startup founder listening to this call that had a line of credit at SBP and then also had their, payroll with the company. But that certainly is the common fact pattern. You have a line and you also had, your proceeds, and they were handling all your banking. So I don't know to what extent it was contractual, but it's pretty common.
Yep, absolutely.
Yeah, and if we do have any of those startup founders that are able to share some of that insights with us, my DMs are open, as well as the rest of this panel. So you can feel free to share that information with us. I'm also getting some DMs here with concerns that really the deadline for the government to act is not Monday morning open, but rather Asia opening. Curious, and then car dealership guy, I'll come to you in just a second. Curious, Ram, if you want to talk to that about the effects that this could be happening in Tokyo.
Yeah, well, no, I fully agree. That was what I was saying earlier. So Sunday, 6 p.m. Eastern time is when you want to get an announcement ahead of the Asian markets opening. If you don't, then the Asian markets obviously would be challenged and probably open at some significant discount. And if there's no resolution, obviously the U.S. markets would open at some kind of discount as well. So correct. On the timing, what the timing should be Sunday, 6 p.m. Eastern, no matter what. Second, the message should be complete deposit protection, including for unsecured creditors. Anything less than that isn't decisive enough to create the calm that depositors and institutions want to see.
Understood. Thank you, Ram. Okay, car dealership guy, I saw we got you up here. Curious to hear if you had any thoughts or questions on the matter here.
Hey, Wolf. Good to finally join. No, I think I'm obviously looking at it and how it may affect just loans, the auto business. These things ripple. While it's tax refund season right now for dealers throughout the country, which is pretty much, people have some larger down payments and it's a bit busier. I think most dealers you speak with will be able to attest that it's been a lot slower this year relative to, prior tax season and prior years. And so while it started, we had a wave of consumers coming in, say, just about 3 to 4 weeks ago. It's actually slowed down significantly now. And on my end, I've been sharing data and anecdotes as that's been happening, but waiting for the official data to be released as well very shortly. But I think just looking at this, I have people in my network texting me as well, like, hey, one guy texted me, hey, my company was with SVB, the management's hung us to stay calm. We don't know how they're not sure how they're going to make payroll. And again, that's just an anecdote to share. But the point I'm trying to make is that, this thing clearly has tentacles, much further than I think any of us imagine. And I think it's sort of hard to contextualize right now. But, being like a top 15 or top 16 bank, really curious to see how this impacts other industries in ways that we can't, it's really tough to sort of imagine at this point. But there's no doubt about it that, people suddenly don't have that income. It's going to come at that car. It's going to come at, other things, that house, whatever it may be. And, it may be another sort of element or another wrench in the wheel here that changes things up again, for as it has been over the last couple of years. It's been just super volatile. And being in the car business and seeing, all these the values of cars kind of going all over the place, and when you least expect to go up and down. So just keeping a close eye to it. I want to see how this impacts the rest of the industry.
Did you guys see Larry Summers' announcement, Mario? You should take a look at that. So Larry Summers on Bloomberg was just interviewed, and he says there's no reason why he doesn't see that unsecured depositors are not made whole, which I fully agree with. And Larry Summers is an important voice. Of course, he was a runner-up to be Fed chair. He was a former head of the Council of Economic Advisors and Treasury Secretary, right? So he's the public conscience of regulators, and they tune in and listen to what Larry has to say. So when Larry goes on Bloomberg, he's really talking to the regulatory system and the White House very efficiently. I think that's a very encouraging sign, because that is the right conclusion, which is that unsecured creditors should be made whole promptly.
Yeah, no, it's interesting to see how the FDIC has changed greatly since, I don't know, Bush. When Martin Gruenberg was chair of the Fed. When you go and close a bank, the chairman has to sign it. And the Bushes famously told him, don't close any banks. And he has a stack of papers on his desk, so much so that they literally had to, people were like being mean to him in the office and stuff. So it's interesting to see how far we've come to be in a place where there are smart people in the room that other people take advice from, instead of just doing what they're told from we put you in the cabinet, you do what you're told. So that is encouraging for sure.
Awesome. Thanks, Marshall. Okay, I've got some really interesting DMs that I just came in. Thank you to everybody that responded to that. I'm going to get to them in just a second, but Bilo, do you have a comment you want to throw in here?
Thanks, Gav. Just wondering what people think about, we have upcoming inflation data coming up next week. Now, I know this is just one bank, and you have varying views across the board as to whether this is, a big deal or not a big deal. It's obviously a big deal. Is it a big enough deal to sway the Fed? Maybe not in and by itself, but if we start to see a contagion effect, I'm wondering if that has an effect on the Fed and his pivot plans for the rates. What do you think?
Ram, do you want to jump in on that?
Yeah, I'm absolutely happy to have a view there. So as you may have noticed, that the market was pricing in 50 bips with a 60% probability last week. No way that's going to happen. So it's between 0 and 25. I don't think that what would cause the Fed to lower their pace of rate increases is a financial market dislocation. We don't have that yet. We have a VIX at 27. We've got a regional bank index that's down 40, 50%. We have concerns around whether there's a broader loss of public confidence in the banking system. And you have a number of days between now and when the Fed makes that decision. Every day they will utilize to inform their decision. And we should do the same. But my base case expectation would be that the FDIC drives towards a conclusion this Sunday evening ahead of the Asian market open, and that unsecured creditors are made whole, and that stops the concerns around public confidence. And if that's the case, that's a big if. That's the gold standard approach. We don't know whether that's going to happen or not. If that's the case, then I'd expect a 25 bips rate increase. I'd love to hear Michael's take as well.
All right. Not sure if Michael wants to jump in on that. But real quick, I just got some incredibly fascinating DMs that came in when I asked about if SVB was making people contractually only be with them. And I'm getting a little bit of back and forth, but the overwhelming amount of DMs seem to be stating that there is a contractual obligation for the borrowers of the venture debt to also hold their deposits. They prohibit borrowers from even opening bank accounts at other banks. This seems to be kind of lining up with most of the ones that I'm seeing. SVB's terms require that a fair amount, if not all, of your funds go through them. Someone's saying that not everything in our payroll, their payroll went through Bank of America, but definitely they needed to flow most of their fund flow through them. So yeah, this seems to be lining up with a lot of.
Hey, to jump in on that. So I'm gonna read an email from a company in our portfolio. I won't say what it is, but this was the on this exact subject. This was the line. He wanted to give everyone a quick update, etc. Unfortunately, due to a covenant related to our SVB loan, we weren't allowed to hold significant funds with any other bank. We did try to get funds out on Thursday, Friday, but unfortunately, none of the wires cleared. The email, of course, goes, this is the second point. The bigger, problem long-term is, we're talking to other major banks about getting a short-term credit line, which we all know probably how that goes. So consistent with what you just said.
This is very interesting. So I just published in the thread an excerpt from Section 106B of the Bank Holding Company Act. I'll read it out for you all. But the main message, it's against the tying or bundling of services, which is what we are hearing, right? So Section 106 of the Bank Holding Company Act generally prohibits a bank from conditioning the availability or price of one product on a requirement that the customer also obtain another product from the bank or an affiliate of the bank. So, we got lawyers are going to focus in on this and see whether the alleged tying or product bundling violated Section 106B of the Bank Holding Company Act. That's a good thread to stay on top of.
I guess the question, this is out of my depth slightly, is, it's structured in such a way is because they're the first lien holder in the bank, and then there's a liquidity covenant. That's how I guess it's probably structured, given what you just read.
Yeah, that makes sense. That's legitimate, right? So if the bank says, hey, we need a line of sight on your liquidity, you've got to maintain a certain cash reserve, and those are covenants. There's nothing illegal.
I think that's what it is, honestly, because my just anecdotal understanding is pretty pervasive, so it makes sense that this was a liquidity covenant.
Interesting tweet that I'm seeing here from iSource News discussing that Prince Harry and Meghan stand to lose millions in the collapse of SVB Bank. Apparently, the couple set up accounts following the advice of most of their friends in Silicon Valley, and they're only going to be insured up to $250,000. I have no idea how much money was actually in there, but obviously could be a very large sum. So just another one there. States that Oprah as well stands to lose $590 million after collapse of SVB. All of her biggest accounts were with the bank. So yeah, many, many, many large names involved with this, and just curious to see, what does that look like? How does that waterfall out from there and continue to spread it down the line from them? So I know that we have some really interesting speakers and names that are going to be coming up here as well, kind of chatting with a couple in the DM. So curious to hear some more thoughts, but go for it, Matt.
Well, I was going to say that's really going to help getting the American public to be sympathetic to all the companies and account holders that we're talking about. I think that's the communication issue that the FDIC has to get in front of, is that this isn't a situation. Somebody mentioned before, you're holding, junk bonds or mortgage-backed securities in 2008. This is, government agency-backed mortgage securities is the collateral that the bank was holding. So this is obvious. This isn't a situation where everything's going to zero. And I think that is the most important point of communication, because as this gets covered, relentlessly on CNN and everywhere else, people are going to be left with the assumption that this could go to zero, and it's obviously not going to go to zero. So that's, I think, the thing they need to get ahead of. But that's generally not a great fact, what you just read, in terms of how people perceive this as a quote unquote bailout for, rich people.
Yeah, it's a super divided look, right? And I think Tom was up here beforehand and outlined it pretty well, which is ultimately this is going to largely affect, right? So startups, retail investors, a lot of those people, because this was a place that they went, right? It was, hey, you just signed a big fat Series A. This is where you're going to put it. However, at the same time, right, a lot of other money is going to be commingling in there. Many of it coming from, like we know, these larger status people and accounts and things along those lines. So I'm definitely curious to see how it plays out. But yeah, I agree with you, Matt. It doesn't exactly give the government a better position to kind of negotiate from. All right, I'm excited for this next speaker that we do have coming up on stage. It's going to take just a second for them to connect, but once we get them up here, we're going to get rolling there. Grant, you also just shot me something. Are you open to sharing anything on that?
Yeah. What I shot you was 3 times in my career, I've had phone calls from the bank. One was 2018 after I made a request for a big withdrawal, $8 million withdrawal, and they freaked out. Second one was 2000. During COVID, they wanted to know how to assist me. And Friday, I get a phone call from the guy, big regional bank down in the Southeast, and not one of the top 4 that Ackman was talking about or Cuban was talking about, but he called me and said, "Everything cool, man?" And I said, "Well, bro, why are you calling me?" Okay, and he's like, "I just want to be sure you're good. I'm a big depositor in this bank. I leave money there from my cash business, my online business, and then we have 12,000 apartments that do rentals that deposit to that bank." And he's like, "I just want to catch up with you. I want to have a glass of wine, blah, blah." I said, "Hey, bro, look, like, what are you trying to tell me? We good?" So he's comforting me. Today I hit him and I said, how are your customers doing right now? He said, "I've had $500 million worth of deposits in the last 24 hours. This is one smaller regional bank in the United States down in the Southeast." I said, "Well, how many customers?" He's like, "About 2 dozen." So money is already moving this weekend. He's assuring me they're good. But like Bill said, and he was talking about money moving to 3-year, 6-month treasuries on Monday. If that happens, we could see historic collapse of rates across the 3-year, 6-month, 2-year, and the 5-year on Monday. And I don't know how the Fed fights that. If you got all this new supply hitting treasury bills, seeking safety, how does the Fed say, okay, we need to raise interest rates? It won't matter, by the way. It doesn't matter if he wants to raise them. If the marketplace, am I right, guys? Wouldn't supply beat whatever the Fed wants to do?
So if that happens, we've got bigger issues in our hands because it means that a virtual bank run happened. It means that there was an exit from the banking system into brokerage accounts.
Into treasuries.
Correct.
But that's what Bill was suggesting people should do. People should move to short-term treasuries.
It's a good,
maybe even longer term.
It's a reasonable idea to have yield in a Vanguard money market account with SIPC insurance. We're getting 4.5% yield, and that's going to be higher than a bank deposit account. Yes. Now, this is a very sophisticated crowd and audience. Not many people Saturday, 7 p.m. Eastern time are tuning into that. Most people are going about their daily lives, and they're not going to have a behavior change unless something causes them to, move to alertness. And we're not there yet. This is still like Wall Street Journal article headline. This is still Business Insider. And if the FDIC is decisive Sunday evening and addresses this swiftly, then I don't think you're going to see much pressure on the yield curve.
All right, I want to bring in praying for exits here. Saw a little bit of the DMs that you were sharing there about VC and startup. Do you have some thoughts you want to share?
Yeah, I've just been listening in for about the last hour or so. So I run kind of like one of the larger, or probably the largest VC/startup communities on social. Run my own fund, and I'm pretty tied in with a lot of the large funds and large startups in the Valley. So just wanted to come on and happy to answer some questions and dispel some of the things that have been talked about on here, if helpful.
Certainly. Is there anything that you would like to approach first? You want to throw us a question? Us to throw a question?
Yeah, I think that one of the things that I haven't really heard talked about here, which is something that I've seen that's pretty pervasive happening in the ecosystem right now, is that a lot of funds and a lot of individual large angel investors are actually putting up money themselves without any terms, without even signing docs in most instances. So a lot of the large funds, especially at the growth stage, and ones with pretty large balance sheets, ones that have raised, quite heavily in the last few years, are actually just offering up cash, no sight unseen, no questions asked, and providing a lot of these bridge loans, especially on the payroll side, for these companies. And so, and I've been working pretty closely with Brex, which is a neobank in the space, and they set up a bridge loan facility for companies that are in a pinch right now, and that received about $1 billion in payroll requests in about, I would say, under 24 hours. So it's quite a pervasive issue, and I think that it's affecting people a lot more than just in the Valley.
Awesome, thank you, Matt. Any thoughts on that?
No, I actually haven't been asked. I've strategized. I know that I'm sure the special situation funds right now getting ready to offer these companies to buy out their whatever the certificate of deposit, whatever the receipt they're going to get from the FDIC for the other percentage of their uninsured funds. And so there is actually going to be money going in because there's going to be an opportunity to arb there. But actually, I haven't had companies come to us and say, "Can you give bridge funding yet?"
Okay, got it. Yeah, one of the questions that I had praying for exits to yourself is, what advice do you have for the startups that are now kind of placed into this situation? Really, really difficult decisions to make, right?
Yeah, I think that there's not a lot that we can do, especially given that it's the weekend. But some things that I have heard, for instance, Gary Tan, president of Y Combinator, recently published a tweet where he's asking, startup founders and people who work in startups to go fill out a Google Docs that he posted on his Twitter timeline, basically reaching out to your local representative and letting them know sort of the seriousness of the situation, and providing a little bit of context on who you are as a person and how this is affecting you, because I think that there's this pervasive narrative that's happening in the general public that these are just kind of like wealthy elites, coastal elites, who are being mostly affected by this. But in fact, most startups are run by people who are not necessarily living paycheck to paycheck, but not very far above that. And so I think that, proactive outreach from startups, one thing besides doing that is also just being super, just kind of taking the worst case scenario, which, Bill kind of tweeted about it and spoke about it. But I've also heard from my side of things, people who are speaking with the FDIC and are talking to people on the Hill, that 250K plus 50% of deposits is roughly the figure that we're most likely going to see on Monday. That hasn't been confirmed by anybody in the government to me, but from people who have been kind of spending their weekend talking to people on the Hill, that's the number that I've been hearing. And so, just being proactive about the worst case scenario on what that does to your burn and your runway and how this might affect your customers as well. I've also heard a lot of people who had their personal loans as well as mortgages with Silicon Valley Bank are starting to feel the impact of that as well. And there have been multiple, canceled bids on houses in the Bay Area because of this. And so the ripple effects are just starting to get seen. But I think it's just being proactive and trying to realize what's going on outside of just the startup and how it's affecting you.
And if I could add to that, great advice, by the way. I do think, borrowing a page from the case study I gave you before about Camp, that these companies need to come out from behind the shadows and communicate with their customers, because a lot of them have deep abiding loyalty and love, and it puts a face on things, especially if it's going to be Prince Harry and Meghan and Oprah. These companies should be communicating. There's nothing to be ashamed of. I mean, you put your money into a bank, you expect to be there the next day. So let your customers know that this happened to you and how can they support you, shop with you, whatever, because it's all about, converting cash right now. The second knock-on consequence of this that hasn't been talked about as much is, think about all these different venture funds that had their money in SVP, right? Like they're not going to be honoring term sheets or going forward with deals right now. There's going to be some paralysis that's going to happen in the system. So there's a lot of companies that you work for months and months and months. You have 2 months worth of runway. You finally have a term sheet supposed to close this week. Nothing's closing this week. So I mean, I haven't heard those stories yet, but I'm sure in the next week I'm going to hear it. But there's a whole nother level of knock-on effects that no matter what happens with the Fed, FDIC communication on Sunday, that is full stop going to be happening. These firms are not going to be going forward writing checks, and certainly not going to be initiating new deals for a bit.
Okay, I want to ask a question to Doug in a second, but I want to just come back to Prang as well as Lindsay, who's up here. So Doug, get ready for me. But Prang, do you want to respond to that?
Yeah, I think actually one of the other knock-on consequences that is a little bit even further down the chain is that LPs are probably going to be put into quite a pinch. There was already, just given the macroeconomic climate, an LP slowdown in investing into new funds as well as re-upping in old funds. The bar had been raised much higher for people to basically raise new funds this year. And I think that, a lot of funds were actually using SVB lines of credit in order to basically bridge the gap between the next time that they could call capital and then to the point where they were actually able to receive capital from their LPs. And so a lot of them are in a weird pinch in that way too. And I think that just given kind of like the shock that this happened and how quickly it happened, large institutional LPs who are already slowing down are going to be much more reluctant and hesitant to fund new funds, which also slows down the cycle of innovation in the Valley quite a bit as well.
Understood. Okay, Lindsay, thank you for popping up here. Curious to hear some of your thoughts.
Thank you. Yeah, I mean, I think I echo a lot of the same sentiments that are on the panel. I mean, it's just still my opinion that I think bailing them out is not the best option. Aside from the startups that actually really have a chance. I think that some of this is really related to a combination of errors. Yeah, the bank made some mistakes, but I think we I think we appreciate that. I think we know that that's something that can happen. But I think that one of the biggest issues is that many of the startups were not maybe deserving of the funding necessarily, and maybe they weren't ready. And I think that sometimes funding is a curse. I think that the hardiest companies come out at times like this. And honestly, this is a time of opportunity. So I think it's really important that we really look at that. I think that some of the greatest startups could be born right now. And I think that that's one of the most important aspects of this is supporting that. And I think really building into the next raises that come through the doors and the next things that are pitched to us that we actually have access to, really promoting just like more responsible investing, I think, and also just not hyping things up so much. I think like a lot of times we get excited about like a unicorn and really we should be looking for a camel, something that can really last longer. And I just think there's too much of that glory that's given to things that are going to just, come up and be a 10 or a 20 time exit, if that ever even happens. Right. But I think that the case here is that that's not really doing a good deed for the founders, nor is it doing a good deed for our funds. And honestly, we put ourselves in the situation in a way too. So I just think like we need to mentor better. So that's one of my thoughts.
I kind of want to just take one more dig into that. You were saying that this could be the more like the crucible for some good startup opportunities. That sounded like a little bit like that was in the middle there.
Yeah, I think like the best startups come from downturns. I mean, I've always been much more successful in downturns. Again, it came from the SVB TV and the infomercial business essentially, and e-commerce. Sorry, I'm getting my coffee at the same time here. But I think that one of the most important things is that, the hardiest companies come from struggle. They come from times when things are difficult. Even in nature, if you look at like the strongest tree in a field, it's the one that's been battered by the most wind and the most effort. And I think like to listen to people sometimes on the panel, they're like, oh, these little startups, they're not going to make it. Well, then they're not supposed to make it. I think we have to look at the reality.
Sorry, that's absolutely ridiculous. Like people just lost all their cash in the bank and you're talking about building hardy startups. You're speaking with absolute ridiculous. You need to hear a couple stories of what people are going through right now, because this is the most absolutely ridiculous statement I've heard in this space.
Well, I mean, I'm sorry you feel that way, but that's the reality of business. It's not easy, and not
the reality of business, not startups losing all their cash overnight. The reality of business is there's a free market. You build
it is.
business,
It's a free capital market,
some win,
and
some
you shouldn't
lose.
expect to be bailed out when something bad happens. You have to pivot. You have to switch up, and you can't lean on credit. It's a cash society right now.
You're speaking extremely ridiculous right now, and I can tell you that that's just not the reality that people are facing right now. People have cash in a bank. In many cases, that cash was dispersed between multiple bank accounts. And I just think that the whole the best win, survival of the fittest does not apply here.
I'm sorry that you feel that way. It sounds like maybe what you're working on isn't that good. I don't know. I mean, if it was me, which it's been me before, the case is you have to really look at what is it that you're doing and is it actually making money and can it actually make money? And at the end of the day, unfortunately, a lot of the deals that have come across my desk aren't really fundable like traditionally. And there's a reason for that. And that's something we need to look at. The quality of the deals aren't the best deals. I'm not saying that that's 100% the problem here, but it is some of the problem. People get into a lot of hype, and that doesn't mean you shouldn't keep trying and you shouldn't keep investing and you shouldn't keep trying to give startups a chance. But at the same token, I think that startups have to be, much more hardy, and they have to be much more on top of it. I'm a startup founder myself, so I'm just saying it's not easy. Nobody's just jumping over the table trying to hand out money. So, we have to work harder and be better and really make sure that the things that we're getting people to invest in actually work and gross money. That's all.
All right.
Hi, Jason.
How you doing, gentlemen, ladies, assorted audience? The person who's speaking is a moron. Their opinion is completely stupid. Let me explain why. The companies that have been, in fact, impacted by this are the strong companies in most cases. They're the ones who had capital and through just putting their money in a bank account have lost it. This is not survival of the fittest. This would be somebody stealing the money from your bank account. That's the equivalent of what's happening right now. The money's been essentially stolen from those people, so they can't fund their operations. While it is true that startups are a competition, that is not what is happening here. What's happening here is people had their funds taken from them through no fault of their own. And as one of the other people just pointed out, in many cases, they had split that money across multiple accounts that Silicon Valley Bank managed. And these accounts would be load balanced and swept. that you still don't have access to those. So if you had something at BlackRock or Morgan Stanley or wherever it was, that was being custodianed by Silicon Valley Bank, and the startups I'm working with all weekend still don't have access to that money. So even if you did the right thing, you're getting punished. That's all. I have to go take my daughters to dinner. It's been a pleasure to talk to you all.
Well, I mean, I think you should find.
Thanks, Jason.
Are you aware that there are 6 funds and $750 million worth of even just one of them was spent in debt? I mean, are you aware of that? I think a lot of people.
If you're
don't
talking
realize
about
that.
venture debt, that's a separate conversation. Venture debt is a tiny portion of the overall.
I'm talking about the
you are
last year.
completely uninformed, ma'am. And if you would like to be informed, there's a podcast called the All In Podcast and This Week in Startups. We literally broke down their holdings. You are completely misinformed. You are grandstanding, and you are a moron.
Wow, Jason. So I want to throw a question at you real quick because you seem to have dug into this situation. And as you're, equating this to stealing, how do you suggest that federal regulators deal with the situation?
It'll take no more than $25 or $50 million in a backstop, $25 billion in a backstop for this. And just like TARP, if you guys go look at TARP, and I mentioned this on the pod as well, TARP will end up being profitable modestly for the government. All they have to do is backstop this, and everybody's going to get their money back and wipe out all the equity in Silicon Valley Bank. So none of the management gets anything. Equity's wiped out, but all the deposits are taken care of. It's a very simple thing to do, and that's 90% what's going to happen.
What if it doesn't, Jason?
If it doesn't, people are reportedly going to get 60 to 75 cents on the dollar back over months. A number of startups are going to go out of business. Payroll is going to be missed next week. I'm working all weekend with a number of startups that are trying to get their payroll together. We're trying to get emergency funding together to be wired Monday, Tuesday, Wednesday, as quick as it can be done. Multiple venture firms on board calls all weekend trying to pass the hat around. And then some venture firms had their money in Silicon Valley Bank. So that's locked up. Now they're going to their LPs saying, hey, can you put money in this other bank account? And don't be surprised if 2 other or 3 other banks get caught up in this contagion. And then you see a run on those banks on Monday, Tuesday, and Wednesday. That's what's happening.
Jason,
That's why this is more than just about Silicon Valley.
Jason, is this the Lehman moment for Silicon Valley in general?
Doesn't need to be, and it probably won't be. But if Biden and Yellen and everybody don't come out this weekend, you're going to see my prediction is a full-on panic on Monday. Many other banks are going to have runs, and it's going to cause contagion, second-order effects, third-order effects that nobody can anticipate. And that's why this is very simple. You just come in and say, all the deposits are guaranteed, even though 250 is a limit. We're guaranteeing it for everybody under these terms. And the banks are now in receivership. The equity is worth 0. Sorry to the equity holders. Sorry to the employees of Silicon Valley Bank. This kind of stuff happens. But deposits are secure. That's what the president of the United States needs to do tomorrow. If he doesn't do it tomorrow and Yellen and they don't get out in front of this, every logical person in the world is going to take their money out of any bank that's not Bank of America, Chase, Wells Fargo, whatever the top banks are. And so it's going to be chaos in 48 hours or less if shit is not done today and tomorrow. No, I assume it's being done. Yellen said on Friday, like they're aware of it. Great. This is D-Day. I'm taking my daughters to dinner. I wish you all luck. And then after dinner, I have to go get on board calls and try to pass the hat and raise millions of dollars to hit payroll. I wish you all a great night.
Thanks a lot, Jason. I appreciate you joining.
Thank you, Jason.
That's the same concerns are being echoed by Jason and Bill Ackman. Yeah. It's what's your stance on it, man? We've been doing this 10 hours yesterday. We've done it 14 hours so far today. It's the more I do this, the more I get concerned about what could happen on Monday. But
yeah, I mean it's a pretty easy situation right now. I will say that by the very definition of who these people are, they're optimists. They see the best, when everybody else sees risk, they see reward. And that's what makes them great at their jobs, because they don't miss out on that big one deal out of 100 that makes their book. But I'm very skeptical that the government, the emergency meetings on Monday, I mean, they don't even have, or the meeting, sorry, not an emergency meeting, the meetings on Monday. I don't suspect that the US government or the Fed is going to get ahead of this. I think that is very wishful. The market will open. I don't think there's going to be someone's going to get ahead of this. I hope they do. Of course, I hope they do. But I'd be very, very surprised. And I think that what they're warning about, I think, is possible, especially in the banks that are within the sector. I'm talking about specific banks like Signature Bank and others, First Republic. Not trying to name them for FUD, but trying to name them so that people know what we mean by those banks. So you're not worried that it's your bank. These are startup-focused banks that are going to struggle, and people are going to take those money and move to the big four. And if they move to the big banks, the thing to worry about is concentration of power. It's going to hurt small projects, just like Bill mentioned. And, Jason's right. It's going to be catastrophic.
Real quick, this came out from Bloomberg within the last 10 minutes. The managers of Silicon Valley Bank's investment banking arm are exploring ways to buy the firm back from its parent. So just wanted to report that real quick from Bloomberg on
Yeah, if you
ticker.
can put it up in the nest if you don't mind, Wolf. You just pin it above.
Yeah, no problem. I'm just going to go ahead and
Matt,
grab that.
While you're doing that, Matt, I want to go to you quickly. I know you're
that's
speaking.
what Mario. I think that's what Bill was suggesting was the solution. To not blow this up, and that it had value. 40 years. I'm sure a bunch of family, long-term, high net worth family, community people that invested in this bank. You don't want to see a major name ever go down. There's got to be value in 40 years of relationships.
Also, just got this reported to me by someone in the comment. I heard rumors about this, but this is the first person that's actually confirming it to me. Etsy sellers did not receive payment yesterday. Someone said that their wife's a seller. They scratched together business while poor.
Hold on. Why?
I believe Etsy has exposure.
How much? Yeah, but how much? Yeah, go ahead.
No, I believe their payroll was running through, to vendors was running through that. That was my point about before when I was saying, get those Etsy vendors to start communicating. These are real people. These aren't big tech companies.
Yeah, and to that point, a lot of the Silicon Valley-backed companies that are distributed like that have their payrolls running through Silicon Valley Bank, whether it's through Gusto or another of these services. A lot of them use Silicon Valley Bank.
That was my point about communication. I'm detecting based upon just the cadence of emails, and I still am waiting for a significant percentage of email updates from those that now at this point have exposure. There's still a bury your head in the sand, kind of don't know what to do, don't talk openly about it. This perception that that you're not somehow a victim. You've done something wrong by having your money in a bank that actually is hurting a lot of these companies by not being forthright. Going back to that conversation before, that is a totally ridiculous conversation, like totally two separate issues. And think about this fact. Any company in America, if you had all your money in a bank, including your payroll, you wake up and find out that money is potentially gone and you can't make payroll. Now your board of directors is having an emergency meeting because they're very aware of the laws in the United States that it can pierce the liability can pierce the corporate veil if you have people working for you and you have line of sight that you may not be able to pay them. So scrambling about what we do with it, that would derail any company, regardless of whether or not it raised money at an inflated valuation or whether anybody on this call thinks that they shouldn't exist, 6 months from now. It's totally ridiculous, totally unrelated. These are human beings, and a lot of these are great companies. But by the way, if they were all bad companies that we all hated, they're still, in this case, just people who put their money in the bank. It could happen to anybody on this call. Second point, in terms of Ackman's proposal, like if you think about what we spent in the pandemic, trillions of dollars of government stimulus, billions and billions and billions of dollars that was wasted. To me, this is a no-brainer in terms of backstopping those deposits because we've gotten so much less for so much more money in the past. And at the end of the day, the underlying assets here are these agency-backed bonds that do have a maturity of 2%. Who better to be able to hold that risk than the actual counterparty, which is the government, right? So at par, we know that these return 100% plus 1.8%, whatever the rate is on the 2-year. So I think
I wouldn't dismiss the fact that the government takes this step and is so worried about contagion come Monday that they don't do something that they might not otherwise do because of moral hazard or precedent, and actually take a dramatic step and backstop. I'm not counting on it. I'm counting on
Matt,
the
how
50%,
often?
but I'm not.
How often has the government done the right thing at the right time? You
That is a very wise point. As somebody who worked in the government and for many years, the answer is usually they're behind and they settle for a half measure first. So the half measure here would be to announce what the dividend would be. But I do think that I think they probably settle on that because even taking a step back, that might be enough to stem the tide. But if we keep seeing headlines throughout the weekend of lines showing up at different banks and somebody on this.
Did we lose you, Matt?
Yeah, he dropped out.
Hey, Wolf, did you have a question?
I had
for
a
Matt?
question for Matt though. Like, are there regulatory hurdles, or can they just come out and just?
Sorry about
declare-
that. I got cut off, but go ahead.
Yeah, my question to you is like, what are the regulatory hurdles, and can they just come out and declare, all deposits are now insured? For you take the $250,000 cap off, and we're all good. Because like, who's gonna, how can they do that just in a day or two?
Hey, real quick, just an interesting tidbit and insight here that was reported about 4 minutes ago. Whale Chart reported that Kim Olson, who was the chief risk officer at Silicon Valley Bank, previously had the role of senior managing director, enterprise risk management at AIG, which had that $150 billion bailout back in 2008. Also, Kim Olson since has deleted her LinkedIn page. And also, it looks like she was only hired into that risk management role January of this year. So a lot of movement going on there in that risk management department last few months. Did you have a comment on that, Mario?
No, I was reading it earlier.
Guys,
Matt, from the audience, somebody asked this question. I don't know if it's been asked before, so just stop me if it has. But somebody asked, I think it's a really good question. The need for a Glass-Steagall arrangement in order to insulate depositors and small investors for the moral hazard of over-financialized exotic products. So, is there has that been something that's been considered? Matt,
you want to touch on?
While we're waiting for Matt, Douglas, do you want to jump in? Did you have a comment or a question?
Yeah, sorry, jumped out of here. Yeah, my thunder was stolen a little bit about government being behind the eight ball. I think, everyone in this room, the calm heads are, all right, here's a couple of solutions for this, pretty much backstop these deposits and we'll sort the rest out. And I think the thing that's in the knot in everyone's chest is, and this may be cynical, is they'll fuck it up, right? they're gonna mess.
Douglas, where do you stop? Let's say this happened to other banks. Let's say this is just the start of the domino.
They're usually, this is what happened in 08. They were a little too slow in things, and it did get out of control, unfortunately. So I don't have a whole lot of faith that they're gonna act quickly and with the right measures.
Yeah, that's quite frankly, I think what's in the back of everyone's mind right now.
Yeah.
It's like, cool, here's the solution. Nope, they're gonna fuck it up. Sorry for the language, guys, but I just wanted to get that out in the open. And like, it's not even cynical. It's just like what you've seen happen for so long. And if we keep going down that road, it's going to get political. It's going to go down in directions I do not want to do or, bring into this conversation.
That's why
there you go.
That's why I asked the question.
How to get it out there.
What powers do they even have to like suddenly declare that all deposits are fully insured? Like, who can do that? And what are the hurdles to just announce that tomorrow? Right.
Well, to be a little crazy about it, like, do what you got to fucking do.
Hey, Douglas, sorry to interrupt for a second. Just want to share some news. So this is from Citizens Free Press that we just put up in the Nest. It's scenes from First Republic branches now in California. And then there's an article from Daily Mail that the contagion is spreading to First Republic Bank. So again, our goal is not to lead to a bank run. Our goal is to report what we're seeing. And often you see it here way earlier than you will see it from others. And so just wanted to make sure that people are aware. If you have an account with First Republic, please do your due diligence. We are not providing financial advice. Matt, do we have you back now?
Yeah, I'm sorry about that. I got cut off.
What are your thoughts right now about First Republic? Or actually, don't speak specifically to a bank, to other smaller banks. We've heard these proposals. They make sense. We know, we hope, but we know that the government's going to be slow. What do you think is the right thing to do on Monday?
Well, like if we look at this scenario with SVP, what caused the run, which is 97% of the holders were not insured, right? So they did what humans do, is they protected their self-interest, and they had a fiduciary duty anyway to their investors otherwise, right? So other banks in America ranges, 30 to 50%. So if the contagion continues to spread, by the way, you have very big banks that benefit from this, right? With deposits flowing out and in. I think it's going to depend on the magnitude of this reporting and hysteria over the next 24 hours that will dictate what the government does. I know we're saying the government never does the right thing, but politics still govern these decisions. So if there's going to be headlines all about lines of banks, the only thing that stops that is backstopping momentarily while we sort this out. So I don't want to mention specific banks because I think it's unfair without scrutinizing their balance sheet. So I'm not going to get into any other banks, but I go back to what's the underlying problem here. The insurance didn't work because most were not insured. So that is going to change. And the fact that these banks were allowed to carry this and not mark to market, that must change immediately. So the customer has a much better view. And not that you could expect a deposit holder with $20,000 in a bank to look behind the company and determine, where they're putting their deposits. But even still, that mark to market is going to have to change very quickly. So I think we just continue to talk this through over the next 24 hours. As these headlines build, the need for the government to actually box up all those deposits is going to grow greater.
So there's a headline Zero Hedge just put out. Again, another good account to follow. I assume most people on here follow them, but that just said U.S. discusses fund to backstop deposits if more banks fail. So I assume there's a story. I don't know who's reporting that, but that's a headline that came across Bloomberg.
I think there's a narrative building right now. And, you heard, I don't want to say there are talking points like there are in DC, but, it seems like Silicon Valley, the as an institution, the Y Combinators, the tech stars, there's been this like narrative building. I don't know if everybody's noticing this, but I'm going to spell it out much more clearly and like in a very simple way. We have to do this. This is required for the innovation sector, that if this fails, everything else will fail and it will lead to a bank run across all the other banks. Is it just me noticing this, or does it seem like that?
Danish, my question to you is this. I've been thinking it, so let me just ask it. Is that your bias, though, because you're in tech, you are this affects you, or you've been through this process, and so that's the reason for your statement as opposed to, like, for example, the average person?
I think what's interesting is that I was just mirroring what Bill Ackman, what Mark, even what others have said.
But they're all you guys are in the same industry, isn't it? So I'm trying to say, so I can see why you all agree. But I'm saying is, do you think what you're saying is reflective of everybody else? Is my question.
Well, the one thing that Matt can tell you from his time in government, and Matt, I'd love for you to weigh in, is that when you come up with a good narrative and everybody repeats it and parrots it, suddenly that narrative becomes the prevailing narrative. And that's actually how talking points get around DC. Matt, I don't know if you wanted to weigh in on that, but they sound so similar. It's incredible.
Well, right. Stating the obvious, political institutions ultimately there's a tipping point reached, right?
Exactly.
And so,
Matt, your audio is cutting in and out, Matt.
I'm sorry.
I just want to remind everyone. Matt, did you want to finish?
Matt, is your audio better?
No, name redacted. Go ahead.
I just want to remind everyone, in 2008, there were no...
Let's try it again. Can you hear me? Is it better?
Yeah, we can hear you.
Yeah, go ahead, Matt.
All right. Sorry about that. Blame Elon Musk. It's not my fault. But for sure, having been in government, again, back to my days overseeing the redevelopment of the Trade Center in New York, there is a certain tipping point that's reached, especially in a crisis, that then government starts behaving in a much more nimble way and more responsive, to that. I actually think sometimes when the tipping point is reached in a crisis, government acts its best, and I agree with you. I think if we keep reading headlines about banks, that's the thing that becomes the emergency, is the contagion. So I wouldn't rule it out.
So I still feel like my question's not been answered fully, and that is that I feel like, and again, I hope I'm wrong, and maybe Mario could put out a poll. That'd be a good idea. That is what the panel's saying reflective of the average person. Are they? Because on the panel, it's been very consistent that look, then you need to bail them out, and we don't consider it a bailout.
What do you mean? So what do you mean reflective to the average person exactly?
Yeah. So basically, an average person, So basically, So I want to see if my thought is right. That is there two lots of people. You've got people on the panel who are basically in the tech industry, are basically startup companies, or is dealing with companies and stocks and so on and so forth. And they all are very consistent in what they're saying. They're saying there needs to be a bailout, and actually, it's not a bailout because we are basically protecting the deposits of people, of these companies who put money in and they did not expect that money to be lost. But
but would you say would it be? We'll go back and forth on this one. Would it be a question of, if we let the silver whatever SBV Silicon Valley Bank fail, would that harm the economy? Because if the answer is yes, then that answers your question. That means it'll impact the average Joe.
But then the question becomes, if you continue bailing out, that will affect the economy as well, firstly. And the second thing is, what will happen is, would it though? Because what will happen is, as you said earlier, that they were already getting offers of 65 cents to the dollar, 70 cents. So it's just the capitalist market was actually solving the issue to an extent anyway, as opposed to using the money of the people.
So what Matt said, and I'm going to repeat and paraphrase Matt, please correct me if that's not what you meant. If you don't get 100 cents on the dollar, people won't have the faith that they're going to wake up and their money in their banks will still be there. And I think that is what the concern is. Yes.
Is there, Dr. Danish? Is there precedent for this? Is there precedent where a bank failed and the balances were not covered 1-to-1, and we saw a panic afterwards spread to other institutions?
I mean,
they could use as an example.
I mean, we can talk about the 1930s, even 2008. That there's been bank runs in the past, and when bank runs occur, there is a contagion effect. It's not especially if people.
The question is, will bank runs occur if the funds are covered?
I'm not arguing that the general public will necessarily be sympathetic to the tech sector that is disproportionately hit. It's a separate issue of if people feel like they can't trust banks. That's the question. Exactly. That's what we're debating. Right? I don't think that's.
I'd like Mario for you to put up a poll or something to say something along the lines of, should the tech sector be saved, or
it's not
or
that
not?
What,
because
but Suleiman, that's not what Matt or I are saying. I think the framing of the question is critical. Should this bank should people get their money back if they put it in a bank? I mean, that's really the question here. Is people put money in a bank, that their deposits in a bank, they should be made whole on their deposits in the bank. If it happens to be,
hold on, guys, just quickly, guys, 2 minutes. Hold on, Sulaiman, hold on, guys. Justin Watchaguru just pinned it above our co-host Watchaguru. Federal Reserve. I'm not sure if you guys read it. If you did, I apologize. Federal Reserve considering creating a fund to backstop deposits if more banks fail. Oh, that's what you read, actually. Wolf, that's what you read. Yeah.
Yeah.
Or name redacted. Sorry.
So that's separate from what I read, but it's what I had my hand up to read. So you got it.
Okay. So can we? Yeah. So Wolf, can someone expand on this?
Got a little bit more.
Is that expected? Does that give us peace of mind? Is that what we're looking for, or is that just empty words? Because it says if more banks fail. So if we don't have more banks failing yet, we just wait for them to fail, or what happens next?
Well, and Mario, did you say that there was lines in LA, and if so, where is that? Because I can't find that anywhere online.
Yeah, we have. I'll actually send you the DMs. I'll send. Yeah. Okay, Dr. Danish, you can post it. There's a few tweets.
It's the second one in the nest. So if you pull to the right, it's already up there.
Mario.
Okay.
On top of it.
Thank you.
Regulators discussed this new special vehicle in conversations with banking executives. The hope is that setting up a vehicle would reassure depositors and help contain any panic. They asked not to be identified. because the talks were in public. That's from Bloomberg. I can pin the Bloomberg article to the top if you'd like.
See, they're communicating.
Yes, I would like to see that if you could. I just want to remind everyone, even during the financial crisis, there was not I mean, yes, certain banks failed and there were runs on some banks. I mean, Bear Stearns was technically not a bank. They weren't a deposit taking bank. So they're more of a broker, but really the only bank runs were, Washington Mutual and Wachovia for the most part. There was not a systemic bank run like we've seen in the Silicon Valley Bank situation.
So I just want to jump in quickly, and I see audience members kind of agreeing with Slayman's line of questioning, surprisingly. And I want to, I want to mention one of them that I got as well, Slayman. And I'm going to read out exactly what that person said. He's a regular panelist on the show. He's like, no way. Most people don't have 250K in the bank. Most people will say the government is saving the rich, or the government is saving the rich. The average American savings account balance is $4,500 between 1959 and last year. If you think they give a shit about people that have over $250,000 in the bank. So again, I know we're simplifying an issue here, and I know like if a business, Danish, before you say it, I kind of say it for you. If a startup, startups employ, they have employees. So if they can't access their capital, they're not going to be able to pay their employees, which may make, which have low account balances. They depend on those paychecks. So
that's sort of the point.
Addresses that particular point.
That was the
go
point
ahead,
I was trying to make, Mario, was that I'm not too concerned of like a contagion bank run, keep hitting multiple banks, because any videos of what you see of people lining up, those are low, these are mostly people with very low balances that maybe don't understand the system. It'll be more the sophisticated, high net worth people that are they going to panic and start, wiring, and where are they going to put their money? So I'm really not concerned about this spreading. I mean, there could be another bank that collapses if there's a similar situation where they have, sort of, on balance sheet markdowns, and maybe, I don't know, that it's possible, but I don't see a larger systemic like bank collapse over this.
You're saying people standing in line is Web 2.0?
I'm not saying
And just to add to what Name said, I remember Mario reading, I think it was from First, I can't remember the name of the bank earlier on, and they said that 30% of their funds are from the average person, and then 70% are from businesses. So again, it adds to what Name's saying. This is basically affecting the rich, and this is what the average person is saying, that what we're talking about is businesses, startups, and hence why there's an agreement. But people may not agree.
It's affecting. I don't know, is it affecting the rich or it's affecting the businesses? There's a bit of a difference.
That's a very big difference.
The typical, it's not affecting the typical rich person that's sitting on a lot of money. It's not using it. It's affecting a business that's using that money to operate and build a business.
So it's affecting either rich people or it's affecting startups, and the startups themselves.
Do rich people use Silicon Valley Bank?
Not really.
Or is it startups that use
startups?
So it's mainly startups.
Rich people are sitting in the big. The rich people are sitting in the big banks.
So it's affecting startups, but the reason, but Danish, do you agree that the reason why startups decided to use Silicon Valley Bank as opposed to larger banks was because they were willing to accept the risk, and so they both partook in that risk.
Who's they here? Silicon Valley Bank was.
So for example, both. So the Silicon Valley Bank was willing to increase their risk factor, hence why they gave loans and allowed the startup to bank there, and the startup knew that larger banks were unwilling to give them the credit or allow them banking or whatever it may be, or there was some kind of deal about both, because you received messages that there was a kind of connection between both in terms of credit as well as debit, and so for that reason, both partook in that risk. Because
Suleiman, I will push back at that, because just so you're aware, when you are part of YC or when we were part of Techstars, that is just what you do. You join Silicon Valley Bank. It's actually, it opens up a bunch of doors. They know everybody in the ecosystem. They make our bankers, when we used to use them, our bankers would make introductions to VCs all the time. You couldn't go to a party in the Bay Area that wasn't sponsored by Silicon Valley Bank. It was the ecosystem. It was the infrastructure the glue that was connecting a lot of people in the ecosystem. And so it wasn't just because they were fast and loose with credit. And as many people have said, the credit actually represented the loans that they gave to startups was a very small part of their book. It was more around the fact that they had a really good user interface. You could get a hold of them. They understood startups. And so they were able to do those things. And your VCs were using them. I mean, that's really why the large majority of people use Silicon Valley Bank. So, and I want to push back at this, notion that these, this is like rich people, startup founders are the new
just to add to
entrepreneurs.
that, I've just some people have just sent me some information. Again, it needs to be verified that Oprah Winfrey, Harry and Meghan, and these type of people were actually banking there as well.
Dinesh, I work with human behavior, run a lot of over $1 million worth of surveys a month for a number of years. As soon as they mention Silicon Valley and these news outlets start mentioning Harry and Meghan and Oprah and everything else, they will, and then start talking about some of the salaries that these people receive as a developer.
Makes a bailout politically unpopular.
Exactly.
I just want to say thank you. I just want to say good night and thank you. Sorry to try and wedge my way in here and
no, we appreciate you.
Thanks, Douglas.
Thank you all so much. Please
take
care of yourselves.
Yep. Thanks,
bye.
Thank you.
Hey, have a good one.
Joe, that's guys. On that point that Joe just made, does that change if public perception is not empathetic to what's happening in Silicon Valley Bank and the startups there? Could that change what any potential bailout? And I'm using that term loosely.
There are two paths, Mario. There are two paths. One path is I'll draw two pictures for you. One picture that people say that they were too sympathetic to the tech ecosystem, and the other one, photos of people standing in lines outside banks. Which one do you want, Mario? It's not a do nothing.
Like I say,
a photo of Oprah and her losing a 580 million, while the average American can't put.
I just wanna be clear, Slayman Danish. I'm not saying no or yes to a bailout. Unfortunately, I don't have those powers. Just want to be clear. I'm just trying to. I'm trying to see what you know.
I know, but I wanted to paint that picture because that's really the question. The question is
no, but if there's people lining up, but if there's people lining up to the bank and those people are in Silicon Valley, the perception is not going to be the same if it's not people in. Actually, when regional banks start to get hit, then that will be a different discussion. But then till then, if we wait till we get to that stage though, then could it be too late to act? So yeah, exactly. And we I can't remember what senator.
We there was an example you gave when you read out from First Something, which was another Silicon type Valley bank, which
First Republic Bank.
First Republic, that's it. And in that one, they said only 30% of the money is actually normal consumers as opposed to businesses. So again, it's not. The argument still stands. The average person, and I'm just trying to provide another argument. I'm not saying this.
No, 100%.
Yeah,
you're right.
Yeah, because the average person is like, you know what? Why should I bail out these tech people? They were taking risks. But Danish has said that it was for their benefit to socialize, to get socialize and to get links. And in addition to that, rich people like Oprah Winfrey, if she's losing 580 million, why am I going to pay towards that?
Dinesh, I think you mentioned it hours ago. Like, this is going to be politicized. Trump's probably going to come on and say, look at who they're bailing out. The government's been working with Twitter and people like that, and now they're bailing them out.
This is very dangerous.
Exactly what I believe is going to be coming from the right.
The funny thing is, and this is the most insane part of this, is that the people that support the innovation the most are now going to villainize the innovation industry. It is so fascinating. And I understand, I agree that you all are right. I guess I just don't want to admit it to myself that that's going to be the thing that breaks the camel's back. It's so incredibly heartbreaking.
Think of this.
We're going to get bankrupt.
The left wants to go to war.
Is innovation in
guys, can one person speak at a time?
Just to Dinesh's point, mine's really quick. It's the left is asking for war in Ukraine and supporting that, and the right is saying no, which, like, all the roles keep reversing depending on what they can politicize. So I don't put it above anyone to make it a political issue, and doesn't like the left and the right are kind of so blurred nowadays between they just pick a
I think, but Judge, I think it will be politicized after action is taken. I don't think it'll be politicized this early.
Yeah, you're right. You're right.
But yes, Sulaiman, what do you want to say?
So Danish, this is the issue. Look, I agree with you. Innovation is important, right? Innovation tech is important, and I made that argument very early on. But is innovation, and this is a question, is innovation and tech important enough that you want to, because your argument was like, China is going to get ahead of us. So innovation and tech is important enough to fight against a communist country, but by doing it, you almost become a communist yourself.
Got it. So I'll walk you through this. Someone just messaged this to me, Will Green. I'm giving you a shout out. So, because I was reading it earlier and wanted to share it as well. 37,000 small businesses bank with SVB, with Silicon Valley Bank. If only 10,000 of them are impacted, which is not true, probably most of them are going to be impacted, and we assume that they each have 10 employees, that's 100,000 employees. This is 100,000 employees in the innovation economy that are being impacted. If we don't think that 100,000 people that are building the future of this country now not having a job or being furloughed or being interrupted stops our competitive advantage against China, which we actually still have a major advantage against China, especially with generative AI and especially with some of the other stuff that's going on in the world. If we don't believe that this is going to slow us down, don't think of them as a bunch of startups. Think of them as 100,000 employees. That's what we're really talking about here. And I think that's going to be the framing, I'm sure, once they do bail them out, because now it's becoming more obvious it's going to happen with the Bloomberg story.
So, Danish, I don't think you answered my question. So, because I'm not disagreeing with you, but what I'm saying is, because essentially you're basically allowing the government to pay for these things. So why not just make everything under government control? Because that's essentially what you're saying.
No, what I'm saying is that until we have better regulation, we need to shore up the banks so that all the banks don't have a contagion. I think the answer here is similar to what Bill Ackman was saying, which was that they need more insurance. The 250K is just not enough. I mean, people are doing business. I'm sure that people here that are doing business, it's very rare that 250K can cover your business expenses. I mean, we're living in a much more expensive economy right now, especially in the startup side. And so 250K is not even a payroll for some people. So for a lot of people actually in the startup side. So, we're talking about maybe having a conversation around insurance. And I think until that is done, the bank has to do something while we wait for regulation to change.
So if I could jump in, I think I forget who I was talking to about this, but the text of that Bloomberg article, it sounds like unless something changes in 24 hours, they're not going to do some sort of sweeping 100% guarantee of depositors here. But this special fund that they're apparently discussing with the FDIC and Federal Reserve, what it says is they're weighing creating a fund that would allow regulators to backstop more deposits at banks that run into trouble following Silicon Valley Bank's collapse. Regulators discussed a new special vehicle in conversations with banking executives, according to people familiar with the matter. The hope is that setting up such a vehicle would reassure depositors and help contain any panic, said the people. They asked not, yeah. So it sounds like if that's the route they're going, then there won't be a 100% backstop to the Silicon Valley Bank depositors, but just sort of, if there's other bank runs or any other panic that starts to spread. So
is that a mistake? Name redacted?
I think it's personally my opinion. I think it would be a mistake to step in and this isn't going to be the popular view, but I think it would be a mistake to just go in and insure all depositors. It creates moral hazard down the line for other banking companies that they could take on more risk. And, because they know now that if they run into trouble, the depositors are good, right? So personally, I mean, I feel sorry. I feel terrible for the companies that that are suffering as a result. Obviously, like, this isn't the way a startup collapses, right? Okay, if a startup, starts up and it just doesn't work out, okay, fine. But no one ever takes on they don't ever consider the risk of a bank failure as part of their operations and the startup not working out, right? So I don't think that they should guarantee 100% of the deposits. And I know that's probably not popular, but it's just going to create more moral hazard down the road, right?
But a question for you, Naeem, who took the risk? Is it the bank or the startups that are using the bank?
Well, it's the bank, right? The startups didn't do anything. I mean, startups take risk, right? But I mean, that's just but the bank takes.
But in terms of having their money, in terms of having their money in the bank, why should they suffer for having their money? They didn't take the risk.
Yeah, I mean, I'm not saying that they should suffer, and I feel terrible for these people. That's not the way things work. No one. Yeah, I mean,
I mean, not just being empathetic. I mean, like, if you support the startups, but not the shareholders, so not the ones that are taking the risk, not the shareholders of the bank. And if you support the startups, the ones that have the money in the bank and trying to do the right thing and start a business, would that cause moral hazard if you support the startups one to one?
Here's the issue. It would just, I mean, this is where it's a tricky. It's hard to answer that because, while I have empathy, obviously, for these companies and the people that will lose job, the vendors that won't get paid, the credit lines that they're cut off from, it just will create moral hazard down the road. That's why even in the financial crisis, the deposit limit was only raised from 100,000 to 250. If they do an unlimited amount, it will create moral hazard down the line, and these banking companies will take more risk in their investments, right? So
can I add something? I think the companies. I think people were going to see, and look, I'm playing devil's advocate because I do believe the government should bail them out, but the general public is going to say, I know that I can't have more than 250,000 in a bank account, or else it's not insured. It wasn't the bank that took the risk. It was these companies took the risk. It was stupid on their part, right? And mind you, I'm playing devil's advocate
because of the startup.
Yeah, I
don't
agree with that.
One more thing.
Yeah, look, guys.
The banks. One second, Grant.
Go ahead, Grant. Yeah.
The banks did
I'll
not
just give the mic to
collapse.
Grant quickly. We'll go.
Let me finish 1 second. The banks did not collapse because of loan losses. Okay, like they have all these loans to these startups. The loans didn't sour and default to a point where the bank collapsed. It was a bank run. So that's all I was going to say.
Yeah, I can't. Look, I run a business that does about $1 million a day in revenue. Tell me how I'm going to have, what is that? That means I need 4 accounts just to process my accounts receivables in one business every day.
Exactly. And Grant, so what are you going to do?
And that assumes that I don't accumulate any money. I never save any money. Okay. And now it's ridiculous what you guys are saying. Like 32 million small businesses in America. There's millions, probably 10% of those have millions and millions of dollars sitting in bank accounts.
Yeah, and I get it.
They're trying to move across payrolls. They're moving across payrolls, across equipment purchases, debt. Also, it's the only way to get terms with the bank is to have some deposits there. If banks don't have deposits, the banks can't lend money.
Then why didn't they just make it unlimited during the financial?
Excuse me. Well, they could have. They could have made it unlimited then. But I do understand that there could be, then they would start taking more risk. But let's say a guy's in the rental business. Okay, one of my businesses is rentals, and I have 12,000 rentals. What am I expected to have? And the average rent's $2,000. Okay, so am I expected to have 100 accounts for every so many rental? Like I'd be spending most of my time just managing money in 50 or 60 different business accounts.
Right.
Now take it to a guy that's got $1 billion in cash, which I happen to know some of those guys. They would literally wipe out they would need the totality of every bank in America to have a minimum of 250, and at $1.2 billion, they would wipe out every bank. There's plenty of companies with that kind of money. What does Apple do? with $290 billion in cash.
I get it. I mean, I get your point. I mean, but also with your business's grant, I don't think you factor in the risk to your business if a bank collapses, right? So it's like this is like
never.
You know,
I would never even consider it. I couldn't wake up every day and go to work.
Yeah, I mean, so I'm sympathetic, obviously, to the businesses. It is a very touchy subject. It's just like, what's the answer here? Of do we just make clear across the board, unlimited, FDIC insurance now? I mean, I don't know the answer to that. I could
the short term. Why not?
I like to weigh in and mention that I felt that people have not kind of add this context, so I want to do that. In my I shared yesterday a article from Wall Street Journal journalist Jonathan Well published in November last year. That's actually it does not only happen to Silicon Valley Bank, but also many other banks. The underneath reason that this happened was because banks were piling up that much of cash, and then they have nowhere to go. They have to purchase bonds, and because of the Federal Reserve raising the rates, the bond drops, and then Silicon Valley Bank was just one of those banks that has to cash them out because though they are paying payrolls, their clients are paying payrolls, so their money only goes out, never comes in because of this bull market. But this could happen to many other banks. You better check out that article. There's Wells Fargo, there's Bank of America that's even higher in those laws, and then these were only buried in not reported because they're being buried in the friendly accounting rules. You don't have to report the loss if you have not cashed out the bank. But just imagine when people need to go to the bank and have a bank run on Monday because they fear that they couldn't pay their employee of payrolls. They will need to get them out. So this is what we are going to happen. We're going to see. It seems like no one has talked about this. I come from a crypto industry, so we have seen this firsthand because USDC has happened. USDC was the crypto stablecoin that has reserved 100% back peg, but just because some of that reserve has been banked with Silicon Valley Bank, that bank run has happened on crypto because there's no weekends. But just imagine when wake up on Monday, every business is going to cash out the bank. So we're not talking about bailing out banks here. These are people who run the payroll, and the payroll goes to rent, goes to their utility bills. And these are normal people who need to depend on this. And I just want to add that into the context of the conversation. I can totally resonate with all the sentiments about like some financial sections who are taking irresponsible risk, but this is not what we're talking about here. No one asked the question, who gave the power to the Federal Reserve to raise the rates in that, like without considering these potential considerations? I asked who also in this call have bank accounts with Wells Fargo, have with Bank of America, and then maybe also check with your bank and see if they have bonds. And that's what I want to add to this context. Thank you.
One thing that's interesting about what you just mentioned is that we are now starting to talk about all banks. Suddenly, to Grant's point, it's not something entrepreneurs think about. The one part of your business that has little risk is where you keep your cash. It's one of the only areas where you can feel comfortable. You start messing with people's money, and they start saying, "Hey, I need to start moving it," and it just moves up the chain. I know Grant was messaging some of the people on the back channel about people moving money from local community banks into regional banks. Where do you think they're going to go as the risk rises? They're going to say, hey, let me take it from the regional bank to the larger bank. It's going to be this chain of events unless we backstop all banks in the short run. We make sure that everybody gets to keep their deposits and we're able to backstop them in the case of a bank run. And we get sentiment back to normal. This is not about rich people. This is about ensuring that the contagion does not continue. Ben, do you agree? Ben, are you still there?
Yeah, hi. Yeah, sorry. Yes, I'm here. Yeah. No, I'm from Australia, and what we're noticing over here is I've been selling real estate.
Ben, your audio's cutting in and out.
All right, I'll fix it up. I'll come back in. Just wait.
All right, sounds good. Wolf, did
So
you
while
have a
he's fixing
question?
it, Dr. Danish or Grant, if I've received a lot of questions, but one of them I thought was very good to ask, and because you guys will know better. So someone said 2 points, and they're talking about the people who are basically putting funds into Silicon Valley Bank. And they said these aren't people that took their own money and deposited it into Silicon Valley Bank. A lot of them are startups that got the money from VCs and SVB because of both of them are incestuous, and deposit these funds into SVB. And the second point he made was the people standing in line don't have 250K, but we've talked about that. So the first point, if you could give your response, that'd be brilliant.
It's not who is getting the money, it's where the money is going. The money...
No, but the argument is that it's not their own money, is the argument he's making.
So again, in the entire startup ecosystem, the money is coming from LPs, it's going to VCs, and from VCs, it's going to startups. The startups then take that money and they generate returns for the VCs, who then distribute that money to the LPs. It's kind of like saying, hey, if Coca-Cola shut down tomorrow and all those hundreds of thousands of people lost jobs, people can't say, well, they're a public company, and so it's people's money that it's not their real money. I mean, I think that's how the economy works, Suleiman. So I feel like that's a weird take. I mean, Grant, you raise money.
I get what you're saying, but Grant's gone. The reason for that retort, I assume, is because people earlier were talking about the emotional aspect of how it's affecting people, and they're trying to say, well, it's not their money. In terms of the other point is, obviously, we've discussed it quite a bit. Go on, Joe, go ahead.
No, I think fair question. Joe, go ahead, sorry.
Yeah, I mean, I typically try to look at history when trying to figure out what people are going to do here. And so I look back at like what the approval ratings were for the auto bailout after it happened, right? So the auto bailout was in 2008. I think it was around $80 billion, something like that, 86. Don't quote me, but I know it's around there. And 73 in 2012, after the bailout already took place, 73% of Republicans were opposed. 63% of Democrats were supportive of the bailout. So, I mean, the only solace I have here is, unless a lot has changed, Democrats are typically supportive of a bailout. Although this isn't a bailout, the general perception is going to be that it's a bailout, because most people don't know enough about finance to understand it's not really a bailout. But I think that's how it's going to come across. So maybe because Democrats were supportive of it before. Weird, because it was actually started by Bush, not by Obama. But hopefully there's some solace there that Democrats are supportive of bailouts.
And just to say, before we go to name, I actually think that, and I agree with you, Joe, completely, this is going to be politicized. And I do think that the points I'm making will be the position of most people on Twitter, and it will be more a position of the conservatives, as a guess, based on what I'm seeing. Go on, name.
Well, I guess to follow up what I was saying earlier, again, I will start off by saying, obviously, I sympathize with people that will lose their jobs, people that will not get paid, startups that may shut down. It's a tragedy. It's terrible. But if you get to a point where you make 100% of depositors whole, okay, even though it's not their fault, okay, well, where does it end? Do we now go to, okay, like a Lehman Brothers style collapse that, 1 million people lose their job? Do we now just start paying these people? Because these are people like me and you, it's not our fault if we work for a company that collapses and we lose our jobs. So now should we just get a paycheck from the government? Like, where does it end if you start just giving out, bailouts like this? That's sort of my point. Like, and yes, if you do start making an unlimited FDIC type insurance, you can't just do it for this instance, right? And then take it off and then wait till the next bank collapses and then put it back on again. So this is exactly why in the financial crisis, they just raised the limit. So I could see maybe in this instance, they could double it to 500, but like, if you start making unlimited government guarantees, where does it end, right?
And name, what would be the consequences of that? Because I asked that and I don't think anyone answered it properly. If they made it unlimited, which is what a few people proposed, what would be the consequences of that?
Well, in my opinion, I think someone like Ram would have a better answer, but in my opinion, it would create moral hazard down the line for these banking institutions to take on more risky investments with the depositors' money, right? Because if they know that they could make investments that are higher risk, and that if it doesn't work out, that the depositors will be made whole, then what's going to hold them back, right?
That's
Sorry,
very good.
Sorry, Zain,
I just shared the. Oh yeah, sorry.
Hold on, guys. Just 2 seconds. Everyone, just 2 seconds. Joa, can you share the news you just sent me? Have you verified it?
No, that's just no. That's I'm just showing the sentiment. I'm looking online.
My bad.
Yeah, I just did hashtag bailout, and you see a lot of people saying, "Are you fucking kidding me? Another bailout of a bank?" Then another lady, second largest bank failure happened today. Of course, the government is going to step in. We're becoming a socialist country. Like I'm just looking at sentiment on Twitter, and you can see it already. What we're talking about, like people don't think. I think there's a big portion of the country that's not going to be in favor of this.
I'm just going to add one thing, give it back to Slayman. Sorry to interrupt, Slayman, but I was going to add, it's a similar thing we saw in 2008. I just don't think, the alternative to this is significantly worse in terms of sentiment, in my opinion. And the regulators will know that. If they do something, they'll get a lot of backlash. If they don't do anything, they'll get significantly more backlash. So which one is
the best way to solve this would obviously have been if a larger bank, a top 4 bank, would have come in and, bought this, just taken everything, and then depositors would have been fine with maybe a small government guarantee on some of the loans. But that obviously didn't happen because, the bank's already in receivership.
I see a lot of hands up. Just jump in.
Hey, Mario. Go ahead.
No, just quickly. Zaynan, what link you're referring to?
Sorry, I was just going to
read. If anyone want to read that, because I heard a lot of in this conversation about there are tech sector, there's tech sector, there are banks, and then so I just want to share this. This is not just about Silicon Valley Bank. There are other banks, and then including, I believe, the top 4, which name have mentioned, the Bank of America and Wells Fargo. So go check it out. I'm done.
Yeah, look, here's the problem statement. I'll lay out a proposed solution. And by the way, I described the solution in a thread I just posted, Mario. Take a look at it. But you need policy action. So let's go back to 2008. In 2008, you had a TARPA bailout. That was a $700 billion bill that was attempted to be passed. It failed to be passed. It caused a market dislocation. And then when bank stocks were tanking, it was ultimately passed. Now, fast forward 14 years, we don't have the budget. We have debt ceiling issues. We're even more politically divided. There's no patience or tolerance for a bailout. So, what do we do? Well, what you can do is open up capital to private capital markets. The issue is this. Under the current laws and regulations, banks can buy other banks, but there's a reason why Amazon has not stepped in to buy a bank like SVB or Google or Apple or Berkshire Hathaway, right? Berkshire Hathaway has $140 billion in cash. Apple has tens and tens of billions and so on and the like. It's the same reason why Walmart could not acquire a bank back in the 2000s, if you recall. And it's a brittle industry. It needs revitalization. It needs a new private capital. It needs a modern technology stack, right? These banks are under the threat of the internet because you've got lightning fast digital banking, wire transfers in a second, and social media. So the answer to that is more technology, modernization, revitalization, and private capital, right? There's a reason why no private equity firm stepped up to save Silvergate. It's illegal for a private equity company to own more than 24.9% of a bank. Otherwise, they fall under the supervision of the Federal Reserve and Dodd-Frank. And second, again, there's a law that prohibits commingling of commerce with banking. Those laws are antiquated. They make no sense. Internationally, banks can have other business lines. They can commingle commerce and banking. JP Morgan started as a water business before it became a bank. So my suggestion is we update policy, enable private capital, technology, private equity, entrepreneurship, including big technology firms to get into the banking business.
But that's a long-term fix. And I think people are trying to figure out, what's going to happen over the next several weeks.
Fair.
Guys, Ben, Cadbird, just if you hear us, we're quiet. Feel free to just jump in if no one gives you the mic.
Sorry. I agree with Ram there too. Just that comment he made about social media, and it's come a long way since 2008. So I think whether it was fear of missing out that drove property prices and a lot of assets up, and now it's this fear, the worst is going to happen. So. Yeah, I'm in real estate, obviously, and I've seen, I've been in it for 23 years, and we're seeing a lot of people now not wanting to hold cash. This is in Australia. I'm not sure about other countries, but, people are diving into real estate and not, holding on to the cash. So, I think, it was a very different picture that, at the start of the pandemic about what everyone thought was going to happen, and the complete opposite. So, I think it's going to be interesting times.
Cat Bear?
For sure. Cat Bear, you got something to say?
Yes. Thanks for letting me speak, you guys. I just wanted to go, I kind of think that a lot of people are missing the boat on this. Right now, even discussing bailouts on this specific bank shows how little that a lot of people don't know about these bank accounts, right? So like right now, the initial review, 75% of these funds are recoverable already in the initial review. So the bidding right now, there's a few hedge funds and a few banks that are only bidding on the deposits. Right. So insuring the deposits, and you have bids anywhere between 60 to 80 cents on the dollar. Do you think these companies would come in and bid to pay 80 cents on the dollar if these funds weren't recoverable? And the way you should know that is because what got us into this situation last week, which I feel like most people are very, very confused about. The thing that got us into this position was ensuring that these deposits were safe. That's what people don't understand, is that this bank did not have a bunch of really bad assets. These were bonds and mortgage-backed securities that they sold, the HTM that they had to sell was to generate liquidity, right? Because essentially the main problem that you have here is the main problem you're going to start seeing rising at other banks the longer we go higher for longer. All of this stuff has been stated by these regulators. It's all, I can show you the different stress tests that they have, even in the special scenarios a month ago, so really what we're looking at is that when the deposits dropped at this specific bank, it had a contagion, or it had a problem that a lot of the other banks haven't seen yet, right? Because it kind of is like your specific customer. They're kind of a niche bank where they have a lot of this venture capital money in there, right? So their deposits dropped significantly. So their assets that they had, their long-term assets, were a lot larger because in 20 and 21, they had this huge inflow of all this VC money. Well, that deposit dropped, which means that they need to either reduce their assets to match the deposits or raise the liquidity. And the way you do that is by selling. And I keep sharing stuff from the FDIC or from the OCC on the derivatives when they're talking about a lot of the bigger banks. The way you do that is essentially you have to sell that portfolio for liquidity. It's a way that they insure it. So this is to ensure that the funds are secure once they hit this threshold. So once the bank did that, that's what caused the run. But these assets, the people that have over the 250K, the average, we already know that's fine. The FDIC is already coming forward and saying, okay, people are going to be able to access 50% of their money by Monday. Okay. Not many banks can sustain a bank run. In fact, no bank can sustain. If everyone tried to pull out their money from the bank in the same day, no bank can really handle that, whether they had a liquidity issue. So this has to do with the regulation and making sure this bank would stay solvent. Okay, is really what caused this fear, that caused this bank run, that immediately put them under, this custody. And I think one of the big things is you have a lot of fear and a lot of emotions, because if I was one of those businesses and I have $400 million that I didn't know what was going to happen with it tomorrow, I would be scared and I would be demanding. But we're demanding bailouts when there isn't there's a problem, okay, and it's scary, but guys, this just happened on Friday, and it's the weekend, okay? The bank is already renamed. It's under like its new name is something for like the insurance or whatever. So what I think is going to happen is that, and why everyone keeps saying, why won't these banks come in and buy it? If you don't think that these other banks are in the same position, you're wrong. Which is that these deposits are dropping.
No, that's not true. That's not true.
Okay,
there are banks out there that can take over the bank. The issue was that the equity was negative. If you were to market the HTM securities, that was negative $15 billion. That would have completely wiped out the tier 1 capital. There are banks big enough. It's just that there was no equity value. And there's $42 billion of deposits that left on Friday. And there's nothing wrong with the bank could have been fine. It could have been it could have been SIVB of Morgan Stanley on Monday. It was that these VCs came about and basically said, hey, everyone pull out your money, and they lost $42 billion in a day. When IndyMac went bankrupt
that was the bank
in 2008, they were losing $100 million a day. It took 13 days for them to lose only $1.3 billion. If these assholes hadn't gone on national TV, they wouldn't have forced these securities to be sold and for this big hole to be realized so quickly.
Well, no, I agree with you. The bank run is what kicked it under. But what I'm telling you is right now we're demanding bank runs when the FDIC and all these different entities are coming out and telling you 75 to 80% of this money is recoverable. Sure. So, while we're all sitting here talking about should we have unlimited insurance without like a limit instead of 250,000, guys, the system worked properly. They came in and stopped it, and I know this is inconvenient. I get it. It sucks, especially for the people who have, a few, anything over $250,000 to these bank accounts, right? People whose payroll's frozen. I know it's super inconvenient, but every other solution, when you guys are like, I don't know what the solution is, it's more inconvenient. So yeah, there's a little bit of time, but this will weed itself out without needing a bailout, right? It doesn't need a bailout because they were able, these assets and everything that they have, it's not that it was completely liquid. It was that the bank run made it illiquid, right? That's really the problem here. But the only reason there was a bank run is because they had to realize these assets.
Sorry, Pat, can I ask you a question just based on what you just said? Because so you're basically saying there's no need for a bailout, and there's companies that have offered 80 cents to $1. Now, hypothetically speaking, if a company was, another bank or a company or someone was to take over, would there be a need to bridge the gap between 80 cents to the extra 20 cents per dollar?
Well, I mean, I think that's the cost of doing business, right? So
it's not just the 20%. It's that there's $65 billion of credit lines that were going to these companies, and many of these companies relied on these credit lines to make payroll. It's not as easy to say. Everyone knows they're going to recover 50 to 60 cents. By the way, this week, they're going to probably get the first uninsured dividend from the FDIC, which could be 30 to 50 cents on the dollar. That's not the problem. The problem is this is a bank that had loans and lines of credit to all these companies, and they're not going to be able to pull those lines down, which is why, everyone was waiting for these guys to be sold to a bigger bank.
Okay, but that's a different issue than what we're talking about here, right? The issue that we're talking about here is like what.
It's the capital.
I know, but that's not the issue that we're.
Let Kat finish, and then you can go. Go, Kat.
The issue that we're all debating and saying what's the solution to was the issue of how are we going to make these people and these businesses whole? And what I'm saying is I know that this is not the best route, right? Like I know this is super uncomfortable and painful for the people who didn't pull their money out and now they're like, really nervous and it's over the weekend when they haven't heard anything. But the FDIC has already said 50% of all the bank accounts, people who had 250,000 will be able to access that 250,000, and then everything over it, 50% of that is going to be available on Monday. Okay, they're working as fast as they can.
Kat, can we just the question was special asked. I just want to ask it to you. His argument is that even if you were to get 100 cents to the dollar, as you phrased it, it wouldn't make the company whole because you still are not dealing with the line of credit that they're losing out on. So how would you answer that?
Okay, so I totally agree with that. But this is about, if you're telling me if one of my lenders go under, yeah, I have to go find different lenders. Yeah, it's inconvenient and it sucks, but that's a lot better than having to find different creditors.
If you're a venture company, you can't find somebody to lend you money at those terms in most scenarios.
Why is that special?
So I mean,
The reason why this firm even existed is that they took the risk to lend to companies that don't generate free cash flow. When you go to a traditional lender, most banks don't lend to companies, by the way. 80% of like leverage lending for companies with BBB minus or Baa3 credit is done by private investors. It's done by CLOs, it's done by private credit firms. And when you have companies that don't generate free cash flow or don't have a lot of assets, which is 99% of tech companies, the SIVB was essentially taking a bet when they do venture debt on the reputation of the venture capital firm that's backing the firm. They're taking a holistic bet because a lot of these VC firms had their money at the bank as well. They're taking the accounts receivable at a lot of these firms that sell software, and they're factoring those receivables, and they're working with companies outside of Comerica, outside of PacWest, outside of SVB and a few other banks. Nobody's going to bank these companies. Like, that's what I think a lot of you guys don't understand.
Special, can I ask? So then doesn't that come back to the point that we were talking about before, that these the bank, SVB, as well as the startup companies, knew that they're taking this significant risk that a normal bank wouldn't take, and therefore they should deal with the consequences of that?
I mean, you could say that, but then you could say that about anything, right?
Yeah, but I also don't think their significant risk was their holdings, right? The thing that they had to sell, that they took all the losses on, were mortgage-backed securities and bonds. Like the most risky thing ever.
They took a massive risk. They took a massive risk. Those securities are incredibly risky. If you had a 10-year duration portfolio, Kat, if I give you $100 million and I gave you those bonds in November of last year, you would have lost $30 million because you have 10-year duration. For every 1% interest rates go up, you would have lost 10 points on those bonds. That's an incredible risk that this guy took by top ticking the market and buying $90 billion of this paper and not hedging it using interest rate.
I guess I totally agree with you that they did a terrible job hedging it. Okay. But what I'm saying is in relation to what we're talking about, which is fine. Like when people are talking about this bank, they're making it out like these risky investments into these not profitable early tech venture companies is what caused it to collapse. And really, it was the thing that was the giant red flag was the hit they took from mortgage-backed securities and bonds. Yeah, I understand it wasn't a great outcome, but in terms of risky, most people don't think treasuries and mortgage-backed securities are going to be a problem.
They had off-balance sheet liabilities of $65 billion to these tech companies, and they also had about $50 billion on loans to companies that don't generate free cash flow. So that's not why the bank went under, not at all. But it's not a mischaracterization of the bank.
So Jim,
okay, but what I'm saying is that that's the lending isn't the problem, though. The lending of who they were lending to
that would have been a problem eventually.
That's right.
I would
maybe it will be a problem eventually.
So 1 second, guys. Just Ram. Yeah, you want to say something?
I'll just be very briefly. Look, Silicon Valley Bank had a unique edge in lending to these startups because there's an implied quid pro quo. If you're providing venture debt to a company that's got equity from a General Atlantic, Acceler, or Sequoia, you know those VCs are going to do the next financing and make you whole on that debt. That's the implied quid pro quo. That's the reason why JP Morgan is not going to buy that venture debt portfolio, because they cannot acquire that edge. It's those relationships. It's that soft value. The other part is fundamentally what SVB was doing was lending to unprofitable startups. That's not a good business, right? What banks do is lend against secured collateral that cash flows, things that are required for people to live and work, houses, autos, cell phones, commercial real estate. So I do think that business worked for a very unique period of time with flush liquidity and an implicit backing from venture firms. But I don't believe that lending business is a high quality business for any other bank.
It is not.
So
it is not. That's why it's hard for a small bank to buy them.
Marshall. Go ahead, Marshall.
Yeah. So I just got off the phone with an SVP of Signature, and I wanted y'all's take on this. His take is First Republic is out of cash already. I think that's conjecture mostly. There's no way for him to know that. The other thing he said is they were tested very much on Friday. For their current queued wires for Monday, they have more than enough liquidity. His words, not mine. Thinks Monday is going to be a hard day, but he doesn't see any issues. They're going to put out a press release in the morning, he said, that will give their numbers on their current holdings and liquidity. He said they're mostly 3-month T-bills. But he also said a bunch of things that just like feel kind of like marketing hyperbole. So
who is this guy actually?
This guy is I don't want to give his name, but he's a SVP at Signature for the digital asset stuff. So we're talking a lot about the USDC stuff, and he said they have had a lot of withdrawals, but they also had a lot of inflows from people from other places. So he feels good that they're positioned well, but Monday will be a tough day.
I think First Republic is a much better bank than SBNY, but just an opinion and based on the balance sheet.
Yeah, can you explain that? I don't know anything about banking, right? I'm just a Bitcoin miner. I don't know anything about this
happen
stuff.
On Monday, but if you just pull the balance sheet, I mean, First Republic banks high net worth individuals. They're in every wealthy city on the coast. So it's not like a business bank, that has 93 of its deposits at corporations. They have a high net worth banking arm. They have a very diversified deposit base. They even have, a hedge fund business. They're connected to all the prime brokers. So it's a much more diversified business model. SBNY, I don't want to say anything negative about any institution. It's a decent bank. They have a similar business as Silvergate, which had to shut down a couple of weeks ago, but they are also diversified. They're a lot more diversified. They have commercial real estate business. They have a securities portfolio, but they also bank a lot of crypto firms as well. So it's just funny that this VP at SBNY is saying that First Republic has these major issues, whereas First Republic is just a higher quality balance sheet and a more diversified business with less regulatory risk.
I would add this, like First Republic's a great business any other time but now. And here's the issue. 80% of First Republic's deposits are over the 250K threshold. So that creates more vulnerability at a time like now. By the way, I just posted in the thread a list of the top 100 banks sorted by the percentage of deposits that are uninsured. And what people are going to do, including the short sellers and capital markets that are already doing this, is take short positions in banks that have a high percentage of uninsured deposits. And when those stock prices fall, that triggers more wire transfers out of the system.
Joe, you already had up for a while. What did you want to say there?
But that alone, the fact that their deposits are over 250K doesn't mean that it's a bad institution.
First Republic is a world-class business. I was at Merrill on the deal team. We acquired them, then we sold them post-credit. It's a beautiful business. At this time, in this environment, people are focused on the percentage of uninsured deposits. It's easier than ever to do a wire transfer with a digital bank. There's reporting of lines around First Republic's branch in California, right? I heard that earlier on the Twitter space. So those things are of concern. Anytime but now, First Republic would be a great business.
Ram,
can I play other scenario?
Sorry, 1 second. Sorry, Joe. Ram, what's the percentage of uninsured for First Republic?
80%.
80%. All right, Joe, go ahead. Sorry, I interrupted.
Yeah, something I'd like to ask Ram and Special, based on what Kat was saying, I think there's some validity there. If the FDIC covered all deposits up to $250,000 and the rest of it, 80% of it was covered, do you think the government did what it needed to appease the average person into, hey, it wasn't really a bailout, we needed to step in without causing a lot of backlash? Do you see what I mean? I just saw a new narrative.
I don't think so. And this is why. I think that, first of all, that money is going to be gone for several months. It's not all coming at once. Maybe 30 to 50% can come in the first week. But these are companies that actually use the cash. SIVB was a unique business in that they raised money from venture capital firms. When you did a new deal, you put your money at SVB, but the firms that bank with them, had only raised money for 6 to 18 months. So they're burning a lot of cash. So there was a lot of deposit outflows even in the prior years. They would have 10, 20 billion of outflows in a quarter, and they would have to make up for it by essentially growing with new deals. So one of the risks for SIVB was that as the venture business slowed, it's almost like a Ponzi. You would actually lose more assets than you would gain. Well, let's take a step back. The businesses, there are thousands of businesses
that bank with this firm that have credit lines and that have uninsured deposits. And the effect on liquidity is going to be much higher than the number. If you were to say that, I think 80% is frankly too high. If you look at the FDIC bankruptcies for the receiverships for the last 40 years, most recover 10 to 20% on uninsured deposits. The reason why this could be closer to 50% or 60% is because half the portfolio is securities. But I would say half of that is going to take several months to be returned, and it's not as easy. I mean, there are 8,500 job offers that were given to SIVB employees for 45 days to start. And it's because the FDIC realizes that these employees are going to have to stick around for several weeks to liquidate these assets. And there are also 50 billion of assets that are loans, and these loans, like Oaktree is bidding 40 to 60 cents on these loans that need to be monetized. And those loans, you also need to raise capital to pay people back. So there's going to be a period of like several months where people don't have access to half their cash, nor have access to the credit lines. Now, what is that going to mean? Board of directors that don't want to take risk, because in California, the labor laws are so strict. If you're a board, what you're going to do is you're going to fire everybody on your staff rather than run the risk of employing people without pay. You might hire them back at some point, but you're going to see tens of thousands, if not hundreds of thousands of layoffs over the next couple of weeks, regardless of people getting their money back or not. That money will probably, in some ways, that money might not ever make it to payroll for the people that expect it. So it's not as easy to draw a conclusion like that.
I'll be very brief here.
Aren't you kind of drawing a conclusion on the credit side of it instead of the banking side, which is really like the government's never, I'm not aware of a time that they came in and they're like, we're going to take over these risky commercial loans that no one wants to touch to make sure these companies are operational.
No, that's why they sell the bank to another bank. That's why the FDIC guarantees it. When a bank takes over another bank, the FDIC essentially assists that new bank in taking over the prior bank. And I think in most scenarios, in a situation like this, where you have the 14th largest bank in the country with 220 billion of assets, the best solution is to actually sell the bank to another financial institution. It's not the government's job to provide those loans, but they facilitate a deal. And I think that didn't happen because of the arrogance of a couple of VCs on national television.
Right. Let's go back to the bailout topic. This is really coming around. Is there a proposed solution that doesn't mean taxpayer money is put at risk? I do think Bill Ackman's concept is workable, right? And again, his concept is the FDIC comes out Sunday night and says, we insure all deposits across the banking system. Now, that sounds like a bailout, but it's not. And here's why. If you stop bank runs, then you prevent banks from being forced sellers of bonds and securities into their hold-to-maturity portfolio. And that's it. So they're not going to recognize the loss. Bank run stop. There's no taxpayer money put at risk. It's not actually a fiscal bailout. Does it create moral hazard? Yes. This is not the time to debate moral hazard, though. This is the time to take decisive and swift action to avoid paying real bailout risks down the road.
Nim, do you agree?
Partly, I guess, but yes, Ram's correct. It will create moral hazard, but yes, is there something that we should do today to address this? Sure, but what can they do? So, just I assume everyone on the panel knows this, but FDIC is not taxpayer funded. Okay, the banks are paying. There's a fee. I don't know what it is that the FDIC charges, but the banks are paying into this fund that the FDIC has, in the case of a bank failure to insure these deposits. Okay, so if you make all deposits suddenly unlimited insured, who's going to pay for that? That's where you're going to get into a political issue, because right now, the FDIC is not taxpayer funded. Their fund that the banks pay into for insurance is backed by the government in case something happens there, but it is not funded by the government. Okay, so I get that it sounds great maybe to just say, okay, all deposits are 100% guaranteed, but that's going to create an issue. Who's going to fund that? Who's going to pay for that? We don't have the money to pay for that. So
there haven't been any payouts from the FDIC insurance fund in a very long time. So
years.
It's a 1 to 2 program. It's simply a stopgap measure. Now, pragmatically, this is the weakness in Bill Ackman's proposal. The weakness is that to execute that, it can't get done over a weekend because it goes beyond the FDIC statutory authority and budget. So that's the issue. So therefore, the FDIC needs something more pragmatic. I believe the pragmatic answer is announcing that all insured depositors will be made whole Sunday evening and identify a clear timeline for that. I think anything short of that, and then you're going to see more focus around First Republic and other banks that have high loan to deposit ratios.
So how are they going to make that happen, Ram?
Well, they can announce it. Right now, I've no doubt they're working nights and weekends. They can announce that. The FDIC can cover, Silicon Valley Bank. The capital shortfall is manageable. But again, the FDIC, it's not necessarily the case that they're going to eat all those losses, right? They will auction off these various components, a loan portfolio. There's franchise value there. That franchise value has equity value. So if there's an orderly auction process over an extended period of time, right? So first you put out the fire, you provide, you create public confidence, and then you have an auction process over time, then there's a shot that the FDIC, could come out of this without a much of a loss to the insurance fund.
I get what you're saying, but I think this goes beyond what the FDIC is even able to do. They only have Jim Plafford $125 billion, right? So this would be like Federal Reserve type thing for what you're.
Why? The capital shortfall is a fraction of the 128 billion, a fraction.
Well, this might not be the last bank.
Real quick.
Well, maybe it is. Who knows?
If SVB has a disorderly liquidation, then it's not the last bank. If the FDIC is decisive and swift and reassures public confidence, and the American, public in Main Street America wakes up and they say, "Oh, okay, bank got taken over. The regulators took care of it," and they go on to their daily life, then that's success.
Question here for Ram, name.
I would hope for that. The problem is that's just not how the capital markets work. The cost of capital for a lot of these banks is going to go up. They're going to have to raise equity. That's going to be negative for the stock prices. They're going to have to put out a bunch of AKs. All the tech companies that have exposure via credit lines or deposits are going to have to publish AKs next week if it's material. We have X amount. Right, just like Circle and Roku and all these other companies, Roblox, that had to disclose. You're going to have a lot of negative headlines next week with companies with exposure. That's going to cause fear. People are already DMing me about, I'm not even going to name the banks. Should I move my money from XYZ Bank or ABC Bank or DEF Bank? That's going to continue for most of the week, right? Until there's something resolved.
This is nothing compared to the financial crisis. Okay.
No one's saying it is. No one's saying that it is.
I'm just saying that it's just, I'm not at that level of worry here yet. And I went through the financial crisis on the front lines. I'm sure you did too. But I lost sleep over that. I'm not losing sleep over this. I mean, and again, my empathy goes to these businesses. Obviously, it's terrible. It's tragic. It's not their fault,
Look, there are legitimate concerns around the loss of public confidence in banking. And I think the point you're making, the special situations from Goldman here, is that, look, the Bill Ackman proposal is a good one. It just can't happen over a weekend. I
don't work at Goldman anymore, but go ahead.
Okay. You should DM me later. We should get a coffee in New York sometime. I'd love to chat with you further on this stuff. But I had a phone call with a real estate investor, and what they are doing is they're reassessing all of their banking relationships. They're acting like credit analysts. They're talking to East West Bank. They're talking to all their counterparties. They're all doing work this weekend in the same way that everyone became an expert in immunology and biology with COVID. Everyone's becoming a banking analyst and reassessing their relationship. It starts there. It starts with the businesses that require funding from banks. It's not yet Main Street America.
Thanks for that. Wolf, you got your hand up?
Yeah, I mean, I agree with that. East West, by the way, is an interesting business model. I think they had to sell their CLO business last year. It looks like Wolf has his hand up. Sorry for.
Yeah, thanks.
I guess there are two people with their hands up. Please feel free to go
I
ahead.
got a pretty interesting message from the audience that I think would be a good question, which I can drop to yourself, Jay, or Ram, or name whoever wants to take it. But this was around First Republic Bank. So quote from the message here, they didn't want to be name announced, but they're saying First Republic Bank, obviously one of the most popular banks for hedge funds. What happens if hedge funds lose banking access? The Big Four do not do business with hedge funds. They also said they have spent 3 to 4 months setting up their hedge fund. This is coming from a hedge fund manager. Thursday night, they got an email from First Republic Bank saying that they expected final approval Friday morning, and they would contact them for the final step. They did not receive anything Friday. They are not responding to email inquiries at this time. So kind of curious, what is going to happen to the hedge fund side of this if they lose banking access?
Yeah, could I chat on that for a second, please?
Sure, and then we can go to Rob.
Thank you. Yeah, so I bank with First Republic. My fund banks with First Republic, the one I run, and I've been on the phone with them the past couple of days because, I mean, listen, we keep most of the capital custodied at the prime brokers, so we don't have like a shit ton of AUM, in the bank actually. But I am trying to hedge that relationship at the moment because it is a real risk. I did hear someone say, I think it was Marshall, that SBNY is getting inflows, and I can tell you right now that that is a stone cold lie. They're not getting inflows. I know big real estate developers who've pulled hundreds of millions of dollars in deposits across various accounts. So they're not getting inflows.
That's good color, because a lot of the things you said, I have no way to verify, right? That's why I brought it here. I wanted to hear from people who actually.
They're not getting shit. They're not getting shit.
I thought the point raised earlier was spot on. I was going to go there as well. So the hedge funds do have banking relationships, and it's called prime brokerage. It's where banks like Morgan, Goldman Sachs extend credit, trading, liquidity, repo financing. So that happens. Now, a commercial day-to-day banking relationship, well, that happens as well. Citibank offers those services, but you're right that there were these specialty banks that offered services to hedge funds. Where I'm hearing the most pain is crypto hedge funds. Those crypto hedge funds cannot find a bank for the life of them. So that category and just kind of Web3 it is seemingly locked out, or at least in queue with banks.
Mm-hmm. And if SBNY fails, which it looks like, I mean, listen, I have other opinions about them that I'm not going to get into because it's too much to talk about here. But if there is a run on SBNY, that effectively means that Signet also fails. And if Signet fails, watch your crypto. Okay, that's all I'm going to say.
And why is that? If you can explain to the audience.
Well, it's core payments infrastructure and transfer infrastructure for the entire space, don't you think?
Okay.
Signet's the last man standing in the crypto business.
This is a big fucking deal, man. Big fucking deal. This is no joke. Okay.
So you're basically saying that would impact crypto, because a lot of people yesterday were basically saying,
where's the liquidity? Where are you going to get real time 24/7 365 USD transfers? Where? And their private blockchain is bullshit. They give their users API access. It's mutable. Okay, so they can hide transactions there. I'm not going to get into that. I'm sorry, but this is a big problem.
Yeah, it's interesting. It's interesting what you said, because yesterday it was framed as in the discussion that crypto may have been the answer, but you're saying crypto is equally at risk. Go ahead, Ram.
It's not the answer. If there's one private blockchain that crypto firms rely on to do 24/7 365 USD transfers, it's not all right. There's no infrastructure left.
Yeah, thanks for that. No, I like it because it's a different perspective. Go for it, Ram.
Yeah, no, just briefly, just supporting your point. Exactly. Look, crypto is a 24/7 market. Crypto enables instant settlement, but it needs a real-world connection, and that real-world connection is only Monday through Friday, 9 to 5, and that creates issues around settlement risk. So let's say I say to Mario, hey, look, the funds are on the way, the check's in the mail. That doesn't work in crypto time because Mario may have an obligation to pay some other counterparty, and Mario might get liquidated if he doesn't receive my funds in time. So the mismatch in the speed and velocity of the crypto market versus the traditional banking market is an issue. The solution to that was Silvergate Sen and the signature Signet network. Without that, there's more operational risk and settlement risk between crypto exchanges.
Yes, big time.
Okay, that is interesting. Ram, what about your argument? Because I know you talked about I mean, you and Name basically disagreed about it in terms of, you know, if there was a bailout, why that would be actually beneficial because it stops other bailouts. But how do you basically marry that with the situation that to stop possible other bailouts, you're basically using public money?
Well, I don't know that there's the Bill Ackman proposal. That's the one I think we're talking about, right? What he's saying is that the FDIC says for a period of time that all deposits are insured, full stop, right? Now, that doesn't require a check to be written. Checks are written when banks like Silicon Valley Bank are taken out over the weekend, and then they are forced to trigger losses because of the impairments on their hold to maturity portfolio. So long as these banks can hold these bonds to maturity, they'll be fine, right? The Federal Reserve has $1.5 trillion in losses in its hold to maturity portfolio, but it doesn't matter because they can hold to maturity. So what Bill's saying is, look, just the FDIC comes out and says there's full deposit insurance, and then how can you have a bank run? If there's no bank run, why would anyone have any motivation to have a bank run? Now, yes, there are other issues and concerns, moral hazard, all the rest. But if there's no bank run, then how are you going to have a taxpayer bailout? I don't see the mechanism.
Lindsay, you've been on here for a while. Have you got any thoughts?
Oh, sorry.
Have you got any thoughts?
Go ahead.
Yeah,
go for it, Lindsay. I can talk after.
No, go ahead, Wolf. I can go after you. That's fine.
No, you're good. I was just going to ask questions to the audience, so you're good.
Oh, I mean, I think like just as far as the bank run situation, I think like it's great to try to quell concern, but I think just amongst business people, we just have to be conscientious of the reality. And I think that, you know, the media and things like that can make things worse, of course, and nobody wants that. It's just like during the pandemic, they were saying the same thing, right? And come to find out, there's a lot of things that we didn't know that may have kept us safe, may not have. We don't know really, right? We don't actually know. So I think in the same situation, you know, if the, you know, honestly, the bank was telling the truth finally last week saying, oh, you know, we're having some issues, but they weren't saying that on the first, and they weren't saying that 2 months ago. So I just think that there's some kind of like coming to the table that they need to do, but also on our side, like just really, again, I'm just speaking from business perspective, not private deposit perspective. I'm talking about as business people, as entrepreneurs, as people that set the tone for industry, as people who help to discuss and motivate policy. I just think you have to talk about the side that's scary too, and the uncertainty, because if you don't, you're going to be, you know, kind of like slapped in the face. And so, to some of the points, like where people are saying, oh, well, you should be able to depend on a bank, you should, but you know, we didn't come from a place that had banks like, you know, 300 years ago. I mean, the stock market was created under an oak tree, you know, like this, like America is a place that created a lot of the processes and businesses that we have and the ways that we do things. So, and honestly, that's what's exciting about America is innovation and the ability to innovate in a tough time. I know that like, that's not what everybody's feeling right this second, but honestly, sometimes these kinds of things are downturns can be amazing opportunities. So, you know, it's not that it doesn't feel fun to have to beg or to try to, you know, get funded after the fact, but sometimes that's when you get the better deal, you know, on both sides, whether it's you're the VC or the LP or you're actually the startup. You know, I've had lots of deals I didn't get funded and I ended up owning the whole thing. And that was way better for me, you know, than taking money and having to give up half my company originally, you know. So just saying, like, I think like people get emotional and they worry. And granted, I get that money is so hard right now anyway for so many people. It's been tough since the pandemic for businesses and small businesses and startups, but we'll get through it. I think it's going to be great. I think that this is actually great for the banking business because it's going to show a lot of transparency that's been needed for a long time. So.
Thank you for that, Lindsay. Wolf, you said you had some questions.
Yeah, I think it's one thing which I've kind of been thinking over is where does the money go, right? if you trigger a bank run and we see all these smaller banks and the money's moving out of them, does it just move into the larger banks? Does it go into the stock market, right? Do we see more capital placement in real estate, brokerage houses? Where does that money end up is kind of a big thought that I've been thinking because I love following the money. Yeah, Ram?
It's a phenomenal question, and Bill made a one-sentence reference to this, and I've also been keen out on this, but I think the securities market's a beneficiary, right? There's an alternative to FDIC insurance. We call it SIPC insurance. And by the way, the coverage there is $500,000, not $250,000. And you can own a Vanguard money market fund or a Charles Schwab money market fund at a 4.6% yield, which is higher than the deposit rates across the country. So I agree. I think that's happening. And we'll see how much it happens. And, Bill's point, which is a really good one, is that if the shift is substantial and significant, that creates a concern for credit intermediation, right? Banks play a very important role in extending credit to middle market companies, small businesses, the SBA lending program, capital markets, which is what money markets consist of, bonds, right? Ford Motor Company, Alpha Bonds, and all the rest. Those are large publicly traded companies that can raise money from Wall Street, and it would be a significant policy concern if smaller institutions couldn't access credit.
Hi guys, I'm calling in from Canada, and I wanted to ask two questions from the panel. I'm actually sitting here in Canada right now, worrying about the contagion from this bank collapsing in US last week. So first question I have is, what do you think about the effect on other international banks like Canadian banks, or in UK or in Europe or all over the world, like it happened in 2008? That's the question number one. And the second question I have is, this bank that collapsed was the largest bank in VC funding. So it was funding a lot of innovation, a lot of diversity, and a lot of growth in the technology sector. What would be the replacement of this bank in future, or will it slow down the growth in the technology and innovation? Thank you.
I can answer the first question. This is not like 2008 in the sense in 2008 there were the underlying assets, the subprime bonds that all the broker dealers and a lot of banks held, but there was also counterparty risk, right? Because there was a lot of swaps between banks, derivatives, credit default swaps from AIG to the rest of the banking system. And the reason we had that crisis was with the collapse of subprime, AIG became basically insolvent and could not pay off those swaps, those credit default swaps, basically just meet their mark to market, right? With the other banks, which these other banks, Goldman, Citi, Credit Suisse, Deutsche Bank, they have those swaps hedged with other counterparties. So that was the systemic crisis we had in the global financial crisis, was counterparty risk. And that's why we had a credit crisis and a freeze, and banks just basically stopped lending to each other. So we're not at that level, not even close. There's no counterparty risk problem from the collapse of this bank. Last thing I wanted to say, and then someone can answer his other question. I've gotten 5 DMs so far about how quickly people can access their money. And just to remind people that in any bank, if you have an account under $250,000, like in the Silicon Valley Bank instance, that money's available Monday. So these pictures of people lining up at these other banks is just unnecessary. If people understand that if you have less than $250,000, your money's not going to be tied up for months. That insured money will be available right away.
And not Tiger, I want to hear your thoughts on that, but I do have a question, and it's from the audience based on what you said previously. So let me just read that. Someone said, when talking about crypto not being a use case, in this scenario, you better not be misleading people into thinking Bitcoin is part of the dumpster fire. So if you can answer that, and then I know you had a response for name as well, so please go ahead. Not
Yeah, no, I'm not lumping in like crypto. I think there will be a hit on prices, but in terms of damaging the entire ecosystem in the long run, I'm not making that claim. I'm saying in the short run, it is a problem for liquidity potentially. So that is all I'm saying.
But when you were mentioning crypto, were you including Bitcoin in that or not?
I was including all crypto. Yeah, I was including Bitcoin. I was like, I have a hard time believing that you're not going to see the prices plunge if the core, one of the core pieces of the infrastructure is no longer existent. So, but what I wanted to respond.
Please go ahead.
Yeah, sorry. To name redacted. I agree that it is not 08 by any means, but I think to downplay the collapse as not systemic, as ignorant, it is technically not systemic because it falls underneath the asset threshold. So like they don't need to do stress tests, and that's why they weren't hedged, because they never had to do stress tests. But if you think about like the other derivative effects of this, and I had a post on this, so if you want to read it, you can, but I'll just say it here. A lot of these regional banks, and we've talked about it with First Republic, like they are very key banking partner, right? Because they have the integrations with the fund admins, like Opus Fund Services, and what's the other big one? I'm fucking blanking on the name. I use Opus Fund Services, but so they're very core. These regional banks are core to the capital provider community, right? Hedge funds, VCs, PEs, very core. And if you think about SVB and customers not being able to access deposits or all of their deposits at once, and if there's not a solution in a timely manner, and the contagion kind of spreads across a lot of corners in the technology space, that affects large companies, because the ones who consume, cloud services the most are startups. If you look at, 2020 and 2021, there's a big reason why AWS and Azure and Google's search ads revenue went through the fucking roof, is because 50% of VC dollars raised ended up on the revenue lines of big tech. Okay, so to make the claim that this is not a problem, a bigger problem, is all due respect foolish. Okay, they buy laptops and technical equipment. Okay, startups use software packages from Snowflake, Salesforce, Datadog, Twilio. This is not a joke.
Yeah, I was not making that claim at all. The only, maybe I should have said that. Like, this is obviously, a huge deal. I mean, it's, however you want to call it, it's a big deal, and it's tragic for the startup companies. It's tragic for job loss that will result in it. It's a terrible situation. The only thing I was saying was, compared to 08, do we see a global sort of financial contagion resulting? That was all I was saying. I was not downplaying anything about the collapse of the bank. Makes sense?
I get it, man. Yeah, okay. Yeah, absolutely. No, I've been on other spaces, and like everyone's saying it's not systemic. I'm like, by the government's definition, it's not systemic, but it is systemic.
Oh yeah, for sure. Yeah.
But I think the key is that if you intervene decisively and swiftly now in the next 36 hours, then it can prevent something from becoming worse. Even if it's a 5% chance of becoming systemic, the consequences of that are severe, and the costs and the payouts are far more severe. And once markets start trading, then you start getting these pro-cyclical, self-fulfilling issues. So you want to nip it in the bud, you want to head it off the pass, and now's the time to do that.
Well, we have 6 o'clock Eastern tomorrow. We'll see what they do. They better come out and say something, do something.
Yeah, the question is do we really believe they're going to do something?
Yes, absolutely.
I hope so. I really hope you're.
Let's set up a binary contract. I will go on the over on that one.
Well, there was some news.
What do you guys expecting?
There was some news. Where is it? On Bloomberg. Hold on.
Well, while you're checking that, Kat, you had something to say? Go ahead.
Yeah, I'm saying, what are they expecting? Like, what does everybody think the government is supposed to like? They're I understand that the time is of the essence for a lot of these businesses, but like the smaller bankers, people with 250,000, we already know that they're going to have access to all the money on Monday, up to 250,000, and the other people, they're saying approximately 50% will be available this week. Okay, and obviously they're figuring out to get buyers, but like, let's keep in mind that if this bank didn't have a bank run and it didn't get like seized by the FDIC, right? If that didn't happen, like when hedge funds are bidding 80 cents on the dollar for these deposits, it's to give them that money immediately. And essentially the FDIC will make sure that, these accounts are made 80 cents on the dollar, but that's because they're willing to wait longer because they're going to get more money back. Like this, the regulation that was in place, essentially, other than the bank run portion of it, this bank, if it didn't have a bank run, would have, survived somewhat. And maybe long term their venture paper's bad or whatever. But we're talking about the current situation we're in right now. So I keep hearing people like Ackman and everyone keeps saying like these accounts need to be insured to 100%. That doesn't make sense. Right now, the system, the way that it's built, it's giving them 80 cents on the dollar without it being insured. So what more do you want? And when we say that, then people are like, well, what about their lines of credit? Well, since when is the government supposed to back up risky venture fund line of credits? Like, what is the problem? Like, what are we asking of the government? Because I understand them stepping in a crisis. But, people getting 80 cents on the dollar with the inconvenience of this when a bank goes insolvent, it's really not that bad of a crisis, right? If we look at it, sure, some people are going to get delayed on their paychecks and it's inconvenient, but like, let's think about other times when stuff like this happens and it takes a while till the government can get their ducks in a row, right? So they can line up buyers and things like that. So it sucks, but at the same time, if we didn't have this like regulatory stuff in place, if they didn't do all this, then wouldn't the final outcome be worse and people wouldn't get even more money?
So look, First Republic's got a line around the block. When people make a deposit at a depository institution, they expect full principal preservation. That's the issue. They cannot tolerate a 20% loss because that money was never considered risk capital. I do think there's a way for private capital to take it on the chin. As I mentioned earlier, like why can't we have technology companies and PE firms step in? And there are reasons in the law that don't make any sense, that are outdated. But the other is like, look at Larry Summers as the tell. Larry Summers came out a few hours ago. Mario, if you guys can pull that up or get the transcript, it's worth sharing here. What he said is that he expects that there's no reason that unsecured depositors can't be made 100% whole. And the reason why Larry's important is Larry, again, he was a former Treasury Secretary, runner-up to Chair Powell and Council of Economic Advisors. What he says, he's giving license and leading the regulators. They can coalesce around his proposal, and that's a good proposal.
I mean, but how is this a good proposal? How does that mean the government isn't your backing?
One second, Kat. Vinny, I know you disagree, so what's your thoughts?
Yeah, so let's start with making sure the narratives are clear here. Silicon Valley Bank took about $80 to $100 billion and plugged it into mortgage-backed securities. This is not risky loans to startups. This is, effectively securitized. It's MBS, and it's effectively your treasuries, right? So it's not like they went and made all these risky investments across the spectrum. They banked the Silicon Valley community. They banked the wine community. They provided banking services, but they didn't invest that money aggressively into technology. So that makes it very clear that the reason they lost money is because in 2021, when there was a lot of capital coming in, they decided that, and based upon the guidance from the Fed, that rates were not going up. They decided to buy heavily into low-yielding mortgage-backed securities because they had nowhere else to put the money. And then the moment Powell got re-elected, he changed the story because he changed from a loose monetary policy stance. He got Biden to re-elect him, and like 6 weeks later, it's like, oh well, we have to tighten now. Sorry, inflation is not transitory, and he started jacking up rates. The problem is that started impacting the yields on the MBSs that they had, and therefore the value of those assets dropped, and this is why we have a hole. To be very clear.
Well, they also tried to do that convertible capital raise of $2.25 billion, and it failed, and then that was the end of it.
But that was now. I mean, we're talking about like how did they get into this mess? And the second thing is, this is a regulatory failure because the regulators allowed them to so the way it works is, if you have mortgage-backed securities, for example, that you are not going to sell, you're going to hold to maturity. If it declines in value, you do not have to take any impairment on your balance sheet for that. You can just write out to maturity. And so the percentage, I think it was 80% that they were going to write out. They did not have to show losses to investors or anyone else, stock market, etc., because the regulators have that rule. And by the way, that rule applies to the Fed as well, because the Fed holds to maturity, and they've got $1.5 trillion, according to Ron, sitting in this exact same predicament, that it's underwater, but they're just going to hold to maturity. So the problem really right now is a capital mismatch and a liquidity crisis. You have a bank that has these mortgage-backed securities that have been impaired as much as everyone else's. They couldn't mark it down on a quarterly basis or monthly basis. So this has caught everyone by surprise, because now they don't have liquidity to pay out depositors. And the run of the bank is what triggered this, right? Because if there was no run on the bank, this wouldn't be an issue, because most banks don't keep, I think 10, 20% max cash. So this is a very tricky predicament, but we must be very careful not to miscategorize what the situation is. This is not a tech bank failure, high risk startup investment bank. This is not what they do. So that stuff is a very, very small percentage of what they do. This is a mortgage-backed security issue, and this is a treasuries issue, and this is caused by the Fed whipsawing back and forth on rates.
I totally agree with you, Benny. Yeah, that's exactly what I said when I first joined this space. That was the exact same thing I expressed to them, and the reason they had to take it out of their HTM assets and move it over and realize those losses was because of liquidity, which is to make sure that those, that there's these ratios they have to maintain to their deposits. And it was the deposit outflows because of the nature of their business. There wasn't that much VC money coming in. So and I totally agree with you on that. Those weren't these risky things that put them in this position. Regardless of that, okay, with enough time, I think a lot of people are assuming because of this bank run that they're completely illiquid. And no, like I'm saying, like right now, the FDIC is already telling you 80 cents on the dollar they can return of even the uninsured funds, just based off of, everything being sold off. So it's not that this was like just a complete shit show. No, it's a mismatch of the duration of their assets in comparison, and because of the way that we were tightening for longer. And the thing is that, guys, all these banks have HTM assets over to the side that are not on their balance sheets. And if they get into a predicament where the deposit outflows continue to go out, which the stressors are different based on your clientele, this could happen to other banks, right? So the thing is that when you should expect a bailout, in my opinion, should be in the situation where if their assets came out, it doesn't get them close to whole. And I know it sucks when you bank, we all assume there's a level of safety. But if you go to any bank that's FDIC insured, everywhere it's plastered, hey, you only have $250,000 that's insured. And I know what people are saying, which is, in theory, people are like, well, then you're going to see bank runs. Okay, what, are you going to put $250,000 in every single bank when you're a big business? How are you going to transfer money around? Let's be serious. It's not that often that this happens. You only need to worry about this $250,000 threshold if something happens to your bank and it goes insolvent, which does not happen that often. So the thing is that, I think that the system did work as it's supposed to in this one situation, because sure, there's a little bit of inconvenience of time, but it's a lot better than the worst outcome, which is that if that didn't happen, maybe that amount would be lower for those bigger people. But the solution is not that the government should just step in and tell everyone all your money's covered forever. Well, then what's the point of having banks? Why doesn't the government just do everything then? That's what you're suggesting.
Let's expand that for a second, okay? So, who do you think's at fault in this situation? Do you think the depositors that had their balance over 250?
No, I don't. I just think that's
no. But I mean, if this was JP Morgan would the government step in? That's the question I have for you. If JP Morgan had this crisis right now, would the government step in and backstop it?
I don't. I think it would depend on the amount of money that is going to be returned. And in this situation,
multiply the number by 10. So let's say it's $2 trillion worth of assets, and the whole is 100 billion, and everyone's money is involved, and now it's 10 times the size. Should the government step in, or should they let the financial system collapse? There's a question for you.
I mean, I think the government would step in if it got into a thing where it was something the size of JP Morgan. I do believe that, because at that point it's too big of a problem.
In principle, you're saying the government should only step in when it's totally systemic and not just on the facts of the case.
I mean, I guess it would depend, right? So if the majority of the people who are subject to this are going to be returned, I just don't think that there's going to be an instance where the government would have to.
I'm saying to you right now, if the figures were 10x and it was a $2 trillion portfolio, and we're going to take a 20% hit,
but it's still 80% that's being returned. Okay. Wait, 80% that's being returned?
Yes, and so we're going to go from $2 trillion to 1.6 returned, and $400 billion is going to be lost by, people, depositors. In your mind, should the government step in or not? $400 billion.
On 400, no, I still don't think so. If the majority of everyone's getting 80% of their money back, no, I don't think that.
Okay, so you realize that the second and third and fourth order effects of that much of a hit on the economy basically would destroy the entire U.S. financial system. Everyone would basically take the money out of the bank.
If that happens,
$250K and spread it across
the situation you're describing,
you also have a run in the banks on every other small bank. It's not sustainable, because you're basically destroying faith in the financial system. Money would flow out overseas, would flow into Switzerland, UK, even Europe, Singapore, etc. So the money would leave the banking system. There's no.
Well, you have the same problem there. You have the same problem there. You think Singapore and all these other countries are going to back every single dollar of your money? They're not.
No, but the regulations are different.
This is like an apple oranges is comparison.
One second, guys. Yeah. Name. Go ahead. Your response.
This isn't. You can't compare a JP Morgan to this situation. And again, not downplaying the Silicon Valley Bank situation. Okay, but of course the government will backstop JP Morgan, because if JP Morgan collapsed, that would cause a global depression and a global financial meltdown. Okay, so it's like.
Can I just chime in real quick, guys? Just real quick. So I'm talking to Mark Cahotes right now, and he's requested to speak by the host. He's got some very interesting information that I think everyone should hear and needs to hear. So if you could let him in, that'd be fantastic. Thanks.
Yeah, have him request and I'll add him. One second. Sorry, Vinny, go ahead. You had a comment.
Okay, let me just finish the point, because I think this is the point that needs to be made. There are lines outside First Republic Bank today. First Republic is in trouble on Monday. I've already had CEOs message me saying that they're moving a lot of money out of First Republic on Monday, first wire out. There is going to be a run on that bank, and there's going to be a ripple effect on many other banks. And honestly, the hedge fund guys are all lining up to basically short the entire banking sector and create panic, because they make money on the short side here on Monday. If there's no backstop, we are going to see a collapse of the financial system come Monday, at the very least with small banks, when people move their money to the big banks and consolidate there because they believe that's safer. This is not good for America. This is not good for the financial system.
Vinny, in terms of, specifically in terms of Name's argument, though, he said it's not an equal comparison because one impacts the world economy, whereas the other one doesn't.
I didn't hear that part. It cut off me.
Yeah, what I was saying was to ask about JP Morgan. I think what your question was, should the government backstop
with respect to capital flows, America has a very open capital system. You can move money around the world easily. Other countries like South Africa, you have closed capital system. Moving money in other countries is not that simple. If the U.S. financial system collapsed or people started taking 20% haircuts in every bank, in the major banks, no one would leave their money in South Africa, in the U.S. bank accounts.
Okay, well, what I was saying was, like, we're talking about Silicon Valley Bank, which I don't think represents, and again, not downplaying it to make it clear, but this bank collapse doesn't represent a systemic contagion to the whole global financial system is all I'm saying. So of course, if JP Morgan ran into problems that would cause a global depression and financial meltdown, the government would backstop that. That's all I'm saying.
I think he's dropped. And you're back. You're back. Go ahead, Vinny. Are you back? No.
Cohorts are requested. Do you guys see it?
Who is this? Sorry,
Mark Cohorts. He requested.
He's
Do you guys see it?
not requesting or showing up for us. So there's a pretty common glitch that happens on Spaces, and if a space is more than 1,000 listeners, a lot of people can't be seen. Like Stock Market News wanted to come up, I can't see him. Kurt Gavin wanted to come up, I can't see him. So you can just let him know that it's a pretty common glitch.
Hey guys, thanks for hosting the space. I do have to jump, but sorry, Mario and Wolf and Suleiman, thank you very much.
Thanks for being here, man. You've really contributed quite a lot. If you want to tell him to message us, and then I can forward the message on. That's probably the best way to do it.
Okay, cool.
Name, thank you so much. Yeah, you contributed greatly. I appreciate it. Vinny, did you hear what Name said?
No, I had to leave and rejoin. I only heard the back end of it. He was saying that it's not. He was saying that, but what I could hear was it's not a international crisis. It's a U.S. problem. Is that correct?
Yeah, essentially, what he said was that you can't compare the two because one would impact the global economy, whereas this is a specific problem which wouldn't have far-reaching effects in the same manner. So therefore, you can't make the same equivocation.
That's fair. I'll actually concede that point. However, like I said, the second, third, and fourth order effects are unknown for us if we go into a multiple bank run week this week, and all the small banks basically get taken down, or a large number of them, and then the regulators have to step up. This was a regulatory failure. Make no mistake. This wasn't the transparency, the mark-to-market rules, the way banks are allowed to have the ratios they had, etc. This is a regulatory failure. It's not, and it can become systemic. And that's all I'm saying is like, we don't know what happens. You could argue it's isolated to Silicon Valley. I just don't think that's true. Come Monday, if this isn't resolved, we're going to have a much bigger fallout.
So, Vinny, you weren't here for the discussion earlier, so I'll ask the same question again. I do apologize if it comes across a bit boring. But I guess the main argument that the people have is, and we received a lot of messages when we finally brought this up, is that why should the average person who's struggling to even put his light on have to basically fund or get people from Silicon Valley who've decided to go to that bank, whatever it may be, and they've taken the risk on themselves. The bank's taken the risk on, they've taken the risk on. They could have went for a larger bank if they wanted to. So why is it that the average American has to bail these people out? Now, I understand your argument that it's not a bailout, but what they're saying is, even when it comes to covering their deposit, why should they have to cover the deposit?
So again, let's make sure we understand something. We've gone from a zero interest rate environment to 5%-ish in about a year and change. And the banking system, I don't think has ever been stress tested to this effect, ever, not with this sort of level of rate hikes. And so the regulators, again, they're at fault here, and the Fed as well, because they basically created strain on the system that is just impossible for bankers to manage. I wouldn't say impossible, but the number of banks that are actually underwater right now with mortgage-backed securities and other bonds and treasuries, it's a lot bigger than people realize. I think that I saw a stat of like $600 billion, whatever, of unrealized losses that are sitting on banks' balance sheets across the country because they were holding long-duration bonds that they bought in 2021, and they're holding to maturity. And because of the accounting rules that the regulators set, it's not transparent in terms of how much they've got in real reserves. And not just the transparency, they don't have the ratios of capital primed for what the actual mark-to-market values of these securities are. And so, first of all, a bailout would be like, hey, let's save the company, let's make sure the shareholders are made whole. That's bullshit. No, like, nobody wants that, right? What we're saying is that this is a regulatory, like, you might as well just be buying Bitcoin at this point, because if the regulators go on about Bitcoin, I mean, how many times have you sat and listened to these Bitcoin hearings at Senate and whatever else, and like, we need regulations that protect people just like we have in the banking system? Really? Well, where's the protection now? Okay, it's not there. And so if it's not there, then what's the point?
Look, I get that. I get that. But then, as you said, it was a failure by the bank, and it was essentially a decision made by the people who use the bank to, to use them, and because they usually, we've discussed this, so you may have missed it, but basically, they could have went for the larger company like JP Morgan, but the reason they went for smaller company like Silicon was for a variety of reasons. Some of them was that they were giving them credit when other companies wouldn't, and that was linked to them putting deposits in. And then in addition to that, it was basically in terms of the connections, so being able to get connections in the various fields. So they made a decision to go with them, knowing they're a smaller bank. So therefore, that decision's gone wrong. And so why should now the government bail them out? Why should the people have to bail them out?
So that's not a very fair characterization. So I mean, look at the wine industry, right? The wine industry banks with Silicon Valley Bank because they went to Napa, they went to Sonoma, they set up offices, they started helping the wine industry and the farmers finance their crops, their inventories, etc., and provide very good bespoke solutions for most of the wine farms out in Silicon Valley. So they're not tech, right? But they are farmers. So why do we want to protect corn farmers and other farmers in the Midwest when we don't want to protect the farmers in Northern California farming wine? Why do we subsidize farmers in other parts of the country for other crops? We can make these arguments all day long. The point really is, do we want to unleash what is potentially a black swan event on the entire US financial system and possibly the global financial system? Or do we try to contain this and say, look, what is the real loss here and what is the issue? If the Fed backstops it and says, look, we'll take on, these illiquid assets, and maybe the FDIC gets involved and says we can insure some of it or whatever the case is. First of all, is there something worth saving? Because if there is, then people will probably be made whole anyway. And if there's not, how do you prevent a total meltdown and a knock-on effect that basically pushes people out of, it's kind of funny though, because the perspective that people have is kind of very selective, right? If it's in your interest, you're like, oh, well, we should definitely save it. If it's not in your interest, you're like, why should we care? But the reality is that we spend hundreds of billions on, protectionist rules in the country to save people from disasters and whatever else and bad economic decisions that they make, etc. We do this all the time. We do it for centuries. We bail out the banks in 2008, same thing. I just don't see why this time is any different. And I think the ramifications of this is far worse.
Right. So, Kat, you want to respond?
Well, in 2008, it was completely different, right? So that was for the average Joe. That's number one. Where this is the major people at risk. It's not that this bank didn't have insurance, right? It's that if you have over 250,000, in one account at one bank, that's not covered, right? So these are bigger entities. Now I understand they're publicly traded companies, things like Roku, all this other stuff. I totally get the problem here. But what I'm saying is that this isn't a total failure of a bank, right? These assets still are 80 cents on the dollar. It doesn't require government intervention.
Numbers coming from. If you just do the math, they're 175 billion of deposits.
So in Bloomberg,
Kat, you can finish, then we can go over to Jay.
So if you, in Bloomberg, they issued, it came from Bloomberg Terminals, a screenshot, it's on my page, that the hedge funds are negotiating right now with the FDIC to buy the depository accounts for 80 cents on the dollar. And a few different banks are doing it, but that's on the depository end. It's not on the, a lot of the assets. So that's what we're looking at right now, because we know that's collectible, but that'll get the money to people faster. But we already know just in 1 week, so this all stopped on Friday, got seized Friday, and they're saying by Monday, the people with 250,000 will get that in their account, and everyone else will get about 50% of their deposits accessible. I'm sure they're going to prioritize things that were in transit for ACHs to be transmitted. And I know it sucks because everyone's in the dark over the weekend, but Jay, earlier, this conversation started because people are wondering, should we bail them out? Shouldn't we bail them out? When I'm like, we're going to get 80 cents on the dollar, you're like, well, what about their lines of credit?
I think Bloomberg's wrong. I was a hedge fund guy, and I'm looking at their balance sheet. And for a near-term recovery, I think 80 cents is far too high. They have 175 billion of deposits. You mark to market, right? With using the duration, you can mark to market the HTM securities. I'm assuming it's like a $25 to $30 billion loss. So assume you have, something like 55 to 60 billion of those securities, plus the cash of 13 billion that they had, plus the $21 billion sale. But on the 50 billion of loans, those loans are being bid like Oaktree's bidding 40 to 60 cents on them. So I think 60 cents is something reasonable.
So those
if
are
I
the
were
loans.
to go bid.
Okay, that's the loans.
No.
But
Calm
we're
down.
talking
No,
about deposits.
wait. I'm adding up all the numbers. I'm adding up the HTM security value plus the cash plus the discounted value of the loans. And there's no way that in the near term, I would bid 80 cents on the uninsured deposits. I think 60 cents is a lot closer to what someone would be willing to pay up front. I think the Bloomberg article gave a range of 60, 80 cents. And I think next week there was also a range given of 30 to 50 cents. And you're just picking the highest point of both those ranges. And there's a big difference between 30%, 50% for next week. And there's a big difference between 60%, 80% as well. I mean, I just don't think I think people are making light of that issue.
I think you guys are looking at this.
I don't think that.
I think you're looking at it way too micro. You're analyzing the bank itself and what the bank issues are. The problem is this is not only a Silicon Valley Bank problem. This is a banking problem. The government increased the rates. A lot of banks, hundreds of banks, have these treasuries that they bought in 2021 because of COVID for 10 years. And basically, whatever the government does here, it'll send a message to sophisticated financial people that have large sums of money and things of that nature, that if you have money in your bank here, we're only going to cover, even if it's 80%, right? Even if they do go as high as 80%, we're only going to cover 80%. What are the sophisticated financial people going to do? They're going to move their money to safer places away from the U.S. That causes a bank run. That causes a financial meltdown. And I think that's what Vinny's trying to say. This is a macro problem. This is not a micro problem. It's not a Silicon Valley Bank problem. It's an entire banking issue of the United States. And whatever America does right now, it'll set the precedent for what's going to happen to all the other banks.
Where are you going to take your money that's going to insure it for 100%?
I think that's very valid. And when you think about how hedge funds work, they're bidding on stuff to get a return above the risk-free rate. So if you're a hedge fund, you're going to put in your cost of capital. You're going to say, all right, what is this asset worth? This asset is worth 80. I want to mitigate my risk. Maybe I'll pay 70. Then I want to get paid for my time. I'll pay 60, 65. So, I mean, that's kind of how the capital markets work. They're not going to pay you full value, even if the recovery is 95 cents. Nobody's going to pay you the full value up front of what you're going to get.
So 1 second. Okay, this is Mark. Thanks for joining us. What's your thoughts on this? We'll just get somebody else's opinion on the discussion. Mark, you just need to unmute.
Hey, I'm here. Can you guys hear me?
Yes.
So first of all, thanks for letting me speak. I think a lot of you guys have it really wrong. Some of you have it right. Tiger has it right. And the lady who thinks the government shouldn't bail out people has it right. Silicon Valley Bank is a fuck show. It's been a fuck show from the start. They didn't match assets up with liabilities. They took excessive risk. And the people who have money there or borrowed money there thought they could borrow money very cheaply and make 10 to 15 times their money on their greedy VC investments. And it's just not the way the real world works. And when you take too much risk and you make mistakes, you should fail. And you should fail big. If I make mistakes and I lose money, no one bails me out or no one bails any one of you other guys out. So this should be a good message if they allow this thing to fail, which they should, and not bail people out, which they shouldn't. They should let the process work, because otherwise no one will know what taking risk and the ramifications are or will be about. In terms of Rahm's misguided view about short selling, Rahm is an idiot. A flat-out idiot.
Hey, dude, calm down.
Can we keep this space civil, please?
I'm civil.
Yeah, that's
no, you're not, dude. You dropped the F-bomb 3 times, and you're a world-renowned short seller.
That's fine. And you know what? Rahm got on a world-renowned program and recommended.
But this space isn't about Rahm. The space is about the topic at hand. So I'd like to hear from you about that, though.
Mark, right, guys, Mark, if you just keep it civil, like, just get your point.
I'll keep it civil. I'll keep it civil. But a guy who recommended Silvergate at $25 last held 2.5 90 days ago, how you can take this guy seriously is beyond me, which is why society and you guys are in the problems that you are. A lot of this stuff and a lot of these assets should never have been financed in the first place. And they were financed because of easy money. And when people who lose their asses, right, lose their asses because they take too much risk and they don't have things figured out, they should go broke. They should lose it all because that's what capitalism is about. That's what free markets are about. And this constant begging and Bill Ackman crying that he needs things bailed out or Larry Summers or things like that, it's absolutely ridiculous. It's ridiculous. And let the chips fall where they may. Good banks will do well. Bad banks will fail. And that's what it is. But Silicon Valley Bank, Silvergate, Signature Bank, all these banks were set up on unsustainable, fake, fraudulent models that do bad things. And if bad things happen...
I think you're painting with a broad stroke here. I think you're completing
one second, guys. Marshall, come. Mark made some points. I'm assuming Ram is talking about you unless there's another Ram, so I'll give you a chance to respond.
Well, look, I'll be brief. And Mark, I don't hold any ill will to you. You got Silvergate right. If that's what you want to hear from me, you have it. In December, I published a thread saying, I don't have a view on Silvergate because you shared information with me on the hold to maturity portfolio. And I indicated that. So to give you some background, Laura approached me and said, hey, can anyone make the case for Silvergate? And the downside risk on that is tremendous. And, I went out because someone's got to stand up for a bank, and I made the best case I could. I withdrew my point of view in December. That's all I can say. It's all I can do. And I apologize if I created some offense to you, but I thought that the date was civil, and I just expect that civility going forward. But if we can leave that, welcome.
You'll get it.
Mark, 1 second. Just let Ram finish, and then you.
No, I'd love to just
because it's interesting. Because Mark, you know what it is. It's important to have you on the space because you're giving a different perspective that
I'd like
that not many people have given a few out.
Look,
so,
let's make the topic about Ram or Mark. Let's make the topic about what matters. How do we resolve? How do we move forward? Focus on policy. And, I agree with, I said earlier in the space today.
But Ram, yeah. he said specifically about his position, not about you. Perfect. He specifically said, let the market decide. We live in a capitalist society. There should be no bailout. So specifically about that point.
Look, first off, I agree that Silicon Valley Bank was making loans to unprofitable technology companies. It's not a sustainable business model. And the reason why Silicon Valley Bank can make that work is there's an implied quid pro quo with VC firms that are implicitly backstopping that. And that's why JP Morgan's not going to buy them. And I also agree there's a mismanagement issue around asset duration liability mismatch. They took in $40-60 billion in deposits, turned around about 10-year maturities, and obviously a failure in board oversight. That's all absolutely the case. Now, here's the question, right? Looking beyond SVB, these shareholders will get wiped out, right? And they're held accountable. That's the system working. No one's saying the shareholders should get bailed out. If anyone's saying that, I'd love for you to raise your hand and make the case. No one's saying that. I think the topic on the table now is, okay, what are the broader consequences? So there's been some reporting that First Republic's got a line around the block. First Republic's got a high loan to deposit ratio. My text messages are blowing up with VCs and porcos saying, what do I do with my deposits? Right now, this is just the Wall Street Journal and Barron's headline, Business Insider headline. It's a legitimate topic to ask, how do we safeguard public confidence in the banking system to prevent further fallout? I think that's a legitimate topic.
So, Mark, there's 2 points there. How do we keep confidence in the banking system? And the second point is this. What they want is a bailout for the people who actually deposit their funds. So if you can, your response to them both.
3 points. I have zero problem with Ram till he got on Twitter with some other people to orchestrate a short squeeze in Silvergate. The second you try to manipulate a stock and organize a short squeeze, which you did, Ram, and it's all over Twitter, that makes you public enemy number one to me. Okay? You had no basis to do that if you didn't have an opinion on the stock, but you were all over Twitter with all your homeboys trying to orchestrate a squeeze. That's when I went sideways with you. That's not cool. That's not cool.
Mark, let's leave that topic because it's not. Well, sorry, Ram.
And it.
1 second.
Go ahead.
Well, I just think that obviously it's not the topic at hand. I don't know anything about it.
I get it, but okay.
That's
Ram,
fine. If you just want to stick to the specific points,
I have no problem with you or anyone, but let's keep short sellers are piling into these stocks. Let's keep that out of it.
Look,
because there's
okay. I'll make one. Look, just to point out, and Mark, let's look. What you've seen in Silvergate, Signature Bank, is defamation of banking institutions that have accelerated the loss in public confidence in these institutions. We live in a digital banking era. Information moves faster than the speed of light. People can do withdrawals with a wire transfer by the click of a CFO. I made one tweet about Silvergate in the last 2 months. One tweet. And who's rushing to the defense of a bank? These are hard banks to understand, to penetrate the balance.
It's not.
People, look, I view it as a public duty to come to the aid of a distressed institution. I have no issues with that.
Right, guys. Mark. If we can keep it to the topic at hand, it's not that I'm trying to divert.
That's fine. All I'm saying is
no. Please don't say it, because you said that last time, and then we've had a back and forth, and I just don't think it's right talking about someone personally.
I'm not talking about them personally, but where everyone gets confused is this is not about short sellers attacking banks. Has nothing to do with it. It's these banks not behaving properly. Silvergate can't file its financials. They said their numbers can't be relied upon. They've lost all business. They launder money for worldwide financial criminals. They're under investigation by the Department of Justice and the SEC. And the FDIC told them to get out of the send business. This has nothing to do with short sellers. This has to do with Alan Lane, who runs the company, ran the company into the ground, and he should be arrested. That's a fact. And you
Mark,
guys, wait a minute.
Do you have knowledge? Do you have knowledge of AML violation that at the level of neglect? Let me ask you this: did you trade on that information?
Beg your pardon?
Did you trade on that information?
No, because you guys squeezed the living crap out of me.
Silvergate.
Huh? Right, Mark. I keep on saying it. I actually want you on the space because you're giving an alternative view and position on this, and it's going to be for an interesting debate. But you keep talking about Silvergate, which is not relevant to this. So specifically, the 2 points about SVB Bank and the issues that are pertaining to that. If you can answer that, that'd be brilliant.
Fair enough. SIVB, no one should be bailed out. Depositors will eventually get their money or a big chunk of their money, but it's going to take a long time. And it should take a long time, and everyone should learn from it. And everyone should be in banks that are credit worthy, and people should understand what risk means under risk and reward. And when you get Ackman and Larry Summers and all the talking heads out there saying these guys, depositors should be bailed out, then you could be with the shittiest bank possible. The fact that these guys were paying nothing for interest rates on their deposits was a problem. If they would have paid above market interest on deposits, everything would have been good. But
I don't think that's the case.
What about the second point? Oh, sorry, go ahead.
I beg your pardon. That's not why they went. That's not why they fell.
Of course, it's not why they fell. But if you, what was Silicon Valley Bank paying the last 3 months on their deposits versus everyone else?
On 70 billion of their deposits, yes, they're paying zero. That's not what caused the problem.
I get that. But when you pay zero on 70 billion, right, and all of a sudden something changes, it doesn't give people incentive to hang around. And it doesn't give people incentive when the VCs who've kept you up tell everyone to pull their money. That's not the short.
That was the problem.
Okay.
It was that they had 15 billion of HTM losses. They would have wiped out tier one capital. And when the VCs went on national television and said, let's everyone take our money out, $42 billion of capital left the bank in 24 hours, forced them to realize the losses. They had negative 985 million at the close of business on Friday, and the rest is history, right?
Well, then why isn't everyone dragging Peter Thiel through the mud? Why is it always blamed on?
I would love to drag Peter Thiel through the mud. You look a lot better than Peter Thiel. No one has anything against you, man.
But
we started this space talking about Peter Thiel and him going on national television. I mean, when Indy Bank failed, right? IndyMac, it took 13 days. They were taking out $100 million a day. This dude gets on TV and literally causes this bank to fall overnight. I'm not saying it's a good bank, but people could have had time to plan.
Well, I mean, it's kind of okay. Then people should go and tar and feather Peter Thiel if they want. But this whole narrative that it's the short seller shorting the hell out of regional banks is just wrong. It's just uneducated and very wrong. And I take offense to it because it's not the case.
What's your answer to the second point?
Excuse me.
Sorry, Mark. What's your answer to the second point? Because I'll get people to respond to what you said. At the second point, which is the main concern what people have here, that by not bailing them out, this could cause an effect, cause a cascading effect on other banks, and then we'd have other banks in the same situation, and it'd be.
I think the lesson from this is going to be, or should be at some point in time, that you shouldn't have uninsured deposits at non-too-big-to-fail banks. And non-too-big-to-fail banks shouldn't be making risky, illiquid loans to places that aren't seaworthy. And I've said it, and I've said it a million times. Jamie Dimon is the best banker going, and he would sell his mother for a nickel if he could make money.
Now let's talk about that though, right? Let's say the 5 biggest banks.
Let me just finish. If he's not in a business, you probably shouldn't be in the business. If he's not lending to crypto, you probably shouldn't be in that business. If he's not doing what Silicon Valley Bank does, you probably shouldn't be in the business. Now, maybe tomorrow night he'll buy Silicon Valley Bank for $1.30 a share, and he'll say all the deposits are good. Silicon Valley Bank is now a division of JP Morgan. Maybe that's the solution. That's probably going to be the solution, something that looks like that, and depositors could bring a sigh of relief. But the whole point, and my point is, you should not bail out or reward reckless activity. And what's not being said here is that Silicon Valley Bank was a reckless bank that should never have sold at $700 a share, never should have been in the S&P. They should lynch the people who sold stock on the inside. And Peter Thiel, who is a big customer of these guys, right? He should be, questioned on exactly what he knew, when he knew, and who he told to get out before everyone else. That should be the issue.
Can I ask a question, Mark? Do you consider First Republic Bank a reckless bank?
I don't know First Republic Bank. I don't know the first thing about it.
Okay,
I have nothing. I have nothing to do with it.
Why would $70 billion sit in a bank with no return?
Well, that's a wonderful question, and it's probably because of the way Silicon Valley expressed or tried to do business with people, and it will do business with you if you keep your deposits here. And they never offered fair market rates on their deposits.
What does JP Morgan pay on their deposits? For anyone in the audience that has a Chase account, they pay absolutely nothing. No, they don't. They don't pay that on their checking accounts. They don't pay that on their savings accounts.
$70 billion.
They don't pay that on their. They don't pay that on their They don't pay that on their savings accounts.
Okay, you didn't get that $70 billion on $250,000 deposits.
Yeah, exactly right.
Exactly. I can get 3.5. I can get 3.5 there.
I can get 470 at Morgan Stanley.
Yeah, there you go.
I can get 5 at IB. I can get 370 at a Wells Fargo savings account. No one gets anything on checking. I mean, that's been the way from go. But the guys who bank with Silicon Valley, part of the quid pro quo is we'll do this for you, we'll do that for you, we'll do payroll for you, we'll do all these things, but we're not going to pay you on your deposits. So that's not exactly what I would call sticky money. In terms of First Republic, I don't know First Republic. I know that Signature Bank runs a scam in Signet. I know Sen is finished. I know Silvergate is finished. And I wasn't involved in Silicon Valley Bank. But, it's kind of like a plane falling out of the sky. I think the management was beyond inept, and the way they handled everything was inept. But this is not a 2008 kind of deal. And it's never going to be a 2008 kind of deal. Banks are healthy in general. And if some guys are mismatched on their assets and liabilities, they're going to have a big problem. And maybe the Fed or the FDIC forces these guys to raise money. But if you have a good business model and you're a good banker, you should be just fine. If you have a bad business model and you're a bad banker, you're probably going to suffer. And it's okay to go out of business, because the public then should understand that you don't get a whole lot of reward for taking no risk. Risk and reward need to be balanced. And it hasn't been balanced since rates have been low. That's just a fact of the matter. And a lot of you are probably young enough to not even remember when rates were high, or you don't remember the Russian debt crisis or various things. But inflation's a problem. And that's why rates are higher. But this is going to serve as a tightening. This is going to serve as money is no longer going to be easy to get. And that's a good thing. And if you're able to borrow money at the going rate and you have a substantial or sustained business model, you'll do fine. But the days of funding all these companies that have the 93rd taxi app or food delivery app or all these losers, these days are over. And that's a good thing if you're constructive on the world. That's a good thing. That money is tighter. That money is going to go to good things, not bad things. And these zombie companies and zombie banks, zombie hedge funds, all these crypto scams, they should go out of business. They should go out of business.
Okay, so Grant, Vinny, Special Aram, what's your retort to him in terms of, he's made a number of points, some of which is that in a capitalist society, you shouldn't be